Okay, students, let's begin with our first chapter in our CMA Inter Financial Accounting paper. Let's go through this. It is your accounting fundamentals. Okay, a lot of weightage in this chapter. They ask a lot of marks, 7 marks, 14 marks, most of the times in every attempt. We'll see all the examination questions once we have discussed the concept. Okay, first, when we'll discuss some important key concepts that we always need to know when we are doing accounting. First thing is entity concept. What is entity concept? For example, you can see here, there is a company called as Shalini & Co. Shalini & Co is the business name, and there is Shalini over here. You feel, oh sir, Shalini only has invested money, so it is same. Both are same. Yes, 100%. It is same but different. Clear? That is the meaning of entity concept. That is business and business person are two different entities, two distinct entities. Okay, because of this concept itself, we have the concept of drawings coming into picture, capital coming into picture. That means even if owner puts money into the business will consider that money as liability. On the liability side, they will show it. And for owner, whenever owner takes money, for business it is an asset because owner is supposed to give the money back. This concept is called as entity concept. Clear? Next concept which we always follow is accrual concept. Okay, accrual concept is what basically, see, we have Shalini over here and we have Krishi over here. Shalini has to give 2 lakhs. Let's say 2 lakhs payment is supposed to be done. March. Okay, 1 rupee was also not paid. Shalini was supposed to pay 2 lakhs, but not even a single rupee is paid. Are we going to show it in books or not? Okay, if we show the entries only when it is paid and received, that is called as cash concept. We don't follow cash concept. We follow what? Accrual concept. In accrual concept, what we do? Okay, in accrual concept, we have to understand this. Transactions are recorded as and when they take place. When the transaction takes place, they are going to record the transaction. Unless they tell in the question in some exceptional cases that cash concept is followed. Otherwise, it's always going to be accrual concept. Clear? So 2 lakhs, even if it is not paid, if it is payable or receivable, also we are going to record the transaction even if 1 rupee is also not paid. So because of accrual concept only, we always have credit sale entry. Money did not come, but still we pass the entry. Credit purchase entry. Money we did not pay, but still we pass the entry. Outstanding expense entry. We did not pay at all, but still we show the entry. Clear? This is the concept of accrual. Next, we have something called as periodicity concept. Periodicity concept. That means what? Everything of a period should be recorded in that period. Simple. Okay. All transactions of a period must be recorded in that period only. All transactions of this year should be recorded in this year only. That means again, I have electricity bill supposed to be paid in March. March month electricity bill I have not paid. Okay. That means what? Even if I have not paid, I should show it as electricity expense of this year only. Even if I'm going to pay the bill next year. Imagine I'm staying in one building. I have not paid the rent at all. I'm going to pay the rent only next year. Still, it is this year's rent. Therefore, it has to be recorded in this year itself. Clear? This is your periodicity concept. Next, we have money measurement concept. What do we have? Money measurement concept. Simple again, whatever we can measure in terms of money, we are going to record it. What we can't measure in terms of money, we are not going to record it. Clear? Record transactions that are measurable in terms of money. Now, we have Abdul over here. Okay, he has appointed Santosh and he has to pay him 5,000 rupees per month salary. Can we measure it in terms of money? Yes. And we have appointed one more person called Akash. Akash is not going to be paid any salary at all. Abdul told, Akash, you work for me. I will not give you any salary. End of the day, I will go and give you a nice head massage. Okay, nice head massage I'll give you. That only is your salary. Go home. Clear? Is it measurable in terms of money? No. Therefore, only things that are measurable in terms of money are going to be recorded. Clear? Yes. Next concept is going concern concept. Going concern concept. What does it mean? That means we have no plan. Okay. Imagine there is no indication or intention to shut the business. There is no indication that business will close, or there is no intention also to shut the business. Imagine Shalini starts one chocolate business. We'll discuss what is this indication and intention. Okay. Shalini started chocolate business. Okay. She started selling this chocolate. Nobody is buying. Once they take it, they are not going to come back and buy the chocolate again. Very bad response for the chocolate. She fed that chocolate to one dog. Dog also is not eating that chocolate. Clear? So in that case, what happens? Going concern concept, there is an indication that business is going to be shut. Nobody is going to buy. Obviously, you have to shut the business. Chocolate business is going superb. It is going superb. But she is tired of the business. So what she will do? She wants to shut the business. That means there is intention. So if you have no indication or intention that business will close, such concept, that concept is called as going concern concept. That means business is going to continue even in the next year. Clear? Next, we go into matching concept. What is matching concept, guys? See, Shalini is there over here. Okay, she is wearing blue color glasses. So she decided that she'll wear blue color chappal also. Okay, this is called as matching concept, but we are not matching chappal and glasses over here. Income and expenses should be matched. That means if you're showing income in this particular year, expense which is related to earn that income, whatever expense we have incurred, that also should be recorded in this year itself. Clear? If income is recorded in a period, expense related to that income must be recorded in that period only. If income is recorded in a particular period, whatever expense is there which is related to that income, okay, which was incurred to earn that income, should be recorded in that period. So matching means what? Income, expense, both should be recorded in the same year. Clear? This should be the concept of matching. This is called as matching concept. Next, dual aspect concept. What is dual aspect concept? This we call as double entry system of accounting. That means for every debit, there must always be an equivalent credit. So whenever we are passing journal entry, for one debit, there should be one credit. If for a debit, there is no credit, that time there is a problem. If for a debit, there is no credit, that time there is a problem, and that problem we solve when we are doing rectification of errors. Clear? So for every debit, there should be a credit. We follow double entry system of accounting. Realization concept. Realization concept. Let's say Akash is having one bakery over here. He has made one credit sale to Kartika. To Kartika, he has made one credit sale. So here what we are telling, any income must be recorded to the extent it is going to be realized. When he made the sale only, Kartika took the goods and went, and immediately next minute only Akash's number was blocked. So now Akash has doubt that he's not going to get the money itself. So in such case, we should not record the income because we don't have guarantee that we are going to get the income. I mean, not guarantee, but we don't have any little certainty. We don't have certainty that we are going to receive the income. So if any income must be recorded to the it should be recorded only to the extent it is going to be realized. If we are going to make a sale, we know we are going to get the money, then we are going to record the income. Okay, cost concept. Cost concept. All assets must be recorded at cost when they are purchased. Whenever you purchase an asset, it should be recorded at cost only. Imagine I purchase one, let's say, okay, Abdul is there and Pinky is there. One building is purchased. Abdul purchased one building. Building value in the market is actually 1 crore, but Abdul paid only 1 rupee. Now Abdul will show the building at 1 crore or 1 rupee. Abdul will show it at 1 rupee itself. Abdul will show it at 1 rupee itself. Why 1 rupee? Because this is the amount that was paid to Pinky. So this is called as cost concept. So everything has to be recorded at cost. Okay. Now conventions. There are some conventions which we have to study. First one is conservatism. This is also called as prudence. Conservatism, or it is also called as prudence. Now let's try to understand with one example. We have Sriram over here. Sriram today evening when he was going home, when he was going home after class, what he did, he went straight to one, on the road he found one astrologer. Astrologer had one parrot, and that parrot had some small chits. Okay, small chits were there. Okay, Sriram told, let me try my luck. 10 rupees he paid that astrologer. Parrot picked one, chit, and in that it was told that Sriram will win a lottery of 20 lakhs. 20 lakh lottery. So what did Sriram do? Sriram went to his uncle. He told, 1 month later I will win the lottery. He took one lottery ticket also from Kerala. Okay, he told he'll win the lottery after 1 month. So he borrowed loan of 20 lakh and went to Goa. Now don't ask me what they're going to do in Goa. Okay, what Sriram is going to do in Goa, that is left to him only. We are not going to discuss that. Okay, so this 20 lakh is spent in 20 days in Goa. Okay, after that when the lottery ticket result came, not even a single number was matching. So now what happens? Sriram is in trouble. What did Sriram do? Future income, possible income, he recorded it today only and he spent it. He thought income will be there and he spent it. So therefore, concept of conservatism comes into picture. What they're telling, all expected loss should be recorded, but not the expected profit. That means if at all this parrot would tell that 1 month later you will have one loss of 1 lakh, okay, Sriram will record. How? By creating a provision, taking money aside and keeping it over there. Taking money and keeping it aside, he would have created a provision. When he creates this provision, what will happen? He is prepared for the future loss. In case there is a loss in the future, that time what is going to happen? Even if there is a loss, he has kept that money ready, so he is in a good position. That's why they said record the expected losses, but do not record the expected profit. See, this expected profit, when Sriram took money and went to go and spent it, that profit did not come only. So now he's in trouble. Okay, therefore, this is the concept of conservatism. Clear? Consistency. This is like you guys studying. Today you studied, tomorrow you did not study, after that you studied, after that you did not study. That is not allowed, guys. Okay, if you want to clear these exams, you have to follow consistency. So same way, all rules and concepts followed must be applied consistently over a period of time. Whatever rules are there, whatever you are following, it should be followed consistently over a period of time. This is the concept of consistency. That means if you are following, for example, WDV. Sir, first 3 months I'll follow WDV, sir. After that, I'm going to follow straight line method, sir. No, not possible. Consistently, you have to apply the same rule so that comparison can happen from previous period to this period. Clear? Full disclosure. Full disclosure. Oh, this thing is nice. It is showing profit. I want to show it. But this is going to show a loss that I don't want to show in books of accounts. Can we do that? No. All information required for the reader must be disclosed. That means reader needs to know about income also. Reader needs to know about expense also. Therefore, whatever income is there, whatever information is there which is required for the reader, it must be disclosed. Clear? Next, we go into the next concept, is materiality. What is materiality? Sir, I know so many things, sir. I will go and tell everything to the reader. Is it required? No. Disclose only that information to the reader that is needed for the reader. For example, we have an employee. Okay. This employee is always coming late. We are like, okay, coming late, no problem. Let's leave it. Okay. Is it going to bother the reader of the financial statement? No. But when this employee is coming late, if we charge one fine of 1,000 rupees, that time there is some money involved in this transaction. This is going to bother the reader. So that will be told. So this is the concept of materiality. Clear? Only information which is required for the reader or important for the reader, go ahead and disclose it. Okay. Now, next concept that we are going to discuss is capital and revenue expenditure or receipts. Capital expenditure, revenue expenditure, okay, or receipts. Now, usually capital means what? The thing that impacts the balance sheet. If I purchase an asset, it goes straight into balance sheet because it's a capital expenditure. Revenue means what? Trading account and P&L account item. Okay, so usually revenue means trading and P&L item. Capital means it is a balance sheet impacting item. Okay, now revenue is usually short term and recurring. I'm paying electricity bill. It's a short term thing. Today I paid the bill because I used the electricity for 1 month. Next month, if I don't pay bill, they'll cut the connection. Correct? It's a short term thing and it's a recurring thing. It keeps happening. Capital means what? Long term. I purchase one machinery. I'm going to use it for 5 years. I'm not going to keep purchasing machinery every month. Okay. Non-recurring. It does not happen frequently and it gives you extra benefit. What is this extra benefit? By purchasing one machinery. Let's say you're purchasing one machinery. This is your plant and machinery. When you have a machinery, when you purchase this machinery, your income increases. That means you're going to get extra benefit by purchasing assets. Clear? So capital expenditures usually give you extra benefit over a period of time. Revenue expenditures give you benefit only in this particular period. Okay, we'll take some examples. Building purchased by computer dealer. Building purchased by whom? Computer dealer. What is his business? Computer. Now purchasing building is not his business. Building he has purchased so that he can use it for his business over a long period of time. It becomes a capital expenditure. It becomes a capital expenditure. Building taken on rent. You have to pay rent every month, recurring. You will not pay rent once and get benefit for 5 years. Revenue expenditure. It becomes a revenue expenditure. Clear? Building purchased by real estate dealer. Building is purchased by real estate dealer. So now real estate dealer means his business only is purchasing and selling building. So now what happens? It is a revenue expenditure. For him, it is a recurring thing. He purchases building this month, next month, this month, next month. He keeps purchasing building. It is a revenue expenditure. Clear? Computer purchased by computer dealer. Computer purchased by computer dealer. Business only is purchasing computer and selling computer. Okay, it is going to be a revenue expenditure. But the same computer, if it is purchased by real estate dealer, if it is purchased by real estate dealer, what will happen? It is a capital expenditure. It is a capital expenditure. Clear? Can you see what happened over here? Things that are directly related to your business, it becomes revenue. If your computer dealer purchasing computer, revenue. If your computer dealer purchasing building, capital. If your real estate person purchasing building, revenue. If your real estate person purchasing computer, it becomes a capital expenditure. Is this clear? Now, repairs to building or machinery. Now, when you are doing repair, now understand this. There is this machine over here. This is the wire of the machine. Nothing. Don't think what is this, sir? Full round. Okay, this is the wire of the machine. So this is the switch of the machine. So we have a machine over here which is giving you a benefit of 5 units per hour. 5 units per hour is the benefit. Now when it's giving you benefit of 5 units per hour, I am doing some repair. Okay, no extra benefit. That means after the repair also it is going to give me benefit of 5 units per hour only. So that means it does not give me any extra benefit, no extra benefit. It will be considered as revenue. But after the repair, it is going to give me 6 units per hour. Is it giving me extra benefit? Then it is going to be considered as capital. It is going to be considered as capital. It is going to give me extra benefit. It will be considered as capital expenditure. So did you understand? Whenever you have a repair, you have to understand when you are doing repair to building or machinery. That means when you are doing repair to an asset. For an asset, when you are doing repair, if it is giving you extra benefit, capital expenditure. If it is giving you no extra benefit, revenue expenditure. You are like, okay, sir, I had one car. This car was giving mileage of 15 kilometers per hour. 15 kilometers per hour is the mileage. Tire got spoiled. So I replaced the tire. When the tire was not there, I could not use the car at all. That means it was giving me 0 kilometers per hour because I was not using the car. But if I use the car, I could have gotten 15 kilometers per hour. Now, if I replace the tire, I am not going to get some extra mileage or something small. Minute it might be there, but majorly nothing I'm going to get any extra benefit. So in this case, what happens after replacing the tire also, you are going to get 15 kilometers per hour only. Even if you replace the tire, you will get 15 kilometers per hour only. So in this case, what happens? You're not getting any extra benefit. You're going to consider it as revenue expenditure. But imagine you have a car. Okay, this was a petrol car. You removed the petrol engine and now you have added the diesel engine. So what happens automatically? This is not going to be, when you are putting the diesel engine, it's going to give you extra benefit. It will become a capital expenditure. Did you understand how the repair works? Repair gives you extra benefit, capital expenditure, otherwise it is revenue expenditure. Next, plant and machinery purchased. If you purchase on machinery, it's always long term, it's non-recurring, capital expenditure. Installation charges of plant and machinery. Installation charges of plant and machinery. What happens over here, guys? This also becomes capital. It's like a chain reaction. This one was capital. In this chain, one more thing came. This is also capital. In this chain, one more thing came. This is also capital. In this chain, one more thing came. This is also capital. So chain reaction. As a chain reaction, you get multiple things. It's always going to be capital expenditure. Now, for example, see over here. Abdul is there. Chennai. Okay, to the port. He's in the port over here. Okay, one machinery, ordered machinery from Russia. What machinery and all? You don't go to ask me from Russia. Okay, he ordered one machinery from Russia. Now, because he ordered machinery, he has to pay for the freight. Because he ordered the machinery, he has to pay duty to the government. Because he ordered machinery, he might have to pay carriage or he might have to pay loading and unloading and all. Everything is a chain reaction. So whatever came because he ordered the machinery, everything will be considered as capital expenditure. So if you have one capital expenditure, along with that, if you have multiple capital expenditures, everything will be considered as capital expenditure. Is it clear, guys? Yes. 9. Construction of building. if you construct a building? What is it going to be? Capital expenditure. But because you decided to construct the building, the old land was not proper, preparing the site for construction. Can you see chain reaction? Capital expenditure. Demolition of old building. Can you see chain reaction? Capital expenditure. Temporary huts for workers. Can you see chain reaction? Capital expenditure. Temporary huts demolished after construction is over. Will you keep that hut? Not required. Demolished. That is also a chain reaction. Everything is capital expenditure. That means once you decide to construct one asset, after that as a chain reaction, whatever comes, everything is going to be considered as capital expenditure. Everything is going to be considered as capital expenditure. Is this clear? Yes. Now, inauguration of new factory building. Factory building is ready, no? To construct the building, whatever chain reaction was there, everything is capital expenditure, but factory is already ready. After that, if any expense is there, it is not going to be considered as capital expenditure. It is going to be revenue expenditure. So building is ready. Inauguration is just like a marketing or advertisement expense. It will be considered as revenue expenditure. But if the building, usually when advertisement and all, it's huge, you can make it into deferred revenue. That means revenue only, but I want to show it over 3-4 years. So I'll consider it as deferred revenue. Now, we'll go into the cycle. Okay, accounting process. We always start with journal. Okay, sir, journal I don't want, sir. I don't like journal at all. Too many times I have to pass the same journal entry. You can have an alternative, which is called as subsidiary books. So after journal and subsidiary books, what is the next stage, guys? Next stage, everything is posted. Everything is posted into something called as a ledger. From ledger, we transfer everything to trial balance. In trial balance, we have something called as unadjusted trial balance. That means all adjustments are outside. Once you do the adjustments, then the trial balance will change. You pass the adjustment entries, trial balance will change. Once the trial balance is adjusted, then we prepare trading P&L account and also balance sheet. This is called as final accounts. And this is the entire journey. Okay, you can call this as accounting process. This is your accounting process. Clear? Okay. Now, journal and ledger, we'll try to understand. What is a journal? Alternative for journal, we know it is subsidiary books. Okay, if you have too many journal entries and all, you can have a subsidiary book. Otherwise, journal is called as primary book. It's called as primary book, and ledger is called as secondary book. Okay, so all transactions are recorded in journal. Okay, and it is recorded in chronological order. What is chronological order? It is recorded date-wise. But in ledger, what we do, we don't record everything. We are posting everything. That means posting means what? Transferring the debit and credit items from the journal to the ledger. Whatever debit is there, put it to the correct ledger. Credit is there, put it to the correct ledger. Clear? Ledger is always in analytical order, based on analysis. Whatever is related to a particular thing will be all in one particular ledger only, and everything related to another thing will be in another ledger. Okay, so here we are going to record everything based on particular order, that is analysis. Here it is based on date, chronological. Clear? We'll go into journal. Now, whenever we have journal, okay, when we are talking about journal, we have two methods to pass a journal entry: traditional approach and modern approach. Whichever method you have been following till now, you please continue to follow that only, because right now don't go to switch when we have few days left for our exams. Okay, you're comfortable with a particular method, you continue with that method itself. Okay, traditional approach. Traditional approach, we have three things: real account, personal account, nominal account. Real account, personal account, and nominal account. Real account means what? All non-current assets. All non-current assets are going to be considered in real account. Basically, your fixed assets and all real account. Okay. Cash, also real account. Even though cash is a non-current asset, it's a current asset, but still it will be considered as real account itself. So all non-current assets plus cash. Personal account. Personal account means what? Natural persons. That means human beings. Okay. Artificial persons. That means companies, business. Representative person. That means owner's money, capital, drawings. All this will be considered as personal account. And then the third thing we have is nominal account. Nominal account, what we do? We have expenses, losses, incomes, gain. Nominal account, we have expenses, losses, income, and gain. Now here we have to understand one thing. Real account, personal account, nominal account, we have to understand one thing. Real account rule is debit what comes in, credit what goes out. Debit whatever comes in, credit what goes out. Personal account rule is debit the receiver, credit the giver. Okay, and nominal account rule is debit all expenses and losses, credit all incomes and gains. Clear? Okay. Now we go into next thing, that is modern approach, which is more simpler and easy. Here everything is classified into asset, liability, expense, income, capital. Capital is called as equity. Simple rule, guys. Asset increases, debit. Asset decreases, credit. Liability increases. Obviously, liability is opposite of asset, no? So, liability increases, credit. Liability decreases, debit. And expenses. Expense increases, debit. Expense decreases, credit. Incomes increases, credit, and income decreases, debit. Capital is just like liability, so increases credit, decreases, you're going to debit. This is the modern approach. Clear? Now whenever we discuss further, always these four things will always trouble us. We have to understand this. First thing what we are going to discuss over here is outstanding expense. Outstanding expense means what? Sir, I was using one building, sir. I did not pay the rent at all, sir. Very good for you, sir. Very bad for that fellow. Okay. Now, outstanding expense means what? Liability. Liability. Why liability? Liability because you have the responsibility to pay. Whenever you have a responsibility or you have an obligation, okay, to do anything, that time it automatically becomes liability. So here I did not pay the expense, but I'm supposed to pay the expense. I have an obligation. Okay, this will be considered as liability. For liability, what entry you are going to pass? Expense account debited. Expense account debited to outstanding expenses account. Expense account debited to outstanding expenses account. Is this clear? Now, next we go into something called as prepaid expense. Prepaid expense. Prepaid expense is going to be an asset. Prepaid expense is going to be an asset. Now here prepaid expense, what is the rule? Prepaid expense account debited to expense account. Sir, I didn't understand anything, sir. Okay, sir, listen. Here, outstanding expense. You did not pay the expense, but according to accrual concept, you are supposed to take it as expense this year. If you don't pay also, expense increases, expense should be debited. But did you pay it? No. So you can't write to cash. If you pay, you can write to cash, but you did not pay. So it will be credited to outstanding expense. Liability will always be credited. Okay. Prepaid expense. That means you did not, you paid more. Next year's expense also you paid. No tension at all next year. Aram se you can sit over there. So prepaid expense account debited. Prepaid expense account debited because it is an asset. And then expenses next year's. So you have to remove the expense from here and you have to put it into next year. So expense decreases this year, expense account credited. Clear, guys? Okay. Next, income. Income accrued. That means what? I did everything. I am supposed to get the money. That fellow has not given the money at all. Income accrued. Income accrued is an asset. Income accrued is an asset. Okay. Income accrued is asset. That means you receivable. Whenever it is receivable, it is asset. Receivable account debited to income account. Sir, you did not receive. No, sir. Why you are showing it as income? Accrual concept. Even if we have not received it, we are going to show it as income of this particular year. Now, income received in advance. Next year's income, we already received it. Next year's income, periodicity concept, we have to put it to next year. So what we are going to do, remove it from income. Income, when you remove, income reduces, income account debited. And next year's income, if you get this year, for you it is not a good thing. It's a liability because next year you have to go and do the work there. Income received in advance is credited because it is a liability. Is this clear, guys, still here? Yes. Next, we'll go into the concept of cash book. We'll go into the concept of cash book. Now, what is cash book? Something that records cash. Okay, records all cash and bank transactions. It records all cash and bank transactions. Okay. Now, if you have a cash book, you don't have to prepare trial balance again. If you have cash book, no, again you don't have to prepare trial balance. Directly the balance of cash and bank will go to trial balance. What am I telling? If you have cash book, you don't have to prepare ledger, no cash ledger and bank ledger. Directly the balance will go to trial balance. Yeah. Okay. Trial balance you have to prepare. Ledger you don't have to prepare because already cash book will be in the format of a ledger itself. Again, you don't have to prepare ledger. What is the point? Okay, cash book when you prepare, no cash ledger, no bank ledger, straight away the balance will go to trial balance. Three types of cash book we have: single column cash book, double column cash book, and triple column cash book. Okay, single column cash book means what? Sir, simple sir, only one column is there, sir. One column is there, sir. What is that one column, sir? Cash column or bank column? Okay, single column cash book means we have only one column. Yes, 100% correct. But what is that one column? It is a cash column or it is a bank column. If I am doing all cash transaction only, I don't have bank account also, then I will maintain cash column. I am doing everything through bank itself, then I will have the bank column. Clear? Simple? Done? Yeah. Double column cash book. Double column cash book means what? We have two columns. We have two columns. What are those two columns? Either it is cash and bank. Okay. Otherwise, it can be cash and discount, or it can be bank and discount. Okay. Either you have cash and bank column, or you have cash and discount column, or you have bank and discount column. Is this clear? Triple column cash book. Triple column cash book means what? Everything is there. Cash, bank, discount. All the three are there. Now, when we are talking about discount. Okay, very important to understand discount concept before we go further. Discount has two types of discount. One is called as trade discount. Other one is called as cash discount. Trade discount means what? See, simple. Today you went, okay, you were going home on the road. You found that one person is selling one amazing pen, tick pen. One tick pen is selling. If you do tick once, it becomes black. Tick again, it becomes red. Tick again, it becomes blue. Oh, you're like, wow, what an amazing pen. You ask that guy, how much, sir, for this pen? He said, 100 rupees. You're Indian, no? What you will do? You will not buy it at 100. Immediately, you will start bargaining. Directly, bargain is not, when he's telling 100 rupees, you are not asking for 90. You are directly hitting his ego itself. You are like 20 rupees. Will you give it to me for 20? Then that fellow will be like, no, nothing below 80. You told no, 70. You have to give it to me for 70 rupees. Then he said, no, sir, it's not possible. 70, it's not possible. So you used the proper Indian bargaining technique. You started walking. When you started walking, that person, when you're walking and you're keeping one ear like this, and you're like, okay, he will call. And then that fellow is like, sorry, that fellow is like, sir, come, it's okay, take. I'll give it to you at 70. Now, 100 rupees was the actual value. He is giving it to you for 70. Now tell me one thing. In your books, you will show it at 70 or you will show it at 100. You will show it at 100 only. When you go to a mall, one nice board will be there, 5,000. They will cut it and they will write now at 999. So now, will you record the transaction at 5,000? No, you are going to pay only 999. So you will record at 999. When you finish that, 70 rupees, you saw that you forgot your wallet and your phone at home that day. So you told him, sir, one thing, sir, I don't have money. I will come tomorrow. 100% I'll come and give you 70 rupees. That fellow, for some strange reason, he has agreed. And he told, okay, go. Come tomorrow, sharp. Whatever time you have come today, same time you should come and you have to give me the money. You said, okay, sir, I'll give. Now you went home. You purchased the pen. You will record the transaction at 70. And he went home. He will record the transaction at 70. For you, it is credit purchase. For him, it is credit sale. Clear? So trade discount is discount at the time of buying or selling, no entry. Can you see that 30 rupees you just ignored? Directly you pass the entry for 70. You did not record the entry at 100, then reduce it to 70. Directly you are going to record it at 70 itself. So trade discount is always ignored. Remove the trade discount, net amount only you are going to pass the entry. Okay. Now, next day when you went to make the payment, he was very much impressed by your honesty. He told, oh, you came back. Okay, fine. I'll give you 10 more rupees discount. 10 more rupees discount I'll give you. This is called as cash discount. Discount at the time of payment or receipt. Now, can you see cash discount? You cannot do anything. You have to record it. Why? Yesterday you have already recorded the transaction at 70. Now you cannot go and erase it and make it 60. So 70 you have recorded, but you're going to pay only 60. For you it is going to be discount. Clear? Discount. So you have to record cash discount. Now, cash discount has two types. One is called as discount allowed. Another one is discount received. Simple. Understand this. Money is coming in. Okay. That means you can give discount. You can be the person who is giving discount. That means discount when receiving money is called as discount allowed. Okay, discount received means what? Money is going out. That fellow told pay little less. So for you, it is discount when paying money. This is discount received. Is this clear? So when money is coming in, you are giving discount, that is discount allowed. When money is going out, you are getting discount, that is discount received. Clear? Discount allowed is always, when you give discount, it's bad for you, it's an expense. And when you're getting discount, it's always good for you, it's an income. So if discount is an expense, what will you do? Expenses have to be debited. So discount allowed account debited to debtor account. Discount allowed account debited to debtor account. Is this clear? Okay. Why debtor, sir? Who is going to give you money? Debtor. So debtor balance will reduce. Okay, if you give him discount, imagine somebody has to give you 10 rupees and you told don't pay. That means debtor went down, but that don't pay is an expense for you. Expense is debited. Okay, discount received. From whom can you get the discount? From the creditor. You have to make payment to your creditor and you're going to get a discount. So creditor account debited to discount received. Creditor account debited to discount received. Is this clear? Okay. Now, single column cash book. Look at it. Can you see it's looking just like the ledger only? But instead of particulars, we are going to write receipts. On the debit side, you have receipt. Okay. And on the credit side, you have payment. It can be, this amount column can be cash or it can be bank. One of them. 2-column cash book. Okay. Again, date, receipts. Here it is cash and bank. It could also have been cash and discount, bank and discount, anything. And payment side, you have again cash and bank. 3-column cash book, triple column cash book. You have discount, cash, bank. All three are there. Discount, cash and bank. Everything is there. This is a 3-column cash book. Clear? Now note. Okay. Check received and deposited. Check received and deposited. Now understand this. Bank account debited to debtor account. Usually when you receive a check and deposit, this can be a troublesome thing in 3-column cash book. When we have 3-column cash book, this can be a point which can trouble you. So we'll discuss this point. Okay. Check received. You received the check? No. Okay. Very good. You received the check and you deposited on the same day. So directly you're going to pass the entry bank account debited to debtor. Bank account debited to debtor. Check received on one day, but you deposited on some other day. You got the check today evening, bank was already closed, so you kept it in your cupboard and you're going to deposit on some other day. So now what happens over here? You received the check, but you have not deposited. So you'll create one temporary account, check in hand account debited. Check in hand account debited to debtor account. Check in hand account debited to debtor account. Deposited. When you deposit, what will you do? Check in hand went. And where did it go? It went into bank. Bank account debited to check in hand. Is this clear, guys? Yeah. Let's go further. Next thing is petty cash book. Okay, petty cash book. Let's say there is one company called as Karthik Limited. One company is there, Karthik Limited, and Karthik Limited has lot of transactions, cash transactions, bank transaction, everything is there. To look after all these transactions, he has hired one ultimate person called as Bambani. Bambani is the person who he has hired as a cashier. Now Bambani has too much work on his head. Somebody is coming and asking 10 rupees to drink one chai. Bambani has to give. Somebody is asking 5,000 rupees to purchase goods. Bambani has to give. So it becomes big headache. So what Bambani has done, he has hired one assistant for all small cash transactions. He is going to hire one person called as Jeenal. Jeenal is called as petty cashier, and Bambani is going to give 5,000 rupees to Jeenal. And Bambani is telling, see Jeenal, do one thing, whatever expenses are there below 5,000, you pay it. Don't send that person to me itself. Clear? So now petty cash book, what happens? Petty expenses and pet are paid by petty cashier. Petty expenses, small expenses are paid by petty cashier. Big expenses are still paid by Bambani only. When money comes in, it is still handled by Bambani only. Small expenses only are paid by petty cashier. Clear? Now you have petty cash. You have normal as well as impressed. What is normal? Imagine I am the person, okay, giving you money. I gave you 100 rupees. You spent only 20 rupees. Next week again, I'll give you 100 rupees. Next week you spend 50 rupees. Still I'll give you 100 rupees. That means every week I'm giving you the same amount of money irrespective of whatever you spend. Every time period, same amount is given irrespective of amount spent. Clear? Impressed. Impressed means what? I gave you 100 rupees. You spent 80 rupees. Okay, I'll give you 80 again. Your balance is again 100. You did not spend anything, I will not give you anything. You spend 20, I will give you 20 again. So amount spent by petty cashier is reimbursed by cashier. So in petty cash, in Impress system, what happens? Always we are going to give the petty cashier only what he is going to spend. Clear? Now petty cash book, this is the format. You will have a receipt column over here. You have a date column, then particulars, voucher number, LF, rupees. So what you are going to do? This is the fixed format. After that, you have one thing called as carriage, one more column, carriage. One thing called as stationery, one more column, stationery. Then you have something else. Again, you keep on adding. Things which are going to repeat, again and again, make a column for those things. If things are unique, it happens only once. Don't make a column for that. Put it under a column called as miscellaneous expense. Clear? This is petty cash. If it comes in the exam, you should be very happy. Simple concept. Clear? Now, the next concept is called as BRS. Bank reconciliation statement. Very, very important concept. Okay, very, very important concept. So next we are going to go into BRS, bank reconciliation statement. Now what is this, sir? Is it a ledger, sir? Is it a ledger? No. Is it a journal? No. It is just a statement. Statement showing what? Difference between cash book and passbook. Now cash book, sir, what's a full cash book? Even discount column and all we have to bother. No. Cash book, bank column, and the passbook. What is cash book? Cash book, bank column means what? Records maintained in books of accounts about our bank. Whatever transactions we are doing in the bank, we are going to maintain in books of accounts. This is an asset. This is an asset. Okay. What is passbook? Maintained by bank. Records maintained by bank. Okay, our own transactions, but for bank, no, we are a liability. We have money in the bank, so for us it is asset, but bank has to give the money to us whenever we go and ask. So for bank, we are a liability. Clear? Now, in books, in cash book, basically, okay, if you tell normal balance is called as favorable balance. Okay, it is debit balance. Passbook, normal balance, it is credit balance. If at all, just now, if someone sends you money on Google Pay, you will get one message. You'll be like 100 rupees credited to your account. That means there it is credit balance. In your books, it is debit balance because for you, bank is an asset. Assets have debit balance. For bank, you're a customer. So banks, you're a liability. Liabilities have credit balance. Okay. In books, if it is OD balance means what? You have taken more money than what was there in your account. So for in OD balance, that means it is a liability. If it's a liability, credit balance. If it's a liability, credit balance, that means what? It's a liability for you. Now, if you have taken money from bank, for you it is bad, but for bank it is an asset. Therefore, bank it will be debit balance. Clear? Okay. Now, movement of balance. You have to understand the movement of balance so that we are in a better position to prepare the BRS. Clear? If money comes in and you have normal balance, I have 100 rupees normal balance and money comes in, what will happen to the balance? Balance will increase. If money goes out, you make payment, balance will decrease. Simple logic. Okay. OD means what? OD. That means you have already taken more money than what is there in your account. Clear? Already you have to pay somebody 500 rupees and you take again money and pay someone. Okay, that time what happens? Already you had to pay bank 500 rupees. Again you took money. That time the balance will, OD balance will increase. Okay, when money goes out, balance will increase. But when money comes in, imagine you have to pay bank 500 rupees. You put 200 into your account. That time balance will decrease. Simple. Okay, if it is normal balance, money coming in, balance will increase. Money going out, balance will decrease. But if it's OD balance, money coming in, balance will decrease, OD balance will decrease, and money going out, balance will increase. Now we always use the hand movement method for preparing BRS. Okay, right hand is your start point, left hand is your end point. Right hand is your start point. If they tell, okay, balance as per cash book is given, okay, then right hand. Then left hand will be your end point, that is balance as per passbook. Now you have to understand one thing. Whatever happens to right hand, if right hand moves, balance increased, balance decreased, then it has not happened in the left hand. So you will reverse it. Whatever happens in right hand, you will reverse. Balance increase, you will decrease it in the BRS. If it decrease, you will add it in the BRS. But if something has happened in the left hand has moved, or left hand has increased. Now what you will do, you will not make any change in the left hand will be like that only, and right hand also will increase. Okay, if left hand decreases, right hand will decrease. So simple. If a movement has happened in the start point, balance increased, you will minus in the BRS, balance decrease, you will add in the BRS. If left hand has moved, if balance has increased in the left hand, then you will add it in the BRS. If left hand has decreased, you will decrease it in the BRS. Clear, guys? Yes. Entered here, reverse it, not entered. Okay, not entered, do it, enter it. Clear? Now see over here. Here, if it is entered, then you are going to reverse it. Here, if it is not entered, here it is going to be reversed because it is not entered. Here, if it is not entered, then do it because here it is entered. Ending point, it is entered. Simple. If right hand moves, reverse it. If left hand moves, move the right hand as well. Clear? Common differences. Some of the things which are commonly causing difference between cash book and passbook. Okay. First one is check deposited, not credited. Check deposited but not credited. Now here what happens? Entered in the cash book. Check is deposited. That means I did my work. So I passed the entry in my cash book, but not entered in the passbook. Okay, because it is not credited. I have deposited. No. Okay, not entered in the passbook. Check issued, not presented. That means I wrote one check to somebody and gave it, but that fellow has not gone and put into his bank. That's why money has not gone from my account, but I have given the check. So entered in the cash book, not entered in the passbook. Okay. Bank charges. Bank, will they do one thing? Okay, whenever they want to have any bank charges, they will call you. Sir, bank charges, I will cut the amount. Can I cut the amount today? No, they will not make any call like that. Correct? They will just take the money whenever they feel like. So bank charges entered in the passbook, but you will get to know later. When you see the passbook only, you will get to know. So not entered in the cash book. Interest and dividend received. Already money is received. The money has come and it is sitting in your account. We don't know about it. Entered in the passbook, but it is not entered in the cash book. Is this clear? Yes. Difference between cash book and passbook. Difference between cash book and passbook. Okay, two things can cause difference. One is called as timing difference. That means I enter today, passbook they will enter tomorrow, or passbook they enter today, I will enter it tomorrow. This is called as timing difference. Other one is error. What is this error? I deposited 100 rupees in cash book, I put it as 5,000 rupees. Mistake from my side. I deposited 1,000 rupees, passbook they have put it as 100 rupees. So mistake from bank side. Either mistake from our side or mistake from bank side. This is going to be called as error. BRS. Okay, BRS. Without adjusted cash book. With adjusted cash book. Without adjusted cash book. With adjusted cash book. Okay, now if you have a BRS situation over here, without adjusted cash book and with adjusted cash book, now understand this, they only will tell you in the question that we have to prepare BRS with adjusted cash book or without adjusted cash book. If they just tell BRS, that means no adjusted cash book at all, go and prepare BRS, that's all. If they tell adjusted cash book, then do it. What is adjusted cash book? See, there are a lot of differences. No, differences which are under our control. Okay, our control. We can do that. We can rectify that thing. Okay, without adjusted cash book means what? Enter everything in BRS itself. With adjusted cash book means what? Adjust the cash book. Adjust the cash book for what? For items not entered in cash book. See, bank has entered, I did not enter. That's why the difference is there. If I enter it over, no difference only after that. Okay, I'll enter it, no difference. End of story. Or errors in the cash book. I made mistake in the cash book. If I rectify it over, no difference after that. I don't have to prepare BRS for that particular item. So these are the things which are under your control. You are going to adjust it. Okay. After that, prepare BRS. After that, what you're going to do? Prepare BRS. Clear? Done? Yes. Now, next topic we are going to discuss is trial balance. We'll discuss all the concepts of chapter number 1 and then we will solve the past examination questions of chapter number 1 so that our revision happens. Then we'll go into next chapter. That is the process we are going to follow. Okay, trial balance. Trial balance is what? Basically, is it a ledger? No. Is it a journal? No. What is it? It's a list of all ledger accounts. It's a list of all the ledger accounts in one place. Okay, you have this serial number, particulars, LF, debit, credit. All ledger list will be there so that our final accounts process becomes easy. Clear? Now assets usually have debit balance, liabilities have credit balance, expense has debit balance, incomes have credit balance, capital have credit balance, and drawings have debit balance. Remember modern approach, based on that the balance will always be there. This is the balance which will be there. Next we will go into the concept called as depreciation. Very, very important concept called as depreciation. So let's move into the next concept, guys. Depreciation. Okay. Depreciation is basically what? Decrease in the value of tangible asset. Decrease in the value of tangible asset. A tangible asset is something that has physical existence. Okay. If you have decrease in the value of tangible asset, it's called as depreciation. But decrease in the value of an intangible asset is called as amortization. Amortization. Same thing, just difference in words. That's all. Okay. Now imagine what are the reasons for depreciation. Imagine there is Akash. He has one car. Okay. This car costs 2 crores. Reasons for depreciation is what? One, wear and tear. Wear and tear means what? You're using the car every day. The car is being used. Because of that, the value of the car is reducing. This is called as wear and tear. Next, passage of time. Passage of time. You are not using the car at all. You have parked it nicely inside the compound. Every day you're cleaning the car, keeping it absolutely shining. Okay, but still the value of the car will go down because as the time passes, newer generations or newer cars will be there in the market. So passage of time also will reduce the value of the car. Technological changes. Imagine this is a petrol car and suddenly they have introduced EVs. Everywhere there is going to be only EV anymore. So because of the technological change also, the value of the car can go down. These are the reasons for depreciation. Now in depreciation, we have two things that we have to always understand. One thing is computation and another one is accounting. One is computation of depreciation, other one is accounting. First we need to know how much depreciation, then we will do the journals for that. Okay. Now methods we have is SLM, straight line method, WDV, okay, written down value method, sum of digits method. Sum of digits method. This is one method which is not used often, so you can ignore it also. Machine hours method, production units method, and depletion method. Focus mostly will be on SLM and WDV. So straight line method, okay, other names for straight line method are original cost method, fixed installment method. Here, the major thing that you have to remember from examination point of view, okay sir, if it is a straight line method, then depreciation is going to be same every year. Every year the depreciation is going to be same. What is the formula for depreciation? Depreciation is equal to cost minus scrap value divided by useful life. Okay, this cost will be given in the question. Scrap value will be given in the question. Useful life will be given in the question. You are just going to substitute the values and find out the depreciation. Clear? Now, example. We have cost 1 lakh, scrap value 10,000, useful life 3 years. Now, how will you get the depreciation? 1 lakh cost minus scrap value 10,000 divided by useful life 3 years is equal to depreciation will be 30,000 per year, and every year the depreciation is going to be same. It is not going to change. Every year depreciation is going to be same. WDV, that is written down value method. WDV, written down value method. Now depreciation is equal to year 1. Okay, depreciation is equal to year 1. Year 1, what happens in WDV method? Depreciation will not be same. It will keep changing every year. Every year depreciation will change. Okay, first year when you're calculating depreciation, it will be cost into depreciation rate. Whatever the cost you have incurred to purchase the asset into depreciation rate. Year 2 onwards, what is going to happen? WDV into depreciation rate. Return on value what you get into depreciation rate. Let's try to see with an example. Cost is 10,000, depreciation is 10%. So first year what you will do? Year 1. Okay, if you're following SLM, it will be 10,000 into 10%, 1,000 every year. Because why every year 1,000? Because it has to be same every single year. It has to be same every single year. This is SLM. Clear? Now when we go into WDV you understand. First year what was the formula? Cost into depreciation rate. Cost into depreciation rate, you get 1,000. When you remove that 1,000, you will get the WDV at the end of first year. Clear? That gives you 10. Again, you will calculate on that 10%. Now it becomes 900. Now you will get the WDV. On that, again, you will calculate depreciation 810. So 7290 will be your final WDV. This is your WDV method, and it will go on year 4, year 5, same way it will continue. So if first year you are going to calculate on cost, then you will get the WDV. Every year you are going to calculate on WDV, and this is the WDV method of depreciation. Now, sum of digits method. Sum of digits method, not constantly followed, but it is there. So we have to understand that. Okay, here the depreciation will be number of years remaining divided by sum of digits of useful life into cost minus scrap value. Number of years remaining means what? Whenever, imagine it is 5 years, and if I tell number of years remaining in the first year, it is always including the current year, That means year 1, year 2, year 3, year 4, year 5, including current year you have to calculate. Sum of digits of useful life. If I tell 5 years, you can do 5 plus 4 plus 3 plus 2 plus 1. Okay, like that also you will get the sum of digits. Or easier method will be to use the formula n into n plus 1 divided by 2. That means 5 into 6 divided by 2, which will be 15. 5 into 6 divided by 2, which will be 15. Is this clear? Okay, this is the methodology that we are going to follow. Now, if you are following example, cost is given 10,000, scrap value is 2,000, useful life is 5 years. How you will calculate under sum of digits method? First year you will do 5 divided by 15. How did I get 5? Number of years remaining. We are in year 1. Year 1, 2, 3, 4, 5. So 5 divided by 15 into cost minus scrap value. This is the depreciation. Year 2. 4 divided by 15 into the cost minus scrap value. You will get the depreciation. And year 3, and it will continue like that. Clear? When we are having production units method. Now when we go into production units method, here it is going to be units produced divided by total units into cost minus scrap value. Okay, how many units you have produced and how many units you can produce. Okay, multiply into cost minus scrap value. Next, when we go into machine hours method is hours used, how many hours you have used the machine divided by total hours into cost minus scrap value. Depletion method is when we take land and all. What happens? Quantity that you have extracted from the land, just the land will not have any depreciation. But if land has some natural resources in it, when you extract it, quantity extracted divided by total quantity into cost minus scrap value. Clear? Now we go into accounting. Now we go into the accounting. Clear? Now accounting, when we are going, reduce from the cost of the asset. Okay, reduce it from the cost of the asset. First thing. First method is that whenever there is depreciation, we reduce the asset value only. Okay, asset purchased. Whenever you purchase the asset, what is entry? Asset comes in, money goes out. So asset account debited to bank account. Asset account debited to bank account. And for depreciation, what will be the entry? What did I tell? Depreciation will reduce the cost of the asset. So the entry will be depreciation account debited to asset account. Depreciation account debited to asset account. Next, second method. Create provision for depreciation. Here asset we will not touch. Asset will be like that only, but we'll create a provision for depreciation. So when I purchase the asset, it doesn't matter. Asset purchase is always going to be same thing. Asset account debited to bank account. For depreciation, what is going to be the entry? Depreciation account debited. Because depreciation is an expense. Both the places depreciation account is debited to provision for depreciation. To provision for depreciation. Here what was it? It was here to asset account. Here it is to provision for depreciation account. Clear? Now remember this, in both the methods depreciation is an expense. Because depreciation is an expense, P&L account debited to depreciation. P&L account debited to depreciation in both the methods. Clear? Now sale of asset. When I sell the asset, if I am selling the asset and I am following method 1, method 1 what happened? Asset depreciation was reduced from the cost of the asset itself. Okay, sale of asset, when asset is sold, the entry will be bank account debited because we are getting money. Bank account debited because we are getting money to asset account. Bank account debited to asset account. Clear? At what value? This will be at sale value. At what value? This will be at sale value. Clear? Whatever value we get. Now profit on sale. How do we understand whether it is profit on sale? WDV on the date of sale. Okay, written down value on the date of sale is over here. Sale value is higher. If you sell it at higher value, that means it is a profit. Profit should be credited to P&L. So P&L account is credited, asset account is debited. Asset account debited to P&L. If it's loss on sale means what? WDV is here. You have sold it at lesser value, lesser than the book value you sold. That means it is loss on sale. P&L account is debited. Asset account is credited. P&L account is debited and asset account is credited. Is this clear? Now, next, asset sold. Next, asset sold. If asset is sold, okay, if asset is sold, first thing you have to understand what happens when you sell. Again, you get money, bank account debited, but we won't put it to asset account this time. We have a separate. When we have second method, no, we have to maintain a separate account called as asset disposal account whenever we sell the asset. Whenever we sell the asset, you got the money, put the money into asset disposal account. Okay, now what happens? Asset is there. Money what you got, you are putting into asset disposal account. What you do? Take the cost. Where is the cost? Cost is in the asset account. Remove it from asset account and put it to asset disposal account. Transfer the cost of the asset also to disposal account. And on this asset till today, whatever depreciation you have calculated, it is there in provision for depreciation account. Provision for depreciation account debited to asset disposal account. Clear? Total provision for depreciation on asset sold. Total provision for depreciation on assets. So till today, whatever provision is created, that you are going to transfer it to asset disposal account. Same thing again, profit or loss. Profit or loss also same thing. Now, first method, what we are doing, everything in the asset account. Now, everything is happening in the asset disposal account. Profit should be credited to P&L. So asset disposal account is debited. Loss should be debited to P&L. So asset disposal account is credited. Is this clear? How do we tell it is profit? Sale value is high. WDV is low. How do we tell it is loss? Sale value is low. WDV is higher. Clear? Now, depreciation on asset unsold. End of the year, the assets which are not sold, on that we have to calculate depreciation. No, assets which are sold are gone. Assets which are purchased have come. Which is not sold, what we are going to do? WDV on all the assets at the start of the year. At the starting of the year, what and all assets were there, of that WDV will be there. You have to take it. Then WDV of the asset sold. What asset is sold? Remove that. That time you will get WDV of assets which are not sold, and WDV of assets which are not sold, you will use it for depreciation purpose, and directly you will calculate depreciation on that particular thing. This is how you calculate depreciation on the assets which are not sold. Okay, this topic is also there in our chapter number 1. Finally, we go into adjustment entries. Let's proceed further into adjustment entries. This is also a very important topic. Okay, now they have introduced adjustment entries in chapter number 1 itself. But learning adjustment entries is very important, because when we go to final accounts, we should know everything. Clear? Yes. Now, entry that is passed at the end of the financial year to record the transactions which weren't recorded. Entry that is passed at the end. See, if there is a transaction and it is recorded. That means you have passed a journal entry, and from the journal it has gone into ledger, and from ledger it has gone into trial balance. Clear? It has gone into trial balance. Now it is there in the trial balance. End of the story. That means it is recorded. If it is not there, if you have not recorded, that means it is not there in trial balance. If it is not recorded, it is not there in trial balance. If it is not in trial balance, then these are called as adjustment entries, for which we have to pass the entries. Clear? First one. So first adjustment that we are going to see is closing stock. Okay, first thing is closing stock. Now closing stock, what is the entry, adjustment entry when we are talking? Closing stock is an asset, we have to record it. So closing stock account debited to trading account. Closing stock always goes to trading account, credited to trading account. And in balance sheet, you're going to show it as asset. What we have to understand is all adjustment entries have double impact. When we are preparing final accounts, it has double effect on the final accounts. Second one is drawings. Drawings, you have to understand one thing. Ultimately, drawings will always be subtracted from capital. It will be subtracted from capital. But in drawings, we have 3 kinds of drawings. One, drawings in cash. That means owner, what he did, evening he wanted to eat one pani puri, he took the money from the business, went and ate one pani puri. So drawings account debited to cash. Drawings account debited to cash. If drawings is in goods, what he did, we were manufacturing some chocolate. He took the chocolate and went and gifted to his girlfriend. So now in that case, what happens? Drawings account debited to purchases. What purchases we were having, that is going to reduce. So drawings account debited to purchases. And if drawings is an asset, if at all drawings is an asset, how is that? We have a chair over here. He took the chair only and take it to, he took the chair itself home and is going to use it at home for his personal purpose. So now drawings account debited to asset account. Drawings account debited to asset account. Is this clear? This is the second one, that is drawings, which you have to be very, very clear about. Now, next one is free samples. Next one is free samples. I gave some free samples to somebody. Why will I give? I am giving it with the hope that that fellow will like it. After he likes it, he will take it from me. He will take the goods from me, purchase the goods from me. So advertisement expense account debited to purchases. Advertisement expenses account debited to purchases. Clear? This is the situation. Now fourth one, donation. Fourth one is what? Donation. Now when we are talking about donation, okay, understand this, donation. If donation is given in cash, that means you gave donation in cash. It's an expense only. Donation account debited, cash went, so cash account credited. If donation is given in goods, if you're giving donation in goods, donation account debited to purchases account. Donation account debited to purchases account. Is this clear? Yes. Next we have the fifth one, that is free samples. Next one is what? Free samples. Okay, free sample given to employees. Okay, free sample if it is given to employees. Why am I giving free sample to employees? Simply for him to use. Imagine I'm manufacturing chocolate. I gave my employee, take, use it. Okay, not adjusted with salary. That means I gave him and I'm not taking the money back from him. Then it's going to be advertisement account debited to purchases. Advertisement account is debited because it is expense, and from the goods, from purchases, the goods have gone out. So purchases account is credited. But if at all I'm going to adjust those free samples with his salary, then what is going to happen? Next time I won't give him salary. I will pass the entry salary account debited to purchases. When I pay salary, what is the entry? Salary account debited to cash. But I'm not giving the salary in cash. I'm giving the salary in goods. So salary account debited to purchases. Is this clear? Yes. Next we have abnormal loss. Next thing that we have to see is abnormal loss. Okay, abnormal loss, what we are going to do? Abnormal loss account is going to be debited. Okay, loss is loss. No, it has to be debited. Abnormal loss account debited to purchases or to trading account. Both of them are correct. Abnormal loss account is debited to trading account. Imagine I had some goods which I kept inside. This building caught some fire and these goods are all destroyed. Now what happened? I have to remove it from the trading account. No. So therefore trading account is credited. Then later if insurance company is going to give me money, insurance compensation receivable, then what I'm going to do? Insurance company account debited, insurance company has to give me money. Now my loss is not loss, abnormal loss account is credited. Why it is not loss? Because it is going to be adjusted with the insurance money. Okay, insurance company account debited to abnormal loss. Now next, no insurance compensation. Nobody is going to give you insurance compensation. If they are not going to give you, that means it is 100% loss for you itself. So P&L account debited to abnormal loss. P&L account debited to abnormal loss. Clear? Okay. 9. Stationary stock. You have some stationery. Okay. Your main business is something else, but you have some stationery which you are going to use. You did not use it this year. You will use it next year. Stationery account debited to trading account. Goods in transit. Goods are in transit. Goods are coming. It is your goods only. It has to reach you. So what will you do? That is also like your closing stock. It has not reached here. That's all. So you're going to write goods in transit account debited to trading account. If the goods had reached here, but you did not sell it, then you would pass the entry closing stock account debited to trading account. Goods have not reached. So you're passing the entry goods in transit account debited to trading account. Is this clear, guys? Yes. Now we are going into the most important adjustment, which is always going to be there, bad debt. Bad debt, provision for bad debt and all, you have to be very, very careful. Okay, when we're talking about bad debt is amount not recoverable. Bad debt means what? Amount not recoverable. I gave you 50 rupees and I know that you're not going to give the 50 rupees back. For me, it is a bad debt. Amount not recoverable, it is a loss. If it is a loss, what happens if it is a loss? Loss should always be debited. Loss should always be debited. So you'll pass the entry bad debt account debited. Who did not give you? Debtor. So debtor account is credited. Bad debt account debited to debtor. Is this clear, guys? Yes. If it is provision for bad debt or doubtful debt, that means you are creating a provision. That means you are not sure whether you will not get the money or not. You have a doubt that you will not get the money. You have a doubt that you will not get the money. That time what entry will you pass? P&L account debited. Okay, you're taking the money from profit and keeping it aside. So P&L account debited to provision for bad debt. Provision for bad debt means what? Taking money and keeping it aside, thinking that in the future there is going to be a loss. Therefore, the entry will be P&L account debited to provision for bad debts. Is this clear? Yes. Now, bad debts. Bad debts. Okay, understand this very, very clearly. If PDD exists, that means provision is there. Why did you make the provision? You made the provision telling that there might be a situation that I have loss in the future. Therefore, I'm going to keep the money aside. If I'm going to keep the money aside, whenever the bad debt occurs, I'll take the money from there. Correct? So, if I have PDD, that means I kept money aside. Then you have to take the money for whenever bad debt happens, you have to take it from PDD itself. So, PDD account debited to bad debt. PDD account debited to bad debt. If there is no PDD, you have no provision for bad debt at all. That time what you are going to do? You have to take from your profit itself. P&L account debited to bad debt. This is very, very important. Understand this chart, very, very important. If you have a provision, then whenever there is bad debt, you will take the loss from the provision itself because you already kept the money aside. Okay, see, when you create provision, what you do? P&L account debited to PDD. That means from P&L, you removed money and you kept it over here. So when there is bad debt, from here, you will remove it. Clear? Okay, if there is no PDD, if you have no PDD, then what you're going to do? P&L account debited to bad debt. That means no provision is kept aside. Then you have to take from your pocket itself. Okay, pocket is P&L. Is this clear, guys? Yes, we'll see the examples over here. Example, debtors are 1 lakh. We have debtor of 1 lakh. Bad debt is 10,000. 10,000 bad debt. So what entry will you pass? Bad debt account debited 10,000 to debtors account 10,000. Clear? Normal. Now, what if in the same situation, PDD balance was 12,000? That means I already had PDD. In the past, I have taken money and I have kept it aside. I have a PDD. So that time what will happen? PDD account debited 10,000 to bad debts. PDD account debited 10,000 to bad debts. Clear? Therefore, after that, PDD will be 2,000. So 12,000 was there in PDD. Therefore, see, if there was no PDD, what did I do? Bad debt account debited 10,000 to debtors. That has happened. If there is PDD, I'll take it from PDD. So PDD account debited to bad debts. PDD balance will be 2,000. How from 12,000, 10,000 you have taken, you will be left with only 2,000. Okay, if there is no PDD, you did not keep money aside. So that means you have to take the money now from profits. So P&L account debited to bad debts. P&L account debited to bad debts. I hope it's very clear. Okay, what if PDD is 8,000? You had provision of only 8,000. Now what you can do? When you have 8,000, can you take 10,000? No. So 8,000 you will take from PDD. Extra 2,000 what you want, you will take it from P&L. You will take it from P&L to bad debts 10,000. Done. Done, done, done. Okay. How much provision to create? This is the next question. How much provision to create? Now, they will tell you provision is to be created at the rate of 5%. Provision is to be created at the rate of, at the rate of 6%. They will tell certain things like this. Provision required minus existing provision balance. Whatever provision you require, let's assume that you require provision of 10,000. Right now, the provision is 6,000. So, difference 4,000, you have to create provision. Okay, what is this existing provision? Existing provision is whatever PDD opening balance was there, starting of the year, whatever PDD was there, from that whatever we have removed for bad debt, remaining is our existing provision. Clear? Right now, imagine I require 10,000 PDD. 10,000. Starting of the year, I had 8,000 PDD. From that, I have already removed 2,000 for bad debts. So I have only 6,000 remaining. So 6,000 will be my existing provision. That means remaining 4,000 I have to create now. I have to create provision now. Clear? Okay. Provision for discount on debtors. What is this, sir? I don't have doubt that you are not going. I don't have doubt that whether you will pay the money or not. But I know that whenever you pay the money, you will ask for discount. So that time I have to give discount. For me, that is one loss. Discount is a loss. So what I have to do, I am taking money for that. So I am making a provision for discount on debtors. Discount on debtors. Entry is what? Same. Provision entry, same. P&L account debited to provision for discount on debtors. P&L account debited to provision for discount on debtors. Now, discount allowed. What will be the entry? Discount allowed account debited to debtor. Discount allowed account debited to debtor. This we have already seen. But if there is provision, then provision for discount account debited to discount allowed. If there is no provision, then it is P&L account debited to discount allowed. If you have provision, discount will be taken from the provision. If you don't have provision, discount will be taken from the P&L account only. That means it will be taken from existing profits itself. Clear? Same thing what we did for bad debts. Bad debts recovered. Next is bad debts recovered, guys. Bad debts recovered. Okay, what happens in bad debts recovered? Bank account debited. Why? Because you're getting money. You're getting money, so bank account is debited to bad debts recovered account. Bank account debited to bad debts recovered account. Okay, now what happens to this bad debts recovered? Bad debts recovered account debited to P&L. Why? Here it is transferred to P&L because it is an income, and here bad debts recovered is just transferred and it is going to P&L. Expenses are also debited to P&L, but incomes are credited to P&L. Is this clear? This is your bad debts recovered. Provision for discount on creditors. Expecting that the creditor will give discount, we are going to create provision. This is not going to happen. Okay, entry you can write provision for creditors debited to P&L account, but usually we don't pass this entry because of the concept of conservatism. Future profits we are going to not record, future losses only we are going to record. Okay, in case it is recorded, if they tell in the exam in the question, we can't avoid it. So that time what happens? Discount received, creditors account debited to discount received, and if there is a provision, discount received will be adjusted with the provision. If there is no provision, it will go to P&L. Clear? The final topic in chapter number 1. In chapter number 1, final topic that we have to discuss is rectification of errors. Rectification of errors. Okay, so here what happens? First thing we have is error of commission. Error of commission means what? Wrong, I did, sir. This is error of commission. Yes, here it is. That means wrong. You did the work, but you did it incorrectly. That is error of commission. Error of omission means what? You did not do the work itself. Okay, in error of omission, we have two things: partial omission, complete omission. One side we have missed, other side we have done correctly. That is called as partial omission. Trial balance will not tally. Complete omission means what? Both the things we have forgotten. Trial balance will 100% tally. Clear? Now, when we are going into error of commission, okay, one-sided if it is missed. Again, if it's an error, one-sided error, trial balance will not tally. But if it's two-sided error, that means trial balance will tally. That means if I pass the wrong entry also, but both the places if I make the mistake, trial balance will still tally. Error of principle. Error of principle means what? You have followed the wrong accounting rules. We have discussed all this capital expenditure, revenue and all. You forgot about all that and you have passed one entry. Okay, trial balance will tally because you have passed the entry according to the wrong rules. Okay, this is called as error of principle. Compensating error means what? You made one error, you made one more error. One error, you made debit mistake, one more error, you made credit mistake. Because of this, it is compensating with each other and trial balance will tally. Okay, one error adjusts the difference that is caused by another error. Now, when you are doing rectification, always rectification, you have to follow it in 3 stages. 3 stages we have to do the rectification. 1, correct entry. 1, wrong entry. Then you have to write the rectification entry. Correct entry means what? Ignore the error. Correct entry means what? Ignore the error and pass the entry for the transaction. Forget about the error. What transaction had to be passed, what entry had to be passed, pass that entry. Wrong entry means what? Pass the entry for the error. See what mistake they have made and you have to write that entry. When you compare correct entry and wrong entry, automatically you will get the rectification entry. Here it was supposed to be debited, not debited, do it. Okay, you will get the rectification entry. Now, understand this shortcut or tips for rectification. Debit is missing. You did not do debit. What will you do? How will you rectify this? Debit it. Debit it. Credit is missing. You did not do the credit. Now, what will you do? How will you rectify this? Credit it. Clear? Simple. Debit is less. Debit is less. Now what we should do? We should debit. No. Debit the difference. Whatever difference is there, debit it. Credit is less. That means little less I have credited. I have to make it proper. So credit the difference. Now 100 rupees was supposed to be debited. I did not debit. So go and debit 100. 100 rupees was the credit. I did not credit. So go and credit 100. Sorted? Okay. Debit less. That means instead of 100, I have debited only 80. I missed it and I debited 80. Now go and debit 20. Go and debit 20. Same thing, instead of 100, I have credited only 80. So credit 20. Over sorted. Debited more. Instead of 100, I have debited 130. I debited more. To remove extra debit, what should I do? I should credit the difference. 30 will be credited. Is this clear? I have credited more. Instead of 100, I have credited 130. So if I have credited more, what will happen? I have done extra credit. Extra credit to rectify. What will I do? I will debit the difference. I will debit the difference. Is this clear? Now, debit instead of credit. Debit instead of credit. Instead of credit, what I have done? I have done debit. Now, what I should do? I should double it. To rectify, I should double it. So, I was supposed to do credit of 100. I did debit of 100. First, I should remove this. Then, I should put the correct amount. Is this clear? See, here, if debit instead of credit, see, I had to debit 10. Instead of that, I have credited 10. To remove this credit, what I should do? I should debit. Whenever to remove a credit, what I should do? I should debit. So first I have to remove the wrong thing. To remove the wrong thing, what I'm going to do? Okay, see, I have to credit double or I have to debit double. Whenever the opposite happened, that means debit instead of credit. I have done debit. I have to remove it now. Credit it, then put the credit again. It becomes double effect. That is basically like a ledger. See, in this ledger, I wanted 10. It is not there. It is not there. By mistake, I have put 10 over here. So now to bring the 10 into debit side, what I do? I put one debit. It becomes 0. One more debit when I put, that time I'll get the balance of 10. Is this clear, guys? Yes, this should be the situation. Now, stage of rectification. Stage of rectification. Where and when you are going to rectify, that also matters when you are doing rectification. If it is before preparation of trial balance, there is no concept of suspense account itself. Why? Suspense account comes when you prepare the trial balance and the trial balance is not tallying. That time you put the difference into suspense account. Before preparation of trial balance, if you have found out that there is an error, okay, no suspense account is going to be used. Just rectify it, that's all. After preparation of trial balance, okay, if it is two-sided error is there, pass the entry without suspense account. But if it is one-sided error, that means it has caused a difference in the trial balance, pass the entry with suspense account. Clear? If it's a two-sided error, pass the entry without suspense account. If it's one-sided error, pass the entry with suspense account in the next accounting period. If it is in the next accounting period, that time what you're going to do? Suspense account rule is same. What is going to be done in suspense account? That is going to be same. Okay. And P&L adjustment account is to be used for expenses or incomes. P&L adjustment account is going to be used. That means whenever in the next accounting period we are rectifying something, and when we are rectifying that, if at all there is an expense or income, what you're going to do? You're going to use P&L adjustment account. So in your rectification entry, if it is coming salary account debited, instead of salary, you're going to write P&L adjustment account. Okay, P&L adjustment account, because it's a rectification of last year you're going to do in this year. So we don't want last year's income and expense to affect the profit of this year. This is the stage of rectification. With that, we have done with the concepts of chapter number 1. Now what we are going to do is we'll solve the past examination questions of chapter number 1, whatever they have asked from chapter number 1. Okay, first time we have this question number 23. Question number 23, December 2024, 7-mark question. They have asked it for 7 marks. Let's see. On comparing the cash book of Shivam with the bank passbook for the year ended 31st March 2024, following discrepancies were noticed. That means they are asking a question from BRS. Clear? Now, checks for 85,000 deposited into bank. Now, let's go to the end of the question. Prepare a bank reconciliation statement if the bank balance as per cash book was 182,500. What is your starting point now? Balance as per cash book 182,500. So, your starting point should be You can see over here, balance as per cash book 1,82,500. Balance as per cash book 1,82,500. Now, check of 85,000 deposited into bank. Checks amounting to 25,000 were collected. 25,000 were collected when? In the next month. If it's collected in the next month, what happens? Now, what is your start point? Your right hand is cash book. Your right hand is cash book. Okay, cash book. Check deposited. That means cash book balance went up. Right hand moved. You're going to reduce it. 25,000 should be minus. Can you see check deposited, not credited? 25,000 minus. Clear? Next. Checks amounting to 38,000 drawn on 28th of March. Drawn means checks issued. Okay, on which check of 8,000 was presented in 3rd April. If right hand is what? Cash book. Checks issued means cash book already entry is passed. If check is issued, balance reduces. If balance reduces, you have to add it back. 8,000 will be added back. Can you see 8,000 check issued, not presented? Okay, next. A check of 4,000 entered in the cash book but omitted to be bank. That means you entered in the cash book, you did not put it into the bank. That means when check is entered in the cash book balance goes up. Cash book balance goes up, right hand has moved, so you have to reduce it. So here you are going to reduce 4,000. Okay, next. You have a bill receivable for 18,000. Previously discounted, discount is 90 rupees with the bank, had been dishonored but advice was received on 3rd April. When a bill is discounted, that means bank has given you money, and when it is dishonored, that means bank will take the money. Bank will take full amount, not the net amount. Bank will take full amount because discounting charges is your loss. So bank has taken 18,000 rupees, but you have not received the advice. That means you did not get that message in your phone, oh, this much money went from your account. So when bank has taken the money, passbook, left hand is your passbook balance reduces. Right hand, left hand has moved, so right hand also has to move. So you will reduce 18,000. Can you see over here? Bill dishonored, not entered in cash book, 18,000. Clear? Next. A check of 20,000 wrongly credited in the passbook but reversed on 2nd April. Wrongly credited in the passbook. That means passbook balance went up. Cash book balance also has to go up. Left hand moved, right hand also has to move. Okay, when you are done with that, bank had wrongly debited 15,000 in the account but reversed it. By mistake, they removed 15,000 from your account. So passbook, left hand, passbook went down. So cash book also will go down, minus 15,000. Okay, when you do that, you'll get balance as per passbook 1,58,500. I hope it is clear, guys. This question, which was asked for 7 marks. It was asked for 7 marks in December 2024. Next, we will go into one more question was asked in December 2024. This is also for 7 marks. State with reasons whether the following are capital expenditure or revenue expenditure. Question number 24. With reasons we have to tell. Okay, first one. Expense incurred in connection with obtaining a license for starting the factory. Starting the factory is a capital expenditure. Remember the chain effect which we discussed. Chain effect, whatever expenses come, that also is going to be capital expenditure only. So now see over here. Capital expenditure, expense incurred in connection with capital expenditure is also a capital expenditure. This is what I was telling you about chain effect in the earlier, starting of this video. Okay, 1,000 paid for removal of stock to new site. You removed the stock from one place and put it into another place. Is it going to give you any extra benefit? No. So that is going to be a revenue expenditure. Shifting expense will not give any extra benefit. Is this clear? Now, next. Rings and pistons of an engine were changed at a cost of 5,000 to get fuel efficiency. You change some parts. Repair. Do you remember repair in capital and revenue part? Repair if you do to the machinery. After the repair, if it's going to give you extra benefit, then it is going to give you capital expenditure. It's going to be capital. Otherwise, it's going to be revenue. Here they are telling to get fuel efficiency. That means you're going to get better extra benefit over here. Okay, so it is going to be considered as capital expenditure. Changing the parts is increasing the benefit. It's increasing the benefit. Okay. Next. 2,000 spent as lawyer's fees to defend a suit claiming the firm's factory site belonged to the plaintiff. The suit was not successful. Somebody filed a case. You're trying to, someone has filed a case telling that the land belongs to you. You're fighting for that case. Will you get extra land? No, you will save your land. So the 2,000 what you're going to spend is not going to give you an extra benefit. It will preserve the existing benefit. Therefore, it is a revenue expenditure. No extra benefit is received. Clear? Next, fifth one. 10,000 was spent on advertising the introduction of a new product in the market, the benefit of which will be effective during 4 years. You have spent 10,000, benefit you will get over 4 years, but advertisement is always revenue expenditure. It does not give you extra benefit. Revenue expenditure, as there is no future economic benefit, it may be classified as deferred revenue expenditure. Did I tell you, whenever we have revenue expenditure, if I feel that, sir, I'm going to get benefit in future also, I will spread it for future. This is called as deferred revenue expenditure. We have discussed this particular point. Clear, guys? Yes. A factory shed was constructed at a cost of 1 lakh. Factory shed was constructed at a cost of 1 lakh. Okay, this is anyways capital expenditure. Sum of 5,000 has been incurred for construction of temporary huts for storing building material. Did we discuss this temporary huts? It is a chain reaction. That means 1 lakh plus 5,000. 1 lakh 5,000 will be capital expenditure. 1 lakh plus 5,000. 1 lakh 5,000. Capital expenditure. Factory building will give you future economic benefit. Temporary huts are expenses incurred because of a capital expenditure. That will also be taken as capital expenditure. Is this clear, guys? Yes. A pair of bullocks for 50,000 was killed by lightning. Revenue expenditure. Bulls are not assets in balance sheet. Therefore, it is going to be treated as revenue expenditure. You had some bulls. Okay. Animals are not going to be taken as asset in the balance sheet. So if it is gone, it is going to be treated as a loss revenue expenditure. Clear? Okay, guys. Let's go further. In June 2024, they have asked one 7-mark question. Okay. They said on 31st March 2023, trial balance of Singhania Brothers, balance of the machinery account appears at 19,80,000. The firm allows rate of depreciation on machinery at 15% per annum on WDV. On scrutiny, it was found that the machinery appearing in the books on 1/4/2022, okay, at 4,50,000 was disposed on 30th November 2022 in exchange of a new machinery costing 3,50,000. Okay, they found that there was one disposal. You are required to calculate total depreciation to be charged in the P&L and profit or loss on exchange and book value of the machinery on 31st March 2023. Okay, guys. Now, understand this. Total depreciation to be charged. Depreciation on old machinery. What was the old machinery which was there, which we disposed? It was in the books at 4,50,000. When asset is sold, till the date of sale, we have to calculate depreciation. That means it is sold from 1/4 to 30th November. That means April, May, June, July, August, September, October, November. 8 months. So 4,50,000 into 15% into 8/12. That means the depreciation is going to be 45,000. Depreciation is going to be 45,000. And they have purchased one new machinery in exchange of a new machinery costing 3,50,000. So now what happens, this machinery we have purchased on 30th November. That means December, January, February and March. 4 months we are going to use it. So this is going to be 3,50,000 into 15% into 4 divided by 12. This is going to be the depreciation. What about the depreciation on old machinery which is not disposed? Okay, depreciation on old machinery which is not disposed. That we have to calculate. WDV was how much? 19,80,000. In this value of new machinery is how much? 3,50,000. This will give you the WDV of the old machinery which is unsold. Okay. What was the WDV? 19,80,000 given in the question itself. Out of that, remove the new machinery which is sitting there. That time you will get the WDV of the old machinery which is unsold. On that, calculate 15%. 2,44,500 will be your depreciation on the old machinery, and this will be your total depreciation. What did we do? Depreciation on asset which is not sold. Depreciation on asset which is sold, depreciation on asset which is newly purchased, and depreciation on the everything which is there, remaining assets. Clear? Then we have to calculate the profit or loss. What is the sale value? 3,50,000. What is the new asset you are getting? 3,50,000. But what is the WDV of the asset which is sold? It was 4,50,000, but on that we have calculated 45,000 depreciation for 8 months. This is the 8 months depreciation, 45,000. You have 4,05,000. 4,05,000 is the WDV, but new asset you got only 3,50,000. 55,000 is the loss on exchange. Loss on exchange. Now they are asking you book value of the machine. Book value of machine, what you will do? Old machine value minus what is going, okay, minus the sorry, 2,44,500 is what? The depreciation. Yes, 2,44,500 and the depreciation on the new machine. So old machine value, new machinery value depreciation, and the value of the depreciation on the new machine. Okay, depreciation on old machine and depreciation on new machine. When you remove, you'll get the net WDV. This is the question. Is this clear? Yes. Now, let's proceed further to question number 26. Here also they have asked one question for 7 marks in the exam. See, so many questions they have asked. 7 marks. Now here on 30th September, Sri Sachin Chatterjee's cash book shows that he had an overdraft. 1 second, 26, right? Okay, cash book showed an overdraft of 400 on his current account in the bank, OD. So what is your start point now? OD balance. OD as per cash book. OD as per cash book is your start point, and that is showing 400. Now, checks issued 1,500 had been entered in the cash book but had been presented into bank of only 1,000. 1,500 but only 1,000 you presented, so 500 is not presented. Check issued. Where did you enter it? In the cash book. If check is issued, OD balance, when check is issued, money goes out. That time the OD balance will increase. OD balance will increase, so you will decrease it minus in the BRS. Dividend amounting to 150 had been directly deposited in the bank. That means passbook balance, dividend. It is OD balance. When it is OD, if the money comes in, balance decreases. Passbook balance has decreased, so cash book also has to decrease. This will be added. Bank had credited interest on bank OD, bank deposit of 170, but the same has been debited in the cash book on 6th October. That means you did not put it in the cash book. Bank has credited interest. That means bank has given you interest. So passbook balance, when they gave you interest, because it is OD, balance went down. So cash book also you have to reduce. Here also it is minus. Bank charges of 50 shown in the bank statement, but the same had not been entered in the cash book. Bank charges of 50, okay, shown in the bank statement, but the same had not been entered in the cash book. Bank charges is 50. So what did they do? Bank balance went up. Why? OD. Already we had to pay. Bank balance went up. Left hand moved, right hand also has to move. Okay, add. Then we are writing check is issued to NK Chatterjee for 50, was replaced when out of date. We had issued the check, date got over, we have replaced it. It was entered again in the cash book, no other entry being made. Both the checks were included in the total unpresented checks shown above. Unpresented checks, both the checks are shown, already it is shown. Okay, so what we are going to do now, here we have unpresented checks, checks issued. Both the checks are there, one should not be there. So what we will do in here, instead of taking 500, we will take only 450, because one check only we are supposed to take. One check we got it, it got replaced. The receipt side of the cash book had been overcast by 20. Receipt side of the cash book, that means we put one extra receipt. Okay, cash book receipt means what? Balance will reduce, so we will add it back. Cash book receipt means balance will reduce because it is OD and we have to add it back. Check for 20 had been entered as a receipt in the cash book instead of a payment. Check for 20. We have instead of payment, we have entered it as receipt. So now what happens? Passbook, cash book, cash book. Passbook, what did they do? It's a payment. So balance went up. But in cash book, what did we do? We took it as a receipt. So balance went down. OD. So balance went down. So can you see the difference? So we have to double it. Okay. Cash book, we have to add once and we have to add once more so that we will reach the same level. So add 40, 20 into 2, double it. Instead of debit, we are doing credit. A check drawn for 8 had been incorrectly entered in the cash book as 88. Check drawn means check issued. Okay, it is incorrectly entered in the cash book as 88. So 80 we have put extra. That means cash book balance has gone up. Cash book balance has gone up. So what we have to do? Reduce it and make it 80 again. Reduce it and make it 80 again. So you are required to prepare adjusted cash book and the BRS. Now, which and all will go into adjusted cash book? Check issued. Okay, it is already done from our side. This will go into BRS. Dividend, which we have not done, this will go into adjusted cash book. Bank had credited interest, we have not done, so this will go into adjusted cash book. Bank charges, we have not done, this will go into adjusted cash book. And check is issued, this is already adjusted over there. Receipt side of the cash book has been overcast. Okay, this will actually go into adjusted cash book as well. And receipt side of the cash book, we made mistake in the cash book, this will also go into adjusted cash book. Check of 20 had been entered as a receipt in the cash book instead of a payment. This will also go into adjusted cash book. Check drawn for 8 had been incorrectly entered in the cash book. This is also mistake, adjusted cash book. All these are mistakes. Only one thing will go into BRS in this particular question. Clear, guys? Yes, that shouldn't be an issue. We'll go to the next question. Question number 27. December 2023, they have asked for 7 marks. And here they have told, what did they ask you to prepare? From the following, prepare adjusted trial balance. Already one trial balance is given in the question. We are supposed to prepare adjusted trial balance. Okay, guys, let's start. Now, from the following details, prepare an adjusted trial balance as on 31st March 2023. Okay. First, salary and wages due to be paid 2,000 and 1,000 respectively. Salary and wages due, that means outstanding. So what should we do? We should add it to salary and we should show it as outstanding salary. We should add it to salary and we should show it as outstanding salary. This is what we should do. We should add it to wages and we should show it as outstanding wages. This is the adjustment. Salary account debited outstanding salary, wages account debited outstanding wages. Insurance was paid to the extent of 300 advance, prepaid insurance. So what we should do, we should take it as prepaid insurance. We should take it as prepaid insurance, which is an asset. Okay, and then from insurance, we have to minus 300. We should minus 300 from insurance. Clear? Now, a sum of 500 to be written off as bad debt out of sundry debtors and a provision of 5% to be created for doubtful debts. Do we have sundry debtors already? First of all, we have to see, do we have provision in the question? Do we have provision for doubtful debt in the question? No. What is the debtors? Okay, debtor is showing 40,000. So what I will do, 40,000. From that I have to remove the bad debt. Bad debt is how much? 500. So I will remove 500, 40,000 minus 500, it becomes 39,500. This is my bad debt. On this, they are telling they need a provision of 5%. Provision of 5%. So into 5%, when you do 39,500 into 5%, that makes it 1975 is the provision that is required as of now. Clear? Now, sundry expense includes 2,000 spent for personal purpose of the proprietor. So what we will do? We have to take it as drawings. We have to take it as drawings and we have to remove it from expenses. They have taken it as expense, remove from expense and take it as drawings. Sales for the period includes 500 worth of goods. Okay, cost price, goods cost price taken by the proprietor for personal consumption. He has taken for his personal consumption. So we have to take it as drawings 500 and from sales we have to minus 500. He also taken goods worth rupees 1,000 cost price for personal consumption which has not been recorded anywhere. This one what we will do, see, one which he had taken for personal purpose, they have taken it as sales. So remove from sales and take it as drawings. One more which he has taken for personal purpose, we have not taken anywhere. So that what we will do, we will take it as drawings 1,000 and then we are going to remove it from purchases 1,000. From purchases we have to remove 1,000. Depreciation to be provided as follows. Plant and machinery 10%, building 5%, furniture 10%. Okay, what we are going to do for all this? We are going to show depreciation in the trial balance as debit and from the asset we are going to subtract. From the asset we are going to subtract. Is this clear? Next, after that we have closing stock. Closing stock is 20,000. What will we do with closing stock? Closing stock, we will show it in debit and we are going to reduce it from purchases. Instead of putting into trading account, we are going to reduce it from purchases. Is this clear? These are the adjustments that we are supposed to do. We'll go item by item now. First, purchase. Okay, can you see purchase? Let me show you. See, purchase, how did we calculate the purchases? Now, the balance of the purchase was 65,000. It's given in the question only 65,000. Then what is happening? Okay, you can see over here, drawings. Drawings. Yes. The drawings is 500 and drawings is 1000. Two times. Drawings account debited, drawings account, two drawings are there. One is 500 and one more is 1000. Okay, so you're going to remove it from purchases. Then one more is, see, it was included in sales, guys. So what we are going to do, drawings, we are going to take the drawings. Oh, sorry. I think this one we made a mistake. This is not like this. Understand this. Sales for the period included drawings. That means drawings they have already taken. Can you see personal consumption? Drawings is there in the question. Can you see drawings anywhere? No, in the trial balance there is no drawings. Okay, so they had taken 500. It was there in sales. What we should do, it should not be there in sale. It should be removed from purchases. So we are removing from purchase also, and the other 1000 also we are going to remove. Then what we are going to do, there is opening stock. Opening stock, can you see in the question itself they have given you opening stock 21,000. 21,000 you are going to add it to the purchase. This is called as adjusting the purchase. Add it to the purchase, and 20,000 which is the closing stock which is given over here, 20,000, that you are going to remove from the purchase. That time you will get the adjusted purchase. So all the adjustments you are doing in purchase itself, and you are showing 64,500 as your purchase. Can you see 64,500 is your purchase? And the stock, you can see the stock. Opening stock is not there because it is already adjusted. And closing stock, can you see here, it has come into the trial balance. Closing stock was outside the trial balance. We brought it into the trial balance because we passed the adjustment entries. Okay, next we go further into the next one, that is carriage inward. There was no adjustment for that. Directly you are going to write carriage inward debit because it's an expense. Next, wages. Wages, we are not going to write 6,000. We are going to add the outstanding. Do you remember outstanding wages? And we are going to show 7,000. After showing 7,000, we have to show outstanding wages as a liability. So liabilities will have credit balance. Can you see we added to wages also? We showed it as outstanding also. The next thing that we have is salary. Salary also had one outstanding amount. So salary 10,000 plus 2,000. We are going to show salary as 12,000. And we are going to show the outstanding salary as a liability, credit item. Clear? Next, we have rent, rates and taxes. Rent and all, there was no adjustment at all. Directly you are going to put 1,800 expense. Insurance 1,500. This what we are going to do. There was one prepaid insurance over here, 300. So what we are going to do, we are going to subtract that over here. We already discussed it. 1,200 we are going to put, and then the 300 we are going to show it as prepaid insurance. Prepaid insurance is asset. Assets have debit balance. Clear? Next, what we have, interest paid 1,000. I don't think there is any adjustment for this. Directly you are going to write interest paid 1,000. Then what we are going to do, sales. Sales is 95,000. 95,000 is sales. In that, remember, one drawings was included in sales. So you are going to remove that drawings of 500. 95,000 minus 500, 94,500. Drawings was included in sales. So we have removed it, and we have also removed it from purchases. Is this clear? We have also removed it from purchases. Now, if I have to tell you that correct entry should have been drawings account debited 500, okay, to purchases. By mistake, they have written it as to sales. So we are removing it from sales. Is this clear? And we are correctly removing it from purchases. Now, after that, what do we have next? Cash and bank. No adjustment in cash and bank. Directly you are going to write 21,500 debit because it's an asset. Clear? Next, we have bills payable. Bills payable is a liability. Directly we are going to write credit balance. Next, we go into Sunday creditors. Sunday creditors are also liability. So directly 35,000 credit balance. Then we have plant and machinery. Plant and machinery 10,000. Yes. But what we have to do? Depreciation. Depreciation rate is how much for plant and machinery? 10%. So 10,000 minus 1,000. 9,000 we are going to show as plant and machinery. And depreciation, we are going to show depreciation 1,000 over here. 3 depreciation. So 1,000 depreciation is over here. Next item after that is our buildings. 5,000. 5,000 building. How much is the depreciation on building? 5%. So you're going to remove 5,000. You can see over here 5,000 minus 250. 5%. No, so 250, 4,750. And that 250 should be shown as depreciation. It is added to depreciation 250. This is how we are adjusting the trial balance. Clear? Now, next we go into the next item, that is furniture. Furniture is how much? 3,000. 3,000 and the rate of depreciation is 10%. 3,000 minus 10%, 300. This becomes 2,700. And then you have 300 over here, depreciation 300. Is this clear? Next, after that, you have bills receivable 10,000. Bills receivable 10,000. So you're going to directly write 10,000. Then you have sundry debtors 40,000. But remember, we did all these adjustments. Sundry debtor is going to be how much? 40,000 minus 500 minus 500. What is this 2 minus 500 minus 500? It was taken as sale. Remember, if it is taken as sale, debtor would have increased. So you're going to remove that debtor. So two things we have to do over here. 39,500 minus 500, because that sale, when sale reduces, debtor also reduces. So this becomes 39,000, and on this you will calculate 5% provision. So 39,000 into 5%, 1950. See, one error is going to affect the other thing. So this 500 you have removed because it is bad debt, and this 500 you have removed because you are going to reverse the sale. When sale reverses, sale goes and debtor also reduces, and then you are going to create provision. So 1950 you have to show 1950 provision for doubtful debts. Clear? Yes. Then we have capital 66,000. We have not made any adjustment to capital and all. Directly you write 66,000. Then we have sundry expenses. But in the expense one, drawings was included. Where is that? Over here. Sundry expenses included, drawings also. So now what you're going to do? 5,000 minus 2,000, 3,000. Okay, net amount. Done. After this, what we are going to do? All the things we have seen. Bad debt is an expense, so we have to show debit. Then drawings, 3 drawings were there. One which was included in expense, one more which was included in sale, and one more which was included in purchases. So total drawings becomes 3,500. Then P&L we have to write, because P&L is debited. Whenever we create provision, P&L debit and provision is created. So 1950. Depreciation, all 3 we are going to put. Closing stock also we have put. When you are doing this, your trial balance will 100% tally. So all the adjustments if you do, trial balance has to 100% tally. This is your next question, okay, which was asked in the exam for 7 marks. Now finally, in December 2023, they asked one question for 5 marks. Explain the following accounting conventions. We have discussed these conventions. We'll have a look at it again. First one is full disclosure. Full disclosure means what? You are not supposed to keep anything aside. You are supposed to disclose everything to the reader. All information that you have, you're supposed to disclose to the reader. Consistency means accounting policies you have to apply consistently over a period of time. Okay, then materiality. Materiality means what? Whatever is important to the reader, you're going to disclose that. You're not going to, whatever is useful for the reader, only that you're going to show. Don't stuff everything on the reader. Okay, conservatism, provide for future losses, don't provide for future profits. This is it, guys. With that, we are done with chapter number 1. Next, we go into the next chapter. With that, we'll start with bills of exchange. There we'll start with bills of exchange. Is this clear? Yes. Okay, students. The next topic that we are going to discuss is bills of exchange. So we finished accounting process. The first fundamentals chapter we have finished. Now we go into the second chapter and we move into bills of exchange. Now, what is bills of exchange? Bills of exchange is a negotiable instrument. Okay, it's a negotiable instrument. Now, just try to understand the story of bills of exchange. We have one person called as Sriram and we have one person called as Shalini. Okay, what does Sriram do? Sriram sold goods to Shalini. Whenever we sell goods to a particular person, it can be cash or credit. If it is on credit, sold goods on credit. Then obviously you have some doubt in your mind that later, 3 months later, are you going to get the money or not? Okay, so the goods are sold on credit. Goods are sold on credit. So now the person who sells, that is Sriram here, this person is called as seller, and the person who is buying, and this person is called as buyer or purchaser. Clear? Now, after that, what happens in bills of exchange? Sriram will draw a bill on Shalini. That means the person who will draw a bill. Drawing bill means what? Writing the bill, okay, with all the details, signing, giving it to the other person for also to sign and accept it. Okay, so the person doing this is called as drawer. The person doing this is called as drawer, and the person who receives this bill, okay, is called as drawee. Okay, Sriram draws the bill for 3 months. So now if there is a bill and if that person accepts it by signing, the person will accept it by signing, and the bill will be sitting in Sriram's pocket. Clear? This concept is called as bill of exchange, and for Sriram this is bills receivable, and for Shalini it is bills payable. For Sriram it is bills receivable, and Shalini it is bills payable. Clear? So what happens? Drawer will draw the bill, give it to the drawee, drawee will sign and accept it and give it back. Clear? Now, we have to understand about the concept of due date. Due date and also something called as maturity date. What is due date? What is maturity date? Due date is the date when you are actually supposed to make the payment. If you are a drawee, you are supposed to make the payment on the due date. Clear? But what is maturity date? On the due date, if at all something happens and you are not able to make the payment, so we give you some extra days. These extra days are called as grace days, and these grace days are always 3. So to the due date, when you add 3 days grace, it becomes the maturity date. Clear? Now, date of bill is 1/1/2024. Date of bill is 1/1/2024, and tenure is given as 3 months. Time period is 3 months. So if it is given 3 months over here, what you will do? Straight away, it's given in months. Add it to the month column. Add it to the month column. So automatically it becomes 1 plus 3, 4. 1/4/2024. 1/4/2024. Grace days are 3 days. So add the days to the days column. It becomes 4/4/2024. Is this clear? Now, next, you have 1/1/2024, date of bill. Okay, tenure is 1 month. What is the tenure? 1 month. Okay, so 1 month, it's given in months. So add it to the month column. 1 plus 1 becomes 1/2/2024. Add 3 days to the days column. 1 plus 3, it becomes 4/2/2024. Is this clear? Okay. Next, you have a situation over here. 1/1/2024. It is given in days. It's not given in months. So if it is given in days, you have to add the days to the days column. 1 plus 30, it becomes 31/1/2024. Clear? Add 3 days. 3 days to the days column. 31st of January plus 3 days, that makes it 3rd February 2024. So what do we understand? Month and days are not same. 1 month and 30 days are not same. If it is month, add it to the month column. If it is days, add it to the days column. Okay, 1/2/2024. 1/2/2024, 30 days. 30 days. So what you will do? Straight away you will add it to the days column. But if you add 1 plus 30, you cannot tell 31st of February, because February does not have 31st of 31 days. We are in 2024, so February has only 29 days. 2024 is a leap year, so February has 29 days. So 28 days are done in February, and the next 2 days will be in March. So 2nd of March will be the due date. Add 3 days grace to that, it will become 5th of March as the maturity date. 5th of March will be the maturity date. Clear? Next, we move forward. 15th of June is the date. They have given 15th of June. 2 months. So you have to add it to the month column. That makes it 15th of August. But 15th of August is a public holiday. So you cannot make any payment on that day. That's why they are considering it as 14th August. Add 3 days grace, it becomes 17th August. So what you have to understand, if there is a national holiday, you will take the previous day. If it's an emergency holiday, you will take the next day. Because national holiday is not a surprise, you already know about it. So you will take the previous day. Emergency holiday is a sudden holiday, so you will take the next day. Clear? Next, we go into a concept called as bill drawn after date. Now, when you're drawing the bill, you can have two situations: bill drawn after date or bill drawn after sight. If bill is drawn after date, then the tenure starts from the date of the bill. Tenure means what? The time period, ticking time period will start from the date of the bill. If the bill is drawn after sight, then the tenure starts from the date of acceptance. Okay, bill drawn after date, the tenure starts from the date of bill. Bill drawn after sight, the tenure starts from the date of acceptance. Is this clear? Yes. Now, let's proceed further. We have Sriram as the drawer, okay, and Shalini as the drawee. We'll try to understand the entire situation with this these two people only. Now, goods sold by Sriram. So Sriram has made the sale. So what should be the entry in the books of Sriram? We have to see both the parties, in the books of Sriram as well as in the books of Shalini. So what is going to be the entry in the books of Sriram? Sriram will pass the entry Shalini account debited to sales. Why Shalini account debited? Because Shalini has not given the money. So Shalini has to be debited, or Shalini becomes a debtor. Shalini account debited to sales. Clear? Now, goods sold by Sriram. Other side, what you are going to write? For that person, it is a purchase. Purchase account debited to Sriram. So here, Shalini becomes a debtor, and here Sriram becomes a creditor. Is this clear? Yes. Now, bill is drawn for 50,000. Bill drawn means just a piece of paper, no validity. The bill gets validity only when the other person accepts it. So, bill is drawn for 50,000, no entry for that in both the parties. But if the bill is accepted by Shalini and given back, now it becomes a valid bill. Now, what should be the entry? Okay, we will write bills receivable account debited. For this person, Sriram, it is bills receivable. So, bills receivable account debited to Shalini. And here what we are going to write? Sriram account debited to bills payable. Clear? So, here bills receivable account debited to Shalini. There Sriram account debited to bills payable. During the tenure. That means during the time period, 3 months, 4 months, whatever time period we have given, in that time period, what can happen? First thing is hold the bill. Sriram will just keep the bill in the pocket and wait. For that, there is no entry. For holding the bill, there is no entry. Okay. Other option, what Sriram has is, Sriram can't wait for 3 months. Sriram wants money right now only. So what he is going to do? He is going to the bank and discounting the bill. Discounting the bill means what? Going to the bank and giving the bill and taking the money early. And bank telling the bank, don't worry, Shalini will pay you after 3 months. So bank will obviously cut some money. They will not give you full amount because they are giving you money early. So that amount which they are going to deduct is called as discounting charges. So bank account debited. Imagine discounts the bill with the bank for 49,000. 50,000 bill, bank will not give full amount. They will cut their charges. So bank account debited 49,000. Okay, what they are not going to pay, that is a loss for us. So discounting charges account debited to bills receivable. Bill is gone. So bills receivable is credited. Okay. Then what if bill is endorsed to Dinesh? What is endorsed? See, just like Shalini has to give us money, we have to give money to somebody else. Now, when we have to give money to somebody else, what we will do? We will tell, I don't have money today, but I will give you bill. Okay, so the bill which we got from Shalini, we are going to give that bill to Dinesh. So, bill endorsed to Dinesh. That means bill is endorsed to a creditor. Creditor is a person I have to pay. So, I endorse the bill to a creditor. So, what should be the entry here? Dinesh account debited. Creditor is gone. You made a payment or you gave something that is equivalent to a payment. So Dinesh account debited to bills receivable. Dinesh is a creditor. Creditor liability reduces. When liability reduces, it is debited. Bills receivable is an asset. Asset reduces. So asset is credited. Is this clear? This is what can happen during the tenure of the bill. But what will happen in the books of drawee? In the books of Shalini, no entry. No entry, guys. No entry at all. Now, Shalini, no, you don't have to bother only. If you are Shalini, you don't have to bother. Why? You already told 3 months later you come to me, I will make the payment. 3 months later you come to me, I will make the payment. Now, Imagine during these 3 months, you are going to keep it in your pocket, you are going to keep it in your cupboard, you are going to discount it with the bank, you are going to endorse it to a creditor, or you just make one paper boat and leave it in the water. Doesn't matter at all. Doesn't matter. I am not going to be bothered at all. You do anything with the bill. You come to me 3 months later, I will make the payment. So there is no entry during the tenure of the bill in the books of drawee. In this case, it is Shalini. Clear? Yes. Now, on due date. On due date, what can happen? Two things can happen. Two things can happen. One is bill is honored. Other one is bill is dishonored. Either bill is honored or bill is dishonored. Bill is honored means you got the money. Bill is dishonored means you did not get the money. Now, if bill was held by Sriram, if bill was kept in Sriram's pocket only, then who will make the payment? Shalini will make the payment to Sriram. So you are going to get money. So bank account debited to bills receivable. Bank account debited to bills receivable. Is this clear? Now, what if bill was discounted? If bill was discounted, bill is sitting in bank's pocket. Bill is sitting in bank's pocket. So Shalini will make the payment to bank. Because Shalini will make the payment to bank, we don't have to pass any entry. We don't have to pass any entry. Bill was endorsed to Dinesh. So what will happen? Shalini will make the payment to Dinesh. Shalini will make the payment to Dinesh. We are Sriram, no entry. Now, in the books of Shalini, you see, in the books of drawee, what happens? Whether Sriram comes and asks the money, that is, drawer comes and asks the money, or whether our bank comes and asks the money, or whether Dinesh comes and asks the money, doesn't matter. Whoever comes and asks the money, they have to make the payment. They are going to make the payment. So the entry is bills payable. Bills payable was a liability. Liability gone. Bills payable debited to bank. Bills payable debited to bank. This should be the entry. Bills payable debited to bank. Is this clear? Next, we have bill dishonored. Okay, what if you are not going to get the money? If you are not going to get the money, then you have to think of the entries. If bill was held by Sriram, that time what happens? We did not get the money, bill over, no, bill got over, bill got cancelled because date is only over. Now what happens? Shalini account debited because Shalini has to give us money. Shalini becomes debtor again. Shalini was debtor in the past. Shalini gave bill. That's why we had removed Shalini from debtor position. Now Shalini has not made the payment. So Shalini becomes debtor again. Shalini account debited to bills receivable. Shalini account debited to bills receivable. Okay, this is if bill was held by Sriram. Now, if bill was discounted, what if the bill was discounted? Then you will pass the entry Shalini account debited to bank. Shalini account debited to bank. Why? If bill was discounted, bill is with the bank. Bank went and asked Shalini for money. Shalini did not give the money at all. So what will bank do? They will just take the money from your account. Bank will just take the money from Sriram's account. So bank account credited because money went and Shalini has to give us money now. Because bank took the money, we will not keep quiet. Now we will start asking money from Shalini. So Shalini again becomes a debtor. Shalini account debtor to debited to bank. Clear? If bill was endorsed. If bill was endorsed, it was endorsed to Dinesh. Dinesh will go and ask the money. Dinesh will go and ask the money. But Dinesh did not get the money. When Dinesh does not get the money, what will Dinesh do? When Dinesh does not get the money, what will Dinesh do? Dinesh will ask Sriram. So Dinesh becomes creditor for us. And we will ask Shalini. So Shalini becomes debtor. So debtor account debited to creditor. This will be the situation. Now, understand this. In the books of drawee, that is Shalini, whatever happens, if bill is dishonored, finally the drawer will come and ask you money. So bills payable account debited because bill is gone. It is dishonored. Okay, to Sriram. We have to make payment to Sriram. So Sriram becomes a creditor again. Is this clear? So what you have to understand, if you have to think of a tip, bill dishonored, always in the books of drawer, debit will be drawee only. Can you see? Debit will be drawee only. All the cases debit is drawee. Okay, Shalini debited, Shalini debited, Shalini debited. If the bill was in your pocket, credit bills receivable. If bill was with bank, credit bank. If bill was with endorsee, credit the endorsee. But in the books of drawee, always bills payable account debited to drawer or Shriram in this case. Clear? Yes. Next we'll go into a topic called as noting charges. Okay. What is noting charges? Noting charges is basically amount paid to notary public for noting the fact of dishonor. Now, it is dishonored, right? Now you have to go and file a case now in the court. When you go to court and file the case, the judge will be like, wait, first of all, I don't trust anybody properly. You go and tell the lawyer you go to the lawyer and tell him that it is dishonored. He will confirm the fact that it is actually dishonored. Then you come to me, and otherwise don't come to me and waste my time. So when you go to court, first you have to go to notary. Notary public is a lawyer. For noting the fact of dishonor, what he will do? He will go and tell, sir, the due date is over, sir, I didn't get the money only, that fellow did not make the payment. So that fellow will tell, okay, give you all your bank statement and all, I will check in your bank, okay, whether that fellow has made payment or not paid, okay, confirm that he did not pay. Now what he will do? On that bills receivable, on this bills receivable, he will write dishonored. He will write dishonored and he will sign. When the lawyer signs, that time what happens? Lawyer is confirming that it is actually dishonored. Okay. Now, if bill was held means what? Bill was with you only. If bill was with you, okay, who will go to lawyer? You will only go to lawyer. So for you, noting charges account debited to bank. Obviously, bank lawyer is not your uncle. No, lawyer will charge some money. So for you, that is an expense. Noting charges account debited to bank. You paid lawyer's fees. Now, paying lawyer's fees, is it because of your fault? No, it is because of Shalini's fault. So what you will do now? You will be like, because you did not pay on time, I had to go to lawyer also. Sorry. So you pay me the bill amount. You pay me the bill amount. Plus you pay me the lawyer's charges also. So now what happens? Shalini account is debited because again we are making Shalini a debtor to noting charges. Otherwise, expenses usually get transferred to P&L. We don't want to transfer this expense to P&L because it is not my expense. Okay, I have to get this money back from Shalini. So Shalini account debited to noting charges. Shalini account debited to noting charges. Is this clear? Yes, this should be the situation. Next, what will be the entry if bill was discounted? If bill was discounted, who will go to the notary? Who will go to the lawyer? Bank will go to the lawyer. Bank will make the payment, but bank will take the money from me. So Shalini account debited to bank. That means bank took the money from me. I will ask the money to Shalini. So Shalini account debited to bank. Clear? If bill is endorsed, that means who will go to the notary? The Dinesh will go to notary. Dinesh will ask me money. I will ask Shalini money. So Shalini becomes debtor. So debtor debited. Dinesh becomes creditor. So creditor credited. Is this clear? Okay. Now in the books of Shalini, whoever comes and asks money, she has to pay. So noting charges account debited to Sri Ram. Noting charges account debited to Sri Ram. Noting charges debited because it is an expense. Sri Ram is credited because we have to make the payment. So Sri Ram is a creditor. Sri Ram is a creditor. Okay. And then expenses are transferred to P&L. So P&L account debited to noting charges. Can you see whose expense it is? Shalini's expense. Because Shalini's mistake, that is why that other people have ended up paying. So other people will recover the money from Shalini and Shalini will consider it as expense in her P&L. Is this clear, guys? This is the concept of noting charges. Next we go into renewal of the bill. Renewal of the bill means what? Person is good, time is bad. Renewal of the bill means what? Person is good, time is bad. That means person wants to make the payment, but person does not have the money. Okay, so what happens that time? Renewal of the bill, cancellation of old bill and new bill drawn and accepted. Old bill is cancelled and new bill is drawn and accepted. Clear? So what happens in renewal situation? Shalini will go to Sriram and tell, see Sriram, I want to make the payment, but I don't have money today. So you do one thing. Okay, I don't have money today. So you do one thing. Okay, we'll cancel this old bill. You give me more time. New bill you draw. You give me more time. Okay. Now, for cancelling the old bill, what should be the entry? Cancelling the old bill. Cancelling old bill means exactly dishonor only. Dishonor entry only. So, Shalini account debited to bills receivable. Clear? What will Shalini do? Bills payable debited to Sriram. Just like what we learned, no dishonor entries, we will pass the same dishonor entry. Okay, now new bill is drawn and accepted. New bill is drawn and accepted. So see, first time this fellow trusted her. Okay, she did not make the payment. Now again, when you are giving extra time, do you think you'll just give extra time like that? No, you will tell, okay, I will give you 2 more months time, but I have to get interest. I will give you 2 more months time, but I have to get interest. So interest, two things. Sriram can be telling that, okay, you do one thing, I'll give you 2 more months time, you have to give me interest today. Or I'll give you 2 more months time, when you pay after 2 months, you have to pay along with interest. So either the interest is paid now or new bill will be with the interest. Okay, either you are going to pay interest now or you are going to have new bill with the interest. Okay, so now what happens? If at all interest is paid now, interest is paid now, so Sriram will receive the interest. So cash or bank account debited to interest account. Sriram will receive the interest. For Sriram, interest is an income. So interest account debited to P&L account. Interest account debited to P&L account. Clear? Then the new bill will be same. Bills receivable account debited to Shalini. New bill will be 50,000 only because interest is already paid. New bill account debited to Shalini. Okay. If interest is, okay, understand this. If interest is paid for Shalini, interest is what? Expense. So interest account debited to cash or bank. Interest account debited to cash or bank. Okay. Interest is an expense. Expense is transferred to P&L. P&L account debited to interest account. P&L account debited to interest account. Now what will Sriram do? What will Sriram do? Draw a new bill. Shalini will accept it. So Sriram account debited to bills payable. First, what we did entry when bill was drawn and accepted, that is the entry over here because old bill is cancelled. Old bill is cancelled over here. Interest amount is paid by Shalini to Sriram. This fellow receives the interest, transfers it to P&L as income. This person pays the interest and transfers it to P&L as expense. Clear? Now, new bill with interest. That means I'm not going to pay the interest today. I'll pay the interest to you in future only, but we are following accrual concept. We are following accrual concept. So what this person will do, will pass an entry, Shalini account debited. Why Shalini account debited? Because Shalini has to give me interest. Shalini has not given interest. So Shalini becomes debtor for that interest of 200 rupees. And interest account is credited because interest is income. And interest is transferred to P&L. Okay. And then what happens when you draw the new bill? You will not draw the new bill for 50,000. You will draw the new bill for 50,000 plus 200. 50,200. That means new bill will be with interest. New bill will be with interest. So 50,200. Bills receivable account debited to Shalini. To Shalini. Now from Shalini's angle you think, I have to pay interest, but I have not paid interest. Interest account debited to Sriram. Interest account debited to Sriram. And then P&L account debited to interest. Interest account debited to Sriram and P&L account debited to interest. Clear? Then Sriram account debited to bills payable. Sriram account debited to bills payable. Is this clear? So what's happening over here? Sriram debited to bills payable. That means new bill is drawn and accepted. But can you see it is 50,200. 50,200. This is the concept of renewal of bill. Renewal of bill. Now we go into retirement of bill. That means in renewal of bill, what happened? That person could not pay on time, asked for more time. Retirement of bill means what? The person has money, doesn't want to wait for 3 months, will pay within 2 months itself. Bill closed early by drawing. Bill is closed early by drawing. When that person was paying late, you told, no, boss, pass interest. Now when the person is paying early, don't you think that person will ask for a discount? I am paying early, boss, give me discount. This is called as cash discount. But here the word we are going to use for discount is rebate. The word we are going to use is rebate. So now Sriram will not get full amount, rebate of 500. That means discount of 500. For Sriram, discount is actually an expense. So bank account debited, rebate account debited to bills receivable. Bank account debited, rebate account debited to bills receivable. Amount came but not fully. So what you did not get is an expense, loss. Shalini, she's going to make the payment, but not full amount. So bills payable gone, okay, to bank, not full amount. What she is not going to pay, for her, it's like a discount received. So it is credited. This is income for this person and this is expense for this person. Is this clear, guys? Yes, this is the situation. Now, we go into bills for collection. Bills for collection. Now, bills for collection. Bills for collection means what? Okay, as a drawer, no, I have too many bills. I can't keep track of all the due date, again make call, collect the amount and all that. That is a big headache for me. So what I will do, bills are sent by the drawer to bank for collection. I'm giving all the bills to the bank and telling them, you keep track of all the bill. Whenever money comes, you put into my account. If money does not come, inform me. That's all. You're giving bank one job to collect the bill. Okay, bank will charge bank charges. Obviously, bank will not do the work for free. Bank will charge some bank charges. No entry in the book of drawee. Drawee, I told you, no. On the date of payment only, we'll go to drawee. Before that, drawee is not bothered at all. Drawee is not bothered. Whatever you want, you do with the bill. Okay, bill sent for collection. I sent the bill for collection. So my bills receivable went, and a new terminology comes: bills for collection account debited to bills receivable. Bill has gone from my pocket. That means bills receivable is gone, but bill is gone to bank for collection. So bills for collection account debited to bills receivable. Amount received. Amount is received. So now what will you do? Bank account debited to bills for collection. Amount is received. So bank account debited to bills for collection. Clear? Now, amount not received. If amount is not received, then what you are going to do? Drawee account debited. Because that person has to give you. Remember that time, whenever amount was not received, you were writing Shalini. So drawee account debited to bills for collection. Drawee account debited to bills for collection. This is one more topic. Small topic. If at all they ask, you should be able to answer. Clear? Accommodation of bill. Very important topic. They always can ask questions from this. In the last two attempts also, there are questions which we are going to look at. Okay. Accommodation of bill means what? Remember, when did that bills of exchange topic started? Sriram sold goods to Shalini. Accommodation of bill means nobody sold goods to anyone. Nobody has sold goods to anyone. What has happened is there no transaction between these two. But Dinesh and Pinky, two people are there. Dinesh and Pinky, both of them require money. Both of them require money. So what they do, they make a plan. Dinesh draws a bill for 50,000 on Pinky. Dinesh will draw a bill on Pinky for 50,000. Okay. Pinky will accept the bill and give to Dinesh. Pinky will accept the bill and give to Dinesh. See, this is just running on trust. Both of them are running on trust. One person draws the bill. No transaction has happened. One person draws the bill and tells, you accept it and give it to me. I will give you money. Wait. Okay. Dinesh then will go to bank. Dinesh will discount the bill with the bank. Bank will not give full amount. Bank gives 48,000. Bank gave 48,000. Now the amount comes to Dinesh. What Dinesh will do? Dinesh will share the money with Pinky. When the amount comes to Dinesh, Dinesh will give amount to Pinky and both of them will share the money. Both of them will share the amount. See, amount will be shared. Did you understand? Dinesh draws bill on Pinky. Pinky accepts it. Dinesh takes the bill, immediately goes to bank, discounts it, gets the money. Full amount is not received but gets the money. That amount is shared. Amount is shared 24,000 Dinesh, 24,000 Pinky. Sir, always it should be 50-50. Yeah, no, it is about their understanding. Clear? Here it is, in this example, it is 50-50. Okay. So on due date, who is supposed to pay? Pinky is supposed to pay to bank. On the due date, Pinky is supposed to make the payment to bank. Bank will ask for 50,000 rupees. But Pinky got only 24,000 rupees. So therefore, on due date, what will happen? Dinesh will return his share to Pinky. Dinesh had 24,000. Dinesh has to return his share to Pinky. But when he's giving the share back, now not only the amount shared, even the discounting charges was there. No, 50,000 bill, you got only 48,000. That means 2,000 is the discounting charges. 2,000 discounting charges. This also is going to be shared by Dinesh and Pinky. In what ratio? In the same ratio in which amount was shared. Amount was shared in the ratio 1:1. Discounting charges also will be shared in the ratio of 1:1. Is this clear? Okay. So on due date, Dinesh will make the payment. Dinesh is not Dinesh is supposed to make the payment to Pinky. What is the share of each person? Amount shared plus share of discounting charges. What is the share of each person? Amount shared plus share of discounting charges. So Dinesh to Pinky, what will happen? 24,000 plus 1,000 share of discounting charges, 25,000 he will pay. 25,000 when you give to Pinky, Pinky had already 24,000 with her. So 25,000 plus 24,000 plus Pinky will put 1,000 from the pocket and it will become 50,000. It will become 50,000. Okay. So now this note is very, very important, guys. Focus on this note. Discounting charges to be shared in the same ratio in which amount is shared of the bill. In what ratio you share the amount, same ratio you are going to share the discounting charges. At the end of the question, one more thing is, at the end of the question, always prepare ledger of the drawer or drawee. Prepare the ledger of the other party to find out the amount payable or receivable. When you prepare the ledger only, you will get to know how much amount is pending or how much amount is receivable. Clear? This is the concept of bills of exchange. Now what we will do, we'll go into the past examination questions of bills of exchange. Okay, first question is December 2024, question, 7 marks question. Okay, in December 2024, I think this should have been June, I think. June 2024, 2 questions we have which we have to discuss. Bills of exchange. Indra drew upon Chandra a bill for 90,000. Always in bills of exchange questions, no, go to the end of the question. Go to the end of the question. On 1st April 2024 for 3 months for mutual accommodation. Okay, always when we are going to solve these kind of problems, right? Bills of exchange, you are required to look at the ending. You are required to pass journal entries in the books of Indra. So always look at the ending and start your solution like this. Journal entries in the books of Indra. Journal entries in the books of Indra. Get ready. Okay, and then read the question part by part. Indra drew on Chandra. Indra, you are Indra now. Indra drew on Chandra a bill for 90,000 on 1st April for 3 months for mutual accommodation. Chandra accepted and immediately on receipt, that person has accepted it. Okay, so now for Indra, Indra has drawn the bill. So it is bills receivable account debited to Chandra's account. Bills receivable account debited to Chandra's account. Clear? Now what happens? On April 4th, 3 days later, Indra got it discounted at 6% per annum and remitted 1/3 of the proceeds to Chandra. Okay, on April 4th, Indra got it discounted at 6% per annum. How many months bill was this? 3 months bill. Okay, so now understand this. Bank account debited. Discounting charges will be how much? 90,000 is the bill amount. 6% per annum. 3 months is the duration here. 3 by 12, you get 1350 as the discounting charges. Out of 90,000, if 1350 is not paid, 88,650 is what you are going to get. Okay, 2 bills receivable, 90,000. You discounted the bill, you got the money, but not full amount. Okay, now 1/3 of the proceeds you are giving to Chandra. 1/3 of the amount you are going to give to Chandra. So now what happens? Chandra share is 1/3. Chandra's share is 1/3 of the amount and 1/3 of the discounting charges also. So you are going to write Chandra account debited to bank 88,650 into 1/3. 88,650 is the amount that you got. 88,650 into 1/3. Okay, 29,550, and also the discounting charges which is there 1350 into 1/3. That also 1/3. Clear? So amount also 1/3 we are going to put on Chandra's head, and discounting charges 1/3 also we are going to put on Chandra's head. Is this clear? Yes. Next, at maturity, Indra was not able to send the required sum and asked Chandra to receive a 2 months promissory note for 60,900, which Chandra did. What happened over here? Now, on the maturity date, Indra has to give the money, no, because Chandra has to make the payment. Now understand this. Indra drew bill on Chandra. Chandra accepted it and gave to Indra. Indra went to bank and discounted it. And whatever money bank gave, little money Indra has given to Chandra. So on due date, Chandra has to make the payment. On due date, Chandra has to make the payment to bank. But Chandra did not get the full amount, no. So to make the payment, Chandra has to get the share from Indra as well. But Indra was not able to send the required sum. Indra could not give. That day Indra did not have. So he told Chandra, do one thing, you give me a promissory note. I will give you a promissory note that I am going to make the payment. Okay, promissory note is just like bills payable. So now what happens? Can you see over here? Chandra account debited to promissory note. Instead of writing bills payable, we are writing promissory note 60,900. 60,900. Clear? Now, Chandra got the note discounted for 60,000 and met his acceptance. Chandra, what he did? He got the note discounted with the bank. Who got it discounted? Chandra. Who are you? Indra. So you don't have to bother about any journal entry. Indra became insolvent and just before his promissory note was due for payment, Indra became insolvent. That means this promissory note bounced. So now what happens on the maturity date? Promissory note account debited. Okay, bills payable we used to write. Now promissory note account debited to Chandra's account. 60,900. Clear? Now, only 25% was recovered from his estate. Now you have to find out. See over here, discounting charges. Account debited to Chandra. What is this, sir? Discounting charges. See, Chandra, when he discounted 60,900 bill, he got only 60,000. No. So 900 rupees is discounting charges. That has to be shared. No. 1/3, 2/3. Okay. That time we gave 1/3. 1/3 was Chandra's share. 2/3 is Indra's share. So 2/3 discounting charges account debited to Chandra. We have to give that 600 rupees also to Chandra. Clear? Now, finally, what happens? Chandra, we have to check. I told you, end we have to do the ledger. When we do the ledger, all the journal entries which we have written, we are going to post. We get a difference of 60,600. That means credit balance is there. Credit balance means what? We are supposed to make payment. Credit balance means we are supposed to make payment 60,600. 60,600 when you are supposed to make payment. Okay. How much you are able to make? You are able to make only 25,000. 25,000 only you are making. So Chandra's account debited for 60,600. What you are going to pay to bank account 25%. What you are not going to pay to deficiency account 45,450. What you are not going to pay to deficiency account 45,450. Is this clear, guys? Any doubt with this? Okay, this should be it. Okay, finally you have to prepare ledger to find out whether you are supposed to pay money or whether you're supposed to receive money. Okay, whenever you are not going to get money, that is called as bad debt. Whenever you are not able to pay money, it is called as deficiency. Yes, that should be it with that particular examination question. Let's go into the next question, which was asked for 7 marks. On 1st July, G drew a bill of 80,000 for 3 months on H for mutual accommodation. So always in these kind of questions, go to the end. Give necessary journal entries in the books of H. Give necessary journal entries in the books of H. So straight away we start our solution and we write in the books of H. In the books of H. Clear? Now you are going to write date, particulars, LF, debit, credit. Date, particulars, LF, debit, credit. Now don't read the question fully. Just see the ending. Whose books? Now it is H. So remember that you are H. Surround everything around H. Whatever is happening in H books, you are going to pass the entry. So first you are going to go into the question. G drew a bill of 80,000 on H for mutual accommodation. H accepted the bill. Who are you? You are H. So somebody drew a bill on you and you have accepted it. So you are going to pass the entry. G account debited to bills payable. G account debited to bills payable 80,000. G's account debited to bills payable 80,000. Clear? Next. G had purchased goods worth rupees 81,000 from J on the same date. Who purchased goods? G purchased goods. But who are you? H. Ignore that. No entry for this one. Okay, because you are H. You don't have to bother. G endorsed H's acceptance to J in full settlement. You had given bills payable to somebody. That fellow has endorsed it. I am not bothered only. I am not bothered only. Okay. Remember, when endorsing and all, drawer will be worried. But drawee, nothing. No entry. Okay, on 1st September, J purchased goods worth rupees 90,000 from H. 1st September, J purchased goods from H. We are only H. So you're going to pass the entry. J's account debited to sales. J's account debited to sales. Clear? Next, J endorsed the bill of exchange received from G to J and paid 9,000 in full settlement. Now understand this. G is there, H is there, okay, and there is a new person called as J. G drew a bill. G draws bill. H accepts the bill. And this bill was for 80,000. What did G do? G endorsed the bill. G endorsed the bill to J. Okay, endorsed the bill to J. What did J do now? J has purchased goods. No, H sold goods to J, sales. So what J did, this bill which is there, which he got, he just endorsed it back to H. Can you see? J endorsed the bill of exchange received from G to H and paid full. It is our own bill, no bills payable. My bills payable came back into me itself. So now what happens? See this, bills payable account debited 80,000. Now, but amount which we sold goods was 90,000. So what they did, 9,000 they gave, 9,000 in full settlement. So bank account debited 9,000. 1,000 they did not give, and they use the word full settlement. Whatever they do not give or whatever we do not pay, that is called as discount. Here I am not getting 1,000 rupees, discount account debited. Expense for us or loss for us to J's account. Clear? Next, what happens after that? On 1st October, H purchased goods worth rupees 1 lakh from G. H purchased goods. So now what we are going to do? Purchases account debited to G. Your H. So purchase account debited to G. H paid the amount due to G by check. H paid. Whatever amount is there, H has paid. Now how will you find out how much is the amount? You have to go and prepare the ledger. You have to go and prepare G's account. Post all the transaction. Purchase, one bills payable, balancing figure will be 20,000. So they said H is going to make the payment. No bad debt, deficiency, nothing. H is going to make the payment. So the entry will be G's account debited to bank. G's account debited to bank. End of story. So two questions which they have asked in the recent exams also, both are mutual accommodation. So mutual accommodation becomes very, very important. Is this clear, guys? Yes. Okay guys, let's go into the next topic, that is consignment. In chapter number 2, we have 3 topics: bills of exchange, consignment and joint venture. So we finish bills of exchange, we'll go into the next topic, that is consignment. Consignment, what happens? We have one person called as Dinesh. Okay, he is doing business in Chennai. He wants to do business even in Mumbai, but in Mumbai he does not know anyone. He cannot go and sit in Mumbai. So what he will do, he'll hire one agent in Mumbai. He'll have an agent in Mumbai, and that agent is called as, okay, consignee, and the person who is sending is called as consigner. Okay, selling, imagine this person is selling coriander leaves or something, whatever he is going to sell. Okay, this person is going to send the goods to Bambani, a person called as Bambani in Mumbai, and Bambani is going to be the agent and Dinesh is going to be the principal. Bambani is going to be the agent and Dinesh is going to be the principal. Okay, now owner of the goods. Who is the owner of the goods? Dinesh is the owner of the goods. Dinesh is called as consigner and Dinesh is the owner of the goods. Goods are sent. Stock is in consignee's godown. Goods are sent. Now where is the stock sitting? Stock is sitting in consignee's godown. Still the owner is Dinesh only. Consigner itself is the owner. Till the goods are sold by consignee. Till the goods are sold by consignee, the owner will be Dinesh itself. So ownership transfers when goods are sold by consignee. Ownership transfers when goods are sold by consignee. Clear? Yes. Now, consigner sends goods to consignee. That means sends one pro forma invoice. We cannot send invoice. Why? Invoice is when the ownership is transferred. They are going to send only the pro forma invoice. That means goods are transferred to you. Consignee, what they will do? Consignee, when the sales happen, they will maintain the records and they will send something called as account statement. They will send something called as account statement. And when consignee is going to sell the goods to customer, that time invoice will be given by consignee. Consignee will give the invoice to the customer. Is this clear? And details, what will this account statement have? All the details of the transactions done by consignee. This is the documentation which you have to remember. You can also get this in MCQ. So what happens? Consignor will send the goods, but when sending the goods, he will not write invoice because we are just transferring goods, not a sale. Okay, sends pro forma invoice. When consignee is selling to the customer, that time the invoice will be given to the customer. And for telling the consignor what and all I have done, how much I have done, okay, they will send one account statement. One account statement will be sent by consignor. Is this clear? Okay. Now, sorry, account statement will be sent by consignee, not consignor, consignee. Closing stock on consignment. This is a very important calculation. Closing stock on consignment. Now try to understand, if consignor is sending the goods, first he will put the goods into a truck, carriage, then that will go into a boat, freight and insurance will be there. Then it will reach the port. In the port you have to pay government duty. You have to pay duty to the government, and then again it will go into one truck, again carriage. Finally it will reach the godown of the consignee. It will reach the godown of the consignee, and in the godown of the consignee they have to pay rent, salary, electricity, all that has to be paid. Rent, salary, electricity and all has to be paid. Correct? Now closing stock, when we are calculating, where is the stock? In the godown of the consignee. Godown of the consignee. All the expenses. First the stock which is there plus carriage, this, everything that you have spent for it to reach till there, all the expenses will be added. All the expenses will be added when you are calculating closing stock. And this closing stock is sitting in the godown of the consignee. It's sitting in the godown of the consignee. But who is the owner of these goods? Consignor. Who is the owner? Consignor is the owner. Because consignor is the owner of the goods, that is why closing stock will be calculated in the books of consignor. That's why it's called as closing stock on consignment, consignor's books. Clear? Okay. Closing stock on consignment. See how we are going to calculate. Cost or invoice price of the goods. Whether it is sent at cost or invoice price, you're going to take the value of the goods plus share of non-recurring expenses. Share of non-recurring expenses means what? Expenses incurred till it reaches the consignee. That's what I told. This one, this one, this one, this one. Till it reaches the consignee. Those expenses you are going to add. Rent, salary and electricity will happen again and again. These are called as recurring expenses. This will not be added when you are calculating closing stock. Clear? Okay. Abnormal loss is avoidable loss. Abnormal loss, something when we are transferring in during transit and all, goods can get lost. No, it is not under our control. So now goods are in transit, goods are in godown. Two places it can get lost. When it is going on the way only it got lost, or after it reached the godown, there it got lost. Now abnormal loss, understand this. Value of stock lost. How much stock you have lost? Calculate the value of that. You know the cost or invoice price will be given. Now share of expenses till the point where goods are lost. Share of expenses till the point where goods are lost. Now understand this. If the goods are lost in the ship, then what will you do? You will add the carriage also to abnormal loss. You will add the ship expense also, because after that we have not spent anything. If goods are destroyed in the port, then you will add this and the duty you are going to add. If the goods are lost over here, then you are going to add this and this you are going to add. If goods are lost in the godown of the consignee's godown, if it is lost, now you have to add everything till it reaches the godown. Okay, so what we were discussing was abnormal loss, guys. If at all abnormal loss has happened anywhere, okay, then you have to add the expenses till that particular point. If abnormal loss has happened in the godown, then you have to add all the expenses that you have incurred till the goods have reached the godown. But this rent, salary, electricity, the non-recurring expenses are there, no, that you are not going to take. Clear? Abnormal loss, avoidable loss. Okay, now understand this. Share of expenses till the point where goods are lost. Till the point where goods are lost, you are going to add all the expenses. Now let's go into accounting. Accounting in the books of consignor. We'll focus on consignor. Goods sent on consignment. Goods are sent on consignment. Okay, what should be the entry? If it is at cost, we will discuss first. Consignment account debited to goods sent on consignment. Consignment account is debited because it's an expense, and goods sent on consignment is credited, and this goods sent on consignment will be transferred to trading account. So in trading account, what happens? You have purchased goods, okay, but you did not use it. You sent it on consignment. Buy goods sent on consignment. Clear? Now, if it is sent at invoice price, invoice price means what? Cost plus profit. You are adding the profit only and sending it to the consignee. Then the entry will be consignment account debited to goods sent on consignment. This will be at invoice price. But immediately what we should do, because it is at invoice price, we should remove the loading effect, reverse the profit, record it first at the invoice price itself, then reverse the profit, goods sent on consignment account debited to consignment. You just pass the reversal entry, goods sent on consignment account debited to consignment. This is for the profit portion. Expenses of consignor. Consignor has spent some money. All this accounting is in the books of consignor. Consignor's expense should be debited to consignment account debited to bank account. Consignment account debited to bank account. Expenses of consignee. Consignee has spent money. That means we have to give the money, because consignee's job is only to sell the goods. That's all. No money has to go from consignee's pocket. Consignment account debited because it is expense to consignee's account. Consignment account debited to consignee's account. Why are we crediting consignee? We are crediting consignee because consignee has to be paid. We have to give the money back to consignee. Okay, cash sales by consignee. Cash sales. Cash sales, they have sold goods. Did they give you money? No. Consignee has to give money because money belongs to consignor. Consignee account debited to consignment. Why consignment account is credited? Because it is income. Why consignee account is debited? Because consignee becomes debtor. They have to give money. Credit sales by consignee. Credit sales by consignee. Consignee account debited to consignment account. Again, same thing. Consignee has to give us money. For consignment, it is credit because it is income. Amount sent by consignee to consignor. Amount is sent by consignee to consignor. Consignee sent money to us. So, bank account debited to consignee account. Bank account debited to consignee. Amount sent by consignor to consignee. That means we have sent amount to them. Consignee account debited to bank account. Consignee account debited to bank account. Abnormal loss. What should be the entry? Abnormal loss account is debited because losses are always debited to consignment account. Remove it from consignment account. Then P&L account debited to abnormal loss. Transfer that abnormal loss to P&L. Remove from consignment and transfer it to P&L. Closing stock. Closing stock. Closing stocks is always an asset. Asset should be debited. Consignment closing stock account debited at invoice price or cost. Then to consignment account. To consignment account. Opening stock, what we will do? Consignment account debited. Opening stock will always be on the debit side. Consignment account debited to consignment opening stock. So closing stock is credited to consignment account and opening stock is debited to consignment account. Okay, guys. Stock reserve. Stock reserve means what? Unrealized profit. We will see it in multiple places, the stock reserve concept. Stock reserve means unrealized profit. When goods are sent at invoice price. Okay, we sent the goods at invoice price. 100 plus 20. I have sent the goods at 120. Okay, and closing stock is there in the consignee's go down. I added profit and sent to consignee, but consignee has not yet sold it. I added profit and sent to consignee, but consignee has not yet sold it. So in that case, what happens? Okay, in that case, what happens? It becomes closing stock. Okay, but closing stock includes the profit also. If closing stock includes the profit, what are we going to do? If closing stock includes the profit, is it realized profit or it is unrealized profit? It is called as unrealized profit. Closing stock includes the profit, but we did not earn that profit yet. We did not earn that profit yet. Therefore, it is unrealized profit. Understand this. Consignor sends goods to consignee at invoice price. Consignor sends goods to consignee at invoice price and it is sitting in the stock of the consignee at invoice price. That time you will have to pass an entry for stock reserve. Closing consignment account debited to stock reserve account. Consignment account debited to stock reserve account. Okay, this is the situation. Now, last year also they would have done no stock reserve calculation for last year's closing stock. So now that is this year's opening stock. So we have to reverse the stock reserve. Stock reserve account debited to consignment account. First, what we are going to do? Consignment account debited to stock reserve. Then stock reserve account debited to consignment. Consignment account debited to stock reserve and stock reserve account debited to consignment. Commission, guys. Commission. Okay. Now commission payable to consignee. Commission is payable to consignee. Now there are multiple types of commission. First one is called as normal commission. Normal commission means what? Bad debt is the loss of the consignor. Normal commission, you sell, I will give you commission. If there is bad debt, you don't worry, it is my loss. Consignor's loss. Sales into percentage directly. Del creditor commission, that means I will give you extra commission, but bad debt is the loss of the consignee. That means you sell, but if you are not able to collect the amount that you sold, I am not responsible. Bad debt is the loss of the consignee. Again, sales into percentage. Overriding commission, that means up to one level I will give you normal commission, but if you increase the sales, then I'll give you extra commission. So normal sales into normal commission percentage plus excess sales into excess commission percentage. So normal up to one level you are getting normal commission. If you do more, then you will get excess commission. Okay. Now profit on consignment. If you have profit on consignment, it will be transferred to P&L. If it is loss on consignment, it will be debited to P&L. Consignment account debited to P&L, P&L account debited to consignment. This is how you are going to record the profit or loss on consignment. Okay. In the books of consignee. Now consignee's books we have to worry. Goods sent to consignee. No entry. Not my goods. No, his goods is just sitting over here. Goods returned by consignee. Again, no entry. Expenses paid by consignor. Consignor paid the expense. Why should I be bothered? No entry. Expenses paid by consignee. Consignee has paid. Now there should be an entry. Consignor account debited to bank. I paid the expense on. I'm just the agent. I paid the expense on behalf of the consignor. So consignor has to give me money. So consignor account is debited. Okay. To bank account. Sales. Cash sales. You got money? Yes. Bank account debited, but it is not your money. You are supposed to give it to consignor's account. Credit sales. Credit sales. Okay. Customer account debited because customer has to give you money to consignor because you are supposed to give the money to consignor. Amount received. When you receive the amount, if it is del creditor commission, okay, or if there is no del creditor commission, whichever commission it is, when you receive the amount, bank account debited to customer. Bank account debited to customer. Bad debts. When we are talking about bad debts, guys, del creditor commission is there. If del creditor commission is there, bad debt is the loss of the consignee. Then commission account debited. Commission account is debited because commission is an income. Commission is an income. Commission account debited, okay, to customer. That means because it is my loss, my commission, what am I getting? I will get it, but it will reduce this bad debt will reduce my income. No del creditor commission, then consignor account debited because consignor is going to pay you to customer. Consignor account debited to customer. Is this clear? Finally, we have commission. When you are supposed to get commission, for you commission is an income. Consignor is supposed to pay the commission. Consignor account debited to commission income account. Amount sent by consignee. We are sending the money. To whom we are sending? Consignor. Consignor account debited to bank account. This is the concept of consignment. This is the concept of consignment. Now let's go into one examination question and see how they have asked questions. Okay, question number 11. Go to the end of the question. You are required to show the consignment account, Jatin's account and loss in transit account in the books of Kush. So we have to be in whose books? In the books of Kush. In the books of Kush. Okay. Now what we are going to do in the books of Kush? Kush of Kanpur sent to Jatin of Jaipur. You are Kush sent to Jatin of Jaipur consignment of 400 electric sewing machines costing 24,000. Invoice price is 30,000. So what should be the entry? Consignment account debited because it's an expense. Consignment account debited to goods sent on consignment. Can you see? 400 into 30,000. 400 into 30,000. Goods are sent at invoice price. Immediately what should you do? Reverse the profit. So you'll write buy goods sent on consignment. 400 into 6,000. Why 6,000? 30,000 minus 24,000. This gives you 6,000. 24 lakhs. Is this clear? Now after that, what you are going to do? Kush paid freight and insurance of 96,000. Kush paid Freight and insurance of 96,000. Okay, Kush is you only. So you're going to write consignment account debited to bank account. Consignment account debited to bank account. Next. Jatin spent 31,200 for clearance and all selling expenses were 1,500 per machine as and when the sales were made by Jatin. Okay, now he spent 31,200. What should be the entry? Consignment account debited 31,200 to Jatin's account. Can you see consignment account debited to Jatin's account? Is this clear? Consignment, it is an expense. Jatin has paid, so we have to pay the money back to Jatin. Next. In transit, 10 sewing machines were stolen for which insurance company paid 1,85,000 in full settlement to Kush. Abnormal loss. Abnormal loss. We have to calculate the abnormal loss. How many machines are sold? 10 machines were stolen for which insurance company gave. Okay, 10 machines are stolen. 10 machines into 24,000. Cost of the machine was 24,000. 2,40,000 you lost. Okay, what is the expense? Where is it lost? In transit. Okay, so 96,000 was the transit and insurance. So 96,000. Sir, what about this 31,200? 31,200 is clearance. Once it reaches only, it will clear. Before reaching only, this was lost in transit. So 96,000 into 10 divided by 400. 10 boxes only, 10 machines only are lost. 10 out of 400 machines. So 10 divided by 400, 2,400. 242,400 is your abnormal loss. Abnormal loss. So what should be the entry now for abnormal loss? Okay, now understand this. Abnormal loss account debited to consignment account 242,400. Abnormal loss account debited to consignment account 242,400. Is insurance company giving you something? Yes, insurance company is giving you 1,85,000. Bank account debited to abnormal loss 1,85,000. Balance amount which no one is going to give you, it's a loss. Loss should be transferred to P&L. P&L account debited to abnormal loss 57,400. 57,400. Is this clear, guys? Okay. Now let's go further into the question. Jatin sold 210 sewing machines at 32,000 per sewing machine and 130 sewing machines at 35,000 per sewing machine. So 210 and 130, totally 340 machines are sold. 340 machines are sold into, okay, what is the selling expense? 1,500. So 340 into 1,500, 5,10,000 they are spending as selling expense. So we have to pass the entry for that. Okay, consignment account debited to Jatin's account 1,500 into 340 machines. So consignment account debited to Jatin's account 5,10,000. Okay, next after that, what is happening? Jatin was entitled to a commission of 5% on the total sales value plus 1/4 of the amount by which the gross sale proceeds less total commission thereon exceeds the invoice price. Okay, overriding commission is also there. Overriding commission, let's calculate the commission. Now, see this. Our sales is how much? First we'll record the sales. First we'll record the sales. Okay. Now, sales. Did we show the calculation for sales? Okay, no. So, how we are going to calculate the sales, guys? 210 machines are sold for 32,000. 210 into 32,000 is equal to 210 into 32,000. So 67,20,000. And then 130 machines are sold for 35,000. 130 into 35,000. That makes it 45,50,000 plus 67,20,000. 112,70,000. 112,70,000. Can you see the sales here? Jatin's account debited to consignment account. Jatin's account debited to consignment account. Okay, now you have to calculate the commission. Commission, you see, 112,70,000 into 5%. What, sir? 5%. What 5% are you talking about? 5% on total sales. Array. Where is it? Okay, sorry. 5% on total sales. So 5% on total sales will be 5,63,500. 1 into 5%, 5,63,500. Invoice price of the machine sold. What is the invoice price of the machine sold? 340 into 30,000. 340 into 30,000. 30,000 was the invoice price. 1 lakh, 1 crore, 2 lakhs. So can you see something extra we are spending? I mean, we sold at not spending. We are selling it at an extra value, higher value, higher value. Excess sales is this. From excess sales, please remove the commission 563. That time you will get this. So 25%. Okay, before charging, after charging, same logic. 25 by 125. When you do 25 by 125, you will get 101,300. This is your commission. This is called as excess commission. 101,300 excess commission. 563,500 normal commission. So 563,500 plus 101,300, you will get total commission of 664,800. 6,64,800 is the commission. So what should be the entry? For commission, what should be the entry? Okay, we are going to give the commission, so we are going to pass the entry. Okay, we are going to pass the entry. Consignment account debited to Jatin's account. Consignment account debited to Jatin's account. Sir, we didn't understand that excess commission. Okay, sir, listen, sir. Okay, now understand this. Total sales is this much. 5% commission, normal commission. Done. Invoice price of the goods was what? 30,000. Okay, so this is the amount. You should have sold at this, but you sold at higher value. And here they have told specifically, okay, plus 1/4 of 1/4 is 25% of amount which the gross sale proceeds less total commission thereon exceeded the invoice price. What it exceeds the invoice price. So now what you're going to do? 112,70,000 minus 102 lakhs. Okay, 10,70,000. 10,70,000 minus, remove this commission already we calculated. This is the excess that is there. 25 by 125. You'll get 101,300. Add the two commissions. That's your commission. That's the end of the story. Okay, guys, let's go further. Final amount due was settled, they said. Final amount due was settled. Okay. Now, if you look at the question, all the things are done. Now what you have to do? Only thing we have to do is calculate the closing stock. When we are calculating closing stock, it's an important calculation. See over here, closing stock. How many machines are there? Closing stock. You had 400 machines. Out of 400 machines, 10 machines got abnormal loss. It became abnormal loss. 340 machines are sold. So 50 machines are remaining. 30,000 was the invoice price. 50 into 30,000, you will get 15 lakhs. Now you have to add the expenses. First we have expense which is spent by consignor. Okay, consignor, see over here. Consignor 96,000. Okay, spent 31,200 by Jatin. So 96,000 into 50 divided by 400. Consignor put all the 400 machines onto the ship and paid 96,000. So 12,000 is the proportionate expense. Consignee did not receive full, received only 390, 10 already lost in transit. So 50 divided by 390, 4,000. So 15,16,000 is the closing stock. 15,16,000 is the closing stock. Closing stock on consignment account debited to consignment account. 15,16,000. Now you have to do what? Stock reserve. Consignment account debited to stock reserve. 50 machines, 6,000 rupees per machine is the profit. So to stock reserve, balance whatever is there, it will get transferred to P&L as profit. Jatin's account, what you're going to do after doing all this, see the balancing figure, you're going to write by bank. That means Jatin is going to make the payment over bank account debited to Jatin. End of story. This is your question. These kind of questions can be asked in the exam. Clear, guys? Yes. Okay. Next, we'll go into the next topic, that is joint venture. The next topic is joint venture. Okay. What is joint venture? Joint venture is temporary partnership. Joint venture is temporary partnership. Okay. Now, let's say we have one person called as Pavan and we have one person called as NM. NM is Narayan Murthy. Now, imagine these both want to get into a business. Okay. Software business. $20 million for Tesla, Indian roads. They are going to make the software. Now, when software is going to be made for Tesla, if the software is ready, after that Pavan and Narayan Murthy have no business relationship. That means only for making this software, both of them are going to enter into a temporary partnership, and this is called as joint venture. So temporary partnership is called as joint venture. Now, accounting. How will you do the accounting? two things can happen over here, which is very important. Either you maintain separate set of books. You're like, sir, okay, everything we'll do separate. We'll not merge it. That is called a separate set of books. Very simple it is. That time you will prepare joint bank account, joint venture account and co-venturers account. When you maintain separate set of books, separate ledgers will be there. Joint bank account, joint venture account and co-venturers account. Separate set of books are not maintained. Okay, then you have to maintain in your own books. No. Then both the co-venturers will record all the transactions in their books. I will record all the transactions. He will record all the transactions. Nothing to worry. Now, otherwise, both the co-venturers will record only their transactions in the books. Both the co-venturers, what they will do? They will record only their transactions. Transaction which is related to them, they will record it. Transaction which is related to the other party, they are not going to record it. These are the three things. So what we have to understand, either separate set of books are there. Now in the exam, they will tell you whether separate set of books are maintained or not. Separate set of books are maintained. Then joint bank account, joint venture account and co-venturers account. Separate set of books are not maintained. Then each co-venturer, either they record all their transactions or each co-venturer records only the transactions which are related to them. Okay, separate set of books are maintained. Now you have to understand, separate set of books are maintained. I already told you only three ledgers: joint bank account, joint venture account, co-venturers account. Everything has to be inside this only. So now you understand this. Amount contributed by co-venturer. Amount contributed by co-venturer. Co-venturer has put money to start this joint venture. So joint bank account debited to co-venturers account. Joint bank account debited to co-venturers account. Is this clear? Joint bank account debited to co-venturers account, because money increases and we have to give the money to co-venturer whenever they take it back. Expenses of joint venture paid from joint bank account. So joint venture account debited because it is expense. Joint venture account is debited to joint bank account. Joint venture account debited to joint bank account. Is this clear? This should be the situation. Next. Expenses of venture paid by co-venturer. Expenses of venture paid by co-venturer. Joint venture account debited to co-venturer. Joint venture account is debited because it is expense, and co-venturers are credited because we have to pay the money to them. They paid from pocket. Income of the venture received. Income of the joint venture, it is received. So joint bank account debited to joint venture account. Joint bank account debited to joint venture account. Income of the venture received by co-venturer. Income came, but he kept it in his pocket. So now what happens? Co-venturer account debited to joint venture account. Co-venturer account debited to joint venture account. Next, stock taken by co-venturer. Stock is taken by co-venturer. Co-venturer told, I will use this stock. Anyways, our business is finished. Partnership is finished. Little stock is remaining. I will take it for myself. So co-venturer account debited to joint venture account. Co-venturer account debited to joint venture account. Now, if there is a profit will be distributed to co-venturers. Joint venture account debited to co-venturer account. Joint venture account debited to co-venturer account. If there is loss, co-venturer account debited to joint venture account. Co-venturer account debited to joint venture account. Next, balance in bank will be distributed to co-venturers account. After that, if there is, we are closing the books, okay, because our joint venture only is closed. So whatever money is there in the bank, we are transferring it to co-venturers account based on the balance in the co-venturers account. Co-venturer, whatever balance is there, we are going to distribute it to them. Clear? Done. Yes. When separate set of books are not maintained, now we have a problem. If separate set of books are not maintained, what to do? First, each co-venturer will record all transactions. Each co-venturer will record all transactions. Okay, that means they will prepare joint venture account and co-venturers account. Joint venture account and co-venturers account. Now we'll try to understand. Let's say there are two co-venturers here. One is Santosh, other one is Nishanti. Santosh and Nishanti are two co-venturers. Now, goods supplied by Santosh. Goods supplied by Santosh. Now, if goods are supplied by Santosh, what we are going to do? Goods supplied by Santosh Joint venture, it is expense, right? Joint venture account debited to purchase because Santosh only has supplied the goods. Nishanti, what she will do? Joint venture account is debited because it is expense for the venture, but Santosh supplied, so to Santosh account. Expense paid by Nishanti. So joint venture account is debited because it is expense, but Santosh did not pay, so he will write to Nishanti's account. Here we only paid, joint venture account debited to bank account. Sales made by Santosh and amount received. Who made the sale? Santosh. So bank account debited because we got the money, and joint venture account is credited because it is income for the venture. Now Santosh got the money, so Santosh account debited to joint venture account. Is this clear? Both the parties we are going to see at the same time. Sales made by Nishanti and amount received. So Nishanti received the amount, so Santosh will write Nishanti account debited to joint venture. Nishanti will write bank account debited to joint venture. Stock taken by Santosh. Santosh took the stock. So what will be the entry? For Santosh it is stock. So stock account debited to joint venture. And for Nishanti, Santosh took the stock. So Santosh account debited to joint venture. Santosh account debited to joint venture. Clear? Stock taken by Nishanti. If Nishanti takes the stock, what Santosh will do? Nishanti account debited to joint venture. Nishanti account debited to joint venture. And what will Nishanti do? Nishanti got the stock, so stock account debited to joint venture. Now if it is profit is earned. So what will happen to profit? Little profit belongs to us, little profit belongs to the other person. So joint venture account debited to P&L, our share to Nishanti. What Nishanti will do? Joint venture account debited to P&L to Santosh. Clear? Now loss. If there is a loss, little loss will be borne by us, little loss will be borne by the other party. So P&L account debited, Nishanti account debited to joint venture. P&L account debited, Nishanti account debited to joint venture. And here what will happen? P&L account debited, Santosh account debited to joint venture. So both the places you can see the mirror image creation that is going to happen. Amount paid by Santosh to Nishanti. Santosh is making payment to Nishanti. So here it will be Nishanti account debited to bank. There it will be bank account debited to Santosh. Clear? Now, separate set of books are not maintained. Each co-venturer keeps record only of their transactions. If each co-venturer keeps record of only their transactions, that time what will happen? Joint venture with co-venturer account will be created. Joint venture with co-venturer account will be created. Now, to compute the profit, I am going to record only my transactions, and one of my transaction is my profit share. So to find out my profit share, what I will do? To compute the profit, memorandum joint venture account is prepared. To compute the profit, what will I do? Memorandum joint venture account is prepared. So to compute profit, memorandum joint venture account is prepared. All transactions are recorded in the memorandum joint venture account. Just to compute profit, memorandum means one rough book you are going to prepare just to find the profit because you want to know your share of profit. Santosh and Bhumika this time. In the books of Santosh. Okay. Goods supplied by Santosh. Goods supplied by Santosh. Santosh only has supplied. Santosh's books. Santosh will pass the entry. Joint venture with Bhumika account debited to purchase account. Joint venture with Bhumika account debited to purchase account. Only you are going to record your transaction. But if goods are supplied by Bhumika, no entry. Expense incurred by Santosh. Joint venture with Bhumika account debited to bank. But if it is expense incurred by Bhumika, no entry because we are going to record only our transactions. Income received by Santosh. Income received by Santosh. Bank account debited to joint venture with Bhumika. Bank account debited to joint venture with Bhumika. Income received by Bhumika, what you are going to do? No entry. Income received by Bhumika, no entry. Stock taken by Santosh. Stock account debited to joint venture with Bhumika. Stock taken by Bhumika, no entry. Only your transactions. Profit, only Santosh share you are going to calculate, and joint venture with Bhumika account debited to P&L, transfer it. Loss, P&L debited to joint venture with Bhumika. Only our transactions we are going to record. Amount received by Santosh. Amount received by Santosh. Bank account debited to joint venture with Bhumika. Amount sent by Santosh. Joint venture with Bhumika account debited to bank. That should be it with joint venture. Okay, that should be it with joint venture. Let's have a look at some questions. Okay, this is the third question, which is there in your study material. Let's have a look at it. X and Y entered into a joint venture for purchase and sale of some household items. Okay. Now they asked you to prepare joint venture account, joint bank account, and joint venturers account, co-venturers account. Can you see? So we are going to prepare joint bank account, we are going to prepare joint venture account, and we are going to prepare X account, and we are going to prepare Y account as well. Clear? Now let's have a look. They agree to share profits and losses in the ratio of their respective contribution. Whatever they have contributed, in that ratio they will share. So X contributed 10,000 in cash and Y 13,000. So what should be the entry? Joint bank account debited to X to Y. Joint bank account debited to X, joint bank account debited to Y. So here you can write by joint bank account, by joint bank account. Now, the whole amount was placed in a joint bank account. Okay. Goods were purchased by X for 10,000. Goods purchased by X. So what we are going to do? Joint venture account debited to X account because X made the payment. So here you are going to write by joint venture. And expenses paid by Y amounted to 2,000. So joint venture account debited. Who paid? Y. So to Y's account we are going to transfer. Is this clear? Next, after that, they also purchased goods for 15,000 through joint bank account. They purchased goods for 15,000 through joint bank account. So when they purchased goods 15,000, what should be the entry? Joint venture account debited to joint bank account, and here we are going to write by joint venture. Next, the expenses on purchase and sale of the articles amounted to 6,000, those made by Y. Okay. Now what should be the entry? Joint venture account debited to joint bank account. Joint venture account debited to joint bank account because expenses was expense on purchase and sale of articles amounted to 6,000, those made by Y. Okay, that means 6,000 is the expense, but already Y has paid 2,000. So the remaining amount will be paid from the bank account. Joint venture account debited to joint bank account. Okay, then we have goods costing 20,000 were sold for 45,000. Sold for 45,000. So joint bank account debited to joint venture account. Joint bank account debited to joint venture account. And the balance were lost by fire. They are telling balance goods are lost by fire. Okay. Now, let's try to find out. It's gone. Anyways, it's a loss. Nothing to worry about it. Already we have debited everything to joint venture account. If something is not sold, not sold. It will create a loss. If something is sold, good. Now, profit sharing ratio you have to find out. X had contributed 10,000, Y had contributed 13,000. But X also, goods also was contributed by X 10,000. Expense paid by Y. So total amount that is contributed by the two people are 20,000 and 15,000. Therefore, profit sharing ratio is 4:3. Profit sharing ratio is 4:3. Now what you are going to do? Transfer this profit 8,000 over here and 6,000 over here. From joint venture account, you're transferring the profit to X and to Y. Is this clear? Then finally, what happens if you notice? X has to get 28,000, take the money from the joint bank account, and Y has to get 21,000, take the amount from joint bank account. This is how you are going to close the joint bank account. See how much has to be paid to which co-venturer and just give the amount to them. That's it. Clear? Yes. We'll go into one more question. Okay, fourth question. Here you can see you are required to prepare joint venture account and Mukesh account in the books of Anil, joint venture account and Anil account in the books of Mukesh. That means they are not maintaining separate set of books. They are not maintaining separate set of books, but each co-venturer is keeping record of all the transactions. Each co-venturer is keeping record of all the transactions. Now, see here. Anil and Mukesh enter into a venture to take a job for 2,40,000. Okay, the job is 2,40,000. They provide the following information regarding the expenditure incurred by them. Anil, Mukesh. Now, in the books of Anil, joint venture account, and Mukesh account. In the books of Mukesh, you will prepare joint venture account and Anil account. First, we will see one side. Okay, we'll focus fully on Anil only. So now what happens? See over here. These are the expenses Anil has incurred. 68 plus 13 plus 10. 81, 91,000 incurred by Anil. So what will be the entry for this? Joint venture account debited to, see, bank account. Joint venture account debited to bank account. Material, cement and architect fees is paid by Anil. The other things are paid by Mukesh. So you are going to write joint venture account debited to Mukesh account. All these things you are going to put to Mukesh account. This totals up to 1,19,000. You can see that we have put it into Mukesh account. Okay. After that, what is the situation we are in? Plant was valued at 10,000 at the end of the contract, and Mukesh agreed to take it at that value. Mukesh is taking the plant. So what should be the entry? Mukesh account debited. Mukesh has to give us money to joint venture 10,000. Next, after that, contract amount was received by Anil. Anil received the amount. So bank account. We are in the books of Anil only. Bank account debited to joint venture account 2,40,000. After that, whatever is the profit is 40,000. It is shared equally, they said. So our profit will transfer to P&L and Mukesh's profit will transfer to Mukesh's account. Mukesh's profit will transfer to Mukesh's account. And finally, you can see that Mukesh is having credit balance. That means we have to give money to Mukesh. We have to give money to Mukesh. So we'll write Mukesh account debited to bank account. Is this clear, guys? Okay. Okay. So in the other person's books also, you will have to pass the entries. It will be similar to what we have already done. So with that, I think we can wind up joint venture. It's a small concept. If at all anything is asked in the exam, please don't make any mistakes. Yes, guys. Let's go into the next topic. That is going to be final accounts. Okay, students. Let's proceed to the next chapter that we are going to do in, that is final accounts. Okay, so chapter number 1 and chapter number 2 are completed. Chapter number 3, we have final accounts, NPO and incomplete records. All three are there in this chapter. Okay, final accounts, we have to understand business can be of two types. Either you are into trading or you are into manufacturing. If you are into trading, then you will prepare trading account, P&L account and balance sheet. If you are into manufacturing, you will prepare manufacturing account, trading account, P&L account and balance sheet. What is the purpose of preparing trading account? The purpose of preparing trading account is to find the gross profit. Okay, the purpose of preparing P&L account is to find the net profit. And finally, the balance sheet is prepared to know the financial position. If you are doing manufacturing, then you will prepare manufacturing account. Manufacturing account is prepared to find the cost of goods manufactured. Manufacturing account is prepared to find the cost of goods manufactured. Then you are going to prepare trading account for same purpose to find the gross profit. P&L account, same purpose to find the net profit. And balance sheet to know the financial position. Clear? Now, trading account. We'll understand what and all are the regular items of trading account. In trading account, we always start with opening stock on the debit side. Then purchases less returns. That means in the question, if there is any purchase returns, we have to subtract that and we have to take the amount over here. And then we have direct expenses. What are the direct expenses? You can have wages, coal, etc. Okay, direct expenses, power and all those things. Then you have by sales. Even in the trial balance, if sales returns is given, sales less returns you have to take. And abnormal loss, if it is there, you will credit the trading account. And then if insurance company gives you anything, then you will take the remaining amount to P&L. Okay, closing stock. Closing stock is one more thing that will be there in the trading account. If credit side is more, that means it is profit. If debit side is more, that means it is loss. Clear? That is your trading account. Now going into P&L. Going into P&L account. Gross profit is brought down. Gross profit brought down. Then what happens? Indirect expenses are taken over here and indirect incomes are taken over here. Clear? Indirect expenses and indirect income. So basically expense and income which did not go into trading account, all of them will be sitting in the P&L account. Okay. Again, if credit side is more, that means it is profit. Net profit will be transferred to P&L appropriation account. and here also net loss will be transferred to P&L appropriation if you're preparing P&L appropriation. Otherwise, directly it will go to balance sheet. Directly it will go to balance sheet. Balance sheet we already know. Okay, we have liability side and we have asset side. In balance sheet, one thing we have to understand that always write the non-current assets on top. That means fixed assets you write on top and current assets you write below. And first you write the capital on the liability side, non-current liabilities, and then you write the current liabilities. Clear? P&L appropriation, in case it is there. Okay, net profit is brought into P&L appropriation, and then dividend. If you are distributing the share of profit, you're going to remove that share of profit, and if you're transferring to general reserve, you'll transfer to general reserve, and balance amount will go to capital. So distribute the profit, transfer to general reserve, and balance amount will go to capital. Now we go into manufacturing account. If you have manufacturing account, now understand, when we have manufacturing account, opening stock, closing stock, you have to be very careful. Raw material and work in progress will be in manufacturing account, and finished goods will be in trading account. Finished goods will go to trading account. So now here what we are going to do, see, opening WIP, closing WIP. Work in progress is sitting over here. Raw material, what we have to do is raw material consumed. We have to put the raw material consumed. So opening stock of raw material plus purchase of raw material minus closing stock of raw material. Opening stock of raw material plus purchase minus closing stock of raw material. This will give you raw material consumed. Then you can have all the direct things, that is direct wages and other direct expenses. And any other expenses which are related to manufacture also will be sitting in manufacturing account. Okay. Byproduct sale. Byproduct sale means what? Some waste product is there, we are selling it. That is an income that is credited to manufacturing account. Finally, the balancing figure will be the cost of the manufacture. This cost of the manufacture will be transferred to trading account. From there, the process is same. Trading account, P&L account, and balance sheet. Trading account, P&L account, and balance sheet. Is this clear, guys? Yes. Next we move into depreciation. Understand this. Depreciation, if it is on office building, it will go to P&L. Depreciation, if it is on factory building, that means it is used for manufacture, it will go to manufacturing account. Depreciation on assets used for manufacture, for example, plant and machinery and all used for manufacture, it will go to manufacturing account. Depreciation on other assets, okay, that will be going to P&L. Salary will go to P&L. And salary to supervisor, if you are giving salary to supervisor is required for manufacturing, it will go to manufacturing account. Clear? Raw material, okay, repairs and maintenance, okay, factory building and plant and machinery repair will go to manufacturing account. Any other repair will go to P&L account. Clear? Now that is it with the final accounts, guys. Okay, why we are not talking about adjustments is because adjustments is already covered in chapter number 1. Okay, adjustments we already discussed over there. So straight away we'll look at some tricky questions. We'll take this question number 12 from study material. Yes, question number 12, it has a lot of adjustments in it. So we'll focus on question number 12. Question 12. Mrs. Joshi has presented you the following trial balance on 31st December 2023. They have given you the following trial balance. Okay. Now purchases. Let's see what they have asked finally. You can see over here itself, you are required to prepare trading account, P&L account, and balance sheet as on 31st December 2022 after considering the following adjustments. First, a sale of 25,000 made for cash had been credited to purchase account. Sale has been credited to purchase account. So can you see that rectification also is involved in this particular question? Now, understand this. Question number 12. Let's see if I have made that adjustment already. Yes, rectification. Can you see this rectification? Sale of 25,000 made for cash has been credited to purchase account. See over here. Usually what is the entry for sale? Cash account debited to sales account. Cash account debited to sales account. What did they do? Wrong entry. Cash account debited to purchase account. Can you see? It was credited to purchases. So now how will you rectify it? Purchase has to be removed. So purchase account debited to sales account. Purchase account debited to sales account. That means you have to remove 25,000 from purchases and add 25,000 to sales. Can you see? 25,000 we have to, yes, 25,000 we have to add to sales. Can you see the 25,000 added over there? And here purchase is debited. So we have to add 25,000 to purchase as well. 25,000 debited to purchase, that means add to purchase. 25,000 credited to sales, that means add to sales. Next, this one is sorted. Next, private purchase amounting to 600 had been included in purchase day book. Private purchase means what? Personal purpose. So again, what is the correct entry for that? Drawings account debited to bank should have been passed. That is not done. Purchase account debited to bank is what they have done. Purchase account is debited to bank. So what is the rectification entry? Drawings account debited to purchases. Drawings account is debited to purchases. Is this clear? So now drawings, we have to take 600 and we have to remove 600 from purchases. Can you see 600 we are removing from purchases? 600. And drawings we have to take 600. Can you see 600 is added to drawings over here? Yes. Okay. Next, this one is also sorted. The loan account in the books of proprietor appeared as follows. Can you see loan is there? Okay, starting of the year only we had 50,000 loan and ending of the year we have borrowed again 50,000 loan. So on this there will be full interest. On this there will be no interest. Why no interest? Because it is borrowed only at the end of the year. Interest paid includes 3,000 interest to UBI bank. How much is the interest over here? 10% loan from UBI bank. That means 50,000 into 10%. We have to pay 5,000 as interest. Only on the opening balance we are going to charge interest because the loan that is borrowed during the year, that has happened at the end of the year. So on that there is not going to be any interest. So 5,000 is the interest. Clear? But they have told clearly over here, interest paid includes 3,000 interest paid to UBI bank. That means 2,000 interest is still pending. 2,000 interest is still pending. So what we will do? Outstanding interest 2,000 balance sheet. And then in the P&L, when we are doing the P&L, can you see to interest 2,000 is added. Why 2,000 is added? Because it is outstanding interest. Interest account debited to outstanding, it should be added to interest. Clear? During the year, goods worth rupees 1 lakh were invoiced on sale or approval basis at cost plus 25%. Out of these goods worth rupees 20,000 accepted by the customer, 40,000 worth of goods were rejected and properly accounted, but no intimation has been obtained for the balance of the goods. 20,000 is accepted, good, it is sales. 40,000 is rejected, okay, it should be reversed. They have already passed the entry. Remaining is still with them. Okay, sale or return basis. Look at the adjust working note now. Now understand this. Sale on approval basis. 1 lakh is the goods plus 25%. Can you see? Goods worth rupees 1 lakh were invoiced on sale or approval basis at cost plus 25%. At 25%, so the total sales is 1,25,000. Out of that, okay, accepted. 20% is accepted. 20% is accepted. 25,000. Accepted. They have passed the sale entry. Good. Rejected. 50,000 is rejected. That is also they have accounted correctly. Nothing to worry. Balance 40% is rejected and remaining 40% no, not accepted, not rejected. That means if they accept also, they will accept it only in the next financial year. So 50,000, what should we do? We should remove it from sales because we are going to reverse the sale. It is not accepted or rejected, and it should be reversed from debtors as well. Reverse from sales, reduce from sales and reduce from debtors. That means pass the reversal entry. Reversal entry you pass. And then closing stock on approval, take 40,000. Closing stock on approval, you take 40,000. So here, what are we going to do? Okay, understand this. Let's see. 50,000 is reversed from sale. Okay, very good. Then after that, closing stock in trading account. Closing stock on approval. Can you see 40,000? Because closing stock should be taken at cost. 40,000 they have taken over there. and then that closing stock should also be there in the balance sheet, because closing stock even goes to balance sheet. Then apart from that, one more thing that we have to understand is 50,000 has to be subtracted from debtor as well. Where is our debtor? Okay, for a debtor we have made a better calculation. Okay, see, debtor over here minus the sale on approval basis. So first what happens? Sale entry gets reversed. So sale account debited, that's why sale is reduced. Debtor account credited, that's why debtor is reduced. Then whatever is, if sale is reversed, that means stock should be taken. Stock, closing stock will be taken at cost itself. Closing stock, trading account you will show it, and also in the balance sheet you will show it. Clear? Yes. Next, debtors were shown after deduction of provision for doubtful debts of 2,000. It was decided that this debt was considered to be bad and should be written off, and provision for 1,000 should be made, which was considered doubtful. Okay, debtors, what did they tell? Yes, they have already reduced the provision for doubtful debts. So what we should do? 5,000 is there, 54,000 is there, debtors. Okay, now let's check what is the trial balance amount of debtors. 1,04,000. 1,04,000 is the debtors. Out of that we have removed 50,000. Now one more thing is, sale on approval is done. Sorry. Yeah. Therefore, now what is the PDD? PDD, they said it should be 1,000. Can you see that they have told PDD is 1,000? Over here, 1,000 should be made, which was considered doubtful. So therefore, PDD is 1,000. Balance sheet, the debtor should be 53,000. Okay. Balance sheet, the debtor should be 53,000. See, they said debtor is after deducting the provision. Provision they had deducted. We should have actually added back the provision. But the provision, what happened? It became bad debt. So already they have deducted. No. So again, why to worry about it? Already they have deducted. So that is already sorted. Now we need a provision of 1,000. So make a provision of 1,000, PDD 53,000. So now how will you deal with that? In the P&L account, can you see PDD 1,000? We have created PDD, and in balance sheet, debtor should be shown at 53,000. Balance sheet debtor will be shown at 53,000. I hope it is clear, guys. Next, suspense account represents money advanced to sales manager who was sent to Mumbai in August for sales promotion. Okay, suspense account. Can you see in the trial balance there is a suspense account? Is there a suspense account? Yes, suspense account over here, because they didn't know what it was. Now we are going to find out. On returning to Kolkata, he submitted a statement disclosing 2,000 was incurred for traveling, 1,200 legal expense, 1,800 miscellaneous expense, balance lying with him yet to be refunded. So now have a look at this working note. Suspense account 8,000. They said 2,000 should be traveling expense. Okay, so you take that 2,000 as traveling expense itself. Then they said that 1,200 is legal expense. Okay, take that 1,200 as legal expense. Then they said that 1,800 is miscellaneous expense. Okay, take that 1,800 as miscellaneous expense. Then they said balance is still with them. It has to be refunded. So this balance 3,000 will be shown in the balance sheet. In balance sheet, what we are going to do? We are going to show balance sheet 3,000. So you will go to the balance sheet and you will write receivable from sales manager 3,000. Is this clear? Receivable from sales manager 3,000. Next, what we are going to do? Business is carried on in a 2-storied rented house. The ground floor being 50% of for the accommodation is used for business. Ground floor being 50% of the accommodation is used for business. Mrs. Joshi lives with her family on the first floor. Ground floor is 50%, it is used for business. First floor is 50%, it is used for staying. So now what we have to understand? The rent. Go and find the rent. Where is the rent? 6,600. So here we need a working note for that as well. The rent working note, let's have a quick look at it. See, 6,600 is the rent. Out of that, 3,300 will be taken as rent because it is for the ground floor. And 3,300 will be taken as drawings because it is used for personal purpose. So now what you will do, in P&L you will show 3,300 as rent, and in balance sheet you will subtract 3,300 as drawings. So total drawings will be subtracted from capital. Clear, guys? Yes. Next, after that, we have the next adjustment. Furniture account represents old furniture which was replaced on 1/1/2023. 1/1/2023 is starting of the year itself. Buy a new furniture costing 1,20,000 with an additional cash payment of 80,000 lying debited to purchase account. Furniture we purchased, but we debited the amount to purchase account. However, assets were put to use on 1/4/2023. Okay, very good. Very good adjustment over here. Now let's go into the furniture calculation. Furniture new is how much? 1,20,000. Furniture old is how much? 85,000. And cash paid is how much? 80,000. So total amount is what? 1,65,000. Okay. Therefore, loss on sale is 45,000. Why? Old furniture went and the cash paid is 80,000. So totally from our pocket 1,65,000 went. But the new furniture which we got is only 1,20,000. Therefore, loss on sale is 45,000 which will be debited to P&L. And cash paid is actually, instead of debiting furniture, they have put the cash paid is taken into what? It is taken as purchases. So what we have to do, this 80,000 we have to reduce from purchases as well. Okay, 80,000 we have to reduce from purchases as well. 80,000 is reduced from purchases. Then what is the other thing that we have to do over here? 45,000 we have to show as loss on sale. Can you see 45,000 loss on sale? Then the furniture calculation, furniture and fixtures, 1,20,000 minus 12,000, directly depreciation they have calculated. Is this clear? Are you following this? Yes, that should be it, guys. I hope it's clear. Okay, again, see, and with an additional cash payment of 80,000 lying debited to purchase account. They have debited to purchase account. Now, if you look at the furniture in the question, furniture and fixture is showing 85,000. What is this 85,000? This is the old one. Sorry, where is it, guys? 85,000. This is the old furniture. That is gone, no? That furniture we are going to remove, and additional cash is also paid. That also we are going to remove, and then furniture new one is going to be taken. New furniture is going to be taken. Is this clear? I hope it is clear. Old furniture gone, new furniture comes, and money also is paid for the new furniture. Loss on sale we are going to take, and the new furniture we are going to take. Loss on sale we are going to take, and the new furniture we are going to take. Okay. Now here obviously depreciation is there. Depreciation is to be charged on furniture at 10%. New furniture we know it is 1,20,000. So what you will do, straight away 1,20,000 minus 12,000, 1,08,000, and that 12,000 depreciation should be shown in the P&L, depreciation on furniture. Then what they told, plant and machinery 5%. Go and check what is the plant and machinery value. Plant and machinery 5,30,000. So directly what we will do, 5,30,000 minus 26,500, 5,03,500, and take that depreciation 26,500 in the P&L. Then after that, what did we do? Motor car 5%. Motor car 5%. Go and check how much is the motor car. Where is the motor car? Motor car 70,000. So what we will do, straight away 70,000 minus 3,500, 66,500, and the 3,500 we are going to take it in the P&L. Depreciation on motor car. Clear? I hope everything is sorted there. After that, we proceed further. General manager is entitled to a commission based on the percentage of net profit, such commission being charged to P&L account before ascertaining the net profits, calculated in the following manner. They gave one slab rate for the general manager. First 30,000 profit, he will not get any commission. After that 10%, after that 20%, then after that 30%. This we have to calculate only when the profit is ready, and closing stock is 22,000. Where will we put closing stock? Trading account, you will put closing stock of 22,000. Okay, closing a stock of 22,000, and show also in the balance sheet closing stock of 22,000. All the adjustments we have already discussed. Now we'll go into the items which are there in the trial balance. First one is purchases, 1,75,000. Purchase has all the circus. Circus we have already finished. 1,75,000 purchases. Clear? Then after that, interest 8,000. Debit side it is there. That means interest is an expense. Can you see 8,000? Outstanding we have already added, and it becomes 10,000. Then after that we have debtors 1,04,000. I think debtors is already sorted. We have done the debtor calculation over here. Then suspense account already gone. We have done whatever required adjustment for suspense account is done. Rent is also done. Plant and machinery, furniture and fixture is also done. Now salary, any outstanding, anything they have spoken about salary? No, directly you take salary as 7,000. Where is salary? Salary you can directly take it as 7,000. Then wages. Wages will go to trading account. Directly take wages as 2,500. Clear? After that you have GST 6,000. It will go straight into the balance sheet. Input credit it is. Balance sheet you will show GST as 6,000 debit, so receivable. Motor car 70,000 that we have already taken. Octroi is a direct expense, so take octroi directly into trading account. In trading account, can you see octroi of 500? Then you have insurance of 10,000. No additional things are mentioned. Insurance 10,000. Unexpired insurance. Unexpired insurance means prepaid insurance. It should go to balance sheet as a said prepaid insurance 2,300. Then you have factory shed. Factory shed is an asset, directly 30,000. In the asset side of the balance sheet, you will take factory shed as 30,000. Then you have bills receivable. Bills receivable is also an asset. Directly you will take 25,000 bills receivable, 25,000. Then after that you have patent. Patent is an asset, 32,100. Directly you will take over here 32,000, 32,100. Clear, sorted. Then you have sales return. Sales return should be subtracted from sales. Go to trading account. Can you see minus 2,000 over here? So sale is completed. Then after that, going into the credit side, sale is 3,25,000. Can you see 3,25,000 over here? Yes. Then 10% loan from UBI. Loan should go straight into the balance sheet. Go to balance sheet and write loan 1 lakh. Okay. After that, you have bills payable 86,000. Go to balance sheet and write bills payable 86,000. After that, you have capital account 4,87,000. Go to balance sheet. Take that as your starting point. Capital account. Drawings is already subtracted. Net profit we are going to find out. Okay. After that, let's go further. Yes, sundry creditors, direct amount, balance sheet liability side 102,500. Then you have apprenticeship premium received. Premium received, it's an income. Go to P&L and directly write premium 2,000. Then you have purchase return 1,500. Purchase return should be subtracted from the purchases. So 1,500 is subtracted and that this is your purchases. So with this, if you notice, trading account, all the items we have discussed, we get gross profit. Gross profit will go to P&L. After that, what we get? Net profit. Now, net profit we get, and then commission we have to calculate. How much is the net profit before commission? 1,17,800. That you have to just take your calculator in the P&L, find the balancing figure. That will be your net profit. Clear? Net profit before commission. What did they tell in the question? They said commission up to 30,000 0. Can you see up to 30,000 nil? Then they said next to 30,000 you will get 10%. Okay, 3,000 commission. Then they said next to 30,000 you will get 20% commission, 6,000 commission. After that balance you will get 30% commission, and the balance is 27,800. On that 30%, total commission will be 17,340. 17,340 commission we have received. Okay, now what we are going to do? 17,340 commission, you are going to take it in a P&L. I mean, not received, sorry. Commission is going to be paid 17,340. Did we pay it? No. So in balance sheet, you will show it as outstanding commission. And then the net profit, whichever is there, it will get added to profit. I mean, it will get added to capital. Clear? With that, our balance sheet also should tally. See, we have discussed all the items which are there in this particular question. This one major question we have picked so that most adjustments are covered over here. Then let's go further. June 2024, they asked on 5-mark question from final accounts. Okay, let's discuss that one. Question number 10. Okay, on 31st of December 2022, sundry debtors and provision for doubtful debt are 50,000 and 5,000 respectively. How much is sundry debtor? 50,000. During the year 2023, okay, 3,000 are bad and written off on 39/2023. An additional amount of 400 was received on account of a debt which was written off as bad debt last year. If bad debt is recovered, the entry is cash or bank account debited to bad debt recovered. Now understand this. We had debtors and the debtor balance was 50,000. Oh, we'll do what they have asked only. They have asked first prepare bad debt account. Okay, first thing that they have asked is to prepare bad debt account. Then they have asked you to prepare provision for bad debt account over here, assuming that the same percentage should be maintained for provision for doubtful debts as it was on 31st of December 2022. 31st of December 2022, what was the percentage? 5,000 was the debtors and 5,000 was 50,000 was the debtors and 5,000 was the provision. That means 10% provision they are maintaining. Now also they said 10% provision should be maintained. During the year, 3,000 are bad and written off. 3,000 bad and written off. So what you will do, you will write bad debt account debited to debtors account, bad debt account debited to debtors account 3,000, and provision what we had, by balance brought down, provision we had 5,000 rupees. 5,000 rupees was there in provision. Next, debtors left. Bad debt recovered will not impact us. Bad debt recovered will not impact debtor as well as bad debt or the provision for bad debt, because the entry for bad debt recovered is bank account or cash account debited to bad debt recovered. It will go to P&L as income. The debtors left was verified and it was found that sundry debtors on 31st December 2023 stood in the books at 40,000, out of which a customer, Mr. X, who owed 80,000 was to be written off as bad. Again, one more bad debt. 31st of December 2023, we have debtor of 40,000. So now what we will write, bad debt account debited to debtors account, bad debt account debited to debtors account. Again, there is a bad debt of 800 bad debt. Now, debtor is how much? Debtor on 31st of December 2023 is 40,000. From that, you remove the bad debt of 800. You will get 39,200. 39,200 is the debtor. Now, you have to create provision of 10%. On this, we need provision of 10%. So, that makes it 3920. 3920. So you will write over here to balance carried down. It should be 3920. 39,200. Sir, why are we not removing that other bad debt also from this 40,000? Because other bad debt is happening on what date? Other bad debt is happening on 30th of during the year, 30th of September. That means it is already removed. After removing that bad debt, we have on 31st of December 40,000. But there is a further bad debt of 800. So because there is a further bad debt of 800, that 800 we are going to remove and then we are going to calculate the provision. Clear? Is this clear, guys? Yes. So now bad debt is there and provision is there. Whenever there is a bad debt and provision is there, we will not transfer bad debt to P&L, we will transfer bad debt to provision. So here I am going to write by provision for bad debt 3,800. So here you will write to bad debt 3,800. So now what is going to happen? 3,800 plus 3,920 minus 5,000. You have to create a provision of 2,720. So you will write by P&L balancing figure 2,720. You have to create a provision of 2,720. I hope it is clear. This is your solution for that particular 5-mark question which they have asked. With that, we are closing final accounts. We are going further into the next one. Okay. Final accounts are done. Yes, that should be it with final accounts, guys. No other topic we have to discuss there. Next, we go into NPO. We go into NPO, non-profit organization. Okay, so the next topic that we are going to discuss is NPO. NPO is non-profit organization or not-for-profit organization. Okay, in this we can prepare we will have 3 things to look at. That is one, receipt and payment account, income and expenditure account, and balance sheet. Receipt and payment, income and expenditure, and balance sheet. Receipt and payment account is like a cash book. It's like a cash book. It will have all receipts and all payments. Income and expenditure account is like P&L. Okay, it will be like P&L. It will be like P&L account, how we prepared in final accounts, exactly like that. But we can't use the words profit or loss, because why can't we use the words profit or loss? Because it is non-profit organization. So we have to use the words surplus or deficit. We have to use the words surplus or deficit. Okay. Now, balance sheet. When we go to balance sheet is a position statement. Balance sheet is a position statement. No capital. You can't use the word capital. You will use the word capital fund. You will use the word capital fund. Okay. Now, Difference between receipt and payment and income and expenditure account. Receipt and payment account, we follow cash system. And income and expenditure account, we follow accrual. Receipt and payment is like a cash book, no? So you have to follow cash system. Income and expenditure account is like P&L, so you have to follow accrual system. All receipts, okay, all receipts will be taken over here. Doesn't matter whether it is capital or revenue, everything will be taken over here. That means everything, whether it is asset related, whether it is income expense related, everything will be taken, capital and revenue, and all receipts and all payments will be taken over here. Any receipt or payment related to any year, that means last year's amount you paid this year, this year's amount you did not pay, next year's amount you paid this year, everything will be taken over here. No depreciation. Sir, why sir? No depreciation will be taken in receipt and payment, because depreciation is non-cash and receipt and payment account is cash book. Now you have income and expenditure account. Income and expenditure account. Income and expenditure account, you understand all receipts and payments. Income and expenditure account, you are going to take all receipts and payments. Okay. Sorry. What am I telling? All receipts and payments will not be taken. Only revenue transactions will be taken. Only revenue transactions will be taken. All receipts and payments will be taken in receipt and payment account. Only revenue transactions, because capital transactions go into balance sheet. Any revenue, receipt or payment, okay, only related to current year. Any revenue, receipt or payment only which is related to current year will be taken. Okay, depreciation will be taken because depreciation is a non-cash expense. Even non-cash expenses are taken. Any revenue, receipt or payment only if it is related to current year. So what we have to focus in income and expenditure account, only current year related, and what we have to focus in receipt and payment account, any year related, we are going to take it. Clear? Yes. Next, receipt and payment account is given in question. Okay, if receipt and payment account is given in question, then they are trying to ask you to find the income and expenditure account. Now, expense paid in the year will be there. Where we will get expense paid in the receipt and payment account. Now, if outstanding expense of last year, is there, that means it is last year's expense minus. Outstanding expense of current year is there, that means it is this year's expense, add. Prepaid expense of last year is there, that means it is last year's expense, add. Prepaid expense of current year is there, that means it is this year's expense minus. Okay, sorry. Prepaid expense of last year is there, last year it is paid but it is this year's expense, add. And prepaid expense of current year is there, it is paid this year but it is related to next year, so subtract. Simple logic we have to use. Is it related to this year or not? Outstanding expense of last year, remove. Outstanding expense of last year, remove. Why remove? Because it is last year's expense. Outstanding expense of current year, that means it is this year's expense, add. Prepaid expense of last year prepaid, that means this year's expense, add. Prepaid expense of current year, okay, this year prepaid, it is related to next year, minus. You will get the expense for the current year and that you will put into income and expenditure account. If we are focusing on income, if you're talking about income, then income received in the year, we will get, where will we get this? It will be there in the receipt and payment account. Then income receivable of previous year. Income receivable of previous year. What we are going to do? Subtract, because it is last year's income. Income receivable of current year. What we are going to do? Add, because it is this year's income. Income received in advance of previous year. Income received in advance of previous year. What we are going to do? Last year received in advance but this year's income, add. Income received in advance of current year. This year received in advance related to next year, subtract, that time you will get income of the current year. Is this clear? Yes. Now, if income and expenditure account is given in question, then we are supposed to find the receipt and payment account. Receipt and payment account, what is the logic? Receipt and payment account logic is, doesn't matter which year it is related to. Receipt and payment account logic is, whichever year it is related to, we are going to take it if it is received or it is paid. Expense for the current year. Sir, where will we get this expense for the current year? It will be there in the income and expenditure account. Okay. Now, outstanding expense of previous year. Last year outstanding, that means paid this year, add. Outstanding expense of current year. This year outstanding, that means not paid this year, paid next year, minus. Prepaid expense of previous year. Prepaid expense of previous year means what? Last year prepaid, but that means this year it is not paid, already paid last year, minus prepaid expense of current year. That means it is next year's expense, but it will be paid. So add. It is paid this year, add. You will get the expense paid during the year. Now income, if you're taking income of the current year, where will we get it? We will get it in the income and expenditure account. Income for the current year, you take it. Income receivable of previous year. Income receivable of previous year. What are we going to do? Income receivable of previous year. Last year it is receivable. This year it is received. So add. Income receivable of current year. This year it is not received. It will be received next year. Minus. Income received in advance of previous year. Last year it is received in advance. Already received, minus. Income received in advance of current year. This year received in advance. Add. Add. You'll get income received in current year. You can also do all this using the ledgers. Expense. What is the entry for expense? Expense account debited to cash or bank. So you'll write over here to bank. Expense paid. This year, if it is outstanding, if this year it is outstanding, expense account debited to outstanding expense, outstanding of this year. Last year's outstanding, reverse. So outstanding expense account debited to expense. Clear? This year, if it is prepaid, that means prepaid expense account debited to expense. But last year's prepaid, we have to reverse. So expense account debited to prepaid. When you do this, you'll get the balancing figure, income and expenditure account. Is this clear? Yes. Now income account. Income account, what we are going to do? Bank account debited to income account. Bank account debited to income account. Income received. Okay. Then this year's receivable. If it is receivable related to this year, what will you do if it is receivable related to this year? This year receivable. So you'll pass the entry income receivable account debited to income account. Income receivable account debited to income account. And last year's receivable, what we are going to do? Reverse. Last year's receivable, what we are going to do? Reverse. So we are going to pass the entry income account debited to income receivable. Okay, if it is received in advance, what should we do? Received in advance is a liability. So income account debited to income received in advance. Last year's received in advance will reverse. Income received in advance account debited to income account, and balancing figure will be transferred to income and expenditure account. There are some items which we have to discuss. Donation received. If donation is received, it is a general donation. Always it is general donation. Income and expenditure account, income. But if they don't tell anything, it is a specific donation. It will go to balance sheet as liability. It will go to balance sheet as liability. Entrance fees. Entrance fees in balance sheet, you will add it to capital fund. Okay, unless mentioned differently in the question. Okay, entrance fees will always go to balance sheet and it will get added to capital fund. Renewal fees. Renewal fees. Every year you have to renew. So income and expenditure account, it will go to income. Clear? Honorarium. Honorarium. It is income and expenditure account. Expense. Legacy. Legacy means when someone died and in his will he has written that it should go to this NPO. So that will go to balance sheet and will get added to capital fund. Endowment fund. Endowment fund means what? Somebody will give you money and tell don't use that money. So endowment fund, amount received cannot be utilized, but that amount will be invested and return from that amount invested will be taken, can be utilized. So somebody gives me 1 lakh, I cannot use that 1 lakh. 1 lakh I'll invest somewhere. From that 1 lakh, if I get something that I can use for my purpose. Okay, material consumed can also be there. Material consumed will go to income and expenditure account as expense. Material consumed will go to income and expenditure account as expense. Material purchased. Material purchased only will be material consumed if you don't have opening stock or closing stock. You don't have opening stock, closing stock. So whatever you purchase, it will be consumed. Okay, material consumed is equal to opening stock plus purchases minus closing stock. Imagine this is also 0, this is also 0. Then purchase only will become the consumed part. Is this clear? Yes. Club. We can have restaurant as well as other services. So for restaurant, we can prepare trading account is prepared just to find the profit or loss from the restaurant. And other services, income and expenditure account. Other services, income and expenditure account. Profit or loss transferred to income and expenditure account. Clear? First you are going to prepare trading account. Okay, for the restaurant trading activity which is happening, transfer that profit or loss to income and expenditure account. Other services also transfer it to income and expenditure account. Is this clear, guys? This is the concept of NPO. We'll discuss the questions. Okay, let's proceed into the questions, guys, of NPO, non-profit organization. We'll solve some questions. Question number 3. Question number 3. Okay. The following is the income and expenditure account. So they have given income and expenditure account in the question. So what do they expect from you? From you, they will be expecting the receipt and payment account. Okay, income and expenditure account for the year ended is given over here. And you can see at the end of the question, prepare receipt and payment account of GB Club for the year 31st March 2022. Okay, now first thing that we are going to do when we are in question number 3. Okay, we'll go to question number 3. Yes, first thing always we need to prepare is the opening balance sheet. We always need to prepare the opening balance sheet. Now, if you notice over here, everything is given in one table. Subscription in arrears. Subscription in arrears is what? Subscription receivable. That means it is asset. You can find it on the asset side. Subscription receivable. Then you have advance subscription given. That means it is liability. You can check on the other side. Subscription received in advance 1000. Then you have outstanding expenses, rent. Rent is an outstanding expense. So you can see on the liability side, outstanding rent 500. Okay. Then after that you have salaries, outstanding salaries 1200. Then you have outstanding audit fees. That is also a liability, outstanding audit fees. Clear? Then you have sports equipment less depreciation. Sports equipment is what? It is an asset. So you can find sports equipment on the asset side 25,000. Then you have furniture less depreciation. Furniture is also an asset. You can find it on the asset side 30,000. Okay, then that is it. Prepaid insurance is not there over here. Now, if you notice cash, what about cash? Nothing. Capital fund, directly opening balance of capital fund. This you will usually use to prepare the closing capital. Okay, to get the closing capital fund. This plus the surplus or minus the deficit will be your capital fund. Is this clear? After that, let's proceed. Now, going into the question adjustments, book value of furniture sold. They have sold some furniture 7,000. Entrance fees capitalized is 4,000. On 1st April 2022, there was no cash in hand, but bank OD was for 15,000. Can you see bank OD in the opening balance sheet? 15,000. Okay, on 31st March 2023, cash in hand amounted to 850 and rest was bank balance. Okay, opening balance of cash, closing balance of cash, both they have given you. Okay, this is the situation. Now you go into our receipt and payment account. How will you do it? First, salaries 19,500. Can you see salaries of 19,500? Yes. Now here what we have to worry about is, do we have any outstanding salary? Yes. Can you see outstanding salary here? So 19,500 plus, okay, last year's outstanding means this year it would have been paid, plus 1,200 and minus 350. Minus 350. So 19,500 plus 1,200 minus 350, you will get 20,350. This should be your salary. If you go into your receipt and payment account, can you see 20,350? Plus 1,200 minus 350. Clear? Then after that you have rent. Rent is 4,500. Rent is 4,500. Now what you will do? If you check over here, rent plus minus last year's outstanding, this year's outstanding. So you can see over here rent. Okay. Where is it? Yes. Plus 4,000 plus 500 minus 800. Last year's outstanding you add because it is paid this year. This year's outstanding you remove because it is paid next year. That time you will get 4,200. Then after that you have printing. Printing does not have any outstanding. Directly put printing 750. Expense it is. So payment would have been done. Next, insurance 500. Insurance has something that is prepaid insurance. Starting there was nothing, but end of the year there is prepaid insurance. That means next year's insurance they are paid this year itself. So 500 plus 150 you have to add. So it becomes 650. Insurance 650. Next year's insurance, yes, but you have paid. You are preparing receipt and payment account. So you will take 650. Next, after that, Audit fees 750. Audit fees 750. Can you see audit fees over here? 500 and 750. So what will you do? 750. Last year's you will add 500. This year's you will subtract 750. That will lead to 500 of audit fees. 500 of audit fees. Can you see audit fees over here? 500. Yes. Next, after that, you have games and sports. You have spent money for games and sports. There was no outstanding. There was no prepaid also. Directly you are going to write 3,500. Okay. Then you have subscription written off. Okay. Subscription written off. Directly what you are going to do? Subscription. Okay. 350. Can you see 350 subscription written off? Yes. That means written off means removed. So you can adjust that subscription written off with this subscription. Here you have one subscription, no, 68,000. So from 68,000, remove 350. See, 68,000 minus 350. But subscription has lot of adjustments. Arrears. Arrears means what? Receivable. Last year's receivable is received this year. So add. This year's receivable will be received next year. So minus. So plus 2,600 minus 3,700. Okay. Then advance subscription. Last year it was received in advance. So this year it is not received. Already received minus. This year received in advance means next year's subscription but received this year. So add. So minus last year's, add this year's, you will get 67,050. This is the calculation for subscription. Next, after subscription, then what we have? Miscellaneous expense. There is nothing to worry about that. Directly you put 14,500 on the payment side. Then you have loss on sale of furniture. Loss on sale of furniture we don't need. We need what actually, what did you get when you sold the furniture? Now here they have told book value of the furniture sold is 7,000. So here, okay, book value was 7,000, but you sold it at a loss. So minus the loss. Loss is 2,500. So 4,500 is actually the sale value. You sold for 4,500. This is a receipt. It should be there in the receipt and payment account. Can you see sale of furniture? 4,500. Then after that you have depreciation. Depreciation on sports equipment, depreciation on furniture. Depreciation is non-cash. It is non-cash. That's why it will not be there in your receipt and payment account. Okay. Then here you can find income side. There is 5,000 rupees donation. Donation I told you. Okay. If nothing is mentioned, that means it is general donation. Directly put 5,000 over here. Donation 5,000. Okay. Then at the end of the question, they had told entrance fees capitalized was 4,000. Okay. It is capitalized 4,000. That means it is received. No, to be capitalized, it should be received first. So 4,000 is received. You can see 4,000 on the receipt side. That is it. You don't have anything else. Now here opening balance was OD, 15,000 OD. OD is a liability, so it is by balance brought down. Closing balance, you have cash of 850. That is an asset. Asset you carried down, by balance carried down. And whatever balancing figure is there, that is bank balance 7250. Bank balance 7250. Is this clear? This is the receipt and payment account they have asked you. But we will also prepare the closing balance sheet so that we get an idea about it. Closing balance sheet, everything again from this table. From this table over here. First, subscription in arrears. That means receivable asset 3,700. Clear? Then advance subscription. That means received in advance. Liability 1,500. Then outstanding rent. Outstanding rent is a liability 800. Then outstanding salary is a liability 350. Then outstanding audit fees is a liability, so 750. Then sports equipment 24,000 asset. Can you see 24,000? Yes. Furniture asset 27,900. Prepaid insurance asset. Prepaid insurance you will find 150. Okay. Then what we have to worry about? Cash. Given already cash 850. Then what we have to know? 7,250 or something we got, no? Can you see your balancing figure? 7,250. So this will be 7,250. Is this clear? This is your closing balance sheet. Sports equipment account. Okay. sports equipment account we have to prepare. Why did we prepare sports equipment account? Just to see if there is any purchase. Okay, there is a purchase. Sports equipment, can you see in the receipt and payment account payment side? Yes, this sports equipment and this furniture. Okay, how did we get these two numbers? Because we have purchased sports equipment. For that you have to always prepare a ledger. Opening balance is given, closing balance is given. What extra information you have about sports equipment? You have information of depreciation. So you'll write by depreciation 6,000. So automatically balancing figure, this balancing figure is your sports equipment purchase. Put into the payment side. Furniture, you have opening balance, you have closing balance given already. Okay, and then you know the depreciation. From the income and expenditure account, you can find the depreciation. Then amount received by bank and then by P&L. Both these things, okay, both these things we know. Okay, that I'm automatically balancing figure is purchase, and this will also go to payment side of receipt and payment account. This is your question, guys, of when income and expenditure is given and you have to prepare receipt and payment account. Clear? Next, we can go into one more question, that is question number 4. Here also income and expenditure account is given and they want you to prepare the receipt and payment account and the balance sheet as at that date. So they asked you to prepare receipt and payment as well as balance sheet. Okay, let's go into this question as well. Now, one by one, understand things. Where will the subscription outstanding 2022, where will it go? It will go to the opening balance sheet. Okay, we have to have opening balance sheet. Is the opening balance sheet given to us? No. We don't need opening balance sheet because capital fund is given to us. Can you see the capital fund here? 2,20,600. Okay, subscription, we have all 4. Subscription of last year receivable, this year receivable, subscription received in advance, subscription received in advance. All 4 are there. Okay, then you have salary outstanding last year, this year, everything is there. Okay, audit fees also, they said audit fees for 2021-22 paid during 22-23. That means last year's audit fees is paid in the current year. Audit fees for 2022-23 is not paid. Okay, this is 6,000, this is 8,000, this is 2,000, this is 2,500. Building owned by the association for since 2022 cost 1,90,000. This is the building value. Okay, building value they have told. Equipment on 31st of March 2022. Okay, they said equipment value was 52,000. End of the year after depreciation of 7,000, equipment is 63,000. Opening balance of equipment, closing balance of equipment they have given. Now after that, at the end of the year that we have seen on 2021, in 2021, association raised a bank loan which is still not paid. Long back they had taken one loan, it is not paid, that means it will be still shown as liability in the balance sheet. Okay, cash on hand, 31st March 2023, they have given closing balance of cash and cash in hand, opening balance of cash, both they have given. Okay, now we will start. This opening balance of cash, where will you put? You will put it to the receipt and payment account. Opening balance, can you see 2 balance brought down? Closing balance of cash, where will you put it? 28,500. Closing balance of cash, you will put it as by balance carried down 28,500. By balance carried down 28,500. Is this clear? Yes. Now after that you have 2 salaries, 1,20,000 salaries, but salary has an adjustment. Outstanding, last year's outstanding you will add, and this year's outstanding you will subtract. Okay, 6,000, 8,000. So what will you do? Salaries plus 6,000 minus 8,000, you are getting the total salary payment, what payment has been done. Next you go further. After salaries, the next thing is printing and stationery. I don't think there is any adjustment for printing and stationery. Directly you are going to put 6,000. Then you have telephone. Telephone also does not have any adjustment. Directly you are going to put telephone 1,500. Then postage. Postage, what are you going to do? 500. Directly you are going to put postage as 500. Then general expenses. General expenses you are going to put 12,000. Then interest and bank charges, no adjustment. Directly put it on the payment side, 5,500. Then annual dinner expense. Annual dinner expense directly you put 2,500. Annual dinner expense 2,500. Okay. To audit fees. Audit fees, there is nothing actually. One second, guys. Oh, sorry. Audit fees is 2,500. Huh? Audit fees is 2,500. Annual dinner expenses 25,000. Yes, it's done 25,000 annual dinner expense. Okay, audit fees 2,500. What did they tell? This year's audit fees is not paid. So from 2,500, you will remove 2,500. Last year's audit fees is paid this year. What is last year's audit fees? See here, 2,000. 2,000 you are going to add and 2,500 you are going to subtract. So 2,000 will be shown as audit fees. Last year's audit fees is paid, so that you take in the payment side. This year's audit fees is not paid, that you don't take at all. Next, after audit fees, that one, then you are going to see building owned. Okay, that we will see what to do later. This is done, this is done. Then you can see depreciation. Depreciation will not bother us because we are preparing receipt and payment account. Surplus is there. Then subscription 170. Subscription 170. Last year's outstanding. That means this year it is received. Add. This year's outstanding. That means next year it is received. Minus. Subscription received in advance. Okay, last year received in advance minus. This year received in advance plus. Okay, so you will show the subscription plus 16,000 minus plus. Clear? That time you are getting the subscription. Is this clear? Then after that, you have entrance fees. Nothing is spoken about entrance fees. So directly put 4,000 on the receipt side. Then you have contribution for annual dinner. Directly you put contribution for annual dinner 36,000 on the receipt side. Now what you have to do? You have to worry about the equipment. Equipment you have to find out. Okay, you have to prepare a ledger for equipment. Opening balance of equipment is given over here 52,000. 52,000. Closing balance of equipment is given over here 63,000. 63,000. Closing balance of equipment. Then depreciation is given in the question 7,000. So you will write by depreciation 7,000. Automatically you are getting one balancing figure over here. This balancing figure is what? This balancing figure is what? That is equipment purchased. 18,000 rupees we have spent on equipment purchase. You should go to receipt and payment account. 18,000 by equipment. With that, you're done with the receipt and payment account. You can see automatically your receipt and payment account will tally because all the information is given, no balancing figure to be taken. Okay, then what you're going to do, you're going to prepare the balance sheet. You have to prepare the balance sheet. In balance sheet, when you're preparing, this 30,000 will get added to capital. It should get added to capital. Can you see surplus? 30,000 added to capital. Capital was already given, so you'll get the closing capital. Then after that, this year's subscription receivable. This year's subscription receivable. 18,000 is an asset. It should be there on the asset side of the balance sheet. And subscription received in advance is a liability. It should be there on the liability side of the balance sheet. Then after that, salary outstanding 8,000. That should be on the liability side of the balance sheet. 8,000. Then after that, audit fees outstanding 2,500. It should be there on the liability side of the balance sheet. 2,500. Then building 1,90,000 building. Can you see this building here 1,90,000? Okay, that should be there on the asset side of the balance sheet. 1,90,000 asset side of the balance sheet. Then after that, okay, you can see that equipment at the end of the year is 63,000. It should be there on the asset side of the balance sheet. Then they told long time, once upon a time, sir, we have taken one loan, 30,000, still we have not paid. It should be there on the liability side of the balance sheet. Then after that you have cash. Closing cash is how much? 13,600. Sorry, closing cash is 28,500. That should be there. And when with that the balance sheet should tally. This is when they have given income and expenditure account and we have to prepare receipt and payment account. We'll go into the next set of questions. That is, we have to prepare the receipt and payment account will be given and we have to prepare the income and expenditure account. Yeah, question number 5 and question number 6, we will try to do it. Okay. Here what they have given, receipt and payment is given and we have to prepare the income and expenditure account. You are required to prepare the income and expenditure account and the balance sheet. Clear? Yes. Okay. Now, JB Club furnishes you the receipt and payment account for the year ended 31st March 2023. 31st March 2023, JB Club is furnishing you the details. Okay, this is the information that is given in the receipt and payment account. Now you have to prepare the income and expenditure account and the balance sheet. Okay, very good. Now for preparing the balance sheet, do we have information? Yes, opening balance sheet we need to prepare because we need the capital fund. So if you look at the receipt and payment account, this cash and this bank will straight away go into opening balance sheet. If you prepare opening balance sheet, yes, here it is, cash and bank will straight away go into opening balance sheet. Okay. Then you have two donations, 50,000. Now you have to read the additional information. Always you have to read the additional information. Subscription in arrears for 2022-23. Subscription in arrears for 2022-23. That means this year's. Okay. Now that means subscription in arrears. Now we are preparing income and expenditure account. Now we are not bothered about what is received, what is paid. Okay. Now we are bothered about, is it related to this year? Take it. If it's not related to this year, don't take it. This will be plus, and subscription received in advance will be minus. Subscription received will be plus, and received in advance will be minus. Receivable you have to add, and received in advance you have to subtract. Now if you go into subscription, 1,20,000, 1,20,000 plus 9,000 and minus 3,500. Okay, 1,20,000. Where is subscription? Yes, 1,20,000 plus 9,000 minus 3,500. This should be your subscriptions. Is this clear? Yes. Now, after that, interest on investment 10,000. Interest on investment 10,000. We will go to that one by one. Okay. Next, you can see over here 400 was insurance premium outstanding on 31st of March 2023. Insurance premium outstanding 400. What should we do? We should add it. Outstanding always should be added, and then you will show it as liability in the balance sheet. Okay, insurance premium, you will show that. Then they said miscellaneous expense prepaid. Prepaid, what should we do? Minus it. Because it is not related to this year, it is related to next year, minus it. 50% of the donation is to be capitalized. So 50% donation will go to balance sheet and 50% donation will go to income and expenditure account. Entrance fees to be treated as revenue income. That means full entrance fees will come into income and expenditure account. 8% interest has accrued on investments for 5 months. 8% interest on investment is accrued. So what we should do? We should take it as income and we should show in the balance sheet as asset. Balance sheet as asset. Clear? Billiards table and other sports equipment costing 3 lakh were purchased in the financial year 21-22. Last year they have purchased some billiards table, and of which 80,000 was not paid. That means last year they purchased one billiards table, so asset should be shown, and 80,000 pending payment is there, so 80,000 should be shown as liability. Now if you go to the opening balance sheet, can you see opening balance sheet? Billiards table 3 lakh and creditor 80,000. Now you get the capital fund. This is your capital fund. 3,60,000 is your capital fund. Is this clear? Any doubt with this? Okay. Now 3,60,000 capital fund has to be shown. Now 3,60,000 capital fund when you are showing, okay, straight away go into the balance sheet. Can you see the opening balance of capital fund 3,60,000? Then everything else will get added to it. Now this should be it. Now you have to go one by one. Donation. Donation, what did they tell? Half you have to capitalize, half you will take it. Okay, so can you see 50,000 ka donation? 25,000 donation is over here and 25,000 is added over here in the capital fund. Clear? Yes. Next you have entrance fees. Entrance fees full you will take in income and expenditure account itself. So you can find entrance fees 10,000. Here they did not tell that you have to capitalize the entrance fees. Okay. Interest on investments. Interest on investment. Interest on investment is 1,000. 1,000 is received. 1,000 is received. Now you have to check investment. How much is your investment? Your investment is showing 60,000. That means 60,000 into 8%. They said 8% is the interest rate into 5 divided by 12. So 60,000 into 8% into 5 divided by 12 you are getting interest of 2000 actually, but only 1000 is received. Can you see only 1000 is received? That means 1000 is receivable. 1000 is receivable. So what we are going to do? Here we are going to show interest on investment 2000. And in the balance sheet, you are going to show interest receivable 1000. Interest on investment 2000 because accrual concept, you are going to add it, whatever is receivable, and you will show it in the balance sheet 1000. Okay, clear? Now, after that, you have sale of old newspaper, nothing to worry about it. Directly take 4000, sale of old newspaper. One second, sorry, it's not sale of old newspaper. Interest from bank. Interest from bank is 4000 and sale of old newspaper is 1500. So directly you will put 1500 sale of old newspaper. Okay, after that you can see sale of drama tickets. Sale of drama tickets is 10,500. But on the other side, you can see some drama expenses. You can see that there are some drama expenses. So you can set it off. Okay, we will do that. Together we will do it when we find it. Okay, salary 20,000. So go to the income and expenditure account and write salary as 20,000. Repairs to repair expense is 5,000. Miscellaneous expense. After that you have furniture. Furniture you can't put, no, that means you have purchased one furniture, no. So furniture will go directly into balance sheet. Can you see in balance sheet you are finding furniture, okay. Then you have the next thing, investment. Investment, can you put it into income and expenditure account? No, directly you will put investment also into balance sheet. It will be there in the balance sheet. Then you have miscellaneous expense 5,000. Miscellaneous expense 5,000. Go to income and expenditure account and write miscellaneous expense 5,000, but we had something no related to miscellaneous expense. Yes, what was that? Miscellaneous expense prepaid. So you have to subtract. So that makes it 4,100. Clear? Okay. After that, let's go further. Then you have insurance premium. Insurance premium is 2,000. So what will you do? Insurance premium 2,000. We had something like insurance was outstanding 400. So add that, it becomes 2,400. This prepaid also will be there in the balance sheet over here, and this outstanding also will be there in the balance sheet over here. Don't forget to put these items into balance sheet as well. Then after that you have billiards table and other sports equipment. They have purchased some more billiards table, 80,000 rupees. Is it purchased? No, last year only they purchased, but that pending amount was there. No, last year only they purchased, but the pending amount, see over here, 80,000 minus 80,000, the creditor became 0. It is not going to be taken here as new purchase. Last year they purchased, 80,000 was pending, now they paid it. Clear? Then you have stationery expense 1,500. Directly you will put stationery expense 1,500. And after that you have drama expense 5,000. Drama ticket was 10,500. So net you are going to take over here 10,500 minus 5,000. 5,500 will be taken as the net situation of drama. Okay, after that you have drama expenses done. Cash in hand 26,500. It will go to balance sheet 26,500 cash. Then bank balance 72,000. That will also go to balance sheet 72,000. Okay, so income and expenditure account you're done. You just have to use your calculator carefully and you'll get the surplus. This surplus, where will it go, guys? It will go to balance sheet 140,500. 140,500 will go to balance sheet. Then after that you have to see this 9,000 is receivable. It will be there in the balance sheet as well. And this 3,500 received in advance, this will also be in the balance sheet. Then after that you can also have a look. Insurance and all we have already put. Okay, and billiards table 3 lakhs. Last year we had purchased, it was used. Any concept of depreciation is not mentioned in this question. Otherwise depreciation also would have been there. So they have not spoken about depreciation, so we will not worry about depreciation. Clear? This is one kind of a question where receipt and payment account is given and we have to prepare the income and expenditure account. We can go to one more question, maybe 6th one. Yes, 6th question. We will see one more question on NPO, so that 2 questions on receipt and payment to income and expenditure and 2 questions on income and expenditure to receipt and payment will be covered. OB Library Society showed the following position on 31st of March 2022. The balance sheet was given. So you don't have to worry anything. Already they have given capital fund. Okay, very, very important thing. They have already given capital fund. This capital fund will go to balance sheet 7,93,000. Okay, in the balance sheet you can see 7,93,000. Okay. Then after that, expense payable and all, we have to worry about electrical fittings, furniture, books, investment, cash in hand, cash at bank. Okay, this much they have given. And receipt and payment information is also there. Receipt and payment is also there. You are required to prepare income and expenditure account for the year ended 31st March 2023 and balance sheet as at 31st March 2023 after making the following adjustments. Following adjustments we have to make. Membership subscription included 10,000 received in advance. Membership subscription 10,000 received in advance. So what should we do? We have to subtract it. We have to subtract it and show it in the balance sheet. Provide for outstanding rent. What should we do? Add it. Salary, add it. Outstanding rent, outstanding salary. We have to add it and show in the balance sheet as liability. Books to be depreciated at 10%, including additions. Electrical fittings and furniture are also to be depreciated at the same rate. Okay, depreciation will be shown in the income and expenditure account. Okay, 75% of the entrance fees is to be capitalized. 75% of the entrance fees is to be capitalized. Interest on securities is to be calculated at 5% per annum, including purchases made on 1/10/2022 for 40,000. Okay, all this information they have given. One by one, we'll carefully do it. Balance, we don't have to worry. It's already there in the opening balance sheet. Okay, entrance fees, 30,000. What did they tell about entrance fees? 75% is to be capitalized. That means 25% is not going to be capitalized. So this 30,000 entrance fees you can observe over here. In the balance sheet, 75% is added, 22,500. And 25% we will find it as income. Entrance fees, 25% is shown over here as income. 75% to the balance sheet and 25% will be shown in the income and expenditure account. Next, you have membership subscription. Membership subscription is 2 lakh, but they told over here 10,000 is received in advance. So 2 lakh minus 10,000, you're going to show 1,90,000, and the 10,000 you're going to show in the balance sheet as received in advance, liability. Clear? Yes. Then you have next thing, sale of old newspaper, nothing to worry, directly put sale of old newspaper 1,500. Sale of old newspaper, you can directly put 1,500. Okay, then after that you have hire of lecture hall. Hire of lecture hall, any adjustment, nothing, directly you put 20,000. Then you have interest on securities. Interest on securities is 8,000. Now you have to be little careful. Investment they have made, you have to show the calculation. Interest on securities, can you see? We had investment last year. How much investment we had? 1,50,000. On 1,50,000, 5%. Plus we have purchased 40,000 investment. You can find it in the receipt and payment account. Can you see investment 40,000? Investment in securities 40,000. So what will happen? 40,000 into 5% into 6/12 because it is purchased in the middle of the year. So now total investment interest on securities should have been 8,500. But if you see over here, interest which is received, see the receipt and payment account, interest which is received is only 8,000. So 500 is receivable. So in the income and expenditure account, what we will do is take full 8,500. In the income and expenditure account, take full 8,500 as interest, and the 500 you will show as receivable in the balance sheet. 500 you will show as receivable in the balance sheet. Is this clear? Yes. Then you have to go into the other side. Electric charges. Electric charges is 7,200. Directly go and write electric charges 7,200. Yes, over here 7,200 electric charges. And then you can see postage and stationery 5,000. Postage and stationery you're going to put 5,000. Direct everything. Telephone charges you're going to put 5,000. Telephone charges. Then you're going to put books purchase 60,000. Books purchase will not go to income and expenditure account. Look at the earlier situation. How much books we had? 4 lakh. Okay, 4 lakh plus 60,000. Right now you have 4,60,000 of books, and on that depreciation is 10%. So 46,000 of depreciation. 46,000 depreciation on books. Can you see over here? And the books should be shown in the balance sheet. 4,60,000 minus 46,000, 4,14,000. Then after that, the next item that we have is outstanding expenses, 7,000 paid. Last year's outstanding. Can you see last year there was 7,000 outstanding expense that is paid over here, 7,000. That should be the end of the story for outstanding expense. Okay, outstanding expense. Can you see over here 7,000 minus 7,000? Now outstanding expense is 0. Last year's expense you paid this year. Then after that you have rent. Rent, what is there? Rent they have given in the question itself. Outstanding rent 4,000. So add 4,000. So your rent becomes in the balance sheet 92,000 and 4,000 is a liability. Go and put it in the liability side. Outstanding rent 4,000. Clear? Then after that you have salaries. After rent, what do you have? Where are you? Oh, sorry, not salary. After rent, you have investment in securities that we have already taken care of. And then you have salary 66,000. Salary also there is outstanding 3,000. So you will add 66,000 plus 3,000. It becomes 69,000. And 3,000 you will show in the balance sheet as outstanding salary. Clear? Then after that, you have nothing. Balance carried down, you have cash in hand, cash at bank. Both will nicely go into the closing balance sheet. You can see 20,000, 11,300. Okay, done. Then you have to understand what will happen to electrical fittings, 1,50,000. You have to charge 15,000 depreciation. Okay, that time it will become 1,35,000 and here you will put 15,000 depreciation. Then you have to see the next thing is furniture. Furniture you have to remove 5,000 depreciation and furniture will be shown at 45,000. And investment we had 1,50,000. We purchased one more investment, so our total investment is 1,90,000. Okay, now if you check your income and expenditure account will have a deficit of 1,16,700. Okay, deficit of 16,700. Okay, that time your this thing is done and balance sheet is also completed. Balance sheet will automatically tally because you have put everything and you have not missed anything. These are the two types of questions that can be asked in the exam. Okay, guys. Resident payment again they have asked. Yes, you should be good with this. Good to go. Next, we will go into incomplete records. Accounting from incomplete records. And incomplete records, if you see, if you notice, they have asked questions very often. Yeah, we'll solve this question. December 2024, they have asked one 14-mark question. And June 2024, they have asked one 14-mark question. And December 2023, they have asked one 14-mark question. So it's almost like all the three attempts they have asked incomplete records for 14 marks. So we should address all those three questions. First, we will learn the concept of incomplete records. Clear? Let's go into accounting from incomplete records. Okay, let's go into accounting from incomplete records. Next thing is accounting from incomplete records. Now, let's say there is one guy called Pawan, okay, who manufactures hair oil, manufacturing hair oil. Now, cash, he will know because cash is there in his pocket. Bank balance, he will know, he can just go to bank, okay. Who has to pay him, he'll know debtors, and whom he has to pay, he'll know creditors. But with this information, I mean, he has not maintained any books of accounts. This much information he has kept. Accounting from incomplete records is basically they don't maintain books our regular way, that is following double entry system of accounting. They just have some limited information. With that limited information, we are supposed to go and prepare the trading P&L and balance sheet. Basically, final accounts only is asked over here also. Okay, one thing you can keep in mind that if they ask incomplete records, they will not ask final accounts because both the places you are doing the same thing, trading P&L balance sheet. But here you are doing trading P&L balance sheet after you do some additional working notes. Clear? Now, capital computation. How to compute capital? Always we need to understand how capital increases, how capital decreases. This should be there in our mind. So opening capital, if you have opening capital, if you have additional capital, if you put more money, capital increases. Okay, if you take money, that means drawings, capital decreases, net profit, capital increases, and net loss, capital decreases. That time you will get the closing capital. Okay, now debtors to find credit sales. Why we have debtors account? To find the credit sales. Clear? Now one by one we have to understand. Debtors account is a very important and very common working note when we are preparing accounting from incomplete records. Clear? So now here you have to understand one thing. Opening balance of debtor will always be debit balance. So you will write 2 balance brought down. And then you always debtor is a debit balance. So 2 balance brought down and you will carry the balance down. Balance carried down. Then how can debtor increase? Debtor increases when you make sales? No. Debtor increases when you make credit sales. So can you see if you write 2 sales over here, credit sales, 2 sales, that time debtor increases. If you write 2 sales, debtor increases, credit sales. Okay, then if there is sales return, what is the entry for sales return? Sales return account debited to debtors, so debtor decreases. Discount allowed, what is the entry? Discount allowed account debited to debtors, so debtor decreases again. Then bad debts, what is the entry? Bad debts account debited to debtors, again debtor decreases. Then bills receivable, okay, bills receivable, new bill is honored, or sorry, new bill is drawn. That time what we are going to do? Bills receivable account debited, we have done bills of exchange, bills receivable account debited to debtor, bills receivable account debited to debtor, you will get this amount over here. Is this clear, guys? Okay. If the debtor gives you money, that time bank account debited to debtor. Okay. If bill is dishonored, when bill was given, that time debtor decreased over here. If bill is dishonored, always I told you, whenever bill is dishonored, drawee is to be debited. Drawee is nothing but debtor. Okay. Debtor account debited to bills receivable. Finally, you will have the balance carried on. This is your structure of the debtor account. You always have to prepare debtor account. It can be very regularly asked in incomplete records. Okay, next you have to understand total sales. What is your total sales? Cash sales plus credit sales. Okay, credit sales you can find from the debtors account. Cash sales maybe either it will be given directly to you or you have to find the cash sales from the cash account. You have to prepare the cash account and find the cash sales. Clear? Okay. Next you have bills receivable account, which you might have to prepare. Bills receivable account, understand bills receivable is also an asset. So it will always be to balance brought down and by balance carried down. Now, new bill is drawn and accepted. New bill is drawn and accepted. That time what is the entry? Bills receivable account debited to debtor account. Bills receivable account debited to debtor account. Clear? Now, if bill is honored, what is the entry? Bank account debited to debtor account. Okay, bank account debited to, over here it is, sorry, bank account debited to, not debtor, bank account debited to bills receivable. In bills, once it is given, 3 things can happen. One is bill is honored, bill is discounted, bill is endorsed, and the 4th thing also can happen, that is bill is dishonored. Okay, now if bill is discounted, what was the entry guys? Remember your bills of exchange, what was the entry when bill is discounted? Okay, when bill was discounted, the entry was bank account debited, discounting charges debited to bills receivable. Bank account debited, discounting charges account debited to bills receivable. So here you are writing by bank and here you are writing by discounting charges. Bank account debited, discounting charges to bills receivable. Then, okay, that is one thing. Then apart from that, then what are you thinking about? If it is endorsed, endorsed means what, sir? Okay, creditor account debited to bills receivable. So here you will write by creditor. And if bill is honored, what will happen? You will get money. Bank account debited to bills receivable. So you will write over here by bank. And then if bill is dishonored, what will happen? Debtor account debited to bills receivable. If bill is dishonored, you will write debtor account debited to bills receivable. This is the situation of bills receivable account. Very common working note, can be asked. Clear? Now, next you go into creditors account. Creditors account. Sir, why are we preparing, sir, creditors account? Maybe to find credit purchase. To find credit purchase. If you find credit purchase, when you add the cash purchase, you can get your total purchases. Okay. Now, creditor is a liability. So always liabilities will have credit balance. So you'll write by balance brought down to balance carried down. Clear? Next, If you make purchases, what should be the entry for credit purchases? Purchase account debited to creditor. Purchase account debited to creditor. You can see over here creditor. Okay. Next, after that, you have if bills were endorsed, if bills were endorsed to you, or forget, let's say if there is new bills, you have accepted some new bill. If accepted some new bill, what will happen? Creditor account should be debited, creditor account should be debited, and bills payable will be credited. Creditor account will be debited and bills payable will be credited. And we have purchased, but we have returned the goods. So creditor account debited to purchase returns. Creditor account debited to purchase returns. Then if you have received some discount, if you have received some discount, creditor account debited to discount received. Creditor account debited to discount received. And if there is some deficiency, deficiency means what? We are not able to pay money. We are telling Tata bye bye, opposite of bad debt. Then we are writing creditor account debited to deficiency account. Then if amount is paid, creditor account debited to bank account. If it is paid, creditor account debited to bank account. If bill is endorsed to the creditor, then creditor account debited to bills receivable. If new bill is accepted, if new bill is accepted to pay the creditor, then creditor account debited to bills payable. And that bills payable, if we are telling Tata bye bye, we are not going to pay. Bills payable debited to creditor. Bills payable debited to creditor. Is this clear with the creditor? And next we go into bills payable account. Bills payable is a liability, guys, 100% liability. So by balance brought down, to balance carried down. New bills are accepted by you. Somebody drew a bill on you, you accepted it. So what will happen? Creditor account debited to bills payable. Here you can see by creditor. Can you see? If you tell Tata bye bye to the bill, then bills payable account debited to creditor again. If you pay the money for the bill, then bills payable account debited to bank, and this is your balance carried down. This should be it. This much only in bills payable account. Total purchase, you can see cash purchase plus credit purchase. Cash purchase plus credit purchase. Other than these four ledgers which we have discussed, we might have two additional ledgers. What are the two additional ledgers? Cash account and bank account. You can have two additional ledgers, that is cash account and bank account. And main goal is what? To prepare trading account and P&L account and balance sheet. Okay, balance sheet. But usually we don't use the word balance sheet. We will call it as statement of affairs. Why? From limited information, we are trying to prepare the balance sheet, right? So we call it as statement of affairs. With that, we are done with the concepts of incomplete records. Next, we have to solve the problems of incomplete records. This we have to spend proper time and try to understand how to do it. Okay. Now let's very carefully do it, because it's a 14 mark question and incomplete records is a tricky topic. So slowly I'm going to do it. Rahul does not maintain proper books of accounts. However, he maintains a record of his bank transactions and is also to give the following information from which you are requested to prepare his final accounts for the year 23-24. This is the question that is given. Okay, now no cash transactions took place, they said. Now what we have to understand, debtor information is there, so we have to prepare debtors account. Creditor information is there, so we have to prepare creditors account. Stock is something that will go directly to trading account. And bank balance, what will happen? You have to prepare bank account. And fixed assets, you have to see what is the situation with fixed assets also. Now understand this. Okay, understand this. How are we going to prepare everything? Now debtors. Debtor, this opening balance of debtor, where and all it has to go? Opening balance of debtor. Opening balance of debtor has to go to debtors account. One second, guys. What is the question number? 11, right? Ten and 11. Where is 11? 11th question, it's not solved, so let's solve it. Question number 11. Question number 11. So debtors account we have to prepare all this. First, what we need to know? First, we need the trading P&L balance sheet, correct? So first we are going to prepare trading and P&L account for the year ended. Trading and P&L account for the year ended. Which year end they have asked you to prepare? 31st March 2024. 31st March 2024. Okay, little area you will require for trading account, and remaining area you can keep it for P&L account. And then finally you are going to prepare a balance sheet. And the balance sheet will be balance sheet as at 31st March 2024. Balance sheet as at 31st March 2024. Clear? Then what we are going to do, balance sheet as at 31st March 2024. Then the next thing that we are going to do is, after that, the working notes. The working notes, when we are preparing, first ledger that we require is debtors account. First ledger that we require is debtors account. Then obviously we need the creditors account. Then also we need the bank account. Okay, you need the bank account. What else do we need? Fixed assets, we will just analyze it directly. And then we need to prepare the opening balance sheet. Okay, we can call it as statement of affairs as on 31st of March 2023. Now, how you have to prepare incomplete records question, I will demonstrate with this particular question itself. Everything has to happen at once. Everything has to happen at once. So you read the question and you have to solve it at once. Now you see, first I saw this information over here. Debtors 1,02,500. Now I should know, I should go to the debtors account and I should write to balance brought down. To balance brought down 1,02,500. Then I should go to the opening balance sheet and I should write over here debtors in the asset side 1,02,500. So whatever is required out of that number, I have done it. Clear? Next, closing balance is not given. Closing balance is not given, so we have to find out later. Opening balance of creditor is not given, so we have to find that. Then 46,000 is the closing balance of creditor. So what I will do, I will go to creditors account and I will write here by balance brought down, opening balance we don't know, and we are going to write to balance carried down. This we know, to balance carried down 46,000. Okay, closing balance of creditor, where will it impact us? It will also impact us in the balance sheet. So go to balance sheet and write creditors 46,000. Creditors 46,000. So we have done double information there. Then stock, opening stock, closing stock. Where will it impact us? Opening stock and closing stock. It will, opening stock will go to opening balance sheet. You are going to write stock in the opening balance sheet 50,000. And closing stock will be there in the closing balance sheet. In the closing balance sheet, you are going to write stock 62,500. And then it will also go to trading account. You will go to trading account and write to opening stock 50,000. And in trading account, you are going to write by closing stock 62,500. I hope it's clear about what we are doing here. Next, bank balance. Opening balance is not there. So go to bank account and write to balance brought down. We don't have the opening balance. We'll get it later. Then go and write by balance carried down. Do we know the closing balance of bank? Yes, closing balance of bank is 50,000 and you write over here 50,000. And closing balance of bank will go to closing balance sheet. So in closing balance sheet, you will write, in the closing balance sheet, you will write bank 50,000. Then Fixed assets, opening balance of fixed asset will go to opening balance sheet 7,500. Go to opening balance sheet and write fixed asset 7,500. Go to closing balance sheet and write fixed asset again 9,000. Go to closing balance sheet and write fixed asset 9,000. So whatever information is given till now, we have gone in the order and we have finished it. Is this clear? Next, details of bank transactions. Received from debtors. When we receive money from debtors, what should be the entry? Bank account debited to debtors account. Go to bank account and write bank account debited to debtors account 3,40,000. Bank account debited to debtors account 3,40,000, and then go into debtors account and write by bank account 3,40,000. Clear? Then additional capital introduced. Additional capital you have introduced. So what will you do when you introduce additional capital? You will write bank account debited to capital account. You will write bank account debited to capital account 5,000, and then you will go to the balance sheet. You will go to balance sheet and write capital opening balance, we don't know, but plus additional capital 5,000. This we know. So everything that happens we are recording at the same time. Then sale of fixed assets. Book value is 2,500, sold for 1,750. Book value is 2,500, sold for 1,750. So what you will write? Go to bank account and write bank account debited to fixed asset 1,750. 1,750. Maybe you will have to prepare one more ledger, okay, for understanding, that is fixed asset account. One more ledger you can prepare, fixed asset account, and here you are going to write to balance brought down. What is the opening balance of fixed asset? 7,500, and by balance carried down, closing balance of fixed asset is 9,000. Then what you are going to write after you do this much? Then okay, fixed asset, sale of fixed asset 1,750. So you are going to write over here by bank account 1,750. 1,750. So now there is a loss. So you're going to write over here by P&L account 750. How 750? 2,500 ka asset is sold for 1,750. This 750 loss will also go to P&L. Okay, go to P&L and write to loss on sale 750. To loss on sale 750. Clear? Then paid to creditor 2,80,000 is paid to creditor. When you pay to creditor, what should be the journal entry when you pay to creditor? Creditor account debited. You go to creditor account and you write creditor account debited to bank account. Creditor account debited to bank account 2,80,000. 2,80,000, and in bank account you are going to write by creditor account 2,80,000. By creditor account 2,80,000. Then after that you have expenses paid. Expenses paid, what should be the entry? Expenses account debited to bank account. So you're going to write over here by expenses account, okay, 49,250. 49,250, and expense should also go to your P&L. Go to P&L and write to expenses 49,250. Clear? Next you have personal drawings. Personal drawings means amount taken for personal purpose. So you're going to write over here in the bank account, drawings account debited to bank it is. So you're going to write by drawings 25,000. 25,000. And then what we are going to do after you write by drawings, then you are going to go into the balance sheet and you are going to write minus drawings 25,000. Is this clear? Yes, then you have purchased fixed assets. Purchased fixed assets 5,000. So you'll go into the fixed assets ledger and you'll write fixed asset account debited to bank account, fixed asset account debited to bank account 5,000. And then you'll go to bank account and write buy fixed asset 5,000. Okay, this much information we have. Then no cash transactions took place during the year. Cash transaction is not there, only bank. Goods are sold at cost plus 25%. Goods are sold at cost plus 25%. Cost of goods sold is 2,60,000. They have given you the cost of goods sold. So can you get the sales? Yes. Go into trading account. Go into trading account and write buy sales 2,60,000 plus 25%. Cost plus 25%. So 2,60,000 plus 25%. 3,25,000. 3,25,000. Okay. Now you know 3,25,000. What are you going to do with this now? 3,25,000. Okay. Straight away you have to pass a sale entry. What is sale entry? Debtor account debited to sales. Debtor account debited to sales 3,25,000. Okay. 3,25,000 is your sales. Debtor account debited to sales. This is how you found the sales. Clear? Now actually if you look at the question, we are done with everything in the question. Okay, debtor account, you have opening balance, you have closing balance is not given, you have opening balance, you have sales, and you know the amount received. So automatically you should get the closing balance. So you'll write over here by balance carried down, and this will be the balancing figure. So 102,500 plus 3,25,000 minus 3,40,000. You have 87,500. 87,500 is your closing balance of your debtors. Now what will you do with this 87,500? Go to the balance sheet. Okay, go to the balance sheet and write debtors. Yes, over here, write debtors 87,500. Clear? Done. After that, the next thing, debtors ledger is done. We'll go in the order. Yeah. After debtors ledger, creditors ledger. Creditors ledger, if you see, you know opening balance, you know this thing. You don't know the opening balance, you know the closing balance, and you know the amount paid. You don't know one thing over here, one more thing over here, that is purchases. By purchases. How will you find purchases, guys? How will you find purchases? Do you know one situation over here? We need to find purchases. I can get purchases straight away as the balancing figure because I know how to find gross profit. How to find gross profit? Sales minus cost of goods sold. How much is your sales? 3,25,000. How much is the cost of goods sold? 2,60,000 given in the question. So 3,25,000 minus 2,60,000. You have gross profit of 65,000. Gross profit is 65,000. Now what you're going to do? Gross profit, you got 65,000. Okay. Now you have to be a little careful. Whatever you do, take your calculator. 325 plus 62,500 minus 50,000 minus 65,000. 2,72,500 is your purchases. 2,72,500 is your purchases. So go to creditors account and write purchases 2,72,500. When you get purchases, automatically what will happen? You will get the opening balance 2,80,000 plus 46,000 minus 2,72,500. 53,500 is your balancing figure. This is your opening balance. Okay, sir, I found the opening balance of creditors. What should I do with this? Go to the opening balance sheet and put it. Opening balance sheet, put creditors 53,500. Clear? Now after creditors, the next ledger that we have prepared is bank account. Bank account, same problem. We know the closing balance, but we don't know the opening balance. So 2,80,000 plus 49,250 plus 25,000 plus 5,000 plus 50,000 minus 3,40,000 minus 5,000 minus 1,750. 62,500 is the opening balance. This is your balancing figure. 62,500 is your opening balance. So what will you do? Go to the opening balance sheet and write bank 62,500. Okay. if you look at fixed assets account, you have opening balance, you have closing balance, you have purchase, you have sale. So 7,500 plus 5,000 minus 1,750 minus 750 minus 9,000. You're getting a difference of 1,000, and this difference of 1,000 is depreciation. By depreciation, balancing figure, it is 1,000. By depreciation, balancing figure is 1,000. Go to the P&L account and straight away write to depreciation 1,000. To depreciation 1,000. Clear? Sorted. Everything is sorted. Now only thing that you have to get is the opening statement of affairs. From that you have to get the balancing figure, that is your capital fund. That is your capital fund, which is going to be the balancing figure. So 7,500 plus 50,000 plus 102,500 plus 62,500 minus 53,500. That time you will get 1,69,000 as your capital fund. What will you do with this capital fund? Go to the balance sheet. Go to the balance sheet and write opening balance 1,69,000. Clear? Now you can close your trading P&L. You have the gross profit already, right? By gross profit brought down 65,000. Now using that you will be able to find the net profit. To net profit carried forward to balance sheet. So you can write 65,000 minus 750 minus 49,250 minus 1,000. So you get a net profit of 14,000. Your net profit is 14,000. So you will write over here plus net profit 14,000. With that you will get the closing capital 1,69,000 plus 5,000 minus 25,000 plus 14,000, 1,63,000. With this you should be able to close the balance sheet. Yes, your balance sheet total is 2,09,000. This is your solution, guys. This is your solution. Okay, you can have a look at the trading and P&L and complete it. After trading and P&L, the next part, balance sheet and debtors account is also visible. Then you have creditors account, bank account. Then you have opening statement of affairs and fixed asset account. With that we should be done. Yes, I have demonstrated how to solve an incomplete records question, because you can't read part by part and solve part by part. You have to read one by one and you have to enter it everywhere in the solution, wherever it is relevant. Okay, next we go into question number 12. Question number 12, they have told June 2024. This is also asked for 14 marks. Okay. Sohan is a small trader. Sohan is a small trader and does not maintain his books on the double entry system. The details of his business are available as follows. Details of his business are available as follows. And they have given you on 1/4/2022 what was the situation, and 31st of March 2023 what was the situation. Is this clear? Yes. 1/4/2022 and 31st of March 2023 what is the situation they have given. Now, when you have this information, what will you do? Cash in hand is 0. What will you do? You can clearly see that you have to prepare a cash account, you have to prepare a bank account, you have to prepare a debtors account, you have to prepare a creditors account, you have to put stock into the respective places, investment you have to analyze, maybe plant account, furniture account also we will have to do. These are the regular things we have to do. So now what I will do, first thing, cash account. Where will cash go? Cash here it is 0, but closing it is 1,000. So everywhere where it is relevant, we have to go and enter this cash. Okay, first we will go to the cash account. Okay, opening balance sheet, there is no cash. You have to put cash into the closing balance sheet. Can you see 1,000 in the closing balance sheet cash? Okay, then actually in this question, they have not asked you to prepare trading P&L and balance sheet and all. They have just asked you are required to ascertain Sohan's profit or loss for the year. Only profit or loss they have asked you to calculate. Okay, so you don't need to prepare trading P&L and all. Now next, after that, Bank balance 74,000 credit. 74,000 credit means what? OD. So you can see over here bank OD 74,000 and bank balance 40,000 debit. 40,000 debit means what? Normal bank balance. So you can see over here 40,000. 40,000. Is this clear? Next, after that you have sundry debtors 5,30,000. Sundry debtors 5,30,000 and sundry debtors 8,80,000. Okay, sundry debtors 5,30,000 and 8,80,000. So you can see over here sundry debtors 5,30,000 and sundry debtors 8,80,000 into the balance sheet, directly into the balance sheet. Clear? Sundry creditors 1,50,000 and 1,95,000. So you will write sundry creditors 1,50,000 over here and 1,95,000 over here. Clear? Stock 1,70,000 and 1,90,000. What is the stock? Opening stock, closing stock. Okay, you can see stock here 1,70,000 and you can see stock over here 1,90,000. Then you can see investments 1,20,000 and 1,35,000. You can see investment of 1,20,000 and 1,35,000. So you will go into investment, you will write in the balance sheet 1,20,000, 1,35,000. Okay, then you can see plant 2,00,000, 2,00,000. Plant is 2,00,000. Here also you can see the 2,00,000 here, but there is depreciation. Then you can see furniture 14,000, 14,000. Here it is 14,000, but here you can see 14,000. There is going to be depreciation. So now what happens? If you notice your the capital, okay, sorry, if you see your opening statement of affairs, automatically you will get the opening capital fund. This is the balancing figure. Now, what else they have told? They have told Sohan has withdrawn 3 lakhs. Now, depreciation rates are given over here. Write off depreciation on plant at the rate of 15% per annum and on furniture at the rate of 10% per annum. So therefore, we have removed 15% and we got 170 here, and we removed 10% and we got 12,600 over here. Okay, then they have also told that a provision of 5% on sundry debtors is necessary. So remove the provision of 5%, 44,000. That time you will get the debtors. That time automatically you will get the closing capital also. You know opening capital, you know closing capital. I told you how capital movement will happen at the starting of the concepts of incomplete records. Now you know the opening capital 8,10,000. Opening capital 8,10,000. They said Sohan has withdrawn 3 lakhs. If they has withdrawn, it will reduce. So it will be minus 3 lakhs. Then he introduced fresh capital of 65,000. Because he introduced fresh capital, you will add 65,000 plus 65,000. Then after that, provision is done, that and all is done. Interest on opening capital is to be allowed at the rate of 10% per annum. What is the opening capital? 81,000, 8,10,000. On that you have 81,000 of interest. So this becomes 81,000 you have to add. Then the manager is entitled to a commission of at the rate of 10% on the net profit after charging such commission. 10% after charging such commission. Now you got to know, we'll keep that commission thing pending. We got to know that after you add and minus all this, it is 6,56,000. If you see the closing capital, it is 11,89,600. What is the difference? The difference is profit. What is the difference? The difference is profit. 5,33,600. Okay, you can see over here you are getting a profit of 5,33,600. That's the difference between this thing. And commission is 48,509. 10 by 110, you will get the profit over here. Is this clear? A simple question that they have asked in the exam. Let's go into next question. Question number 13. Okay, 14 mark question again. 14 mark question they have asked. Okay, Rajesh does not maintain proper books of account. From the following particulars, prepare trading and P&L account for the year ended 31st March 2023 and the balance sheet as on that date. Okay, now one by one we have to do it. Okay, debtors. Where will I put this? I will put it into the opening balance sheet, closing balance sheet, and in the debtors account. Okay, go into the opening balance sheet. Can you see debtors as 90,000? And go into the closing, go into the debtors opening balance, debtors closing balance. Then go to the closing balance sheet. Can you see debtors 1,25,000? All things done at once. This is how you are supposed to prepare incomplete records questions. Then stock 49,000, 66,000. It will be there in the closing balance sheet. Closing stock 66,000. and it should be there in the opening balance sheet, opening stock of 49,000. Then in your trading account, you should find this trading account. Can you see to opening stock by closing stock? Clear? Then furniture 5,000 and 7,500. Where will you put furniture of 5,000? You'll put it into the opening balance sheet, and furniture of 7,500 you should put it into the closing balance sheet. Then after that you have creditors 30,000 and 22,500. Creditors, what you will do, put 30,000 creditor into the opening balance sheet and put 22,500 creditor into the closing balance sheet, and go to your creditors account and write by balance brought down, to balance carried down. By balance brought down and to balance carried down, 22,500. Is this clear? Then summary of other transactions is as follows. Summary of other transaction is as follows. Cash collected from debtor 3,04,000. Cash collected from debtor is 3,04,000. So what will you do that time? Okay, cash balance. Where is the cash balance? Okay, opening balance of cash. Maybe later in the question somewhere they have told. See, he had 25,000 as cash balance at the beginning of the year. That's how you get to balance brought down 25,000, and go to opening balance sheet also and put 25,000. Can you see in opening balance sheet all the things are there? That time automatically you will get the capital fund as 1,39,000 is your capital fund. Where will you put this 1,39,000? Straight away go into balance sheet. Straight away go into balance sheet and write 1,39,000 opening capital. Clear? Then we have to read the transactions. They have told cash collected from debtors. Cash collected from debtors, what should be the entry? The entry should be cash account debited to debtors 3,04,000. Go to debtors also, and can you see this 3,04,000? Yes. Next, after that they have told cash paid to creditors. The entry for this is creditors account debited to cash account. Go to creditors account and write creditors account debited to cash account 2,20,000. Clear? Next, after that you have salaries 60,000. Salaries 60,000. So what should be the entry for this? Salary account debited to cash account. Salary account debited to cash account 60,000, and you can find the salary account debited to cash account 60,000, and you can find the 60,000. Where is the 60,000? Yeah, in the P&L you can find the 60,000. Then after that you have rent 7,500. So you'll write rent account debited to cash account. In cash 7,500 is there, and rent you have to show in the balance sheet, in the P&L as 7,500. Next, office expense 9,000. Office expense account debited to cash account. So can you see 9,000 gone in the cash account, and you have to show this office expense in the P&L as 9,000. Then you have drawings of 15,000. What is the entry for drawings? Drawings account debited to cash account. Drawings account debited to cash account. So you can find over here in the cash account by drawings, and drawings will be subtracted from the capital. So in capital you can find minus drawings 15,000. Clear? Next you have additional capital introduced. Additional capital introduced, the entry is cash account debited to capital account. Cash account debited to capital account 10,000, and the 10,000 should be added to the capital. You can see 10,000 is added to the capital. Then you have cash sales. Cash sales, what is the entry? Cash account debited to sales account. Cash account debited to sales account, and this should also be there in the trading account. You should add 7,500 cash sales. Clear? Yes. Then you can find cash purchases. The entry for this is purchases account debited to cash account. You can find over here by purchases, and in the trading account 25,000 should be shown as purchases. Then after that you have discount received. Discount received, what should be the entry? Discount received is creditor account debited to discount received. Go to creditor account and write creditor account debited to discount received 3,500. Go to P&L. Go to P&L and show discount received of 3,500. Discount allowed. Discount allowed, what is the entry? Discount allowed account debited to debtor. Go to debtor account. You can see discount allowed over here 1,500, and it's an expense. It should be shown in the P&L 1,500. Then what you're going to do? Next item, that is returns inward. Returns inward means sales return. For that the entry is sales return account debited to debtors. Go to the debtors account and show the sales return 5,000, and in trading account you will subtract the 5,000. Then after that, returns outward. Returns outward means purchase returns. Purchase returns, go and write returns outward. Returns outward. You will go into the creditors account and at creditors account debited to purchase return, and go to trading account and subtract the 4,000. Next, you have bad debt. Bad debt entry is bad debt account debited to debtors. Bad debt account debited to debtors. So now you have debtors account by bad debt 1,000. Clear? With that, we are actually done with all the things that are given. Now you have to do one by one. Debtors, if you notice, everything is marked. That means only missing figure is sales, 3,46,500. Where should we put this sales? We should put it into the trading account, 3,46,500. That time you will get your total sales in the trading account after subtracting the returns. Going into the creditors account, can you see everything is marked? Only thing that is missing is the credit purchase, 2,20,000. So go to the trading account and write plus 2,20,000. You will get the closing balance. You will get the total purchases. Then after that, if you see the cash account, everything is there. Okay, but furniture we have to analyze. Furniture, what did they tell? Furniture was 5,000. So 5,000 is the opening balance. Closing balance is 7,500. Then what did they tell about furniture? Did they tell any furniture purchased or anything like that? No. They haven't given any information about furniture. So we are analyzing over here. 5,000 became 2,000, 7,500. No information about depreciation also. So this missing 2,500 is there. No. That is new furniture purchase. So the entry should be furniture account debited to cash account. Furniture account debited to cash account, and then the closing balance is the balancing figure, which was not given in the question. Okay, closing balance is the balancing figure. So the 7,500 will go to the closing balance sheet, 7,500. Now you can see missing figure in the trading account is the gross profit. Bring that gross profit down, and missing figure bad debt we have already put in the P&L, and then the missing figure here is net profit. Net profit will get added to balance sheet. Okay, that time you will get your closing capital. Your balance sheet will also tally. 14 mark question in the exam. Easy 14 marks in the exam. Is this clear, guys? Yes. Okay, students, let's proceed further into the next very important small chapter called as partnership. Very important and small chapter, partnership. So first what we will do, we will go through all the concepts and we'll try to solve a majority of the questions of partnership. We'll go through majority of the questions of partnership. Okay, first, what is partnership? Two or more persons join together for conducting business with an intention to earn profit. Two or more people, they are together. Why they are together? They want to earn profits. Okay, partnership, when we are talking about what and all is there, we have to understand the basics. Then we go into admission of a partner. Then we go into retirement of a partner, death of a partner, dissolution, sale, then conversion into company, and amalgamation of partnership firms. Everything is covered. We have to discuss everything. Now first we'll talk about basics. What is a partnership agreement? What is a partnership deed? Partnership agreement is basically rules like day to day what and all has to happen, who is going to do it. That is called as partnership agreement. Okay. When this partnership agreement is registered, it becomes a partnership deed. When it is registered, it becomes a partnership deed. Clear? If not mentioned in partnership deed, there are some points. If it's not mentioned in the partnership deed, it is not possible. That is, profit sharing ratio should be equal. If it is not mentioned, profit sharing ratio will always be equal. And if it is not mentioned, that means if you have not agreed, you cannot give any salary or remuneration to partners. No interest on capital. No interest on drawings. No interest on drawings. Interest on loan of partner is there. No, maximum you can give is 6%. These are some conditions which are there. If it is not mentioned in the agreement, then you should go ahead and follow these rules. Okay. Now, drawings and capital withdrawn. What is capital withdrawn? I put money, that only I am taking back. Amount introduced is withdrawn by the partner. What is drawings? Amount related to the firm, that is profit or amount that firm has earned, taken in anticipation of profit. That means firm money you are using for personal purpose, that is called as drawings. Interest on capital. Interest on capital. How to calculate? Take the capital, multiply the interest rate, see how many months the capital was there. So months divided by 12. Now imagine there is capital. Pawan has capital of 2 lakhs. Divya has capital of 1 lakh. Interest on capital is 10%. Interest on capital is 10%. So what you're going to do that time? Interest will be basically, okay, 2 lakh into 10% into 12 by 12. That is your 20,000 interest. Imagine if capital is introduced on 1/7. On 1/7 they have introduced capital 50,000. That time it's going to be 50,000 into 10% into 9 by 12. 50,000 into 10% into 9 by 12. So 9 months interest will be calculated. And then capital is withdrawn. That means you have taken the capital. So 30,000 into 10% into 3 by 12. 3 months, no need to give interest. So minus, that time you will get interest on capital of 23,000. Next we go into the topic interest on drawings. Interest on drawings. Here, interest on drawings, you have to understand what is the interest on drawings given in the question. 10%. Interest on drawings is 10%. Now imagine Pawan and Divya are partners. Again, Pawan and Divya are partners and drawings is done on 1/6 and 1/2. 1/6 and 1/2. In drawings, whenever you take money from that day, interest has to be calculated. Clear? Now, 20,000 into 10% into 10 by 12. Why 10 by 12? April, May done. So remaining 10 months are remaining. 10 months interest will be charged. Then 15,000 into 10% into 2 by 12. Why 2 by 12? February, till February everything is done. Only February and March remaining. So 2 months interest has to be calculated. 1917. Is this clear? Next. Pawan. Drawings. 1,000 per month on first. So if you have a pattern, if a pattern is there, every month you are taking 1,000 rupees, then the interest will be calculated like this. Total drawings into rate into 6.5 divided by 12. You will use this formula. So 1,000 into 12, total drawings is 12,000 into rate into 6.5 divided by 12, you will get 650. Now, Pawan is taking drawings 1,000 per month on 15th. 1,000 per month on 15th. Middle of the month he is taking. Then total drawings into rate into 6 divided by 12. Total drawings into rate into 6 divided by 12, you will get 600. If at all that fellow is taking at the end of each month, if it's taking at the end of each month, total drawings into rate into 5.5 divided by 12. You can use this formula only when amount is same and the dates are same. Now imagine Divya, drawings 6,000. They just told 6,000 is the drawings. They did not tell when. Okay, they did not tell the date. So that time it is always assumed that it is evenly drawn during the year. So you are going to take 6 divided by 12. You are going to take 6 divided by 12. 6,000 into 10% into 6 divided by 12, 300. Clear? Next. Goodwill. Goodwill is the reputation of the business. Goodwill means what? Reputation of the business. Now what are the factors that are affecting goodwill? Now imagine you have a college. Okay, you have one person called as Santosh. He is selling these balloons. Okay, this heart-shaped balloons he is selling. Okay, heart-shaped balloon. Now imagine what are the factors that are affecting goodwill? Location. That means if you are selling next to the college, then you will have an advantage over somebody else who is selling somewhere else. Customer satisfaction. That means if you are always giving the balloon to the customer with a smile, that means customer satisfaction. That can be your factor that is affecting your reputation. Reputation of owner. If owner is famous, like we have Trump as a partner, then if owner is famous, automatically you will also have that reputation. Technological advantage. Technological advantage. Imagine you are giving some product which is very unique. Nobody else can make that product in the market. That time also you will have an advantage, or you will have that will affect your reputation. Okay, next. Computation of goodwill. We have different methods to compute goodwill. First one is simple average profit method. In this, what we will do, how we will find the goodwill? Goodwill is equal to average profit into number of years of purchase. Number of years of purchase will be given in the question. Average profit we have to calculate. Average profit is equal to total all the profit divided by number of years. Example, if they give you the profit of 2022, 2023 and 2024, total the 3 years profit and you will get the average profit. In case they told number of years of purchase is 5, average profit into 5, you will get the total goodwill. This is your simple average profit method. Next, we move into weighted average profit method. Okay, goodwill is equal to weighted average profit into number of years of purchase. Goodwill is equal to weighted average profit into number of years of purchase. Weighted average profit is equal to total product divided by total weight. Total the product divided by total weight. Okay, sir, how to find the product? You have to give weightage. 1, 2, 3. How to give this 1, 2, 3? Highest weightage will be given to the most recent year. Which is the most recent year over here? 2024. Can you see highest weightage is given? Then lesser weightage for the other years. Clear? Weighted average profit will be 5,50,000 divided by 6. This is the product. This is the weights. Okay, divided by 6, 91,667. Clear? Goodwill is equal to 91,667 into 5. You will get the goodwill. So you have to calculate the product. Okay, divided by the weights, you will get the weighted average profit. Highest weightage for most recent year. This is the most important thing. Doesn't matter if the profit is in ascending order or descending order. You should always give the highest weightage to the most recent year. Super profit method. Super profit method. You are going to get goodwill. Goodwill is equal to super profit into number of years of purchase. Super profit into number of years of purchase. Okay, now super profit is equal to average profit minus normal profit. Super profit is equal to average profit minus normal profit. Okay, normal profit is equal to capital employed into NRR. Capital employed will be given in the question. NRR is normal rate of return. Both will be given in the question. So what you will do? You will find the normal profit. You know how to find the average profit. Difference is called as super profit. Multiply it into number of years of purchase. You will get the goodwill. Okay, this is your profits. For 3 years, you're getting the profits. Capital is 5 lakhs. NRR is 10%. NRR is 10%. Now, average profit is given over here. Average profit. Normal profit, how will you find out? 5 lakh into 10%. Normal profit, you got 50,000. Super profit, you got multiply into number of years of purchase, you will get the goodwill. Annuity method. In annuity method, what we do? Goodwill is equal to sum of present value of super profits. Goodwill is equal to sum of present value of super profits. So in this case, what you are going to do? Okay, you have to take the year. Okay, you have to take the year. Okay, put the goodwill, and goodwill you have to calculate present value of that super profit, whatever you are going to calculate. Now, present value factor, if at all they have given NRR as 10%, then you will take present value at the rate of 10%. How will you get the present value? Take your calculator. 1 divided by 1.1 is equal to, press is equal to, you will get 0.909. Go on pressing is equal to, you will get 0.826. Press is equal to, you will get these numbers. That time you will get present value of super profit. Present value of super profit. If someone is not getting these numbers in their calculator, they can use the alternative method. 1 divided by 1.1. Press into. Then go on pressing is equal to. The numbers will keep changing and you will get these numbers. Clear? Multiply, you will get the present value of super profit. This is your goodwill. Next, capitalization method. Capitalization method. Goodwill is equal to, okay, normal value of business minus actual capital employed. Actual capital employed, you know, it will be given in the question itself. Normal value of business is nothing but average profit divided by NRR into 100. Okay, now average profit, you all know how to calculate. Average profit divided by NRR. NRR is 10, multiply into 100. You got normal value of business. But can you see your actual capital employed is how much? 5 lakhs. So minus, that time you will get the goodwill of 333,330. Do you understand this? These are the methods to compute goodwill. Very, very important. You have to know all the methods. Now, admission, retirement, death, anywhere. Just understand one thing. Goodwill share to be given by gaining partner to sacrificing partner. Goodwill share will be given by gaining partner to the sacrificing partner. Whoever is gaining will give it to sacrificing partner. So you have to always calculate sacrificing ratio. Old ratio minus new ratio. Old ratio minus new ratio. So what we will do, old ratio minus new ratio, you have to understand one thing. When you do this old ratio minus new ratio, if you get positive number, you got positive number, that means it is sacrifice. But when you did that, you got a negative number. That means that partner is gaining. Example. Pawan and Divya, okay, have profit sharing ratio of 2:1. Pawan and Divya, their profit sharing ratio is 2:1. Who are the partners? Pawan, Divya and Ram. Now their new profit sharing ratio is 4:3:2. So what you will do? Old ratio. Old ratio is what? Pawan, Divya, Ram, right? Old ratio is 2 minus 3. 2 by 3. Okay, because it is 2:1 and here it is 1/3 and Ram was not even there, so his old ratio is 0. New ratio 4:3:2, so 4/9, 3/9 and 2/9. Now you have to just take your LCM and you have to calculate. Here you got 2/9, that means sacrifice. Here you got 0, that means no sacrifice, no gain. Here you got minus 2/9, that means this partner is gaining, this partner is sacrificing. Who has to give to whom? Gaining partner has to give to sacrificing partner. So you will pass the entry Ram's capital account debited to Pawan's capital. Ram is supposed to give, so take from his capital account. Ram's capital account debited. Pawan is supposed to get, so Pawan's capital account is credited. Clear? Admission of a partner. Let's go into admission of a partner. There are certain things that we have to always learn or always know when we are doing admission of a partner. First thing is new profit sharing ratio. First thing is new profit sharing ratio. You need to calculate the new profit sharing ratio. Okay, after you do the new profit sharing ratio, the next thing is sacrificing ratio. How will you calculate sacrificing ratio? Old profit sharing ratio minus new profit sharing ratio. That time you will get the sacrificing ratio. Then you have to do the goodwill computation. How will you do the goodwill computation? Average profit, super profit, capitalization, weighted average profit, annuity, all these methods are there. Compute the goodwill. Then the new thing is, which we have to learn, which we are going to learn in admission of a partner, is revaluation of assets and liabilities. You have to revalue the assets and liabilities. So what you will do? Increase in assets. If there is an increase in asset has to be debited. So asset account debited to revaluation account. Asset account debited to revaluation account. Decrease in asset. If asset is decreasing, revaluation account debited to asset account. Revaluation account debited to asset account. Increase in liability. Liability is increasing. Then revaluation account debited to liability account. Revaluation account debited to liability account. But in case liability is decreasing, then liability account debited to revaluation account. If at all you are confused with this, you can always think in two angles. One, asset increase. Asset should always be debited. So credit will be revaluation. Asset decrease. So asset should be credited. So debit is revaluation. Liability increase. Liability should be credited. So revaluation is debited. Liability decrease. Liability should be debited. So revaluation is credited. That is one angle. Another angle is what? You are going to think asset increase, profit. So revaluation credited. Asset decrease, loss. Revaluation is debited. Liability increase bad, so revaluation is debited. Liability decrease, good, so revaluation account is credited. Revaluation account is credited. Is this clear? Okay, this is the angle. If you have profit or loss, you should transfer it to all the partners. Okay, you should give it to the partners. So revaluation account is debited. It will be given to old partners capital account. Old partners. So we are telling the new partner, wait, you wait at the door only. Don't enter. You wait at the door. We will share the revaluation profit, then only you are allowed, because this belongs to old partners. Then if it is a loss also, loss will be borne by old partners. Old partners capital account debited to revaluation account, and both of this will be done in old profit sharing ratio. Next, memorandum revaluation account. When do we prepare memorandum revaluation account? They will tell you do revaluation, but don't do revaluation. Sir, what are you talking, sir? They will tell you do revaluation, then they will tell asset and liability should be shown at original value. When after admission, partners agree to show the assets and liabilities at original value, that time value before revaluation. You should show the value before revaluation. That time what you will do? First you will revalue all the assets and liabilities, revalue, share the profit or loss between old partners in old profit sharing ratio. Then what you will do? Reverse the revaluation, profit or loss share among all partners, including new partner in new profit sharing ratio. Share among all partners, including new partner in new profit sharing ratio. Is this clear? Now, fifth point of admission is reserves. Reserves means what? In the past, we have made some profit and we have kept, but we had not given it to ourselves. We had not distributed to the partners. So share among old partners in their old profit sharing ratio. So reserves account debited to old partners capital account. Reserves account debited to old partners capital account. Clear? Next we have admission. Admission, what is going to happen? Everything you did now till now you kept the person waiting at the door, no calculated goodwill, everything you did, we kept the person waiting. Now capital is introduced. That fellow will bring capital. Now two things can happen. He will just bring capital, or he will tell, I will give capital also, I will give my share of goodwill also. Okay, if he gives capital plus goodwill share, or if he gives only capital also, the entry is bank account debited because money comes in to new partner's capital account. You'll put into his capital account. Amount brought by new partner. Now, goodwill distribution, you understand. Goodwill distribution, whether he brings goodwill share or it does not bring goodwill share. If he brings goodwill share, okay, whatever goodwill he brought, we will distribute it. If he does not bring goodwill, no problem. He brought capital, no. From his capital, we will take the goodwill share. So his capital will reduce. Now, goodwill distribution will be gaining partner's capital account debited to sacrificing partner's capital account. Gaining partner's capital account debited to sacrificing partner's capital account. New partner, old partner. New partner is usually gaining, old partners can be sacrificing, but you will not come to a conclusion. You have to calculate old ratio minus new ratio. Now, existing goodwill in the books. Existing goodwill in the books. Goodwill is written off. Existing goodwill in the books. Goodwill is written off. If you see goodwill on the asset side of the balance sheet, it should be written off. How will you write it off? Old partner's capital account debited to goodwill account. Old partner's capital account debited to goodwill account in old profit sharing ratio. Then making capital proportionate. This they will tell you in the question itself. Make capital proportionate. Making capital proportionate means what? Capital should be in the profit sharing ratio itself. Okay, keeping, one thing they will tell, keeping new partner's capital as the base. They will tell keep the new partner's capital as the base and make the capital proportionate. When that time what you will do, take the new partner's capital, that is the base capital for you. Based on that, calculate the total capital, then distribute it between the partners. If there is surplus, give the partner the money. If there is deficit, take money from the partner. Is it clear? Yes, that is your admission of a partner. Okay, next what we are going to do? Next we are going into retirement of partner. Retirement of partner. Now, partner leaving the partnership firm voluntarily. Retirement means what? Partner leaving the partnership firm voluntarily. Let's see the steps. Again, new profit sharing ratio we have to calculate. Okay, ratio among the remaining partners after retirement. New profit sharing ratio is ratio among the remaining partners after retirement. This fellow when remaining partners are there, in what ratio it will be shared? That is called as new profit sharing ratio. Sacrificing ratio. Sacrificing ratio will be same. Old ratio minus new ratio. I told you this. If answer is positive, sacrifice. If answer is negative, gain. If answer is positive, sacrifice. If answer is negative, gain. Okay, then you are going to do goodwill computation. Then you are going to do goodwill computation. We know how to do that: average profit method, super profit method, annuity method, weighted average profit method, capitalization method. Goodwill distribution. Goodwill distribution. Gaining partner will give to sacrificing partner. You have learned the entry also. Gaining partner's capital account debited to sacrificing partner's capital account. Revaluation of assets and liabilities. Same as before. We have discussed this. Profit or loss shared between all the partners, including the retiring partner. Retiring partner also will distribute the profit because even he is one of the old partners. Then he will go. Then the new partner, remaining partners will continue. Reserves. Share between all partners, including the retiring partner. Including retiring partner. In admission, what happens? Only old partners share it. New partner will not get it. In retirement, what happens? All the partners get it. Then the retiring partner will go. Goodwill existing in balance sheet. Write off all partners capital account debited to goodwill. Write it off among all the partners. Now JLP or SLP. This is a very important thing. Joint life policy or separate life policy. Joint life policy means what? Life insurance policy taken by the firm. Taken by whom? Firm. On the life of all the partners. On the life of all the partners, one joint life policy is taken. Separate life policy means what? Life insurance policy taken by the firm on the life of an individual partner. You are taking on the life of individual partner. That means you are telling this fellow is important for us, or we are telling all are important for us, but firm is taking the policy. Now understand this. If firm is taking the policy, who is paying the premium for the insurance policy? Firm is paying the premium. If firm is paying the premium, that means all the partners are losing money when the premium is paid. From the firm premium is going, that means all are bearing it. Okay, any amount received will be shared by all the partners. Any amount received will be shared by all the partners. That means if partner dies, policy amount is received. 1 lakh ka policy, one partner died, the policy amount will be received. But if partner retires, okay, if partner retires, that time you will not get policy amount, you will get surrender value. One partner retired, so we will surrender the policy and will get the surrender value distributed. Then we will take a new policy in future. Okay, settle the retiring partner. After doing all this, you settle the retiring partner, send him away. Pay it immediately. Pay it immediately. That means whatever is payable to that retiring partner, pay him. What should be the entry? Retiring partner's capital account debited to bank account. Retiring partner's capital account debited to bank account. Treat it as loan. Treat it as loan. That means retiring partner's capital account debited to retiring partner's loan account. Retiring partner's capital account debited to retiring partner's loan account. This is the situation. So they will tell you in the question whether to pay it immediately or to treat it as loan. If they don't tell you that it is paid, then you are going to treat it as loan. If they tell you that it is paid, then fine. If they don't tell you, then it is treated as loan. Clear? Now, section 37 of Partnership Act. Section 37 of Partnership Act. Now understand this. If you don't pay the money to the partner, retiring partner, then retiring partner has an option. At the option of the firm. At the option of the, not firm, at the option of the partner. Now the partnership, if at all the money is not paid, for the partner has an option. Partner can tell, okay guys, you are not paying me. Now you pay in future, but give me interest at the rate of 6% per annum. Or he might tell, give me share in profit. So how to give share in profit? Sir, he is not there only, no. So there is no profit sharing ratio for him. So they said use this formula. Profit into retiring partner's share, which you have not given him, total amount that is supposed to be paid to retiring partner, divided by total capital plus loan. Divided by total capital plus loan. Is this clear? Now, this is the formula that you're going to use. Then we move into death of a partner. Death of a partner means what? Partner has died, so he has had to be removed from the partnership firm. Partner leaving the partnership firm due to death. The death of a partner means partner leaving the partnership firm due to death. Amount payable to the partner by the firm to be payable to executors. Amount payable by the partner, payable to the partner by the firm is to be paid to the executor. Executor is nothing but legal heirs. Okay, the legal person who is supposed to get the money. Payable to executor. Okay, payable to executor. What and all is payable to executor? This list you have to understand. What and all you have to give to the executor. Capital account balance. What is sitting in the capital account? What is sitting in the capital account? Okay, that you have to give, no. What is there in the capital account? Give it to the executor. Current account balance. Current account balance, if it is credit balance, give. If it is debit balance, take. Minus. Clear? Interest on capital, if there is pending, give that. Drawings, what you will do? That partner has taken some money already, subtract. Interest on drawings, we have to charge, so subtract. Revaluation, if it is profit, add. If it is loss, subtract. If it is profit, add it. If it is loss, subtract it. Share in reserves. Share in reserves. What you are going to do? Add it. If it is share in reserves, add it. Goodwill write off. If you are going to write off the goodwill, what will you do? Subtract. If you are going to write off the goodwill, subtract. Goodwill share. Okay, you have to give the goodwill share. Then you are going to add it. JLP or SLP ka share, if you are going to give, that also will be added. Profit share till the date of death. Till the date of death, whatever profit share is there, that has to be given. Till the date of death, whatever profit share is there, that has to be given. So what should be the entry for that profit share till the date of death? P&L suspense account debited to deceased partner's capital account. P&L suspense account debited to deceased partner's capital account. This profit share till the date of death is usually not given to the retiring partner because retiring partner is going voluntarily. This is involuntary. Death is involuntary, so not under the person's control. So P&L suspense account debited to deceased partner's capital account. Amount payable to executor. Amount payable to executor. What are we going to do? Same logic, pay it immediately or transfer to loan. If you transfer to loan, that fellow can ask for share in profit or interest at the rate of 6%. Option is given to that person only. Joint life policy ka accounting. That means when we are paying the premium on joint life policy, how to do the accounting? Okay. Premium is paid by the firm. Premium is paid by the firm. Okay, this you have to understand. Premium paid by firm. If it is treated as expense, treated as expense or treated as asset. When we are paying the premium, either we are taking the premium as expense or we are taking the premium as asset. Okay, now here what happens? Joint life policy premium account debited to bank account. Joint life policy premium account debited to bank account. Premium paid. Okay, here you will take it as premium. Here it is an asset. So joint life policy account debited to bank account. Then what happens? Expense should always go to P&L. So P&L account debited to joint life policy premium. This is not applicable over here. But here at the end of the year, what happens? JLP account must be adjusted to the surrender value. An asset should always show the real position. Balance sheet should show the real position. You are putting some amount as joint life policy, what you have paid as asset. Now, if at all you are not going to recover that much amount when you surrender, you are not going to show it. So every year, what you are going to do? You will match it with the surrender value, bring it down to its surrender value. Therefore, P&L account debited to joint life policy. Imagine you paid 1000 rupees premium, but end of the year 150 rupees is the surrender value. So 1000 minus 150, 850 rupees you have to reduce. So you will pass the entry P&L account debited to joint life policy 850 whenever amount is received. Okay, when amount is received, the entry will be bank account debited to JLP. Bank account debited to JLP is the entry when you receive the amount, and then that JLP will be distributed to all the partners in their old profit sharing ratio. Here also when amount is received, bank account debited to JLP, JLP to partners capital account in old profit sharing ratio, that is balance in JLP is shared. Imagine your JLP is already showing 100, JLP account is already showing 100, and when you surrendered the policy, you got by bank 250 rupees. So this 150 rupees will be there. It will be transferred to partners capital in old profit sharing ratio. Is this clear? This is what you're supposed to do. Next we move into dissolution of partnership. Next we move into dissolution of partnership. Okay, next, dissolution of partnership. Dissolution of partnership. Now, dissolution means what? Shutting the partnership firm. We are like tired, sir. This what is this partnership and all? We'll do company only. We'll think big in life. Okay, shutting the partnership firm. Okay, accounting. Close the books. Our job is what? Just close the books. Steps to be followed. Understand this. Transfer assets and liabilities except cash and bank to realization account. Transfer all the assets and liabilities except cash and bank to realization account at book value, because our job is what? To remove from the books. Realization account debited to asset account. Asset is removed and put into realization. Liabilities account debited to realization account. Asset is credited because we have to remove the asset. Liability is debited because we have to remove the liability. Asset taken over by partner. Imagine some partner is taking the asset. Partner is taking the asset, so partner's capital account should reduce. Partner's capital account debited to realization account at the agreed value, whatever agreed value they have agreed. Liability settled by partner. Partner has paid the liability, so we have to give money to partner. So partner's capital account has to be credited. Realization account debited to partner's capital account at the settled value. Next, sale of assets. Sale of assets. If you sell the asset, what will happen? You will get money. Bank account debited to realization account. Bank account debited to realization account at the sale value. Bank account debited to realization account. Liability settled. Liability settled. That means you are going to pay. Realization account debited to bank account at settled value. Close the realization account. Either you'll get a profit or you'll get a loss. Whatever profit or loss should go to partners. Realization account debited to partners capital account in profit sharing ratio. If it is a loss, partners capital account debited to realization account in profit sharing ratio. Close the books. Close the books. If partners capital account has credit balance, if partners capital account has credit balance, then partners capital account debited to bank. That means we have to give them money. If partners capital account has debit balance, that means they have to give money to us. Bank account debited to partners capital account. Bank account debited to partners capital account. In dissolution, we always come across a concept called as Garner versus Murray. Garner versus Murray rule. Simple, they are telling, if a partner is insolvent and his capital account has debit balance, what does it mean? Partner is insolvent and he has to give us money. Okay, then that loss will be borne by other solvent partners in capital ratio. then the loss which is there, no, which that partner has to bring money, but that partner is insolvent. So that money will be bought by that loss will be borne by other solvent partners in capital ratio. If all partners are insolvent, everybody does not have money, then who will bear the loss? Then the creditor will bear the loss. Creditor will lose money. Everybody has no money to bring. That time what we can do? Nothing. That creditor is there, no, whom we are supposed to pay money. That fellow will not get 1 rupee also. Okay, when all partners are insolvent, you are going to pass this entry. Creditor account debited to bank account. How much we can pay? We will pay. Balance is called as deficiency, and deficiency account debited to partner's capital account. That means this deficiency is actually because of partner. Clear? Partner cannot bring money, creditor will lose the money. Amount to be compensated to partner who was admitted, who had given amount towards goodwill on admission. Amount to be compensated to partner who was admitted, who had given amount towards goodwill on admission. What does it mean? Amount to be compensated to partner, guys. Okay, who was admitted, who had given the amount towards goodwill on admission. That means what we will do, we will remove old partner's capital account debited to new partner's capital account on dissolution. Simple concept. That fellow told, you guys have reputation, and have given money. And he has given money and joined as a partner. Now you have dissolved the firm. What reputation did you have? So whatever he gave money, no, for goodwill, that money you have to give back. Is this clear? On dissolution, old partner's capital account debited to new partner's capital account. Non-applicability. Okay, this giving back is not applicable if dissolution is due to death of a partner. It was not under our control. Our main partner has died. Now we don't know the technology usage only. So we had to dissolve the partnership firm. So not under our control. We will not give the goodwill amount back. Dissolution due to fraud of the new partner. New partner came. He only did fraud, and because of that we are getting dissolved. So we will not give the money back. Agreement was there for no refund. We made agreement first only. If at all dissolution happens, we will not give the goodwill amount back. In these cases, no, we don't have to give the goodwill amount back. Next we go into piecemeal distribution. Piecemeal distribution, what happens? Distribution of cash to partners in parts. Imagine you're selling a partnership firm. Do you think all the money you can get at once? So many assets are there. You can sell everything on one day at the same time? No, it's not possible. Part by part you are going to sell the assets. When you sell the assets, you will get money. When you get money, part by part you will pay to the partners. Maximum loss method and higher relative capital method. Two methods are there. Now, order of payment you understand. First you will pay the realization expense. 1 second, guys. Okay. First you will pay the realization expense. Then you will pay outsiders liability. Outsiders liability means what? You will pay creditor, bank OD, bills payable, after all that. Then you will pay insiders liability. Insiders liability means you will pay the partner's loan. After that, you will pay towards the partner's capital. This is called as piecemeal distribution. When you reach here, only piecemeal distribution. You cannot tell outsider, wait boss, I am following maximum loss method. I will give you money now. I will not give you money today. I will give you money later. All that can we do? No, not possible at all. So when you are paying partner, that time only you follow a method distribution called as piecemeal distribution. Under that you have maximum loss method. In maximum loss method, you are a very negative person. Every installment to be treated as last installment. When you get the money, you are thinking that it is the last installment. Step 1, what you will do? Compute maximum loss. Compute the maximum loss. Maximum loss is equal to amount payable to partners minus amount available. Amount payable to partners minus amount available. Step 2. Distribute maximum loss to partners in profit sharing ratio. Whatever maximum loss is there, distribute it to the partners in profit sharing ratio. Then step 3, deduct the maximum loss from amount payable to partner. Okay, I have to pay you 100 rupees. Your maximum loss share is 20 rupees. That means 80 rupees I will pay you. 80 rupees. If any partner goes into negative means again debit balance, adjust it in capital ratio because we have Ghana versus Murray. Balance amount is amount paid, that is amount payable to partner minus maximum loss. I have to pay you 100 and your share of maximum loss is 20, 80 rupees I will pay you. This is maximum loss method. Next we go into higher relative capital method. In higher relative capital method, what happens? Partner who has higher capital is to be paid first. Partner who has higher capital is to be paid first. This is called as higher relative capital method. Now, computation of HRC. Computation of higher relative capital. Understand this step 1. What you're going to do? Divide the partner's capital by PSR. Divide the partner's capital by profit sharing ratio. Imagine a partner, two partners are there. One person is having 50,000 capital, another person is having 20,000 capital, and the profit sharing ratio is 2:1. Divide, you will get 25,000 and you will get 20,000. This is step 1. This is step 1. Now, step 2, you see, keeping the partner's capital as base who has least resultant amount. You got one person 25,000, another person 20,000. Now, this person got less amount, so take his capital as the base. Keep his capital as the base and calculate the required capital. Then, distribute that required capital in profit sharing ratio. Then, higher relative capital is actual capital minus required capital. Actually, what is the capital minus required capital is the higher relative capital. Step 5. Repeat the steps till one partner has higher relative capital. Higher relative capital is like last man standing match in WWE. Okay, who is the person who is having highest capital? That person will be given first compared to others. Clear? Next, we go into amalgamation of firms. We go into amalgamation of firms. We have one partnership firm over here. We have one sole proprietor. These two will merge and will become one partnership firm. Or we have one partnership firm over here. Here we have one partnership firm. These two will merge and will become one partnership firm. Closing the books of the firm. First, what we are supposed to do? Amalgamation. Close the books of the firm. First, transfer assets and liabilities to realization. Did we have this in dissolution also? This is just like dissolution, but in dissolution you are closing. Nobody is buying you. Here you are closing and somebody is buying you. Okay, transfer assets and liabilities to realization account. Realization account debited to asset account at book value. Liability account debited to realization account at book value. Now, asset taken over by partner. Partner's capital account debited to realization. We have seen this. Liability taken over by partner. Realization account debited to partner's capital account. Asset not taken over by the new firm. If new firm is selling this asset I don't want, what will we do? Sold. Bank account debited to realization account. Liability not taken over by new firm. New firm is selling, I will not pay that liability, you only pay, I am not taking it. Realization account debited to bank account at settled value. Clear? Next we go into realization expenses. Realization expenses, the entry is realization account debited to bank account. PC. PC means what? Purchase consideration. What is the amount that is going to be calculated? New firm account debited because new firm is supposed to pay. Correct? And to realization account. New firm account debited to realization account. How to get this PC, sir? Assets taken over by the new firm minus liability taken over by the new firm. From here you are taking the asset and you are also taking the liability. So net amount, whatever is there, that should be the PC at agreed value. 100 rupees is the asset in my books, but you agree to take it at only 90 rupees. 90 rupees will be the agreed value. Next, partner's capital account debited to new firm. Whatever is there in partner's capital, that will be transferred to new firm because you're going to become the partner over there. Opening entries in new firm. In new firm, what should be the opening entries? Asset account debited because new firm is getting asset. Liability account credited because the new firm is getting liability. Okay. Then to partner's capital account because partner is coming over here. Then goodwill or capital reserve will be there. Goodwill account will be debited or capital reserve account will be credited. One of them will be there. Goodwill, how will you get if PC, purchase consideration, is greater than asset minus liability? Okay, asset minus liability, then goodwill. If purchase consideration is less than asset minus liability, then it is capital reserve. Okay, that should be the concepts of partnership. That is the concept of partnership. Now you have to see the questions of partnership. Okay, we'll try to cover maximum questions from partnership because partnership is always a tricky area. So we'll try to go through many questions of partnership. Question number 1. A and B are currently partners in a firm sharing profits and losses in the ratio of 4:3. A new partner C is admitted. After his admission, the new profit sharing ratio is given 5:3:2. What will be the sacrificing ratio of A and B after the admission of C? You have to calculate the sacrificing ratio. That is basically old ratio minus new ratio. Can you see old ratio here? 4/7, 3/7. New ratio 5/10, 3/10, 2/10. You will get that time the sacrificing ratio. Can you see these two people are sacrificing because it is positive and this person is gaining. So sacrificing ratio is 5:9 between A and B. Correct? Next question. We'll go into question number 2. X, Y and Z are partners in the ratio of 3:2:1. W is admitted on with 1/6 share in the future profits. Okay, Z would retain his original shares. Find out the new profit sharing ratio of the partner. Z would retain his original share. That means Z will get his original share. Now, what is the new profit sharing ratio they are asking? Now, understand this. X, Y, Z and W are there. Okay, X, Y, Z and W. Now, total profit is how much? 1. If you take total profit as 1, okay, what is given to Z and W? What is given to Z and W? Z we are giving 1 by 6. Z told I want to keep the same share 1 by 6. W also we are giving 1 by 6. That means total amount we are giving is 2 by 6. 2 by 6 we are giving to these two people. If you give 2 by 6 to these two people, what will remain? 4 by 6. 4 by 6 will be shared between other two. X and Y will share it in their old ratio, that is 3:2. So 4 by 6 into 3 by 5, 4 by 6 into 2 by 5. That time it becomes 12 by 30, 8 by 30. These people 1 by 6. If you bring it to the same terms, it will become 5 by 30, 5 by 30. Can you see the ratio here? 12 is to 8 is to 5 is to 5. Sir, how sir Z is having same? 5 by 30 is nothing but 1 by 6. Is this clear? Yes. Now they have asked you if you are asking sacrificing ratio, you will do old ratio minus new ratio. When you are doing old ratio minus new ratio, can you see X and Y are sacrificing? X and Y are sacrificing, but Z is not sacrificing. Why Z is not sacrificing? Because the concept only was that no, they told Z will not give anything extra. I mean, Z will not lose anything from his partnership profit sharing ratio. Clear? So these two are sacrificing. This new partner is the person who is coming today, so he will gain. That is your question number 2. Third question. Yes, let's go into the next question. S and N are partners sharing profits and losses in the ratio 5:3. They admit J into the partnership on 3/10 share in the profits or losses, in which J acquired 1/5 share from S and 1/10 share from N respectively. Calculate the new profit sharing ratio of the partners. Now, third question. Understand this. 1/5 is taken from whom? S. 1/10 is taken from whom? N. So what you are going to do, from their old ratio remove 1 by 5, from their old ratio remove 1 by 10. That time you will get their new ratio, and J is going to be the new partner. J is going to get 3 by 10. That is already told in the question. So the new profit sharing ratio is 34:22:24 or 17:11:12. Next, simple questions. I'm just going faster. Now, X and Y are partners sharing profits and losses in the ratio 5:4. That is, this is the old profit sharing ratio. They admit Z into the partnership on for the 1/5 share in the profits, which is given 2 by 15 by X and 1 by 15 by Y. 2 by 15 is given by X and 1 by 15 is given by Y. Z brings 1,50,000 as his capital and 60,000 as premium. Premium means he's giving that 60,000 for his share of goodwill. Goodwill account appears in the books at 1,65,000. Give necessary journal entries in the books of the firm at the time of Z's admission and find out the new profit sharing ratio. This is your fourth question. Understand this. 2 by 15 is given by one guy and 1 by 5 is given by, 1 by 15 is given by one more guy. So minus, remove 2 by 15, remove 1 by 15, you will get the new profit sharing ratio. Remove 2 by 15 from the old partner, remove 1 by 15 from the old partner, you will get the new profit sharing ratio. Do old ratio minus new ratio, that time you will also get the sacrificing ratio. Sacrificing ratio is coming 2:1. Now what happens? This person is bringing money. How much money is bringing? 1,50,000 and 60,000. Total amount that is bringing is 2,10,000. Bank account debited to Z's capital account. Bank account debited to Z's capital account 2,10,000. Next, what we are going to do? Z's capital account debited. Z's capital account debited. We have to give the share of goodwill in the ratio of sacrifice, that is 2:1. It will be given to the other partners. Then there is already goodwill. They said that there is already 1,65,000 goodwill in the books. Goodwill which is there in the books has to be written off. The partner's capital account debited to goodwill in the ratio of 5:9. What is this 5:9? 5:4 is the ratio of their partners profit sharing as per the old this thing. Okay, old profit sharing ratio is 5:4. Is this clear, guys? Yes. Now we'll go into admission questions. Question number 5. Okay, question number 5. Okay, now X and Y share profits and losses in the ratio 5:3. This is their old profit sharing ratio. They admit Z for 1/5 share in the profits. Whenever they tell like this, the 1/5 share in the profits, that means remaining profit is 4/5. Remaining profit 4/5, it is distributed between the old partners. See, you got the new profit sharing ratio. You got the new profit sharing ratio. When you get new profit sharing ratio, you have to calculate sacrificing ratio. Sacrificing ratio has come to 5:3, old ratio minus new ratio. Whenever we have this kind of a situation in the question where they are telling 1/5 is given to one person or 1/6 is given to one person, 1/7 is given to one person, that means balance profit is shared by old partners in their old ratio. So ultimately the sacrificing ratio will be equal to old ratio in this kind of questions. Now they said he pays 80,000 as capital but does not contribute anything towards goodwill. He is bringing money for capital but not bringing anything for goodwill. Goodwill is valued at 60,000. Goodwill is how much? 60,000. But that is the goodwill of the firm. Total goodwill is 60,000. How much is Z's share? Z's share is 1/5. 1/5. So Z's share of goodwill is 12,000. This 12,000 goodwill, can you see it is going to be distributed between the sacrificing partners in the ratio of their sacrifice 5:3. That is, this is how you are going to do. Clear? Next, you have the balance sheet given to you. Okay, balance sheet is given to you. Where will this capital go? It will go into the partners capital account. So you'll open partners capital account. Can you see buy balance brought down, buy balance brought down? Then where will this current account go? Current account will go into partners current account. Buy balance brought down, buy balance brought down. Okay, then you have general reserve. General reserve, what will you do? You will distribute it to the old partners in their profit sharing ratio. Their profit sharing ratio was 5:3. Can you see general reserve? General reserve is distributed. It is put into partners current account. When you have current account given in the question, that means all transactions should be in the current account. Okay, all transactions should be in the current account, and only the the capital introduced and capital taken, capital withdrawn transactions will be in the partners capital account. Clear? The capital of partners are fixed. They only told. All adjustments are to be made through partners current account. They have told this. Okay. Now see here, additional information. Plant and machinery is valued at 46,000 and stock at 96,000. That means plant and machinery value is changing. So you have to prepare the revaluation account. Can you see revaluation account? Plant and machinery, how much was it over here? 50,000. It is becoming 46,000. That means plant and machinery value is going down. So revaluation account debited to plant and machinery. In stock is becoming 96,000. How much is the stock here? Stock is 90,000. That means stock value is going up. Then you are going to write stock account debited to revaluation account. Then they have told one creditor of 6,000 is dead and nothing is likely to be paid on his account. One person has died, so we are not going to give anything to that person. So what you are going to write creditor has to reduce creditor account debited to revaluation account. Creditor account debited to revaluation account 12,000. Is this clear? Now 12,000 has happened. So now what you are going to do? Partners current account. Partners current account you are going to transfer, not partners capital, because it is fixed. Okay, can you see the profit is distributed in their profit sharing ratio? In their profit sharing ratio, it is distributed. Then the capital account are to be proportionately adjusted on the basis of Z's capital and his share of profit through current account. Okay, this profit has to go to partners current account. Can you see 5,000 and 3,000 transferred into partners current account? Then they told to make the capital proportionate. Partner decided to maintain the general reserve in the books of the firm, it seems. Maintain the general reserve in the books of the firm. So what you will do, first you will distribute to the partners, then you will again create general reserve. This is just like memorandum revaluation 5:3:2. Okay, partners current account is debited. Then after that, what are you going to do? You're going to make the capital proportionate based on whose capital? Based on the capital of the new partner, Z. Now see this calculation. Z's capital is how much? 80,000. We already know it is 80,000. Therefore, keeping Z's capital as the base, we'll keep Z's capital as the base and see what should be the total capital. Z's capital is 80,000. Profit sharing ratio of Z is 2/10. So what should be the total capital? 4 lakh. This 4 lakh should be distributed between the partners. 2 lakh, 1 lakh 20 and 1 lakh 20 because you have distributed in the ratio 5:3:2. Existing capital you have to see. What is the existing capital? How will you find existing capital? Existing capital, you have to go to the capital account and you have to find their balancing figure. See the existing capital 80 and 60. So you will write 80, 60. This fellow anyways 80. Can you see we require capital of 2 lakhs. But this fellow has capital of only 1 lakh, 80,000. So 1 lakh 20,000 is deficit. That means he has to bring money. We need capital of 1 lakh 20, but he has capital of only 60. That means he has to bring 60,000. That means he has to bring 60,000. So 1 lakh 20 and 60,000. Is this clear? I hope it is clear. So now what we are going to do, these people are to bring money. If they have to bring money, bank account debited to partners capital account. So here in partners capital, can you see this? What did they tell? Sorry, they are going to make the capital proportionate through current account. They told not to bring money, make it through current account. So partners current account debited 120, partners capital account credited. Partners current account debited 60, partners capital account credited. Clear? This is how it should be, and this is the balance carried down. This should be the balance carried down. Is this clear? Now partners current account. Partners current account, we have a situation over here. Now what we are going to do, goodwill distribution has to be done. Goodwill has to be given by whom to whom. We have already calculated and kept over here. Z is going to give the goodwill to X and Y. Z is going to give the goodwill to X and Y. When Z is going to give the goodwill to X and Y, okay, now what we are going to do, Z's capital account debited. Can you see Z's capital account get debited because Z is giving to X capital account to Y's capital account. Z's capital account debited to X capital account to Y's capital account. Okay, now when you do all this, you'll get the balance carried down. This balance will go to the balance sheet, and here you will get the balance carried down. So can you see everybody has debit balance? Because everybody has debit balance in the balance sheet. Can you see partners current account is on the asset side? Okay, because partners capital is credit balance. Partners capital is credit balance. You will find this in the balance sheet on the credit side. General reserve we removed and we created, so it is still there. Creditor, what happened? How it became 44,000? Because creditor 50,000, we have reduced something, so it became 44,000. Okay, plant 50,000, we have reduced the value of plant, so it is 46,000. Investment we have not touched, it is still 31,000. Debtors we have not touched, so it is still 60,000. Stock we have increased the value, so stock became 96,000, and bank balance is 30,000. But what happened? 30,000. Partner brought money. How much money did the partner bring? See over here, 30,000. Okay, this partner brought 120 and this partner brought 60. So 120 plus 60, 80,000. Sorry, 120 plus 60, 180,000. Okay, then after that, okay, you can see over here. Sorry, they did not bring money. What am I talking? They did not bring money because it was adjusted through the partner's current account. It was adjusted through the current account. This is 1,10,000. From where we are getting 1,10,000? 30,000 plus new partner brought 80,000. So total amount is 1,10,000. This is your question. This is done. Okay, quick recap of all questions we are going to do. Okay, we'll try to revise as many questions as possible. Question number 6. Okay, we'll go into the next question. Question number 6. The balance sheet of a firm on 31st of March 2023 was. One second, guys. Yes. Given here. Now, capital. Where will this capital go? Sun and Moon ka 50,000 and 41,000. Sun and Moon ka capital. It will go into there. Oh, what did they ask in this question? Show journal entries at the time of admission, they said. Oh ho. Now, loan of Sun is there. General reserve is there. Sundry creditors, outstanding expense. Property, motor car, furniture, debtors, stock and cash. Now, profit sharing ratio between Sun and Moon was 3:2. They decided to admit Pluto as a new partner on 1st April on the following terms and conditions. Property and motor car are to be revalued at 45,000 and 6,500 respectively. Now see the property 35,000. It is increasing. So what will you do? First entry that you are going to pass. Oh, so many things. It's a very important and tricky question, this one. Goodwill computation has so many adjustments. Revaluation, we'll keep it pending. This is revaluation. Pluto should pay premium for goodwill to be valued at 2 years purchase of last 3 years average profits. 2 years purchase of last 3 years average profit. Such amount of premium was to be credited to old partners loan account. It should be credited to old partners loan account. Pluto will play 37,500 as capital. He'll bring 37,500 as capital. New profit sharing ratio is 2:1:1. Okay, very good. Last year's profit was 5,000, 6,000 and 7,500. 5,000, 6,000 and 7,500. They've given the profit. Can you see that we are taking as a starting point? 5,000, 6,000, 7,500. Okay, then what is happening? Yes. Then what is happening? Last 3 years books of accounts on verification disclose the following discrepancies. Following discrepancies are there. You have to rectify that. Bad debt previously written off, recovered rupees 400, credited to debtor account. Credited to debtor account. Okay, so now what happens? Now, bad debt previously recovered, written off, was recovered rupees 400, credited to debtor account. Actually, the entry for bad debt is cash account debited to bad debt recovered. Cash account debited to bad debt recovered. So what we are going to do, 400 is added to the profit. 400 is added to the profit. And we'll also pass the rectification entry, debtor account debited to P&L adjustment. Why? Remember rectification, whenever we are rectifying previous year's errors in this year, always instead of income or expense, we have to use P&L adjustment. Okay, 400. Next, closing stock was undervalued by 1,250. That means we took closing stock 1,250 less. So we will increase the closing stock. When closing stock increases, profit will also increase. So we'll pass the entry, stock account debited to P&L adjustment. Usually closing stock is put to trading account, stock account debited to P&L adjustment. Clear? Next thing is furniture purchased 300 debited to purchase account. So what we have to do? The entry for this will be furniture. Sorry, where is it? Here. Furniture account debited to P&L adjustment, because when we reduce the purchase, P&L adjustment. Okay, and what will happen to that particular 300? Go to the profits. Furniture purchased. You are adding. Okay, then if you notice, closing stock, last year's closing stock is this year's opening stock. So opening stock, can you see, reduces. Closing stock increases, profit increases. Opening stock increases, profit decreases. And you can also see the entry for that opening stock. Opening stock account debited to, trading account debited to opening stock. So we are writing P&L adjustment account debited to stock. Clear? Everything is through P&L adjustment. Depreciation was provided at 10% on reducing balance method. Depreciation, what should be the entry? Depreciation account debited to furniture, but we are going to write P&L adjustment account debited to furniture. P&L adjustment debited, that means profit should reduce. 30 rupees profit is reducing. Clear? Then closing stock was overvalued by 2,000. Closing stock was overvalued. So we have to reduce the closing stock. So here we are going to reduce the profit, and next year the profit will increase. So what entry are we going to pass for that? Depreciation. Okay, next year again depreciation will be there. Depreciation account debited to furniture, because last year we have missed. So last year we calculated, this year also we have to calculate. Okay, you can see that 27 over here reduced from next year's profit. And then stock. You can see the stock over here. P&L account debited to depreciation. Sir, why didn't you use P&L adjustment this time? Because it is this year's error rectified in this year. P&L only. P&L adjustment account debited to stock, 2,000 rupees. P&L adjustment, last year's rectification you are doing. So P&L adjustment to stock. Can you see 2,000 is added? Overvalued. Stock is overvalued. 2,000 is added. Correct, no? Yes. A purchase invoice of 1,000 was omitted from the books. You did not record the purchase itself. So what entry will you pass for that purchase? Purchase account debited to cash. Okay, stock account debited to P&L, because you have to add the stock that we have already passed. Then P&L account debited to purchase, because purchase is recorded now. So what happens when purchase is recorded now? 1,000 will reduce again. 1,000 will reduce again. And they said closing stock was undervalued. That means you have to increase the closing stock. 1,000 is added. And here you can see stock account debited to P&L, 1,000 is added. 1,000 is added. Now what we are going to do, 1000 is added. You can have a look at this question. Now all the profits are correct. You got the corrected profit. Take the average, you will get the average profit. Multiply, you will get the goodwill. When you multiply, you will get the goodwill. Now one thing you have to do is take your calculator. Here P&L adjustment is credited, that means 400. Here P&L adjustment is credited, plus 1250. Here P&L adjustment is debited, so minus 1250. Here P&L adjustment is credited, plus 300. Here P&L adjustment is debited, minus 30. Here P&L is debited, 27. Okay, here P&L adjustment is debited, minus 2000. Okay, now you look at all the blues, that is P&L. Here P&L is debited, minus 27. Okay, here P&L is credited, plus 2000. Here P&L is debited, minus 1000. Here P&L is credited, plus 1000. Okay, plus 1000. So now what happens? Whatever is there, no P&L account debited, whatever is there in the P&L loss, P&L account debited to partners capital account, Sun and Moon in their profit sharing ratio. And here 798 plus 532. Okay. P&L wala things, loss you have to put into partners capital. P&L adjustment wala things, don't keep it together, keep it separate. P&L adjustment wala things you have to debit it to partners capital account. P&L adjustment, there is a loss is debited to partners. P&L, there is a profit is credited to partners. This is the step we have to do after doing all that circus. Then revaluation. Now we'll go into revaluation. They said property, plant and equipment to be revalued at 45,000. Now it is showing 35,000 increase. Revaluation account, property, plant and equipment debited to revaluation account. Then you can see over here 6,500 it is becoming motor car. Now it is 7,500 motor car. It is reducing. So 1,000 rupees revaluation account debited to motor car. And then they told to create a provision for doubtful debts at the rate of 5%. 5% on the debtors. Debtor amount is how much? 25,000. 1250. Oh, sorry, debtor amount is not 25,000. Debtor amount is 25,000 plus 400. Rectification. We have done one rectification. No. Sir, which 400 you are talking about, sir? This 400, sir. Debtor account debited to P&L adjustment. First entry. Okay, so on that you calculate 5%, 1270. Revaluation account debited to PDD. In revaluation, whatever the profit is there, that profit will be distributed to Sun and Moon in their old profit sharing ratio. Okay, then if you look at the balance sheet, there is one general reserve. Whenever admission happens, general reserve should be distributed. So now general reserve, what you are going to do? General reserve account debited to Sun and Moon. Okay, then the new partner is going to come. New partner is going to come. How much is he going to bring? Where is the new partner? Pluto will bring 37,500 as capital. So you will pass the entry bank account debited to Pluto's capital account. Okay, then what will happen? The goodwill share. Goodwill share was how much? We had already calculated it. It was 12,762. But what is Pluto's share in 12,762? Okay, you can see sacrificing ratio also we have to calculate. Then Pluto share 12,762 into 1 by 4. 12,762 divided by 4. You are getting 3190. 3190 is Pluto's share of goodwill that will be given to Sun and Moon in their sacrificing ratio of 2:3. Their sacrificing ratio of 2:3. The gaining partner will always be debited. So Pluto is debited to sacrificing partner. Very unique and different question that they have asked in the exam. Okay, let's go further. Balance sheet shouldn't be a problem. Property, motor car, furniture. Okay, furniture we are going to add some value after rectification. Whatever rectification we had done, remove 2 years depreciation. 300 it is. This is basically 300 minus first year's depreciation of 30 minus second year's depreciation of 27. Okay, debtors we just now created PDD. Stock, last whatever stock is there, 46,000. Cash 4,000 we had, 37,500 that fellow brought, 1,000 we made one payment for purchase. Okay. Sun, Moon and Pluto, you should find their capital account balance by doing debit and credit of add and minus of all the things. Pluto we know, 37,500 he brought, 3190 we gave for his share of, we removed for his share of goodwill. Loan of Sun is still there, loan of Moon is also there. Why, sir? What is this, sir? Loan of sun and loan of moon and all. From where you are getting, sir? See, here they told such amount of premium should be credited to old partner's loan account. Whatever goodwill they are getting, they are not putting into capital account, they are putting into that partner's loan account. Creditor is there and outstanding expense is also there. Your balance sheet will tally. This is your balance sheet, guys. Just have a look at the balance sheet. A unique question. This should be a balance sheet. Clear? Next, let's go to the next question now. Question number 7. Question number 7. P and Q are partners sharing profits and losses in the ratio 5:4, old profit sharing ratio. On 1st April, they admitted their manager R into partnership for 1/5 share of the profits. As manager R was receiving a salary of 60,000 per year and a commission of 5% on the net profit after charging such salary and commission. It is, however, agreed that any excess over his former remuneration to which R becomes entitled as a partner is to be borne by Q. R was one manager. Now we are making that R as partner. So whatever extra we are going to give to that R, it will be given by partner Q. The profit of the firm for the year ended was 4,27,500. Okay. Now profit is 4,27,500. Now understand this. When R was manager, he was getting a salary of 60,000. Okay, his salary was 60,000. So out of 4,27,500, if you remove the 60,000 profit, you are left with only 4,27,500 minus 60,000. You are left with 3,67,500. And R was also getting a commission of 5% on net profit after charging commission. So you have to do into 5 by 105. This was the amount. So total amount that R was getting when he was the manager. R was getting 77,500. After that, the profit, if you remove his commission and salary, the profit is 3,50,000. The profit is only 3,50,000. This profit would be distributed between P and Q, correct? This profit would be distributed between P and Q. So go and check what was the profit sharing ratio of P and Q. 5:4. So what you will do, 3,50,000 into 5 divided by 9. So P was getting 194,444 and Q was getting 155,556. Now what they told? Now they told that if this person becomes the partner, whatever extra he is going to get compared to what he was getting when he was a manager, that has to be given by Q. Now if this person becomes partner, our profit will be 4,27,500 only. We don't have to give salary and we don't have to give commission. What is this new person's share? 1 by 5 into 1 by 5. If you do 4,27,500 into 1 by 5, 85,500. Can you see we have to give right now 85,500. Earlier we were giving him 75,500. So that extra amount that we have to give him, that will be taken from Q. Remove from Q and give it to R. It will be given by Q. So 194,444 plus 147,556. The profit is 4,27,500. This is your solution for question number 7. Clear, guys? Yes. Let's go into next question. Question number 8. A and B were partners of a firm sharing profits and losses in the ratio of 2:1. This is your old profit sharing ratio. Now the balance sheet of the firm is given as under capital account A and B, 8 lakh, 4 lakh. Where will you do? Where will you put it? You will put it into the partners capital account. Can you see 8 lakh? Can you see 4 lakh? Then do we have reserves? Reserves are to be distributed between the partners in the ratio of 2:1. So you can see here by reserves distributed to the partners. By reserves distributed to the partners. Then you can see any goodwill in the balance sheet? No. So this should be it. They agree to admit P and Q into the partnership on the following terms. A and B are already there, going to admit P and Q also. The firm's goodwill is to be valued at 2 years purchase of the weighted average profit of the last 2 years. The relevant figures are given. Profit. Okay, now you have to calculate weighted average profit. See over here. 3 years profit is given, last 3 years. Highest weightage will be given to the most recent year. 1, 2, 3 weightage. Multiply, you will get the product. So total of product divided by total of weight, you will get the weighted average profit of 42,000. When you divide it, you will get the weighted average profit of 42,000. Okay, that is the weighted average profit, 42,000. Is this clear? Any doubt with this? No. Now, this is the weighted average profit. How many years purchase? They said 2 years purchase. They said multiply into 2. That time you will get the goodwill. When you get the goodwill, okay, when you get the goodwill, you got the goodwill, right? Now you have to calculate what is that fellow's share. Goodwill, now you have to calculate. See, A, B, C, D, 4 partners are there. Old ratio is what? Old ratio was 2 is to 1. New ratio have they given 3 is to 2 is to 1 is to 1. So do old ratio minus new ratio. You can see this fellow is sacrificing. This fellow is sacrificing. This fellow is gaining. This fellow is gaining. That means this fellow and this fellow, P and Q, are supposed to give the money to A and B. So this should be the entry. P's capital account debited, Q's capital account debited, to A's capital account, to B's capital account. P's capital account debited, Q's capital account debited, to A's capital account and to B's capital account. Clear? So this is how you are going to do the goodwill distribution. After that, what are you going to do? Let's continue. They said the value of stock and plant and machinery to be reduced by 10%. How to calculate this 10%? You know, you can see over here. Memorandum revaluation account debited to stock, to plant and machinery. Building was to be valued at 10,11,000. I think now the building is 9 lakhs. So you are going to increase the value of building. So you are going to write by building. Then you can see there was an unrecorded liability of 10,000. So what you are going to do? Revaluation account debited to liability account. 3 things you have done. The value of reserves, the value of liabilities and the value of assets other than cash were not to be altered. They said nothing you are going to alter. Everything should be remaining same. So whatever you do, distribute this profit to the old partners, then reverse the revaluation. Can you see here 30,000? Can you see here 50,000? Can you see here liability 10,000? And this you are going to reverse. Everything you are going to reverse. Then when you reverse, here you got profit, so obviously you will get loss. But this loss will be shared by all the partners. All the partners means what? Including the new partners. So 14,000 and 7,000, this profit should be there in the partners capital account, 14 and 7. And this 9,000, 6,000, 3,000, 3,000 is from here. Clear? Reversed. Now reserves also, they said what? Reserves also should be there. First you distribute the reserves. Then you recreate the reserves using all the partners. 3 is to 2 is to 1 is to 1. Can you see we had distributed the reserves over here. Okay. Then what they have told, P and Q were to bring capital equal to their share of profit, considering B's capital as base after all adjustment. They said P and Q has to bring money. P and Q will have to bring money equal to their share of profit. P and Q will have to bring capital equal to their share of profit. Now you have to do this calculation of making capital proportionate. Making capital proportionate. B's capital. They said keep B's capital as the base. B's share is 2 by 7. So 4,26,000 is equal to 2 by 7. That means how much is 1? That time you will get required capital of 14,91,000. Distribute it to the 4 partners. Go and see what is their existing capital. How are you getting, sir, existing capital? Go to their partners capital account. All these red things are there. No, use that and calculate the balancing figure. You got the balancing figure of each person. 930, 426, 78 negative, 78 negative. So now what happens? This person 639 is required, but 931 is there. That means there is more. That means it is surplus. Surplus means what? Tell him to take the money. So tell him to take the money. Partners capital account debited to bank. Here if you see 426 is required, 426. Nothing to worry. We kept that partners capital only as the base. Here if you see 2,13,000, but 78,000 negative is there. That means they have to bring 2,91,000. Here also 2,13,000, 78,000 negative is there. That means they have to bring 2,91,000. So what will be the entry when they are bringing money? Bank account debited to partners capital account. Can you see bank account debited to partners capital account? This will be your balance carried down. Whatever balance carried down is there, it will be shown over here. Whatever balance carried down is there, that will be shown over here. That is your balance sheet. Clear? Now, rest of the things, plant and machinery, building, debtors, stock, you should be able to do it. You have done the revaluation. See the revalued figures. Reserves are recreated. Creditors. Remember, even if you did revaluation, revaluation was reversed. This is all at book value only. Cash only has changed. 1,50,000 was there. 3 partners brought money. 1 partner took money. Sorry, 2 partners brought money. 1 partner took money. How we are getting this 291, 291, 291? Can you see over here by bank? That means these people brought money. Here it is to bank. That means that person took the money. Clear? This should be it. All this is from the books itself. This is your question. Let's go to question number 9. Okay, question number 9. The balance sheet of Amit, Bhushan and Charan, ABC basically, profit sharing ratio. That means this is the old profit sharing ratio is as follows. Capital, Amit, Bhushan, Charan. Okay, where will we put this capital? Always go and put it into the partner's capital account. Go and put it into partner's capital account. 180, 160, 140. Clear? Then current account, Bhushan. Bhushan is having a current account of 16,000. So what we are going to do, partners current account, Bhushan, balance brought down. Then can you see current account, Charan, debit balance. So you'll go and write balance brought down, 10,000. Clear guys? Yes. Now, Dev is admitted as a partner on the above date, 1/5 share in the profits and losses. So we have to calculate the new profit sharing ratio. Okay, that is how you're going to do. How we are going to do? Total is 1. You are giving Dev 1/5. 1/5 if you give to Dev, how much will remain? 4/5 will remain. When you do that, 4/5 into 1/3, 4/5 into 1/3, 4/5 into 1/3. Because their old ratio was why we have done that? Here they have told the profit sharing ratio among the old partners will be equal. Profit sharing ratio among the old partners will be equal. So this is actually irrelevant to us when we are calculating the profit sharing ratio. So 1 is to 1/3, 1/3, 1/3. You are getting 4/15, 4/15, 4/15. So the new ratio will be 4 is to 4 is to 4 is to 3. Those people are in equal. This fellow will get 3. Okay, now the sacrificing ratio you have to calculate. Old ratio minus new ratio. Old ratio, can you see 3/6, 2/6 and 1/6. New ratio just now we calculated. When you do that, this person is sacrificing, this person is gaining. One of the old partner is also gaining and the new partner is anyways gaining. Total goodwill is 60,000. Now who is gaining? These two people are gaining. The people who are gaining must give to the sacrificing partner. Gaining partner's capital account debited to sacrificing partner's capital account. You can look at the calculation how it is done and you can practice this. Okay, so then after that in the question they said, Dev brings in 1,50,000 as his capital, but is unable to bring the required sum of premium for goodwill. They will bring 1,50,000 capital, no. So what you will do, bank account debited, put it to his capital account, bank account debited or cash account debited to capital account 1,50,000. Then goodwill of the firm is 60,000. We have already done goodwill calculation. Can you see two partners are going to give? C and D are giving. So C and D's current account debited to A and B's current account. A's current account and B's current account. Okay, one fellow has to give 6, another fellow has to give 12. Be careful with the giving and taking part. Okay, this fellow has to give 6, give it to A. Okay, this fellow has to give 12. Remove, give it to A, give it to B also. Okay, ensure that it is correct. Assets and liabilities are to be valued as follows. Machinery 2,60,000, furniture 1,28,000, provision for doubtful debts at the rate of 10% on debtors. Okay, you know how to do the revaluation by now. There shouldn't be a problem. But did they tell you something? Necessary adjustments regarding goodwill and P&L on revaluation are to be made through partner's current account. It is decided that revalued figures of assets and liabilities will not appear in the balance sheet of the new firm. That means they are telling us, please, you do revaluation also, don't do revaluation also. That means after doing the revaluation, everything has to be reversed. So whatever you did over here, can you see it is getting reversed? Whatever you did over here is getting reversed over here. Here the profits and losses are shared between A, B and C because they were the partners. Now it is shared between A, B and C, D. A, B, C, D, all are sharing it. Now the PDD part, you might be a little confused. PDD, what they say, 10% on debtors. If you go and check what is the debtors, 8,000. 8,000 into 10% if you do, you will get 8,000. Already 4,000 provision is there. That means extra provision of 4,000 only you are going to create. 4,000 only provision you are going to create. And whatever this memorandum revaluation items, it's already there. It should be there in the partner's capital account. Clear? Here, 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 here. Okay. Then what we are going to do, they have asked you to make capital proportionate, I guess. Capital account of old partners in the new firm should be proportionate to the new profit sharing ratio, taking Dev's capital as the base. Take Dev's capital as the base. The existing partner will not bring cash for future capital. Necessary adjustments are to be made through partner's current account. They will not bring money. Okay, very good. Now, Dev's capital is 1,50,000. Dev is the new partner. Dev's capital is 1,50,000. Okay. Now, Dev's share is 3 by 15. If you see the required capital, it is 7,50,000. Distribute that in the profit sharing ratio 4 is to 4 is to 3 is to 3. That is the new profit sharing. Sorry, 4 is to 4 is to 4 is to 3. That is the new profit sharing ratio. Distribute A, B, C, D. Distribute it. That is the required capital. Go and check the partner's capital account. What is the balancing figure? The balancing figure is 180, 160, 140, 150 in the partner's capital account. We require 200, so deficit. We require 200, so deficit. We require 200, so deficit. All the three partners have to bring money, but they said don't bring money, just remove from current account and put it over here. So if you see the current account, there will be an entry, partners current account debited to partners capital account. Partners current account debited to partners capital account. After that, kindly find the balancing figure. Whatever balance is there, just put it to the balance sheet. See here, balance carried on. Three partners are having debit balance. One partner is having credit balance. In partners capital account, all will have credit balance only. Then based on your revaluation, you are going to pass the entries. Based on your revaluation, you are going to pass the entries. Sir, we had created provision, no sir, 8,000. Then why it became 4,000? Because everything what you created, you reversed it. Memorandum revaluation. So all the assets and liabilities what you are seeing, no, it is going to be at book value only. Okay, only this cash will change. Why? Because the new partner brought 1,50,000 money. Other than that, everything is at book value itself. This should be it with that particular question. Let's go into question number 10. P, Q and R are sharing profits and losses equally, had been trading for many years. R decided to retire on 31st of March 2023. Okay, on which date the balance sheet of the firm is as follows. So finally we have moved into retirement. Admission is done. Now we go into retirement. Okay, value of goodwill was agreed at 93,000. That means the goodwill value is 93,000. Okay, now what we have to do, first thing, always old profit sharing ratio is 1:1:1. Who retired? R is gone. So R you remove, new profit sharing ratio is 1:1. Only PQ will remain. Okay, gain ratio, that means these people will gain. This fellow is gone. No, gain will be 1:1 itself. Gain will be in the ratio 1:1. What is the goodwill? Goodwill is 93,000. Who is going? R is going. Our share of goodwill is what? 31,000. Our share of goodwill is 31,000. Yes, our share of goodwill is 31,000. So now you have 15,500 and 15,500 which has to be given by P and Q. P and Q have to give it to the retiring partner. So if you see the partner's capital, you can see P's capital account debited, Q's capital account debited, and it will be in R's capital account. We have given it to R. Clear? I think there shouldn't be any problem with that. Land and building increase in value, it being 1,05,600. Land and building increase in value, it is going to be 1,05,600. How much is the land and building right now? Land and building is 75,000. You're going to increase the value of land and building. So buy land and building. Then you can see plant and machinery was valued at 1,05,000. Plant and machinery is this one, 1,20,000. So plant and machinery value is reducing. Plant and machinery value is reducing. Then they told it was agreed to provide 6% in respect of debtors. You're going to create provision for doubtful debts at the rate of 6%. See the debtor balance. Debtor is actually 74,000. 74,000 into 6%, you're going to create PDD. Whatever profit is there, it should be distributed between the old partners equally. 1:1:1 because their profit sharing ratio was 1:1:1. Sir, why are we not reversing here? Here they did not tell that it should be shown at original value. So no need to prepare memorandum revaluation account, and this profit will go to partners capital account 2220. Clear? Then after that, what do we have? Prepare revaluation account, capital account, and balance sheet. Done. From here, nothing. Okay, they never told that retiring partner is going to be settled or something. So whatever balance is there, transfer it to retiring partner's loan account, and remaining people are still there. Balance carried down. This balance carried down will straight away go into balance sheet. Straight away go into balance sheet. Clear? Partner's loan account will be shown over here. Plant and machinery, new value after revaluation. Land and building, new value after revaluation. Cash is 36,000. Why? We did not pay even 1 rupee cash to anyone. Before it was 36,000. Now also it is going to be 36,000 only. Before it was 36,000. Now also the value is going to be 36,000. So what will happen after that? So cash will be taken, debtors minus PDD. Remove PDD, you will get the new value of the debtors. Stock is there, creditor is there, so that should be it. This should be your balance sheet. Okay, everything is straightforward. This is your first question on retirement of a partner. Retirement of a partner. Clear? Now we have to go further. Now we have to go further. We'll go into question number 11. Okay, guys. Let's go into the next question. That is question number 11. Let's go into question number 11. A, B, and C were in partnership sharing profits in the proportion of 5:4:3. The balance sheet of the firm is also given to you over here. Okay. You can see the question. You are required to submit the journal entries necessary to give effect to the above arrangement and drop capital account of the partners after carrying out all the adjustment entries as stated above. Now, first, A had been suffering from ill health and gave notice that he wished to retire. An agreement was therefore entered into. On 31st March 2023, the terms of which were as follows. Now, the profit and loss account for the year ended 31st March 2023, which showed a net profit of 48,000. That means profit was there, 48,000 was to be reopened. Okay, B was to be credited with 4,000 as bonus. Now, you have to reopen means what? Something they have missed, so you have to bring it back. When you have to bring it back, you have to take from partner and put it back to P&L. Now, what we are going to do? A's capital account debited, B's capital account debited, C's capital account debited. We are removing it in what ratio? In the ratio of 5:4:3. See, can you see over here? 5/12, 4/12 and 3/12. Now you are going to remove it and you are going to put it into P&L adjustment. P&L adjustment 48,000 is put. Now you have missed something, that B was to be credited with 4,000 as bonus. You have to give 4,000 bonus to B. So what you will do? You will remove from P&L adjustment. P&L adjustment account debited to B's capital account. P&L adjustment account debited to B's capital account 4,000. Okay, P&L adjustment to B's capital 4,000. So now what is going to happen? You are going to pass the entry for that. Okay, then they said in consideration of extra work. Okay, guys, he worked more, so we are giving him, which had devolved upon him during the year. The profit sharing was to be revised from 1st April. We are on what date? 2023. We had to revise the profit sharing to 3:4:4. The profit sharing has to be revised. So now this profit sharing, whatever is there, no, after from 48,000, if you remove 4,000, you will be left with 44,000. This 44,000 has to be distributed in the ratio 3:4:4. So 3/11, 4/11 and 4/11. So it will be 12,000, 16,000 and 16,000. Profit is distributed. Clear? First, what you did, remove the profit, gave the bonus, then redistributed in the new ratio. Goodwill was to be valued at 2 years purchase of the average profit of the preceding 5 years. Fixture was to be revalued by an independent valuer. A provision of 2% was to be made for doubtful debts and the remaining assets were to be taken over at their book value. Okay, very good. Valuation arising out of the above arrangement was goodwill became 56,800. Goodwill is 56,800. So what we are going to do, the goodwill calculation, goodwill is 56,800. Who is the partner who is going? The partner who is retiring is A. So what is A's share? Don't look at this 5:4:3. Look at this 4:3:3, 3:4:4. This is the new ratio. Okay, so A's share is 3/11. A's share of goodwill is 15,491. That will be shared between whom? B and C. B and C will bear that in the gain ratio of 13:2. 13:2. Sir, how did we get, sir, 13:2? You have to do 3/11, 4/11, 4/11. New ratio is 3:2. Old ratio minus new ratio you do. Can you see one person is getting positive? That means that person is sacrificing. The other two are getting negative. That means they are gaining. In the gain ratio, it is distributed 13,426. Now, actually, what should be the entry? B is giving, C is giving to A. So the entry should be B's capital account debited, C's capital account debited to A's capital account. This should be the entry for goodwill distribution. Then we have to see the revaluation. What is happening in revaluation? Furniture is become 10,980. What is the furniture value? 8,200. So furniture value has increased. So you are going to pass the entry furniture account debited to revaluation account. This is the value. Okay, then they told you to create a provision for doubtful debts. Provision of 2% was to be made for doubtful debts. What is the debtor amount? 93,500. On that you calculate 2%. 93,500 into 2%. That makes it 1870. 1870 you're going to create provision. Okay, 1870 you're going to create provision. Provision is to be in the ratio of They are 3 is to 4 is to 4. So you're going to pass the entry first. Revaluation account debited to PDD. Then if you see, we have a profit situation because 2780 credit, 1870 debit. 2780 minus 1870. 910 revaluation account is debited to A's capital, to P's capital, to C's capital in their profit sharing ratio of 3 is to 4 is to 4. In their profit sharing ratio of 3 is to 4 is to 4. Done. Yes. After that, what we are going to do? Okay. After that, can you see there is goodwill in the balance sheet? Whenever there is goodwill in the balance sheet, that has to be written off. So A's capital, B's capital, C's capital account is debited in their old profit sharing ratio to goodwill account 40,000. To goodwill account 40,000. Then finally, you have to use your calculator and see how much is there in A's capital. Transfer it to A's loan because they have not told anything anywhere that we are going to pay it off immediately. Then they told one more thing. B and C agreed to continue the business in 3:2 and decided to eliminate goodwill from the balance sheet to retain the fixtures. Okay. Decided to eliminate goodwill. Goodwill has to be eliminated. Okay. And fixtures at the increased value and increase the provision to 6%. Already we have increased it to 2%. No. So from 2%, they want it to become 6%. That means 18. So 3,740 again provision they have to create 3,740. So revaluation account debited to PDD and that loss is going to be borne only by B and C. Why only B and C? Because this increase in the revaluation is done after A event. Can you see? After that, B and C agree to continue. When they are continuing, they are creating provision at the rate of 6%. You are required to submit journal entries and also you are going to prepare capital account. They said journal entries, you already know capital account should be not a problem. Can you see? Whatever journal entries you have done, the capital account is just a posting of that. See, balance brought down, balance brought down, balance brought down. Where are we getting this? From the question itself, from here. Okay, there is no reserve and all. What is this P&L adjustment part? First, we are going to remove it from partners. Then we are giving bonus to this person. Then we are distributing the profits in the new profit sharing ratio, initial entries that we passed. Then goodwill distribution, B and C will remove and they will give it to A. Then revaluation profit distributed to all the partners. Then goodwill which is there in the balance sheet, we are going to eliminate. This entry also we have passed. Then whatever is there in A's account, transfer to his loan account. Okay, revaluation loss. Why? After the partner goes, we are again increasing from 2% to 6%. This is the balance carried down. This should be it with this particular question. Clear? Yes. Done, guys. Yes, let's go further. Question number 12. Question number 12. Compass, cone, and circle are in partnership sharing profits and losses in the ratio of 3:2:1. The balance sheet of the firm as on 31st December 2022 was as follows. Can you see the balance sheet balances over here? Compass, cone, and circle. Reserve is this one. Reserve is this one. Sundry creditors is this one. 40, 60, and 20. So what we are going to do? Oh, again they have asked journal entries to give effect to the above arrangement and prepare the capital account. Okay, journal entries they have asked. Capital account after that will just be posting on, Okay, fine. Do we have goodwill in the balance sheet? No. Next, on 31st March 2023, Cone retired and Compass and Circle continued in partnership, sharing profits and losses in the ratio of 3:2. That means that is their new ratio. What is the old ratio? It was 3:2:1. Okay, 3:2:1. It was agreed that adjustments were to be made in the balance sheet as on 31st March in respect of the following. Machinery to be revalued at 45. Right now, machinery is showing how much? 50. So it has to become, sorry. Right now, machinery is showing 42. It has to become 45. So machinery account debited to revaluation account. You are increasing the value of machinery. Then stock was to be reduced by 2%. Stock is to be reduced. So what should be an entry for reducing the stock? Revaluation account debited to stock. Then after that, what you're going to do? Furniture what was to be reduced to 600. How much is the furniture right now? 1000. So you're going to write revaluation account debited to furniture. Then they said provision for doubtful debts would be 4,000. Right now, how much is the provision for doubtful debt? 3,000. That means we have to increase the provision by 1,000. Revaluation account debited to PDD. Then provision of 300 was to be made for outstanding expense. So what has happened? Revaluation account debited to outstanding expense. Revaluation account debited to outstanding expenses. Now, the partnership agreement provided that on retirement of a partner, goodwill was to be valued at 24,000. On retirement of a partner, goodwill was to be valued at 24,000. Goodwill is to be valued at 24,000. Okay. Now we know the goodwill. And Cohn's share of the same was to be adjusted in the accounts of Compass and Circle. We already know this. So what we will do? Goodwill calculation has to be done. Where have we done that? Here it is. Okay, first what we have to do, obviously old ratio minus new ratio, you will get sacrificing ratio of 3:2, 3:7. Calculate goodwill 10 by 30, 10 by 30. Who is the person? Cohn is retiring. Cohn, if you see, Cohn's ratio is 3:2:1, 3:2:1. So 2 by 6 or 10 by 30, it is going to be. Okay, so Cohn's share of goodwill is 8,000. It will be borne in the ratio of 3:7. Can you see? It is in the ratio of 3:7, 2,400 and 5,600. The goodwill distribution, that means Compass and Circle have to give. So Compass capital account debited, Circle's capital account debited. Compass debited, Circle debited to Cohn. Okay, we are giving it to Cohn. Is it clear? So after doing all the revaluation, just do plus and minus and see if we have profit. Yes, revaluation account debited and it is distributed to all the partners in their profit sharing ratio of 3:2:1. Check in the balance sheet. There is one reserve also. Reserve is 30,000. So reserve is distributed to all the partners in their profit sharing ratio of 3:2:1. Clear? Then whatever is there, now go and check what they have told after that. Profit up to the date of retirement was estimated to be 18,000. Cohn was paid off in full. We are giving Cohn fully. So what we are going to do, check in Cohn's account, whatever is there after putting this revaluation profit, that, this and all, Cohn's capital account debited to bank, done, paid. Compass and Circle was to bring in such an amount in cash so as to make their capital proportional to the new profit sharing ratio, subject to the condition that a cash balance of 20,000 was to be maintained as working capital. They said capital should be proportionate, but who knows what the capital is? We don't know the capital only. So we'll use the formula asset is equal to liability plus capital. Asset we know, liability we know, that a balancing figure will be capital and that capital should be proportional. Now you can see asset. Okay, machinery is 45,000, but can you see we have made it 45,000? So machinery is 45,000. Furniture, can you see they told it should be 600. So furniture will be 600. Sundry debtors is 80,000, but there is a PDD of 4,000. Then stock we have reduced by 2%. How much was the stock? 50,000. When you reduce 2%, that makes it 49,000. Cash, they only told cash has to be 20,000. So this will be 20,000 asset. Liabilities, we have creditors and we have outstanding expense. Creditor is 60,000 given and outstanding expense, they said provision of 300 is to be made for outstanding expense. That time this will be your liability. Asset minus liability, you will get the capital. Capital has to be in their profit sharing ratio of 3:2. Distribute in the ratio of 3:2, you get this capital. Compass, Circle, this is the capital. Now existing capital, sir, from where are we going to get the existing capital? When you prepare the partner's capital account, you will find the value. We need this much, but they have only this much. So this will be the deficit. They have to bring money. We need this much, but they have only this much. This is also deficit. That means they have to bring money. So if you see the partner's capital account, you can see over here, buy bank, and this will be your balance carried down. Rest everything you have passed journal entries for. So you should be in a position to solve. Yes, that should be it with that question number 12, guys. Let's go into question number 13. Balance sheet of ABC, who are sharing profits in the proportion to their capital as follows. Proportion to their capital means 4:3:2. Their profit sharing ratio is 4:3:2. Creditor is there, on all other things are there. Now they told B retired on the above date and following was agreed upon. Now you can look at the question. Towards the end of the question, they just told show the balance sheet after B's retirement. They didn't ask anything else. Okay, show the balance sheet after B's retirement, they said. And can you see A and B in the proportion of 5:3. Actual cash to be brought in or paid off as the case may be. Entire capital is of the new cost should be fixed at 56,000. What and all circus they are doing. 5:3. Okay, old ratio 4:3:2. New ratio between A and C is 5:3. That time you will get the sacrificing ratio of 13:11. Sacrificing ratio is 13:11. They only asked balance sheet. But we have to prepare everything. To go to balance sheet, we have to prepare everything. No, we have to get all the details. Now, how much is the goodwill of the firm? That the goodwill of the entire firm to be fixed at 21,600 and B's share of it is to be adjusted in the accounts of A and C, who are going to share future profits in the ratio 5:3. 21,600. But who is B? B is the person who is having 3/9. B is retiring 3/9. So what is B's share of goodwill now? 7,200. 7,200 is B's share of goodwill. It will be shared between A and C in the ratio of 13:11. So A and C have to give this much amount. A and C have to give this much amount. If you see partner's capital account, A's capital account debited, B's capital account debited to C. Okay, A's capital debited, B's capital debited to C. This is their opening balance of capital. Now we will read the question. Stocks should be depreciated. How to calculate the 6%? You know, stock should be depreciated. So revaluation account debited to stock. Okay, then the provision for doubtful debts has to be brought up to 5% on debtors. Now you calculate 10,000 into 5%. This is coming up to 500. But we have only right now 200. That means 300 is to be created. Revaluation account debited to PDD. Next. After that, we have land and building to be appreciated, increased. So we should create land and building account debited to revaluation account. Provision of 1,540 is to be made in respect of outstanding legal charges. Revaluation account debited to outstanding legal charges. Assets and liabilities except cash and bank were to appear in the balance sheet at their old figures. Very good. Why did they tell you all these circles then? So what you're going to do, whatever is there, distribute between A, B and C. These are the old partners. Then whatever you have done, can you see everything is getting reversed? Everything is getting reversed. Now you have a loss. Loss will be shared only between continuing partner A and C in their new profit sharing ratio as 5:3. Okay, so you have to put by memorandum revaluation, then to memorandum revaluation. Clear? After that, they have not told anything. They never told that we are going to pay the partner or something. So this partner is gone. We will transfer to the loan account. Now what we have to do? We have to calculate required capital. They only told. Making capital proportionate, they have told what is the amount? 56,000. 5:3. So A's capital should be 35, B's capital should be 21. Now all these things when you do, you'll get the balancing figure of A. Now balancing figure of A is 34,800. If you are wondering how you are getting, sir, take your calculator. See the credit side. 40,000 plus 3,200 minus 4,500 minus 3,900. 34,800 is there. 34,800. We require 35,000. That means 200 rupees deficit. See if you see all the red things you see, that is the transactions. 20,000 plus 1,600 minus 2,700 minus 3,300. That means 15,600 is there. We require 21,000. So again it is deficit. Deficit means they have to bring money, bank account debited to their capital account. Can you see over here, bank account debited to capital? You will get the balance carried down. Put the balance carried down into balance sheet. Apart from that, B's loan is a new thing. Bank account, what has happened? 11,000 was there. These two people brought money. Other than that, nothing to worry. Everything is at their book value only. Why is it at book value? Because we had prepared memorandum revaluation account. We had prepared memorandum revaluation account. Is this clear, guys? Yes. Let's go into question number 14. Geeta and Meeta are equal partners. That means a profit sharing ratio is 1:1. Geeta by agreement retires and Lata joins as a new partner. That means retirement come admission. Geeta is gone, Lata comes in on the basis of 1/3 share of the profits. On 1/4. So Lata is going to get 1/3. The balance of the books as on 31st of March 2024 was as follows. They have given the balances. All the balances are there. Now, look at the end of the question always. Assuming that the agreement was carried out, you are required to pass the journal entries and prepare the balance sheet after admission of Lata. First, what we will do, we will calculate the sacrificing ratio. Can you see old ratio between Geeta and Meeta was 1:1? So 1/2 and 1/2. And the new ratio, this person will get 1/3. Who is going? Geeta is going. So Lata will come in Geeta's place. And if you are giving Lata 1/3, then Meeta will have 2/3. That means new profit sharing ratio is 1:2 or 2:1. Okay, 2 for Meeta, 2/3 and 1/3. Can you see when you do that, you will get a gain ratio of 1/2. 1:2 gain ratio. Who is going to gain? Sacrificing partner gone. Old partner gone. 3/6. Here it is 1/6 minus 2/6 minus. That means gain ratio. Who is going? Geeta is going. What is the goodwill of the firm? Goodwill of the firm, guys. Goodwill of the firm. Goodwill and fixed assets valued at 30 and 1,40,000. Goodwill of the firm is 30,000. 30,000 into 1 by 2. That means 15,000 we have to give to Geeta. 15,000 we have to give to Geeta. Who will give? Meeta and Lata will give in their new ratio 1:2. So 5,000 and 10,000 will be given by Meeta and Lata. Very important calculation before even we start the journal entries. They said that fixed assets. Can you see any reserves anywhere? Any reserves are there? No. So nothing to worry. Fixed assets to be valued at 1,40,000. How much is fixed asset right now? 1,20,000. Increase it. So fixed asset account debited to revaluation account 32,000. Oh, fixed asset at cost. Okay. Provision for depreciation is there 12,000. So 1,20,000 minus 12,000. It is actually at 1,08,000, which we have to increase to 1,40,000. Yes, 32,000 increase. Clear? Then after that, it was agreed to be written up accordingly before admission of Lata as a partner. Okay, sufficient money is to be introduced so as to enable Geeta to be paid off and leave 5,000 as cash balance. Geeta, they are telling pay Geeta off, and there should be 5,000 as cash balance in the bank. Meeta and Lata are to provide such sum as to make capital proportionate. Simple, that's it. Okay, revaluation, whatever is there, distribute to Geeta and Meeta. They are the old partners, guys. Old partners equally. 1:1 ratio it was. Then, goodwill distribution. Not goodwill distribution. There is goodwill already in the books only. This goodwill has to be cancelled. So, Geeta's capital account debited, Meeta's capital account debited to goodwill. Removal of goodwill. Okay, then we are going to do Meeta's capital account debited, Lata's capital account debited to Geeta. What is this? This is the goodwill distribution. Can you see 5,000 and 10,000? Goodwill distribution has happened. Okay, then we have to see who has to bring how much. Again, the concept of asset minus liability. We have goodwill. This is gone. Fixed asset is 1,40,000. Already we know. Then after that, we didn't do revaluation of anything. Stock is 60. Debtor is 40. Stock is 60, debtor is 40. Cash balance, they said they want the cash balance to be 5,000 to be maintained in the bank. So 5,000, 2,45,000. Creditor, we have only one thing. What is the one thing? 20,000 in the creditor balance. So our required capital is 2,25,000. Meeta and Lata should have capital of 2:1. Meeta 1,50,000 and Lata is 75,000. Existing capital, how will you calculate? You have to calculate their balance. Okay, by doing plus minus, you have to calculate because we don't have partners capital account. Okay, when you do that, you will get 1,08,000 existing balance, and here it is 10,000 negative. So when we require 1,50,000, if it is 1,08,000, 42,000, they have to bring money. Here, when we require 75,000, it is negative 10,000. That means 85,000 they have to bring money. So 42 plus 85, you will pass the entry bank account debited to Meeta's capital account to Lata's capital account. Meeta's capital account to Lata's capital account. Okay, and Geeta is the partner who is going. So Geeta's capital account debited to bank. They told that they are going to pay the money to Geeta. This should be it. These are your journal entries. Okay. Now, balance sheet, you will be able to prepare everything you know. Just now you wrote asset minus liability. So all this is from your balance sheet itself. This should be it. And one more very important thing you have to understand, guys, when you're making capital proportionate, we have seen three things. One, keeping a partner's capital as the base. Another, capital is given, just distributed. Another, capital is not given only, then you do asset is equal to liabilities plus capital. Next, we'll go into 15th question. Okay, we'll go to the 15th question. XYZ were equal partners. That means 1:1:1. Their balance sheet on 31st December 2022 was as follows. Always, it's better to go to the end of the question and see what they are asking. Partners capital account they want, partners current account they want, and the opening balance sheet of the firm also they want. So what we will do now, this capital 1 lakh, 1 lakh and 2 lakh. It will go to the partners capital account. 15th question, just go and check. Partners capital account 1 lakh, 1 lakh and 2 lakhs. Then what will happen? Partners current account 50,000, 75,000 and 25,000. Go and put over there 50,000, 75,000 and 25,000. Then you have a situation that any goodwill you can see anywhere. Goodwill, no goodwill. Okay, very good. No goodwill, very good. Okay, on 1/1/2023, X retired and it was agreed that he should be paid off all his dues in full on that day. Okay, whatever is there in X capital account, everything will be paid. Very good. For this purpose, goodwill was to be calculated on the basis of 3 years purchase of the past 3 years profit, which amounted to 1 lakh, 1,40,000 and 1,20,000. respectively. So what we have to do, average profit method. So we are going to do 1 lakh plus 1 lakh 40 plus 1 lakh 20 divided by 3. You will get the average profit, 3 years purchase. So you're getting goodwill as 3,60,000. Goodwill as 3,60,000. Okay, now after that, in order to meet his obligation, a bank loan was arranged on 1/1/2023 for 2 lakh, pledging the assets as necessary. So they are going to take a bank loan. Okay. Further, to compensate a loyal manager Q, it was agreed between Y and Z that Q should be admitted as partner. So new partner will be Q, who should bring in over and above a capital of 1 lakh, his share of goodwill in cash to serve as working capital. Okay. So this fellow will bring his goodwill in cash over and above the capital. Capital is ready to bring 1 lakh and goodwill share we have to tell him, he will bring the money. Okay. Y and Z agree to forego 1/3 of their individual share of profit to Q. Y and Z will give 1/3, they will give it to Q. So now you have to understand. Okay. New profit sharing ratio. Yeah, we have to find out new profit sharing ratio. 1/3 is going to Q. So basically, if you observe, X, Y, and Z were having profit sharing ratio 1:1:1. Who went? X went, so Q came. Q is going to get 1. Now it is still 1:1:1. If you observe the profit sharing ratio, X was getting 1/3, now getting 0. So 1/3 is sacrifice. Y was getting 1/3. Okay. Now also getting 1/3 only. Y is getting 1/3 now also. So no profit, no sacrifice. Z was getting 1/3, now also getting 1/3. So 0. Q was getting nothing. Q is now getting 1/3, so 1 minus 1/3. So this fellow is gaining, that fellow is sacrificing. So incoming partner is gaining, exiting partner is sacrificing. What is the goodwill? We got 3,60,000 into 1/3. So 1,20,000. 1,20,000 has to be given by Q to X. Q to X. So you can see over here, Q's capital account debited to X capital account. 1,20,000. Q's capital account debited to X capital account. Now, how much money Q should bring? Q will bring 1 lakh for capital and 1,20,000 for goodwill. So, by bank over here, bank account debited to capital account, 1 lakh plus 1,20,000, total 2,20,000 the Q is going to get. 2,20,000 is going to be brought by Q. Clear? Next, goodwill in cash to serve as working capital. Y and Z agree to forego 1/3 of their individual share of profits to Q, they are telling. Everything is done, no? Yes. So now X is going to be settled. X is going to be settled. X capital account debited to bank. X capital account debited to bank. And whatever is there in X current account also, we are going to transfer it to his capital account. And finally, we are going to settle everything. We are going to transfer everything. We are going to settle everything. Okay. So what is going to happen now? You have to understand. X and X is going to go. Okay, X will be sent, and then finally only Y, Z and Q will be there. Only Y, Z and Q will be there. Okay, so now you have to check what is the balance. Whatever the balance is there, it will go to balance sheet, Y and Z. Same with the capital account also. You can check, and that will also go to balance sheet. That should be it. No revaluation has happened in this question. So directly whatever is there in the balance sheet, just take it and put it into the balance sheet. Clear? Now bank account, you have to be careful. Bank account, what is the situation is 1,50,000 was already there. 1,50,000 was already there plus 2 lakh. What is this 2 lakh? They have taken a loan. See that loan you can see on the liability side. Then 2,20,000 was also introduced. 2,20,000 was introduced by whom? Q, the new partner, brought 2,20,000 and we ended up paying 2,70,000 to X, the old partner. This is how it is. Is this clear? This was question number 15. Let's proceed to question number 16. Okay, we'll go into the question number 16. Question 16, guys. X, Y, and Z are partners. X, Y, and Z are partners sharing profits and losses in the ratio of 3:2:2. That means this is the old profit sharing ratio. The balance sheet is given. Capital account, you can see 1,80,000 and 70,000. So straight away going to partners capital 1,80,000, 70,000. Then, okay, there is no goodwill in the balance sheet. X retired on 1st January 2023. On which date R is admitted as new partner? On which date R is admitted as new partner? X retired on 1/1/2023. Okay, for the purpose of adjusting the rights as between the partners, goodwill is valued at 84,000. Okay, very good. Sundry as debtors and stock to be reduced by and to, reduced by 16,000 and to 1 lakh. Okay, so what we are going to do? Revaluation account debited to debtors, revaluation account debited to stock. Whatever loss is there, it is going to be borne by all the partners. Okay, then in their profit sharing ratio, obviously, okay, in their profit sharing ratio of 3:2 Then after that, X is to receive 44,000 in cash on the date of retirement. So whatever balance is there in X capital account, can you see 44,000 is to bank, and remaining balancing figure, whatever is there, that will be transferred to his loan account. Okay, and balance due to him to remain at loan of 8%. Repayment of loan is to be made at the end of each year by annual installments representing 25% of the future profit before charging interest on loan. Whatever profit we make, 25% we are going to give it as installment. We are going to pay it off. R is to bring 1 lakh in cash as his capital on the date of admission. Very good. Bank account debited to capital account. Okay, then the new partners are to share profits and losses equally after paying the interest on excess loan. Profit and loss will be equal, so there will be 1:1 the new ratio. So now what you will do, you can calculate the sacrificing ratio. 3/7, 2/7, 2/7, 0 because this person is retiring. 1:1, 1/3, 1/3, 1/3. Okay, 1:1 actually. Okay, so that time you get the sacrificing ratio of 1/21, 1/21, 7/21. That means 1:7 is the sacrificing, means gain. These partners are gaining. So 84,000 is a goodwill. We had already seen 84,000 as a goodwill. Who is retiring? X is retiring. So X share in this is 9/21, or basically 3/7. Okay. So now if you see, X share is 36,000, which will be given by Y, Z and R. Y, Z and R will give it. So if you see the partner's capital account, Y's capital account debited, Z's capital account debited, R's capital account debited, and it is given to X. Is this clear? Then finally what we are going to do, balance carried down. Whatever partner's capital balance is there, it will be carried down. Net profit for the year ended is given 64,000. So you see the P&L appropriation 64,000. So 25% of this we should give it as repayment. So 16,000. Then whatever profit is remaining, that will be equally distributed to the partners. Loan account, they had asked, balance in the loan account was 80,000, because after paying 44,000, 80,000 got transferred to loan account. On that loan, interest will be added this year because one full year has gone. 6,408% interest. We are paying 16,000, so balance will remain. It will be paid in the next year or upcoming years. Is this clear? Okay, capital account of new partners. Capital account of partners had these balances. Where did we get this from, sir? Balance carried down. Last time we prepared capital account, balance carried down. Then this time we got profit share. Profit share will be added to the capital account and we get the new balance which is carried down. With this we are done with question number 16. Question number 16 is done. Clear? Now we move into question number 17. Question number 17. P, Q and R were partners sharing profits and losses in the ratio of 2:3:5. This is the old profit sharing ratio. P retired on 31st of March 2022 and X joined as a new partner. P went, X came. Okay, on the same day. The new profit sharing ratio between Q, R and X is 2:3:1. This is the new profit sharing ratio. Balance sheet of PQR is given. So what we can do straight away, first only we can calculate. Okay, the goodwill is given, I think, no? Okay, we'll go in order. In this, from this, what we know, reserves have to be distributed to the partners. So if you look at partners capital account, by reserves in their old ratio is 2:3:5. Then capital has to be put into partners, 10,000, 15,000 and 20,000. So you'll write over here by balance brought down 10,000, 15,000 and 20,000. Then after that, okay, after that you can see X was admitted on the following terms. Machinery was to be depreciated by 3,000. So in revaluation account, they have written revaluation account debited to machinery account. Then building was to be revalued at 30,000. Right now the building is showing 10,000. So increase. So building account debited to revaluation account. Then stock was to be written off by 5,000. So revaluation account debited to stock account. Provision of 5% was to be made against doubtful debts. Debtor is 30,000 into 5%. So you will get 1,500. Revaluation account debited to provision for doubtful debts. Then they have told general reserve would be apportioned among partners. Already we have apportioned it. So till now we got only this much. So we got a revaluation profit which will be shared between P, Q and R. P, Q and R. Okay. Then firm's goodwill has to be valued at 2 years purchase of the average profit. Where did they tell? Show memorandum revaluation. That means whatever is done has to be reversed. So what we are going to do, this 3,000, this 5,000 and this 1,500 and this 20,000, everything is reversed. Whatever profit we got, now we are going to get loss, and it should be shared between QR and X, QRX in the ratio, new ratio, that is 2:3:1. 3,500, 5,250 and 1,750. Is this clear? This is how the distribution is going to happen. This is how the distribution is going to happen. Is this clear? Yes, this should be it. Okay guys, you can see over here by memorandum revaluation, and here you can see 2 memorandum revaluation, by memorandum revaluation, and you can see 2 memorandum revaluation. Is this clear? Yes. Now after that you can see amount due to P was retained in the business as a loan, but X capital contribution should be 1/5 of the combined adjusted capital of Q and R. His capital would be transferred from his loan account. Okay, goodwill would be wiped off from the books after X admission. Partners decided not to alter the book value of assets and liabilities. That's why we prepared memorandum revaluation. The profit or loss of the last 3 years are given. 20,000 profit, 15,000 loss and 40,000 profit. That will help us to calculate the profits. 20,000 minus 15 plus 40 divided by 3, 15,000 is the goodwill. Sorry, 15,000 is the average profit. Multiply into 2, you will get the goodwill. Goodwill, you know, old ratio minus new ratio, how to calculate? Goodwill will be distributed between Q and X, because one person is having 0 here. That means not sacrificing, not gaining. Okay, Q and X will give. You can see the entry for that. Q's capital account debited, X capital account debited, 2P's capital account. 2P's capital account we are going to give. Is this clear? Then amount to be brought. Amount to be brought. So what did they tell? The whatever is the combined adjusted capital of Q and R, 1/5 should be there. So now you have to do, calculate the capital of Q, calculate the capital of R. You are getting 25,650 plus 40,000. 1/5 of that should be the capital of the new partner. New partner is X. New partner's capital should be 1/5 of that. 13,130. So 13,130. If you see, whatever amount you have to bring to make it 13,130, take 13,130 plus 5,000 share of goodwill plus 1,750, then memorandum loss, 19,880. What did they tell here? 19,880 he is not going to bring, just transfer from his loan account. So it will be X loan account debited to X capital account, X loan account debited to X capital account. So you will have X loan, already X loan was there in the balance sheet, loan from X, from this you remove and we transfer it to capital account, and these are the capitals which we saw. P is loan, sir. Who is this P? The retiring partner. Retiring partner's capital account, can you see there was 26,100 that is transferred to his loan account. Then other things are at their book value only. Nobody brought even 1 rupee money. Nobody took even 1 rupee money. Everything will be at their book value. That should be it with this particular question. Let's go into question number 18. Question number 18. Okay, A, B and C are in partnership sharing profits and losses in the ratio of 3:2:1 respectively. The balance sheet of the partnership firm as on 31st March 2023 is as under. The balance sheet is given to you. Okay, always go to the end of the question and check what they are asking. You are required to prepare revaluation account, partner's capital account, partner's current account, C's loan account, bank account, balance sheet of the newly constituted firm as on 1st April 2023. Shabash. So capital account has to go 170, 130 and 70 will go to partner's capital account. Go and check the partner's capital account for our reference. 170, 130 and 70,000 transferred to capital account. And there is a balance in current account 74289356. Go and write 7428 for A and 9356 for C. And other side, can you see current account of B? Premises, plant, vehicle, fixture. Current account of B, stock, debtors, cash in hand. 5018. So you're going to write 5018 over here, balance brought down. Okay, is there any goodwill? No. Is there any reserves? No. C decided to retire from the business as on the date, and D is admitted as a partner on that date. The following matters agreed. Assets revalued as follows. Premises 2 lakh 40. How much is premise? 1 lakh 80. That means premises increasing. See the revaluation account. By premises 60,000. Plant is 70,000. How much is plant right now? Plant is 74. That means plant is decreasing. To plant 4,000. Next, after that, stock 108,358. How much is the stock right now? 124,758. So 124,758 minus 108,358. So you have 16,400. 16,400 to stock. Provision of 6,000 is to be created against debtors. So to PDD 6,000. That should be it. With the revaluation, transfer the profit to the partner's current account, because we have partner's current account 16,800, 11,800 and 15,000, 5,600. Which partners? All the old partners. Okay, you can see the partner's current account. By revaluation, all this amount is transferred. After that, goodwill is to be recorded in the books on the day C retires at 84,000. Goodwill is to be recorded at what? 84,000. Goodwill will be recorded at 84,000. Partners in the new firm do not wish to maintain a goodwill account, so the amount is to be written off against the new partner's capital account. That we anyways know. Gaining partner will give to sacrificing partner. A and B are to share profits in the same ratio as before. A and B will share the profits in the same ratio as before. D is to have the same share of profit as C. Now, who is going? C is going. So C share will be D's share. A and B will be same. So you can understand this. Very simple it is. A, B, C 3:2:1. Okay. C had 1/6. Okay. So not that will be given to D. A, B, D, it will be 3:2:1. So C is sacrificing, D is gaining. Goodwill is 84,000, 1/6. So C share of goodwill. C is sacrificing, C will give it, D will give it to C. 14,000 will be given by D to C. So now see the entry for that. D is going to give, right? D's capital account debited to C's capital account. D's capital account debited to C's capital account. It will be given through the capital accounts. They only told it's going to be given through the capital account. Now, C is to take a car at its book value 7,800 in part repayment, and the balance of all he is owed by the firm in cash except 40,000, which is willing to leave as loan. So he'll take one car, take 40,000 cash, balance will be kept as loan. Okay, now if you see all this is done, take whatever balance is there, take from C's current account and transfer to his capital account. Now you give him one car. If you give him one car, what happens? Capital account debited to motor vehicle. Then you are going to pay, okay, 40,000 will be in loan. Balance of all he is owed by the firm in cash except 40,000. So 40,000 will be kept as loan. So you will transfer to C's loan account 40,000 and balance has to be paid. So to bank account 51,156. Clear? Yes, the partners of the new firm are to start on an equal footing so far as capital and current account are concerned. D is to contribute cash to bring in his capital and current account to the same amount as the original partner from the old firm who has the lower investment in the business. The original partner in the old firm who has a higher investment business will draw out cash so that his capital and current account balance equal to those of his new partners. Simple, they told simple, make capital proportionate. They just told make capital proportionate, that's all. Okay, so we have to have that working note for that. Where is it? Okay, not done. Now, what did they tell? Capital should be same. Okay, they said capital should be same as the person who has a lower capital. Who is the lower capital here? 1,30,000, right? You can see over here, original from the old firm who has a lower investment in the business. Who had the lower investment in the business? B had lower investment in the business, original partner. So everything capital will be same. So everybody has to have 1,30,000, 1,30,000, 1,30,000. Okay, C has to bring money. C is gone. D has to bring money to make it 1,30,000. And A has extra capital. So A will take money. A will take money. Clear? If you see here also, it has to be 6182. How 6182? How 6182, guys? You have to check. Current account, what did they tell? D is to contribute cash to bring his capital and current account to the same as original partners from the old firm who has the lower investment in business. Okay, yes, lower investment in this case is actually A and B are there. 7428 plus 16,800 minus 24,002. Okay, B will be 11,200. C, B 11,200 minus 5018. B has 11,200 minus 5018, 6182. Yeah, 11,200 minus 5018, 6182 is there in B. So again, here also B only lower investment. Everyone should have 6182, 6182, 6182. Therefore, extra person who has extra A, he will take money, and shortage person D will bring money. Okay, then C's loan account, you can see transferred 56,000 was already there. C's loan account, there was 56,000. You can see over here loan from C, and now we just transferred 40,000 and to bank 56,000. What is this 56,000 we are going to pay? Old loan is going to pay, because only 40,000 should be remain. They said no, only 40,000 should be remaining. That means old loan is repaid. Now if you see bank account you are going to prepare all this to bank, by bank, everywhere you have written no, transfer it to bank account. Balance sheet shouldn't be a problem. Whatever revaluation you have done, vehicle you have revalued, I think that you are going to consider. Okay, that you have to be careful. Capital account balances, we know everything is same. 6182, 6182, 6182, 1 lakh 30, 1 lakh 30, 1 lakh 30. Okay, this should be your situation. Okay, why you got bank OD? Because the balance carried down came this side. That means we have less money, but we have spent more money. So we got bank OD in this case. Okay, this should be the question from partnership. Let's go into the next question. Question number 19. Okay, let's go into the next question. Question number 19. Okay, question number 19. A, B, and C have been in business partnership for some years, sharing profits and loss in the ratio 4:3:3. The balance in the books of the firm is given subject to the final adjustment, whereas under. Now we are moved into death of a partner. C died on 30th/9/2022. The partnership deed provided that interest was to be credited. Let's go to the end of the question and see what they are asking, so that we are on the right page. You are required to prepare everything. Revaluation account, partners capital, partners current account, C's heirs account, balance sheet. Nothing. They have not paired us with anything. Okay, so now here we have to understand 19. Okay, profit, goodwill computation. Okay, we'll go to all that. Capital account, A's capital, B's capital, C's capital. 240, 45, 375. You can go straight to capital account and put that partners capital. Okay. Okay, it is a little messed up. You can take this question as practice. It's there in the material. Okay, you can take this question as practice. Correcting the alignment will simply waste time. Let's go further to question number 20. Question number 20, we'll go into question number 20. Here also death of a partner is there. B died on 1st August. Or wait a second, we'll see if we can sort it out. Yes, let's sort it out. Because it's an important question. Yes. Now capital, you can see capital 3 lakhs. How? Capital is here 3 lakh. B's capital here 1 lakh 50. C's capital here 1 lakh 80. So 3 lakh, 1 lakh 50 and 1 lakh 80. Then we have profit for the year before charging interest. Profit for the year before charging interest is 3,12,000. Okay, we'll see what that interest is. Then we have land and building, furniture and fixture, stock, debtors, bank, creditors. Okay. Just checking if it's 3 lakh plus 1 lakh 50 plus 1 lakh 80 plus 3 lakh 12,000 plus 90,000. Yes, this is 90,000. Partners drawings A, B, and C. This, and this drawings. Okay. Now, Next, can we go further, guys? Yes, guys. Yes, yes, yes. Yes, that should be it, guys. Let's continue now. Yeah. Now, see, you can see over here drawings. What will happen to drawings? 48, 72, and 72. It should reduce the capital. So you'll write partners current account. To balance brought down. Okay, will be the drawings. Partners current account. Now we'll go into the question. Okay, C died on 39/2022. This balance sheet was given on 31st of March 2023. End of the year they have given, but C has died in the middle of the year. Partnership deed provided the following. Interest was to be credited on C's capital account of partners at 10% per annum and on the balance at the beginning of the year. On the balance at the beginning of the year, 10% is the interest. Okay. On death of a partner, goodwill was to be valued at 3 years purchase of average annual profit of 3 years up to the date of death after deducting interest on capital at the rate of 8%. They said if partner dies, when you are calculating goodwill, 8% interest and a fair remuneration for each partner. So you have to calculate 8% interest and also fair remuneration for each partner. Okay, fixed asset account what to be revalued by an independent valuer and all other assets are to be taken over at book value. Very good. Wherever necessary, profit or loss should be apportioned on time basis, 2/12, 3/12, whatever you want to do. Amount due to the deceased partner's sole heir was to receive interest at 12% per annum from the date of death until paid. Okay, till you pay 12% per annum. Okay. It was ascertained that profit for the 3 years before charging interest was given 1920, 2021, 21-22. Independent valuation at the date on the date of death revealed that land and building becomes 3 lakhs, furniture becomes 30,000. So land and building, you can check the revaluation account. Land and building is increasing, furniture is decreasing. Whatever profit is there, distributed to partners. Partners current account, you can check over here 18,000, 13,500, 13,500. Is this clear? Next, a fair remuneration for each of the partners would be 75,000. Fair remuneration for each of the partner would be 75,000 per annum. And the capital employed in the business is taken as 7,80,000 throughout. It was agreed among the partners that goodwill was not to be shown. That we anyways don't show. A and B would share equally after the date of death of C. So 1:1 ratio. Depreciation on revised value, ignore. Okay, so now, till now what we have understood, only revaluation account we have understood and partners capital account is sitting just like that. So now you have to understand the very important thing is about goodwill. Okay, it's about goodwill calculation. So now, where is our goodwill computation? Yes, goodwill computation. So what they told over here, very important point, goodwill should be valued at 3 years purchase of average annual profits up to the date of death of C. Till the date of death of C, we are going to calculate. The C died on 30th of September 2022. Before that, 3 years we have to see. So 1/10/2019 to 39/2022. For this time period, we have to check the profit. That means 2019 half, 2020 full, 2021 full, 2019-20 half, 21-22 full, 22-23 full, and 23-24 half. What am I telling? Yeah, 1920 half year profit, because from 110 only we need. 2021 full year profit, 21-22 full year profit, 22-23 only half year profit because this fellow died on 30th of September. Okay, so when we do that, you will get 10,62,000 as a total profit. Take the average, you will get 3,54,000. Did you understand? They said up to the date of death. That means from 1920, we have to take up to the date of death, that is 30th of September 2022, up to the date of death 3 years. So 19 half, 22 half, middle there are 2 full years, 3,54,000. Interest on capital, they said interest on capital should be 8% per annum, and for that they said capital employed, take it as 7,80,000. So 7,80,000 into 8% per annum, 62,400. And then they said salary should be how much? 75,000 per annum. Salary 75,000 per annum for 3 partners. So 75,000 into 3 partners. Salary becomes 2,25,000. That time you get the average profit after interest, after salary. That time multiply into 3 years purchase. 1,99,800 is your goodwill. 1,99,800 is your goodwill. Old ratio is given 4:3:3. New ratio is 1:1. So 1/2. You get the sacrificing ratio. Sacrificing ratio is, gain ratio is actually 1:2. 2. So 3 by 10 has to be given to C. It will be given in the ratio of 1:2. So A and B has to give. So A's current account debited, B's current account debited to C's current account. So can you see this? A's current account debited, B's current account debited to C's current account. Okay, we have done this. Then after this, what we are supposed to do? We are supposed to just give the profit share. Only the profit share we have to give. Now profit share, how to calculate? Can you see over here? Profit before charging interest was 3,12,000. Profit. Now you have a proper calculation. 3,12,000. Break it into two halves. First half 1,56,000. Second half 1,56,000. Sir, why sir all this circus? Because first half there are 3 partners. Second half there are only 2 partners. So interest we have to calculate. What was their capital? 3 lakh, 1,50,000 and 1,80,000. Interest at the rate of 10%. Sir, no sir, 8%. 8% is only for goodwill calculation. Otherwise, the interest is going to be 10% per annum. So 3 lakh into 10% into 6 by 12. 1,50,000 into 10% into 6 by 12. 1,80,000 into 10% into 6 by 12. Interest on capital. That time you will get the remaining profit. This remaining profit will be distributed in the ratio of 4:3:3. Remaining profit will be distributed in the ratio of 4:3:3. 49,800, 37,350 and 37,350. Is this clear? Yes. Now, remaining profit is distributed. This profit we will distribute. We will give it to the partners. Can you see over here? Go to the partners' current account. Interest, interest, interest. 3 partners we give interest for 6 months. Then profit share, profit share, profit share. We give the profit share for 6 months. Now 6 months are over. Now that old partner, one of the partner died. We can send that partner. Whatever is there in this partner's current account. Can you see? It is transferred to executor's account. It is transferred to executor's account. And whatever is there in the capital account, that is also transferred to executor's account. So now what happens in the second half? See the second half. Second half of the year, we have to give interest to X. We have to give interest to Y. And we have to give interest on the loan which we are supposed to give to executor. 227,790. Sir, from where you are getting these numbers? 47,790 plus 1,80,000, 227,790. 227,790. So now what happens? 13,667. 13,667. Okay, C's executor's account. Interest on C's executor account. You have to give this much. And whatever remains after that, it will be given to A and B. Whatever remains after that will be given to A and B. Is this clear? This will be given to A and B. That has to be distributed equally. 1:1. One person will get 1 rupee less and 1 rupee more. Don't worry about that. Don't fight over that. Okay, 1:1. Now what is going to happen? Now very, very important thing you have to understand. Interest is given for these 2 partners and profit is distributed to these 2 partners. This will be their balance carried down. This will be their balance carried down, which will go to balance sheet, and this is their capital account balance. Now C's executor we have not paid. That balance will come over here. How did we get 241,457? 241,457. See over here. 1,80,000 we have to give to executor. Take 1,80,000. Okay, 47,790 we have to give to executor. 47,790. Then interest we have to give 13,667. 13,667. 241,457. 241,457 is what we are supposed to give to the executor. Then creditor, rest of the things and all, you know how to put it. Revaluation you have done, those things will change. The rest of the things will remain same. Not a single rupee we have paid to anybody. Not a single rupee we have received from anybody. With that, we are done with this question. It's an important question. That's why I didn't want to skip it. Question number 20. A, B and C are partners in a firm sharing profits and losses in the ratio of 3:2:1. Their balance sheet as on 31st March 2023 was as follows. Oh, okay. Can you see the balance sheet? B died. Let's go to the end. You are required to pass necessary journal entries to record the above transactions and amount payable to B's executor. Wow. Amount payable to B's executor, they have asked. Journal entries. Now look at the balance sheet. Can you see A's capital, B's capital, C's capital, general reserve, A's loan, B's loan, creditors. Then rest of the things on the asset side, rupees in lakhs. No goodwill is there to be eliminated. Now, general reserve, what we have to do? We have to distribute to the partners. What is a profit sharing ratio? 3:2:1. So, first entry is general reserve account debited to A's capital, to B's capital, to C's capital in the ratio of 3:2:1. Then, after that, they said B died on 1st August 2023. His account is to be settled as on the following terms. Goodwill will be valued at 3 years purchase of the last 4 accounting years. They didn't tell last 4 years till the date of death. They just told last 4 accounting years average profit. Profit was like this: 135, 145, 31 and 165. Take your calculator and calculate the average profit. 135, 145, 31 and 165 divided by 4. Goodwill will be into number of years of purchase 357. What is the share of that person who died? B. B died. Can you see B's share over here? 2 by 6. 2 by 6. That time you get 119. 2 by 6 you will get 119. Is this clear? 119. This has to be shared in the ratio of sacrifice 3:1. Ratio of sacrifice 3:1, 89.25, 29.75. Is this clear? Any doubts with this? No. This should be it. Okay, this should be it. Goodwill computation. Now, goodwill, these people are giving, A and C are giving. So, see the entry. A's capital account debited, C's capital account debited to B's capital. Simple. Goodwill distribution entry. Then they have asked, land and building will be valued at 250 lakhs. How much was land and building? 210. So you are going to increase the land and building account debited to revaluation account. Then you can see over here, plant and machinery will be valued at 240 lakhs. How much is plant and machinery right now? 255. So you're going to reduce it. Revaluation account debited to plant and machinery. Next, after that, for the purpose of calculating B's share in the profit on 1/4/2023 to 31/7/2023, the profit for the year 22-23 will be taken as base. Take last year's profit, they said. So 165 into how many months over here? April, May, June, July into 4 by 12 into, what is that fellow's share? 2 by 6. Oh, what are you talking, sir? Revaluation profit is distributed to partners, that we already know. P&L suspense account debited to B's capital account, 165 into 2 by 6 into 4 by 12. And P&L suspense account debited to B's capital account. Again, interest. What is this interest? Interest on partners loan will be calculated at 6% per annum. How much partners loan was there? 20. B. So 20 into 6% into 4 by 12. You are giving this thing. Then what we are going to do? B's loan account debited to B's executor account. Transfer the B's loan to B's executor account and B's capital account. Check whatever is there in B's capital account. How we are going to check? See B's capital account here, 110. 110. Then go into all the journal entries. Here we have put 55 plus 55. Okay, then here we have put 119 plus 119. And here nothing, here nothing. Here we have put 8.33 plus 8.33. Then here we have put 18.33 plus 18.33. Then here we have put 0.4 plus 0.4. 311.06. Can you see we have transferred it to B's executor account? Okay, we have removed and we have transferred to B's executor's account. And finally, B's executor's account is paid. How much it's paid? They only told that a sum of 50 lakhs will be paid immediately to B's executor and balance to be paid on 1st December 2023 together with the interest of 10%. First you pay 50 and remaining will be loan. And now what you are going to do? You are going to pay after 4 months. Again after 4 months. So executor's loan debited and 4 months interest which you are going to pay debited to P&L suspense and everything is credited to bank. Clear? Beautiful question. That should be it with this particular question. 20 questions we have finished on partnership. Let's go to the 21st question. Let's try to do full proof of partnership. Everything we'll go through. 1 second, guys. The following was a balance sheet of A, B, and C who shared profits and losses in the ratio 1:2:2. 1:2:2. As on 31st December 2022. Okay, you can see the liabilities and you can see the assets over here. Go to the end of the question. Prepare a new balance sheet of the firm, necessary journal entries and ledger accounts of the partners. Okay, new balance sheet, necessary journal entries and ledger accounts of partners. Clear? Now, C died. This is the third question on death which we are going to see. Death of a partner. Third question. The following is the balance sheet. Now, 21st question. What have they asked? Again, journal entries, huh? Journal. Okay, we'll see what they have asked. Goodwill is to be calculated at the rate of 2 years purchase on the basis of average of 5 years profit. Okay, profit for January to March 2022 is to be calculated proportionately on the average profit of 3 years. The profits are given 3,000, 7,000 and 10,000 and 14,000 and 12,000 loss. Can you see that's how we have arranged everything? 3,000, 7,000, 10,000, 14,000 and 12,000 loss. Now there must be some rectifications. We have to be worried. During 2022, a moped costing 4,000 was purchased and debited to traveling expense account on which depreciation is to be calculated at 25%. Moped by mistake you have put into traveling expense. Now you are going to remove from traveling expense. That's why we are going to add it to profit. When we remove the expense, profit will increase. When we remove the expense, profit will increase, and we have to calculate 25% depreciation on that. So profit will decrease. Profit will decrease. Other values agreed on assets. Okay. Other than that, there is nothing. Only one rectification. So you get these profits now. You get these profits. Take the average. You got the average profit. Number of years of purchase. They said 2 years purchase. So this should be a goodwill. Who is the partner who died? C. What was C's share? C's share was 2 by 5. Multiply, you will get C's share. C share. It will be shared by others. Who are the others? 1:2. A and B will share it in the ratio of 1:2. 1333 and 2667. Okay, that should be it with that particular goodwill calculation. There shouldn't be any problem with goodwill calculation. You can see that entry also. A's capital account debited, B's capital account debited to C's capital account 4,000. That is a goodwill entry 4,000. Then after that, can you see that in the question there is general reserve? General reserve will be distributed to all the partners A, B and C. After that, they have told revaluation has to be done. There are some revaluation entries. Stock, building, machinery, investment. Debtors are considered good. All these revaluation, I am not even going to go through this. Okay, you know the entries for that. This is the goodwill which is there in the balance sheet which has to be written off. Can you see 15,000 goodwill is there? That has to be written off. Then P&L suspense. We are going to calculate how. Profit from Jan to March will be calculated proportionately on the average profit of 3 years. Last 3 years, what is the profit? 10,000, 14,000 and minus 9,000 divided by 3. Okay, that comes out to 5,000. 2 by 5. Why 2 by 5? Because C's share is 2 by 5. And he was there for only 3 months in this particular year. Into 3 by 12, you will get P&L suspense to C's capital account. Then we have to pass the entry for bringing that moped. Moped account debited to P&L adjustment account. Then we have to calculate depreciation on that moped. P&L adjustment account debited to moped. Then P&L adjustment, whatever is there, it will be transferred to partners capital account. It will be transferred to partners capital account. Stock revaluation, building revaluation, machinery revaluation, investment revaluation, PBD creation and revaluation profit to be distributed. I am not even going to discuss this. There is one fund called as investment fluctuation fund that also will be distributed to partners. You can see the fund is there. Then whatever you find in C's capital account, please transfer it to C's executors account. They didn't tell that we are going to pay. This is the partners capital account. You will be able to do because just now we discussed all the journal entries. That shouldn't be a problem. Balance sheet also you should be able to do because all the journal entries are passed. Partners capital account, you're just going to post everything. And finally, revaluation also you have done. So new assets and liabilities balance, you know. Okay, guys, let's go into question number 22. Question number 22. Naresh, Rohit and Krishna are partners sharing profits and losses in a ratio of 2:1. On 1st January 2019, they took out a joint life policy of 2 lakhs. Annual premium of 10,000 was payable on 1st January each year. Last premium was paid on 15th January 2023. Rohit died on 1st March 2023. Policy money was received. The surrender value of the policy of each year. Each year surrender value they have given. Show joint life policy accounts on 31st March each year, assuming that premium is charged to P&L or premium is debited to joint life policy account and the balance of joint life policy account is adjusted every year to its surrender value. What they are telling, either show it as joint life policy premium is shown as expense or joint life policy premium is shown as asset. Now first one, if premium is treated as expense, what account we will have? Joint life policy premium account we will have. Every year how much we are paying? The premium is 10,000 we are paying on 1st January every year. So what we are going to do? Joint life policy premium account debited to bank account. Then premium is an expense, so transfer to P&L. P&L account debited to joint life policy premium. Every year that same entry is going to happen. Every year same entry. Then finally a partner died. When they die, how much we will get? We'll get 2 lakh rupees. So the entry will be bank account debited because you got money to joint life policy account. So then that 2 lakh will be distributed to the partners in their profit sharing ratio of 2:2:1. Clear? If the premium is treated as asset, this is very critical. Okay, first what you will do, first year's premium you will pay 10,000, joint life policy account debited to bank. I told you that time, if the joint premium is treated as asset, paid, whatever you paid is treated as asset, every year you have to adjust it to the surrender value. First year, what is the surrender value? 0. Remove everything and transfer to P&L. Next year again you paid premium. Okay, next year what is the surrender value? We get surrender value only in 2021, no? Okay, 20 also, everything you transfer to P&L. Third year again you paid premium. Third year we have a surrender value of 2,000. So remove 8,000 and transfer to P&L. Keep the 2,000 like this. This becomes balance brought down. Then next year again you pay 10,000 and the premium surrender value is 5,000. So 5,000. So 10 plus 12. 10 plus 2 it becomes 12. We need only 5. So 7,000 you remove and transfer to P&L. 5,000 remains. That will be the balance for the next year. Balance for the next year. After that, what happens in the next year? Again we pay the premium and that partner died. So we got 2 lakhs. Now whatever the balance is there, 2 lakh. Already 15,000 is sitting over here. So 1,85,000 which is there, that is distributed to the partners in their profit sharing ratio. This is a very simple question on joint life policy accounting. How you are going to account for the premium. Clear? In case they ask for 4 marks or something, you should be in a position. Easy 4 marks it is. Next we go into question number 23. Question number 23. From here dissolution starts. Prepare realization account, partners capital account and bank account. In dissolution we have a simple rule. First you empty the balance sheet. Then you go on reading the question. Okay, this is dissolution, right? I'm emptying the balance sheet now. First creditors and loan. So what I will do, can you see over here? Creditors and loan transfer to realization account. Liability account debited to realization account transferred. I'm emptying the balance sheet. First step is empty the balance sheet, then you go on doing it. Okay, reading the question. Capital of partners is given. Where will we put it? Go to partners capital account and write balance brought down, balance brought down, balance brought down. Clear? Then on this side you have cash. Cash, what will you do? Go to cash account and write balance brought down 3,200. Okay, then sundry assets. Go to assets realization account 17,000 here. Debtors 24,200 and provision for doubtful debts is 1,200. Provision for doubtful debts 1,200. Clear? Then after that you have stock is 7,800, furniture is 1,000. Transfer. Stock 7,800, furniture is 1,000. Did your balance sheet get emptied? Yes, now your balance sheet is empty. Now as you read, you have to pass the entries. Goodwill is to be ignored. Very good. Tata, bye bye. A is to take over all the fixtures at 800. A is to take over the fixtures. So A's capital account debited to realization account. A's capital account debited to realization asset taken over by partner. Then debtors amounting to 20,000 at 17,200. Okay, debtors amounting to 20,000 at 17,200. So you'll write A's capital account debited to realization account 17,200. Next, the creditors of 6,000 to be assumed by A at that figure. That means creditor A will take over. So creditor is a liability. Liability taken over. Realization account debited to A. Realization account debited to A's capital account 6,000. Next, B is to take over all the stock at 7,000. So what we will do, B's capital account debited. Okay, and he's also going to take sundry assets. So 7,000 plus 7,200 is going to take 14,200 of assets. B's capital account debited to realization account 14,200. And doesn't matter. C is to take over remaining sundry assets at 90% of the book value, less 100 allowances and assume responsibility for, okay. C is going to take the remaining assets. Sundry assets we had 17,000. How do we know that, sir? Here it is there, 17,000. Okay, and taken by B. Taken by B. B is taking it at, see, B is taking the 7,200, but it is 10% less than the book value. So if it is 90%, how much is 100%? 8,000 gone. Okay, sundry assets. A is not taking any sundry assets. So how much is remaining? 9,000 assets are remaining. C is taking it over, but he is taking it at 90%. So 90% of that is 8,100. And 100 rupees again 11. Remove 100 rupees. 8,000. It is taken by C at 8,000. Is this calculation clear? So C's capital account debited to realization account. C's capital account debited to realization account. Clear? Yes, very good. Let's continue. Okay, discharge of the loan. And he's going to assume the responsibility for the discharge of the loan together with the accruing interest of 30, which had not been recorded in the books at all. What is the loan amount? Loan was 1,500. So 1,530, C told I will pay. So realization account debited 1,530 to C 1,530. Then what is happening? After that, they said expenses of dissolution 270. So realization account debited 270 to bank account 270. The remaining debtors were sold to a debt collection agency at 50% of the book value. Remaining debtors. Debtors, how much? 20,000 is taken by A, no? How much debtors are there in the question? 24,200. 24,200 out of the 20,000 is taken by A. So 4,200 are there. It is sold for a debt collection agency 50%. That means 2,100 we are going to get. So the entry should be bank account debited to realization account 2,100 we are going to get. Okay, that is it. I don't think they have told anything else. Now you have to just see the realization account. There is a loss. Transfer the loss to partner's capital account. Okay, then what you are going to see, whichever partner has credit balance, pay. Now see, here this fellow's capital account is credit, so you pay 11,420. Here this debit balance, so they will bring money 5560 and 830, just the balancing figure. If you find credit side more, debit side you write to bank. If you find debit side more, credit side you write by bank. That means the person is paying and receiving. Clear? This should be it with that particular question. That is it, 24. We'll go to 24th question. Realization account, capital account and bank account. Okay. Again, we have to do the same thing. Dissolution of partnership. First we'll empty the balance sheet. Capital account X and Y 40 and 30 you can see over here. Capital account X and Y 40 and 30. So 40,000, 30,000. Then you can see reserve fund 10,000 distribute to the partners. Reserve fund 4,000, 4,000 and 2,000 distribute to the partners. Then joint life policy fund. Joint life policy fund, what you are going to do? JLP, joint life policy fund, transfer it to realization account. Okay. Then creditors 19,000, transfer to realization account, creditors. Then minus 500 provision. Provision you have to put to the realization account this side. Okay, provision is an asset here. 2,000 salary outstanding, transfer to realization account. 2,000 salary outstanding salary. Go to the asset side, 50,000 asset, transfer to the realization account. Okay, 10,000 joint life policy at surrender value, transfer to realization account. Then debtors 10,000, transfer to realization account. But there is provision for doubtful debts, that transfer to realization account, liability. Then we have stock at invoice price, transfer to realization account. And on that there is price loading, unrealized profit or stock reserve, 2,000, transfer to realization account, other side. Investment 8,000, transfer to realization account 8,000, asset. Minus 500, the fluctuation fund, transfer to realization account 500. Okay, capital account of Z, debit balance. So go to capital account and write, okay, Z is 2,000. So put it over here, 2,000 Z. Then you can see over here, bank account 23,500. Bank account 23,500 you're going to put over here, 23,500. Then after that you're going to tell investments were taken over by X at 6,000. So what should be the entry? X capital account debited to realization account. Then creditors of 10,000 were taken over by Y, so, who has agreed to settle the amount with them for 9,900. So realization account debited okay, 9,900. Y's capital account debited to realization account. Okay, remaining creditors were paid at 7,500. So realization account debited to bank account. Where is it? Yes, you paid them. Then joint life policy surrendered and fixed assets realized 70,000. Joint life policy surrendered and fixed assets realized 70,000. So bank account, where is it, guys? Okay, total we are putting here. Bank account debited to realization account 70,000. Okay, total we are going to take. Stock and debtors realized 7,000 and 9,000 respectively. Here also 7,000, 9,000 respectively. Total 86,000 you got over here. 86,000 is sitting over here. One customer whose account was written off as bad now paid 800, which is not included in 9,000 mentioned above. So what we are going to do? Bank account debited to realization. Bank account debited to realization account. Then there was an unrecorded asset estimated at 3,000, half of which was handed over to an unrecorded liability of 5,000, and the settlement of the claim was 2,500, and the remaining half was sold in the markets, which realized 1,300. Oh, very good. So only thing is we are worried about is when did the money come? Okay, realization, bank account debited to realization account. So what is going to happen here? 3,500, 2,500 we are going to consider. Let's show the calculation. Unrecorded asset 3,000. Okay, unrecorded asset is 3,000, 1,500 here and 1,500 here. Okay, then what is going to happen? Liability at the rate of 2,500, 1,000 cash has to be paid. Okay, then 1,300 we got cash over here. Here we got 1,000 cash. So totally net if you see 300 is received. Here 1,000 is to be paid. Here 1,300 is to be received. So 300 is received. So 300 is received. So what we are going to do? 300 is received. We are going to pass the entry realization bank account debited to realization account 300. After that, Y took over responsibility of completing the dissolution and he agreed to get a salary of 400 per month. How many months we have worked now? 400 into 4 months. Realization account debited to Y's capital account. Realization to Y's capital account. Actual expenses were amounted to 1,100. Realization account debited to bank account. Realization to bank account. Then dissolution was completed and final payment were made on April 2024. Now you can see over here there is one salary outstanding. Have you paid the salary outstanding? No, 2,000. Pay the salary outstanding. Then only you can proceed further. Okay. Apart from that, 10,000. What is the 10,000? There is some 10,000 that we are supposed to pay. Stock and debtors realized. Yes. Yes. Yeah, 10,000 is this joint life policy, which is there at surrender value. So you will get money. So it will be bank account debited to realization account. Bank account debited to realization account 10,000. Joint life policy was there, no? Then finally realization, you just close it. This is the salary outstanding which we have paid. Realization profit or loss transferred to partners capital. You can see this transfer to partners capital. Remaining is whatever credit balance is there, pay. Debit balance is there, you take the money. Credit balance is there, so everything is paid. With that, bank also is closed. Done. 25th question. That's a fixed capital method and fluctuating capital method applying Ghana versus Murray rule. Okay. Now going to question 25. A, B and C are in partnership sharing profits and losses equally and agreed to dissolve the firm on 36/2023. On that day, their balance sheet stood as follows. Okay, you can see their balance sheet as on 30th June 2023. Their balance sheet is there. First, we have to empty the balance sheet. I have told you 34,000, 24,000. 34,000, 24,000 balance brought down. Okay, then creditors 12,000 transfer to realization account. Creditors. Asset side, you have sundry asset transfer to realization account. Profit and loss account, we have 12,000 that has to be borne by the partners. 4,000, 4,000 and 4,000. And one partner has a debit balance, so you will be writing two balance brought down. Okay. Now, assets were realized at 50% of their book value. So 50% means they have realized only 25,000. So what we are going to do here? realization bank account debited to realization 25,000 you're getting. Then realization expense amounted to 5,000. Realization account debited to bank account. Realization account debited to bank account. C became insolvent and received 2,000 from his estate. Now you have to understand Ghana versus Murray. Whenever a partner is insolvent, it will be borne by other partners. How much did we receive from C? Only 2,000. So you're going to write bank account debited to C's capital account. Now how much is the loss? Take your calculator and see. In C's capital account, 8,000 plus 4,000 plus realization. Please close the realization. Realization loss also 6,000, 6,000, 6,000. So 8,000 plus 4,000 plus 6,000, 18,000. Out of that, we have removed 2,000. Okay, 16,000 is the loss of C. It will be borne in their ratio of capital 34 and 24. 34 and 24. So now 34 is to 24 if you do, this is the loss which will be borne by the partners A and B. So A's capital account debited, B's capital account debited to C. Done. This is what you're going to do if Ghana versus Murray is there. But they also told in the question, what if it is fluctuating capital? Fluctuating capital. Now what will happen? Now the capital will be 34,000. 34,000. Out of 34,000, we have removed 4,000 and 6,000. So 34 minus 4 minus 6, you have a capital of only 24,000. And here 24,000, out of that we removed 4 and 6. So there is only 14,000. So based on that, we have to calculate now. So 16,000, when you divide in the ratio of 24 and 14, it becomes 10,105 and 5,895. So this will be the only change. Other than that, everything will be same. Other than that, everything will be same in that particular question. So fixed capital, if they tell Ghana, if they don't tell anything, it's always fixed capital. On top, what is there? That one only. If they tell fluctuating capital, see after all the adjustments, what is the capital balance? In that ratio, you adjust. Question number 26. Realization account, partners capital account and cash account. Okay guys, Ram, Rahim and Robert are partners of the firm ABC, sharing profits and losses in the ratio of 5:3:2. 5:3:2. The balance sheet of the firm is also given. First, what we are going to do, empty the balance sheet. Ram, Rahim and Robert. This is 2 lakhs obviously. Ram, Rahim and Robert. Go and put it over there. Partners capital account. Partners capital account. Ram, Rahim and Robert. Next you have general reserve, distribute in the ratio of 5:3:2. So you'll write by general reserve distributed 5:3:2. Then you're going to write loan. Loan will go to realization account, right over here loan. Okay, then you have sundry creditors, transfer to realization account. Creditors account debited to realization. Then goodwill, machinery, furniture, stock, debtors. All of them you transfer to realization account. Goodwill, machinery, furniture and stock. And this bank balance which is there 35,000, put it to show it as balance brought down 35,000. Okay, now you have to write partners of the firm decided to dissolve the firm. Partners of the firm decided to dissolve the firm. Clear? The firm decided to settle the loan creditors directly. Partners of the firm decided to dissolve the firm and firm decided to settle the loan creditors directly. Now, firm will pay the loan creditors. So the entry for this should be what? Realization account debited to bank account 95,000. After that, they said Ram took over goodwill for 75,000. So you'll write Ram's capital account debited to realization account. Then they said Rahim took over machinery and furniture at 90% of the book value. Machinery and furniture 50,000. Sorry, 4,55,000 plus 10,000. That makes it 4,65,000 into 10%. Sorry, into 90%. It's taken over at what? 90%. Into 90%. 4,65,000 into 90%. 4,18,500 you should get. Can you see 4,18,500? 4,18,500. Then they said that sundry creditors at book value. Sundry creditors at book value. How much is sundry creditors? This doesn't make sense. Sorry. Loan is paid. Sundry creditors is still there. So what should be the entry for sundry creditors? Realization account debited to Rahim's capital account. Rahim is going to take that, no? Then Robert took over stock at 95% of the book value and debtors at 90% of the book value. Debtors at 90% of the book value. Stock is 2 lakh and this is 3 lakh. So total 2 lakh into 95%, 3 lakh into 90%, it's coming up to 4 lakh 60,000. Put that 4 lakh 60,000 to realization account. Next, after that, what do we have? Partners have to pay cash if the assets taken over had exceeded the amounts due to them. Okay, that should be it. Debtors we have already put debtors. Now, this is creating a loss. Loss you transfer to partners capital account. Partners capital account, you transfer the loss. Nobody is becoming insolvent in this question. If someone has taken more, okay, someone has taken more, they will give money. If someone has taken less, they will take money. So 246,750, this fellow we are giving. These people are bringing money. Nobody is insolvent. That's the end of the question. End of realization, always what you see if they have credit balance, give the money. If they have debit balance, take the money. That's it. Okay, question number 27. Ram, Rahim and Robert are partners sharing profits and losses in the ratio of 3:3:2. Their balance sheet is given. They decided to dissolve the firm. Okay, dissolution, always you have to do first thing, empty the balance sheet. Empty the balance sheet, question number 27. Okay, look at the assets, debtors, land and building, goodwill, transfer. Debtors, land and building, goodwill. Okay. Then partners capital account 75, 75 and 1 lakh. Transfer it to partners capital account. Oh, sorry, partners current account it is 75, 75 and 1 lakh. And here it is partners capital 15, 25 and 12,500. 15, 25 and 12,500. And finally you have sundry creditors 47,500. Sundry creditors 47,500. What are you going to write here? 47,500. Clear? Sorted? Okay. Land and building 90,000 realized in cash. Land and building 90,000 realized in cash. So what you are going to do? Bank account debited to realization 90,000. 60,000 realized in cash. Bank account debited, realization. Total amount is taken directly over here. 1,50,000. Are you getting this, guys? $70,000 plus 125 plus 25 minus 350. Okay, there is also a bank here missing. If you see, bank balance is not, it's not, balance sheet is not telling. So bank is 1,30,000. So that is why you have two balance brought down 1,30,000. Okay, then we can see investment 5,500 taken over by Ram. Investment taken over by Ram. Ram's account debited to realization account. Then 75,500 taken by Rahim. Rahim's capital account debited to realization account. Then 18,000 taken over by Robert. Robert's capital account debited to realization account. So first you empty the balance sheet, then the task becomes very, very simple. Realization expenses 2,000. So realization account debited to bank account. Realization account debited to bank account. Then after that they said you are required to close the books. That is it, done. So what you're going to do, close the realization with this 47,500. Go and check. Yeah, creditors have to be paid. Creditors account, realization account debited to bank account 47,500. Now loss, profit, whatever is there, distribute to partners. Profit. Anywhere they did not tell anybody is the insolvent. Distribute the money to all the partners. End of the story. End of the story. Let's go into question number 28. Question number 28. This is also realization only, no? Okay, first emptying the balance sheet. First, we are going to empty the balance sheet. 100% we are going to empty the balance sheet. Without that, we are not going to proceed further only. Now, here, asset side. Building, machinery, furniture and fixtures. Building, machinery, furniture and fixtures. Realization account debited to the asset account. Then stock, book debts. Stock, book debts. Then bank balance, cash at bank. What we are going to do? balance brought down 10,000. B's capital overdrawn. So B will have a debit balance. Go to the capital account. You can see B's capital will have 2 balance brought down. B's capital should be 2 balance brought down 1,30,000. Then you go in and see A's capital, C's capital. So you will write by balance brought down for A and C. Then A's loan is there. A's loan transfer to realization account for now. Realization account you are going to write. Where is the loan, guys? Okay, directly you can put to A's capital only. A's loan also put to A's capital itself. Okay, then after that you have creditors 10 lakh. Go and put creditors to realization account. But we can't find creditors. Why? Because all partners are declared insolvent. I told you when all partners are insolvent, who will bear the loss? Creditors will bear the loss. So when all partners are insolvent, don't put the creditor to realization account because we are not able to realize anything for them. Creditors account you open with balance brought down. Creditors account with balance brought down. Clear, the firm was dissolved. The assets were realized as under book debts 45% less. Book debts 45% less. Whatever is the book debts, you are going to reduce 45%. So what we are going to write over here? Debtors 2 lakh into 55%. 45% less means 55% only you are going to get. Then after that, building 1,60,000. So by bank 1,60,000 you are going to get. Stock 1 lakh. So by bank 1 lakh you are going to get. Machinery 2 lakh. So machinery 2 lakhs you are going to get. Furniture you are going to get 40,000. So furniture you are going to put 40,000. Realization expense 10,000. So realization account debited to bank account. Realization account debited to bank account, and this total whatever is there that you're going to put over here to realization 6,10,000. Okay, then after that what we are going to do? See, A's private assets, private liabilities. So A, if you see 2,50,000 minus 2,50,000, A is going to give you 0. Here 2 lakh minus, so A can give you 20,000. Here this fellow already his liability is only more, he is not able to give anything. So B will give us 20,000. So bank account debited to B's capital. B is able to give us 20,000. Bank account debited to B's capital 20,000. Now what we are going to do? Whatever money is there right now, just give it to creditors. To bank creditors. Can you see there is a deficiency? Transfer this deficiency to deficiency account 3,70,000. Then partners, if you see, partners are not able to bring money. If you check for A now, 1,60,000 plus 2 lakhs minus 2,40,000 minus 1,20,000. Sorry, you're getting 1,20,000. That is the deficiency of A. What about B? B and C, if you see B, 1,30,000 plus 2,40,000 minus 20,000. 3,50,000 deficiency they are sitting on. C also is sitting on a deficiency of 1,40,000. If you notice now, 350 plus 140 minus 120, the net what partners are not able to bring is 3,70,000. The partners that they are not able to bring the money, that amount only is the loss of the creditor. That much only the creditor is losing, if you notice. Okay, guys. Yes, that should be it. Question number 29. Okay, question number 29, that should be it. Now we'll go into one more realization question. First, empty the balance sheet. Premises, furniture, stock. Transfer to realization account. Premises, furniture and stock. Next, what you're going to do is trade debtors. Transfer to realization account, debtors. Provision for doubtful debts, 50,000. Cash at bank, 1,40,000. Cash at bank. Go to bank account and write balance brought down. Bank account balance brought down. Clear. After that you are going to see capital account Q and R have capital debit balance. So you're going to write 2 balance brought down, 2 balance brought down for both of those guys. And here P and T have credit balance. So by balance brought down, by balance brought down. Trade creditors 3 lakhs. Trade creditors 3 lakhs. Transfer that 3 lakh to realization account. With that, we have emptied the balance sheet. Done. Now you start reading one by one. It was agreed to dissolve the partnership on 1st April on the basis of the following points agreed upon. P is to take over total trade debtors at 80% of the book value, 3,50,000. So 3,50,000 into 80%, that makes it 2,70,000. Where is it, guys? Realization account. 3,50,000 minus 20%. Sorry, 2,80,000. Okay, bank account debited. Sorry, who is taking it? Yeah, P's account debited to realization account. And then T is to take over the stock in trade at 95% of the book value. 95% of the book value. So it will be T's account debited 1,90,000 to realization account. T's account debited to realization account. I hope it is clear. Okay. R is to discharge the trade creditors. What is the creditor value? 3 lakhs. So realization account debited to R's capital account. Then realization is premises 275 and furniture 25. That means totally we got 3 lakh rupees. So we are going to write bank account debited 3 lakhs to realization account 3 lakhs. Then after that, expense of realization came to 30,000. Realization account debited to bank account. Realization account debited to bank account. Okay, realization account debited to bank account. After that, Q is found insolvent and 21,900 is realized from his estate. So a bank account debited to Q's capital account. Q is able to give 21,900. After that, loss arising out of capital deficiency may be distributed following decision of Ghana versus Murray. We already know we follow Ghana versus Murray for that. You are required to prepare realization and all those stuff. Okay. Now, if you notice, check Q's capital account. Q 2 lakh. And also realization, just distribute all the losses of realization. We are having this situation. So 2 lakh plus 7,000 minus 21,900. 1,85,100 is the loss. It will be distributed in the capital ratio. What is the capital between P and T? Q and R don't have capital only. So P and T in the capital ratio of 7:3, that is going to be distributed. So you're going to take from P and T and giving it to Q. P's capital account debited, Q's capital account, T's capital account debited, and you're giving it to Q. That's it. And then remaining whatever is there. If people have credit balance, they'll take money. Everybody has credit balance, they'll take money. End of the story. End of the story. Question number 30. Question number 30. All the partners were declared insolvent. Profit sharing is 5:3:2. Asset realized 60,000. Prepare necessary ledger accounts. All partners are insolvent. So that means creditor is going to lose money. You have to keep the creditor separate. Okay, so first you are going to see capital account 5,000, 3,000 and 2,000. Okay, so you're going to go to realization partners capital 5,000, 3,000 and 2,000. Then what you have, bank loan 60,000, bank loan 60,000, transfer it to realization, creditor 40,000, keep the creditors account separate. Open the creditors account and you'll write buy balance brought down 40,000. Then fixed asset is 1 lakh. Transfer it to realization account. Fixed asset 1 lakh, 1 lakh. Cash 10,000. Open, keep it in the bank balance only. Okay. Empty the balance sheet. Done. All the partners are insolvent. You got only 60,000 rupees. So bank account debited 60,000 to realization account 60,000. And bank loan you have to pay. So realization account debited to bank account 60,000. Done. Now whatever is there, this is the loss of the partners, distribute it over here. Realization losses distributed. Now what you are going to think? Okay, whatever is there in the bank, whatever is there in the bank, only 10,000 is there. Transfer it to creditor. Transfer it to creditor. And this 30,000 which you are not able to give, that is the deficiency account. And if you see the partners capital account, everybody has a shortage of 15,000, 9,000 and 6,000. That is the deficiencies. Can you see the 30,000 which partners cannot bring is the 30,000 which the creditor lost. 30,000 is the amount which partner cannot bring. That is the amount which creditor lost. That should be it. Okay, that is question number 30. First question. X was admitted into partnership for 5 years, for which he paid a premium of 1,20,000. After 39 months, the partnership firm was dissolved due to misconduct of Mr. Z. Okay, I told that time, if at all you paid premium for goodwill, you paid amount for goodwill, and after that, if it goes into dissolution, other partners have to give the money back to you. Another partner of the firm, Y being the third partner, profit sharing ratio is X, Y, Z, and X. It is 5:3:2. Now, how much you had paid goodwill? 1,20,000 you have paid goodwill. Okay, 39 months are over. How many months are remaining? 21 months are remaining. For so 21 months, you are actually supposed to get 42,000 back. 42,000 is going to be given by whom? The other partners, Y and Z. Y and Z will give you the goodwill share in the ratio 5:3. 5/8, 3/8. So their capital account is debited and your capital account is credited. Clear? Yes. Let's continue. Next question. From here, piecemeal distribution starts. 32. Piecemeal distribution. Okay, going into piecemeal distribution, question number 32. We are going to solve this under higher relative capital method. Okay, higher relative capital method. So here what we are going to do in higher relative capital method, first we are going to take the capital. What is the capital of the partners? 67,000, 45,000 and 31,500. 67, 45 and 31,500. Okay, divided by the, I told you, step 1, divided by the profit sharing ratio. When you divide by the profit sharing ratio, 67,500 divided by 5, divided by 3, divided by 2. You get these values. When you get these values, okay, who has the least figure in this? M has the least figure. Keep his capital as the base. His capital is 67,000, 5/10 share. So what is the total capital? 1,34,000. Distribute this capital. You get 67, 40,200 and 26,800. Now if you notice this minus this, you are getting, this is the higher capital. This minus this is the higher capital. This is the higher capital. One second, guys. Now in these two people, who has to have the higher capital? In these two people, we have to check now who has to have the higher capital. Again, 3:2 ratio. Now what we are going to do? Divide. This person has less, keep his capital as the base. And you got 8,000 as the capital. 8,000 is the capital. Distribute this 8,000 in the ratio of 3:2. When you distribute in the ratio of 3:2, now you are going to see this fellow 4,800, but here 4,800. Good. 4,700, here 3,200. So 1,500 has to be paid to him. So first, highest capital is this person's 1,500. First you are going to pay 1,500 to this person. Then when money comes, can you see higher relative capital out of this 4,700, 1,500 is paid. So you have to pay 4,800 over here and 4,700 over here. That means 4,800 out of 4,700 it is paid, 3,200 you are going to pay in that. After that, whatever money comes, it is to be distributed to all the partners in their profit sharing ratio. Now you will see the statement of distribution. Statement of distribution. Who and all we are supposed to pay? Creditor, 17,000 to creditor. Then you can see M, N and P. M, N and P, after removing their loan, they have some loan here. M and N. Sorry. This is the total, no? M and N. It's going to be subtracted and then we are going to see July. Now they said partner share profits in the ratio 5:3:2. Cash is to be distributed to the partners at the end of each month. Summary of liquidation transactions are as follows. July, what happened? You see 16,000 collected from debtors and balance is irrecoverable. Do we have some money here? 6,500. So already we have 6,500. We got 16,000. Then what has happened over here? 10,000 is received from sale of entire stock. Okay, good. You got another 10,000. Then after that, liquidation expenses 1,000 you paid. So subtract 1,000. Then after that, they said 8,000 cash is to be retained in the business of the end of the month. You have to keep 8,000 for future. So remove 8,000. Okay, very good. So you have 23,500 available with you. Distribute it to whom? You have to give 17,000 to creditor. Outsider first, give 17,000 to creditor. Then you remember the order of distribution we have already kept here. 1,500. Give 1,500 to this guy. And then we have to give actually 4,800 and 3,200. We don't have. In what ratio we will give? In that ratio 3:2. Only these two persons will get 3:2. So 3:2 you will distribute the money. Now the new balance is this. Let's see what happens in August. August 1,500. So August already this closing balance will become opening balance in August. So 8,000. 1,500 is liquidation expenses paid. So minus 1,500. Then as a part of the payment of his capital, P accepted an equipment for 10,000. Book value was 4,000. Okay. Now what happened? Closing balance, we have to keep 2,500 cash retained in the business. What did P do? P did one circus. P was not supposed to take now. P was supposed to take in the ratio of higher relative capital only. P took one machinery itself. What did P take? Equipment of 10,000 for 10,000 rupees. Now what happens? Whenever you are going against the order of higher relative capital which we have calculated, against the plan if you go, you have to recalculate everything. Against the plan if you go, you have to recalculate everything. So distribution for August and September, you have to recalculate M, N and P. M was 55,000, N was 34,500. Okay, over here, can you see 34,500? But P instead of 28,000, P has become 18,000. P instead of 28,000, P has become 18,000. Yes, P has become 18,000. P has taken the 10,000 of machinery. So now what you're doing? Divide by profit sharing ratio. Got one resultant figure. Who has the least? P. Take his capital as the base. Calculate required capital. Distribute the capital. When you distribute the capital, you got that higher relative capital is 10,000 and 7,500. Higher relative capital is 10,000 and 7,500. Here it is 55. Here it is 45. That means 10,000 extra capital. Here it is 34,500. Here it is 27,000. That means 7,500. Okay, out of the two people, again you are going to do divide by 5 and 3. You will get 2,000 and you will get 2,500. You will get 2,000 and 2,500. That should be it. So now you are going to do. Now what are you going to do? Now 2,000 and 2,500 you have done. That time you will get. Again you have to calculate who is the least in this. The least in this is this particular person. The least in this is this particular person here, and you have to take his capital as the base and calculate and distribute the capital. When you distribute the capital, you will get higher relative capital again. So now first you are going to give to N. After that you are going to give to M and N in this ratio 10,000 and 6,000. Balance you will distribute. So now when you have money, now when there is money, first you are going to give to, can you see? Now 4,000 is available. First you are giving to this fellow M, N and P, right? N, you are going to give to N. Can you see his highest capital was 1,500. After that they are going to share in the ratio 5:3 till the 10,000 and 6,000 is recovered. 10,000 and 6,000 has to be recovered. That is the ultimate deal. 10,000, 6,000 has to be recovered. So these two they have distributing in the ratio 5:3. Now you have balance payable. In September what happens? In September again 2,500 which was retained comes 75,000 received from sale of equipment, 1,000 liquidation expenses. So what you are going to do? 2,500 you had, 75,000, 76,500 you have right now. Distribution. First what you are going to do? You have to ensure that they are given 10,000 and 6,000. No, in that 10,000, 6,000 higher relative capital, still there was some 8,437 and 5,063 remaining. Distribute that. Once you distribute that, balance payable comes. Whatever money you have, distribute in the ratio 5:3:2 because everyone's higher relative capital is paid. So you have to calculate higher relative capital, go in that plan itself. But in case you go against the plan, you have to calculate higher relative capital again. Is this clear? One question is there. I have solved under higher relative capital. Now I am going to go to maximum loss. Okay, one question only I am doing for higher relative capital and maximum loss. Other questions, check it out. Practice. Okay, next question will be question number 36. Question number 36 will be the next question which we are going to solve under maximum loss method. 36. This is under maximum loss method. They only told in the question maximum loss method. Now following is the balance sheet of X, Y and Z who are sharing profits in the ratio 5:3:2. 5:3:2. on 31st December 2023, when they decided to dissolve the partnership. When they decided to dissolve the partnership, this was a situation. So what we are going to do in maximum loss method, no extra working note and all, directly we are going to calculate. So now here you understand, we have outsider creditor, and then we have Y is loan. Y is loan is there 2 lakh. 55, 37,500. Oh, sorry. This should actually be X, Y, and Z. 55, 37,500 and 31,500. And Y's loan is 2 lakhs. And then this is creditors. Creditor is 10 lakh. So much amount we are supposed to pay. Okay. Now, then we go into the question. Cash already we have 20,000. So always we start with cash 20,000. Now be very careful. There was a bill of 4,000 due on 1/4/2000 under discount. Very good. Okay. Other assets realized as follows. We'll speak about January. 1st January, 8,85,000 we got. So add 8,85,000 amount received. Okay. Realization expenses. They said expenses of realization were expected to be 5,000, but ultimately amounted to 4,000 only, and were paid on 1st May. 5,000 we'll keep it aside, but later on we got to know that we needed only 4,000. So what happened now? Remove 5,000. You have 9 lakh rupees with you. 9 lakh straight to creditor. No need to even think. Straight to creditor. Now the balance payable is revised. 1 lakh, 2 lakh, 55,000, 37,500, 31,500. February, what happened? February amount received is 3 lakhs. February amount received is 3 lakhs. So what happens now? Amount received 3 lakhs. Okay, 1 lakh you give to creditor, 2 lakh you give the loan. Loan is settled. So all the liabilities are gone. Now you have only partners. Now when you go to March you got 8,000 rupees. March you got 8,000 rupees. When you got 8,000 rupees, every time you have to calculate under maximum loss method. So now what is the amount payable? 55,000, 37,500 and 31,500. If you see, amount payable is 1,24,000. 1,24,000. What is the amount available? Only 8,000. That means maximum loss is 1,16,000. Maximum loss distribute to the partners in their profit sharing ratio. So you have to give 50, this fellow has to get 55,000. His loss share is this. He has to get 37,500. His loss share is this. He has to get 31,500. His loss share is this. When you remove their losses, that time this fellow is going into negative. This fellow is going into negative. I told you, if anyone goes into negative, it has to be distributed, or it has to be borne by others in their capital ratio. What is their capital ratio? 37,500 and 31,500. So I am going to distribute in the ratio of 375 to 315. When you distribute that, this fellow's negative gets sorted, and these two people will bear that loss. Now it is 1070 and 6930. When you remove, you are getting 1070 and 6930. Now what is this actually? This is the amount that is paid. 1070 and 6930 is the amount that is paid. If you total 1070 and 6930, this is nothing but the 8,000. So this method is just told us how to distribute this 8,000 rupees. How to distribute this 8,000 rupees is what has happened over here. Clear? Done. Now balance payable. Revise everything. We had to pay 55,000. We paid nothing to this guy. 55,000. We had to pay 37,500. We paid nothing. So we paid 1070. So 36,430. We had to pay 31,500. We paid 6930. So we have 24,750 after March. Now we go into April. April we got 5,000 rupees. April we got 5,000. Amount received is 5,000. But what was the amount that was payable? 1,16,000. Out of that, 5,000 is received. That means maximum loss is 1,11,000. Distribute the loss in the ratio of 5:3:2. When you distribute the loss, look at this guy. You have to pay him 55,000. His loss is 55,500. You have to pay 36,430. His loss is 33,300. You have to pay 24,570. His loss is 22,200. Did you see that somebody went into negative again? Because somebody went into negative, the adjustment 500 has to be borne in the ratio of 375:315. Remember, their ratio was 375:315. In that ratio, we are going to bear it. So this 500 is gone. Now 272 and 228 will be borne by them because of this guy. So now if you see, when you remove that, this fellow will get nothing. Out of 3130, remove 272, you will get 2858. Out of 2370, remove 228, you will get 2142. 2142 is received. That is, this is the amount paid. Okay, remember we had 5000 amount received over here, 5000. Out of that, 2858 will be given to one partner and 2142 will be given to the other partner. Now what happens? Out of 55,000, this fellow received nothing. So still he has to be paid 55,000. Out of 36,430, this fellow received 2858. So now he has to get 33,572. Out of 24,570, this fellow received 2142. So this fellow has to get 22,428. This is their balance payable. And finally, we have moved into the last month, that is May. In May, they received 10,000, but not only 10,000. Remember, they kept 5,000 aside, but they spent only 4,000. So 1,000 will be added to May. Now see over here. In May, amount received is 10,000 plus realization. For realization, I kept 5,000 aside. Out of that, only 4,000 I spent. So 1,000 will be added over here. 11,000 we are going to get. 11,000. Totally, we have 11,000. But how much we have to pay them? This is the amount that we are paying. Amount payable is 1,11,000. We have only 11,000. That means 1 lakh is maximum loss. 1 lakh is maximum loss. Distribute the maximum loss in their profit sharing ratio of 5:3:2. When you remove it, you will get 5,000, 3,572 and 2,428. Now if you notice, okay, out of this we paid only this much, out of this we paid only this much, out of this we paid only this much. Okay, I mean that is the maximum loss. So out of that, these are all losses. Then finally, whatever balance you get, this will be your amount paid, amount paid, amount paid. Now after May, we don't have any installments. So because we don't have any installments after May, what we are going to do, everything is going to be called as loss of the partners. Everything is going to be the loss of the partners. With that, we are done with maximum loss method. Only one question I'm doing under maximum loss. That should be it. When it goes into negative, adjust it in capital ratio. Otherwise, you should be able to solve that. We move into 40th question now. Okay, guys. A and B carry on independent business and their position on 31st of March 2020. Their position on 31st of March 2023 are reflected in the balance sheet given below. Now, this is the situation of A and B. They are carrying on independent business. A is separate, B is separate. They are carrying on independent business. Both of them want to form a partnership firm. So these people know A and B, they decided to form a partnership on 1/4/2023 in the style of A, B and Co. New partnership firm is called as A, B and Co on the following terms. Capital of the partnership firm will be 3 lakh and it will be contributed by them in the ratio of 2:1. A will contribute something and B will contribute something. Assets of the individual business would be evaluated by C, at which values the firm will take them over, and the value would be adjusted against the contribution due by A and B. Okay, assets of the individual business would be evaluated by C, at which values the firm will take it over, and the value will be adjusted against the contribution by A and B. They will take over the assets at the value that they decide. Okay. C gave his valuation report as follows. Asset of A, stock in trade to be written down by 15%, and a portion of sundry debtors amounting to 9,000 estimated unrealizable. Furniture and fixtures to be valued at 2,000. Investment to be taken over at the market value of 1,000. Okay. We look at the assets of A. See, stock 15% minus. Then debtors 9,000 minus, because they said we can't recover that. After debtors, we have cash at bank, that no problem. Bank 13,000 directly. After that, we have cash in hand, that no problem, 987 directly. Furniture and fixtures, what did they tell? Furniture and fixtures only 2,000 we can get, they are telling 2,000. Investment, they said only 1,000, we can get 1,000. Then liability side, we have creditors. Creditors. 1,10,000 minus bills payable 12,500. 12,500. Okay. Now stock to be written up by 10%. Their stock, they said, return up by 10%. So 1,07,800 it becomes. Debtors are to be admitted at 85% of the value. So can you see we are taking only 85% for debtors. Then rest of the assets should be assumed at book value. Okay, here we can directly take cash at bank 7,500, furniture and fixtures 1,766, cash 234, and creditors 47,000. Creditors 47,000. Okay, then we'll see what they have told in the question. The firm is not to consider any creditors other than the due on purchase made. So this creditor which is there for outstanding expense and all, they are not going to take it over only. So we don't have to bother about it. Okay. You are required to pass necessary journal entry in the books of A and B and also prepare opening balance sheet. Now what we are going to do? PC, purchase consideration is this much. This much is the purchase consideration because of the asset minus liability situation. Capital is this much, which will be distributed in the ratio of 2:1. So 2 lakh and 1 lakh it is distributed. Now if you see, capital should be 2 lakh, but the asset and liability which is going, net assets is only this much. So this much he has to bring money. Capital required is 1 lakh, but this fellow it is 1,01,750. So 1,750 is going to take money. One person has more than what is required, one person has less than what is required. So one person who has less, that fellow will take it over. Okay, one person who has less, that fellow will bring money. One person who has more will take money. Now in the books of A, they have asked you to pass journal entries. What you are going to do? Transfer everything to realization account first. Transfer everything to realization account. A, okay. You can see over here, realization account debited to stock, debtors, furniture, investment, bank, cash. All this will be at book value. Then creditors, outstanding expense, bills payable to realization. This will also be at book value. Transfer assets and liabilities to realization account at book value. Now AB and Company is the new firm. AB and Company, what will happen? AB and Company account debited to realization account. AB and Company account debited to realization account, because can you see what is transferred to them is 118,987. AB and Company to realization account. Yes, 118,987. Clear? Then capital account debited to realization account. Can you see the capital that they have? The capital that they have, it has to be transferred. Yes, capital account debited to realization account, and capital account balance, whatever is there, is transferred to AB and Co. Okay, this is the capital that is transferred to AB and Co. 118,987. 118,987. What is this capital account debited to realization account? This is the loss that is incurred. Loss that is incurred on realization. Same thing in the books of B also. Transfer the assets and liabilities to realization account at book value. Transfer the liabilities also at book value. Then what is going to happen? This is the PC 101,750. Then realization loss adjusted. Then from capital account remove and transfer to AB and Co 101,750. Transfer 101,750. Balance sheet of AB and Co will look like this. All the assets which came from there at the agreed values, not at the book value, at the agreed value, all the assets will be there. But bank, what we have to do? Both the bank balances plus A is going to give some money minus B is going to take some money, because B has more capital, so B is going to take some money. Rest everything is, see, capital is going to be 2 lakh and 1 lakh only. Is this clear, guys? Yes, that is the question 41 now. Yes, not 41, we'll go into 48. Now we'll go into the examination questions. We have covered all areas almost. Okay, even conversion also we just now saw. We'll go into examination question, that is 48. 48th question. Question. Ray Link Limited agreed to purchase the business of a firm consisting of two brothers, A Ray and S Ray, on 31st March 2024. Two sole proprietors are there and this new company is purchasing. Balance sheet of the firm on that day is given. Okay, sorry, not two sole proprietors, two partners are there and it's purchasing. Balance sheet, you can see capital accounts, general reserve, everything is given. Balance sheet. The company agreed to take over the liabilities and all the assets with the exception of cash. The agreed purchase price being 4,50,000. They agreed to take over everything, but cash they are not taking over. To be satisfied as to 1/4 in cash and 3/4 by the issue of fully paid shares. So can you see PC is 4,50,000. 1/4 they are going to give cash to us, and 3/4 they are going to give us shares. And the shares are going to be at an agreed value of 12.5. So divide by 12.5, 27,000 shares they are going to give, 27,000 shares. Company made the following revaluations of assets taken over when bringing them to the books. This is the agreed value. This is the agreed value. They are going to take the assets at this value. You are required to pass the necessary journal entries to record the acquisition of the business in the books of the company and prepare the post-acquisition balance sheet of Rail Inc. Limited. We have to prepare the past journal entries in the books of company. We have to pass journal entries. Journal entries. What and all we are getting? Okay, leasehold premises. Leasehold premises book value is 1,17,500, but no, they are taking at what value? They are taking it over at 1,55,000. So you will pass the entry leasehold premises account debited. Journal entries in the books of Rail Inc. Limited. Journal entries in the books of Rail Inc. Limited. Okay, 1,55,000. Now plant and machinery, they are taking it over at 62,500. Plant and machinery 62,500. Furniture they are taking at 12,500. Stock they are going to take over at 1,45,000 debited, and debtors they are going to take over at 1,25,000. Clear? Then what about the liabilities? They are going to take creditors at 1 lakh. So you're going to write 2 creditors 1 lakh. Then they are going to pay money. How much money they are going to pay? 1,12,500. So 2 bank account 1,12,500. Then they are going to issue shares. How many shares? 27,000 shares at the rate of 10 rupees. So into 10, 2,70,000 will go to share capital, and the 2.5 will go to securities premium. Now, if you see the PC is how much? 4,50,000. But if you do asset minus liability, what they are taking over is only 4 lakh. That means when 4 lakh is the asset minus liability, they are ready to pay 4,50,000. Why are they paying extra? They are paying extra for goodwill. They are paying extra for what reason? For goodwill. That's why goodwill account is debited. Then what are you going to do? Then they ask you to prepare the balance sheet. Journal entry to record the acquisition. Prepare the post-acquisition balance sheet. Post-acquisition balance sheet shouldn't be a problem. Whatever we have in this journal entry, whatever we have in this journal entry, these are the assets, these are the liabilities. You should be able to do the balance sheet. Okay, let's go into 49th question, which is for 14 marks again. Give entries for the following transaction. Okay, give entries for the following transactions. I don't think this is 14 marks. This is 4 marks. 49th question. First, they said realization expense of 8,000 were paid by Rana, a partner. Realization expense of 8,000 were paid by Rana, a partner. Okay, now what should be the entry for realization expense paid by partner? Realization account debited to Rana's capital account. So you will write over here realization account debited to Rana's capital account 8,000. Then realization expense of 10,000 paid by the firm on behalf of Dana, a partner. He has to bear the realization expense. Realization expense of 10,000 paid by the firm on behalf of Dana. So what should be the entry over here? Dana has to pay. So Dana's capital account debited to bank. Dana's capital account debited to bank because Dana has to pay the money. Clear? Then realization expense of 20,000, out of which 60,000 is to be borne by Mana and remaining is to be borne by firm. So what is going to happen here? Realization account debited 20,000, 60,000 borne by Mana. So to Mana's capital account, to bank account. Realization expense of 10,000 to be borne by Kana, a partner, but paid by Dana, another partner. Who has paid? Who has to bear it? Kana has to bear it. So Kana's capital account debited, but somebody else paid. So Dana's capital account is credited. That is the 49th question which we have in our material. 50th question is also an examination question. June 2024, 14 marks they have asked. Okay, you can see Y retired on 1/1/4/2023 and it was agreed that he should be paid all his dues in full on that day. For this purpose, goodwill was to be calculated on the basis of 4 years purchase of super profit method. So it's a retirement question which was asked in June 2024 for 14 marks. Let's quickly have a look at that particular question. Okay, so much information is there. Your first thing, see, calculate the value of goodwill and show its treatment. First, we will address that issue. Okay, now which method they said to calculate goodwill? To be calculated under super profit method. Average capital employed in the business they have given. Super profit method. What is the formula for super profit? Average profit minus normal profit. Average profit minus normal profit is the formula for super profit. Super profit formula is this. Is this clear? Yes, of course. Now, net trading profit for the last 3 years are given 630, 540 and 675. Using that, let's calculate the profit. 630, 540 and 675 divided by 3. You got the average profit. Average profit you got. Clear? Now, rate of interest expected is there given 10%, but fair remuneration to the partner is there. Fair remuneration to the partner. Remove the remuneration. That time you will get the average profit after remuneration. You got the average profit after remuneration 4,95,000. 4,95,000. Now from the average profit you are supposed to subtract the normal profit to get the super profit. They said that capital employed is 26,10,000 and 10% is the NRR. So 26,10,000 into 10%, you got 2,61,000. That time you will get your super profit. That time you will get your super profit. Okay, once you get super profit into how many years purchase? They said 4 years purchase. This is your goodwill. This is your goodwill. Who is retiring? Y is retiring. Okay, what is Y's share? Y's share is over here 2/6. So what happens now? Into 2/6. Your Y share of goodwill is 3,12,000. Y's share of goodwill is 3,12,000. So now what happens? 3,12,000 will be borne by Y. Okay, did they give us the new profit sharing ratio? Profit sharing ratio X and Y will be 5:3. So the new ratio is 5:3. Okay, so what we have to do? We have to calculate the sacrificing ratio. Do you remember the old ratio was 3:2:1? That's why 3/6, 2/6, 1/6. And new ratio is 5:3. So 5/8, 0 and 3/8. Now when you calculate here, you're getting 3/24, 8/24 minus 5/24. Whoever is minus, that means gaining. That means gain is 3:5. And this is distributed in the ratio of 3:5. 3,12,000 into 3/8. 3,12,000 into 3/8. And 3,12,000 into 5/8. 1,95,000. Is this clear? Yes, this should be the situation. Goodwill distribution, they asked us to show the calculation. Then they told calculate profit or loss on revaluation of assets and liabilities and show its adjustment among the partners. Okay, one by one. Stock and furniture to be depreciated by 10%. How much is the stock? 3,15,000. How much is the furniture? 4,20,000. So what you will do? 31,500, 42,000. What is the entry for that? Revaluation account debited to stock, revaluation account debited to furniture. Clear? Next, after that, provision of 5% on debtors is to be created for doubtful debts, and a provision for liability of 18,000 is to be created against bills discounted. Doubtful debts, how much they said? 5%. 8,70,000 into 5%. That will give you 8,70,000 into 5%. 43,500. But we have 30,000 over here. 13,500 is going to be the provision. 13,500 is going to be the provision. Clear? So now what happens when 13,500? You are going to write memorandum revaluation account debited to PDD, and they also told to provide for another liability, that is going to be memorandum revaluation account debited to liability. Memorandum revaluation account debited to liability. Is this clear? Then after that, what do we have? After that, they said value of land and building appreciated by 2,35,000. So land and building account will be debited to memorandum revaluation account. Then they said investment is to be taken at its market value. Market value is 4,10,000. That means we have to increase 35,000. investment account debited to memorandum revaluation account. Then they have told, due to revaluation, the value of assets and liabilities are not to be altered. Why did you tell revaluation? They said revalue but not to be altered. In that case, we know exactly what to do. First, you distribute the profit between X, Y, and Z in their old ratio. Then whatever is done, it is reversed. Whatever is done, it is reversed. Clear? We have seen this multiple times. And then it is to be shared only between X and Z because Y is gone. X and Z in their new ratio of 5:3. Clear? After that, they said show the balance of partner's capital account after Y's retirement. So you have to prepare partner's capital account. You can check the question. What is their capital account balance before the retirement? You can see 9,70,000, 7,40,000 and 3,80,000. Okay, so you are going to write 9,70,000, 7,40,000 and 3,80,000. Do we have reserves in the balance sheet? Yes, the answer is yes. 5,10,000. It will be shared in what ratio? 3:2:1. Reserves, reserves, reserves distributed. Clear? Then after that, the goodwill distribution has to happen. Goodwill, we already know. Goodwill, X is to give, Z is to give 1,17,000 and 1,95,000. So we are going to remove 1,17,000 and 1,95,000 from X and Z's capital account. X capital account, Z's capital account, 1,17,000 and 1,95,000. 1,17,000 and 1,95,000 and we'll give it to Y. We'll give it to Y. Is this clear? We are going to give it to Y. After that, okay, after that, then what we are going to do is, okay, the revaluation, this one has to be put 82,500 memorandum revaluation and then it is reversed between the other remaining partners. Okay, by remaining partners, it is going to be adjusted. Then what they have told, in order to meet Y's obligation, X and Z bring in additional capital of 350 and 720. So by bank 350, 720, they are bringing more money. After that, they told profit loss will be equal. Now what we are going to do, X is to be paid, Y is to be paid immediately. Check Y's balance. 12,77,000 is there. You're going to write to bank, end of the story. And X and Z, they are going to continue. So balance carried on, balance carried on. Clear? Prepare the firm's balance sheet after the retirement of Y. What we have to worry about? Nothing. Capital balance we already got. Creditors, bills payable, all assets will be exactly book value because we had prepared memorandum revaluation account. Exactly book value. Bank account, we have to be careful. We had 2,48,000. Already we had 2,48,000. You can check the question. 2,48,000 was there in the bank. But these two partners brought money. How much money did they bring? 350 and 720. So 350 and 720 is added. And just now you paid 12,77,000 to the retiring partner. Retiring partner has to get 12,77,000. 12,77,000. That time it will be, you will get the cash balance. You will get the bank balance. Is this clear? Yes, this should be it. Now, next 51st question they had asked, what do you mean by piecemeal distribution? Explain it. You are going to do it on your own. 52nd question, they have asked one question in the exam. Okay, what was this question? Statement of net assets as on 30th June 2023. Statement of profit earned during the 6 months. Realization account, capital account of partners. You can take this as a practice question. Okay, A and B were carrying on partners. The firm's balance sheet is given. Partnership. Then what happened? Okay, after this, the business was carried on till 30th June 2023. The partners withdrew in equal amounts of the things. Okay, after that, partners decided to continue this thing. Now, are we going to shut the business or are we going to continue the business? The question is, are we going to shut the business? We are going to continue the business. We are going to shut the business. They gave one balance sheet. 6 months they continued the business. After that, they are going to shut the business. That is by selling the firm to a limited company for 4 lakh payable in equity shares of 10 each. Is this clear? For partnership firm is dissolved and you are going to give it to another firm. You are going to sell it to a firm. Sorry, not a firm, to a limited company. You are going to sell it to a limited company. Okay, this should be it. With that particular question, you should be able to solve it. Okay, next we'll go into question number 41, guys. We'll go into question number 41. Okay, we'll see more of conversion. Following are the balance sheets of X and Y, sharing profits and losses in the ratio of their capital, and the sole proprietor Z. There is a partnership firm and there is a sole proprietorship firm. They have given the balance sheets of both the people. Then they said the partners decided to admit Z as a partner, and Z agreed to amalgamate his business with that of the partnership firm. Z will become partner and his business also will be amalgamated. New profit sharing ratio is given in the ratio of their capitals. In the ratio of their capitals. Okay. Now you can see prepare ledger accounts to close the books of Z. Make necessary journal entries. Now first you have to compute the PC. How are you going to compute the PC? What is there? Now you see over here. Building is to be appreciated by 15,000. Building will be appreciated by 15,000. Where it is going to be appreciated, and provision of 5% is to be created for debtors. Goodwill of the partnership is to be valued at 10,000 and the sole proprietorship at 1,500, and both are recorded in the books. Stock is to be taken at 9,200 and 16,800 respectively of the firm and the sole proprietor. Prepare ledger accounts, okay, and also make journal entries in the books of the firm and prepare balance sheet of the reconstituted partnership they are telling. Now goodwill, okay, we are calculating PC. PC means what? Asset minus liability at agreed values. Okay, goodwill, first item is goodwill. We are going to take it at 1,500. Stock, what did they tell? Stock is to be taken at 16,800. We are going to take the stock at 16,800. Bills receivable will be taken at 5,000 only. Debtors will be taken at 6,000 only. Creditors, after that we don't have anything. Creditors will be taken at their respective value, that is 13,000. Creditors 13,000. Then loan will be taken at 5,000. There is a loan in this particular company. It will be taken at 5,000. And they told we have to create provision and 5% to be created on debtors. Debtor is 6,000 into 5%. That means they have to create a provision of 300. That time you will get PC of 11,000. 11,000 PC. In the books of Z now. In the books of Z, what they are going to do? Close the books. So close the books. What I should do? First I should transfer everything to realization account. Empty the balance sheet. Goodwill will be transferred. So to goodwill, book value. Now book value 15,000. To stock, book value removed from the books. Okay, to bills receivable, book value 5,000 removed from the books. Debtors 6,000 removed from the books, 6,000. And then liability side you have creditors 13,000 removed from the books, and loan 5,000 removed from the books. Is this clear? And then you transferred everything. Wait. And then there is capital account of Z. You are going to write by balance brought down. Z's capital account 10,000 by balance brought down. Okay, then what you are going to do? Okay, what is the PC? X and Y account. X and Y is the person who is going to buy your firm. So X and Y, purchasing person account debited to realization account. Purchasing person to realization account. That should be it. And now what you are going to do? This profit is transferred to capital account. Transfer it to capital account 1,000. So now your capital became 11,000. That what you are going to do? Transfer. Where will this capital go? This capital will go to the new firm. So capital account debited to X and Y, new firm, done, closed. We transferred the capital and that will be the capital in the new firm. Now in the books of X and Y, what we are going to do? They said no, building is to be appreciated by 15,000. So building account debited to revaluation account. They told no, PDD is to be created for 5%. Okay, and also they said stock is to be taken at 9,200. So revaluation account debited to PDD to stock. Both of them are going to be created. And then next revaluation, whatever profit we made 15 minus 1, that will be transferred to X and Y before Z comes in their old profit sharing ratio of 3:1. Now goodwill of the firm is already computed. How much is the goodwill of the firm? Partnership is to be valued at 10,000 they said. 10,000 is the goodwill of the firm. Now 10,000 goodwill account debited to X capital account to Y's capital account. Goodwill account debited to X capital account, Y's capital account. Can you see goodwill there? Okay, that means they said we have to create goodwill. Goodwill should be there in the books, they said. Then after that, what is going to happen? From them, we are going to get, from that other person, I am going to get what and all I am getting, whatever I have listed. Goodwill comes from there, stock comes from there, bills receivable comes from there, debtors comes from there, creditors comes from there, loan comes from there, PDD comes from there, and the new partner called as Z also comes from there. These numbers we already know. We did it in our PC calculation. In our PC calculation, did we do all this and keep first only? All this we are going to get 11,000. Is this clear? Yes, that should be it. Now, balance sheet we have to prepare. Balance sheet, you understand how you are going to prepare. The partnership firm's goodwill plus the new goodwill, building in the partnership firm plus revaluation. We did not get any building from the other one. Stock will be 9,200 and 16,800. New values. Bills receivable also will be taken. Debtors you will take, but you have to create PDD, subtract the PDD, and this will be the net value. Cash, no change at all as it is in the balance sheet. Cash is how much? Only 2,000. It will still remain same thing. Creditors, both the people's creditors will be here. Loan will be here. And the partner's capital account will be here. Partner's capital account. How did this partner's capital account change? Whatever journal entries you have done, plus minus, that you have to do. That time the partner's capital account will change. Yes, let's go into question number 42. Question number 42. Following is the balance sheet of AB and Co. and CD and Co. Two partnership firms. We have seen two individuals becoming partners. New partnership firm. We saw one partnership firm and one sole proprietorship. Now it is two partnership firms. AB and Co. CD and Co. AB and Co. absorbed CD and Co. That means AB and Co. took over CD and Co. on the following terms. Value of goodwill of CD and Co. would be 12,000. Okay, show necessary ledger accounts to close the books of CD and Co. and to prepare journal entries and balance sheet of AB and Co. and AB and Co. after absorption. Now, you have to understand value of goodwill of CD and Co. would be 12,000. First, you have to compute PC, right? First, you have to compute PC. Goodwill, see, 12,000 will be goodwill. Okay. Then investment of CD and Co. will be sold out for 24,000 and realized cash will be introduced in the acquiring business. Investment will be sold. But after selling the investment, whatever money you get, that is to be invested in the acquiring business. That means you are going to give it. Okay. So investment you can see over here, this will be gone. It is sold for 24,000 and that cash will be given to the next partnership firm. 24,000 plus 2,000 cash which is there. This is stock in trade, sundry debtors, machinery, cash in hand, furniture. So total cash which we are getting from them is 26,000. Then stock of CD and Co. to be reduced to 22,000. So the stock value will be taken at 22,000. What stock we are going to get. Then after that, let's continue. Machinery of CD and Co. will be increased by 40%. What is the machinery right now? Machinery is 20,000. 20,000 plus 40%, that is going to make it 28,000. So you are going to increase the machinery to 28,000 machinery value. Then after that you have furniture. After that you have furniture. Furniture of CD and Co. will be reduced by 10%. Furniture of CD and Co. will be reduced by 10%. Can you see the furniture value? 6,000. Reduced 10% will become 5,400. Then after that they said, it was further agreed that AB and Co. following are the adjustments to be made. For AB and Co. also following adjustments are to be made, but for CD and Co. we got to know this much only. Then now what else is there? Can you see debtors? No change at all. Debtors will be taken as it is. So debtor will be 30,000. And bills payable. Bills payable is there over here. Bills payable is 40,000. Bills payable 40,000. So 83,400 is a PC. So the purchase consideration is 83,400. Now in the books of CD and Co, what are we supposed to do? We are supposed to close the books. How will we close the books? Transfer everything at book value to realization account. Stock in trade remove, debtors remove, and machinery remove. Okay, everything you transfer. Stock in trade, debtors, machinery, cash. Cash will be 24,000 because, sorry, 2,000 plus 24,000, 26,000 will be cash. Before the amalgamation only, they are going to sell the investment and going to give the cash also. Okay, then furniture is 6,000. How much is furniture? 6,000. Remove this also, transfer to realization account. And one bills payable also you transfer over here. Then what we usually do? Okay, the new partner, new firm. Partners capital. What are we going to do in partners capital? Okay, C and D, you have C's capital over here. C's capital is 36,000 and 24,000.
Change ಮಾಡಬೇಕು. ಒಂದು ಸೆಕೆಂಡ್ ಇಲ್ಲಿ ತಂದ್ಬಿಟ್ಟಿದೆ.
Okay. So partners capital 36 and 24. You're going to transfer 36,000, 24,000 over here. Now, when they sell the investment, no, how much was the investment in the books? 18,000. They made a profit of 6,000 because they sold the investment at 24,000. 6,000 profit they are going to distribute. So it will be shared between the partners equally because their profit sharing ratio was equal. Okay. Then what is going to happen? They have to open AB and Co. Account. AB and Co. account debited for the PC 83,400 transferred to realization account 83,400. Clear? Next, whatever revaluation profit is there, that should be distributed to the partner. 8,700 is distributed to the partner. Now what we have to understand is, whatever is there in this partner's capital account, these two things, it will go to the new firm. It will go to the new firm, 47,700, 35,700, and that will be their capital balance in their new firm. In the new firm. Is this clear? Next, they have asked you to pass journal entries. Why they asked to journal entries? Because see over here, there is some revaluation that's happening. In AB and Co, following adjustments are to be made. Assets are to be revalued as follows. Goodwill 16,000. Now, what is the goodwill balance? There is no goodwill only. So, you have to create a goodwill. Goodwill account debited 16,000 to A's capital to B's capital. Okay, you have to create goodwill. After that, they have to do the revaluation also. They said that stock is going to change. Stock is going to be 16,000. Right now, stock is going to be 40,000. What is the value of stock? 32,000. Increase. Stock account debited to revaluation account. Then they told that machinery is also going to change. What is going to be the situation with machinery? Yes, machinery is going to be 84,000 and furniture is going to be 7,200. You can see the machinery right now. Machinery is at 60,000. So machinery is also going to increase, but furniture is going to decrease because furniture is right now showing 12,000. They said 11,000, 7,200 they said. Now furniture is at what value? 8,000. Sorry, 8,000. Furniture is at 8,000. So we will be taking the furniture value as 7,200. 800 rupees decrease in the value of furniture. Is this clear, guys? Yes. Then next, revaluation profit will be distributed to partners. Goodwill we have already created. Bank loan. Okay, there is a bank loan. What did they tell? Bank loan to be repaid. So you'll pass the entry bank loan account debited to bank account. Then whatever you are getting from that firm, we have written in the PC calculation. In PC calculation, so we are going to transfer everything. All assets debited to liabilities, and the partner's capital also will come this side. Balance sheet of ABCD. What you are going to do? Add the stock, add the machinery. Debtors, I think only one place. No, debtors only one place there was debtors. Other place there was no debtor at all. Sorry, there is both the places it is there. Add the debtor, add the cash what you had plus what you got. 26,000 you got from them and 10,000 you used for repayment. So that is going to be subtracted. Add the furniture, add the goodwill, all the four partners capital and the bills payable. That should be it with that particular question. With that we will be done with the question number 42. Let's go to question number 43 now. In question number 43, what they have asked. Here, two partnership firms carrying on business under the style of R and Co, partners A and B, W and Co, partners C and D, respectively decided to amalgamate into RW and Co. We have seen one sole proprietorship, partnership, becoming partnership. We saw one sole proprietorship and one partnership firm becoming a partnership. We saw one partnership firm, another partnership firm, one partnership firm taking over another partnership firm. Now we are going to see the fourth variety of sums over here. One partnership firm, both are amalgamated and a new partnership firm is formed. RW and Co, a new partnership firm is formed with effect from 1st April 2023. With effect from 1st April 2023, the respective balance sheets of both the firms as on 31st March 2023 are given below. Both the firms ka balance sheet is given to you. Okay, so capital B. So in one place we have A and B, another place we have C and D. A and B, C and D. Okay, capital of A is sitting this side. So nothing to think about that. Okay, now capital of B is here, capital of C is here, capital of D is here, and bank loan is there. Okay, creditor is there. Sorry, there is no creditor. Creditor is, sorry, bank loan is 0 for this part, this firm. There is no bank loan, but creditor is 9,500. Okay, now they have said profit sharing ratio of A and B is 1:2, C and D is 1:1. Agreed terms are given. All fixed assets are to be devalued by 20%. Everything is to be devalued. Now they said pass necessary journal entries to close the books of both the firms as on 31st March 2023. But before that, we need to know the PC, correct? Before that, we need to know the PC computation. This is the partnership. This is the balance sheet actually, because there was some alignment error. We have shown the balance sheet here. This is the question ka balance sheet. Now PC computation, you have to be very, very careful with PC computation. Now understand this. What did they tell over here? Okay, they said all the fixed assets are to be devalued by 20%. Now you have goodwill. Okay, 0 and 5,000. You can see the question, 0 and 5,000. Machinery. How do we handle this machinery? That machinery will be taken 20% less, 8,000. Okay, stock. Stock, what they told, all stock is to be appreciated by 50%. 20,000 ka stock, we are going to take it at 30,000. 5,000 ka stock, we are going to take it at 7,500. Then they said R and Co owes 5,000 to W and Co on 31st March 2023. This is settled at 2,000. This is settled at 2,000. Goodwill is to be ignored for the purpose of amalgamation. Now debtors. How much is the debtors here? 10,000, 10,000. Take it like that only. 10,000. But 10,000 may, you have to do something over here. Okay. 5,000 owes 5,000. R and Co owes 5,000 to W and Co. This is settled at 2,000. Settled at 2,000 means how much we are supposed to remove? Okay, 2,000 is gone. Now 3,000 is still there. So we are going to remove 3,000 and 7,000 only we are going to balance. Only the common item we are going to remove. 2,000 they are settled. So 3,000 is common now. So remove 3,000 from debtors as well as creditors. Both the places you are going to remove 3,000, 3,000. Is this clear? Cash, they have not told us anything. What about the cash situation? Everything is acquired. Okay, where is it? Sorry. Yeah. The fixed capital of the new firm, RW and Co. They have told A should have 2,000, B should have 3,000, C should have 1,000, D should have 4,000. Mr. B takes over bank OD of R and Co. and contributed to Mr. A the amount of money to be brought in by Mr. A to make his capital contribution. So he is telling, if Mr. A does not have money, don't worry, this fellow only will give money for everything. Okay, so now when you do all this, no, this is your PC. 41,000 and 50,000 is your PC. Loan and all is going to be paid by them. Creditors are only taken over. Loan is going to be paid by them itself. Okay, can you see? B takes over bank overdraft of R and Co. There is one bank loan, no, that is going to be taken over. Okay, now when we go further in the books of R and Co, first what we are going to do, close the books. Close the book. Realization account debited to all the assets at book value. This will be at book value. Then liabilities account debited to realization account. This will also be at book value. We have done this many times. Okay, realization account debited to B's capital account. Realization account debited to B's capital account 15,000. Why 15,000? Because B is going to pay the loan. B is going to pay the loan. So realization account debited to B's capital account. Then RW and Co. That is the new firm. RW and Co. account debited to realization. This is your PC. This is your PC. You have already passed the entry for, you have already computed the PC. Can you see the PC is 41,000. Then after that, okay, after that, then we are going to write realization account debited to partners capital account. This is settling the realization account. You'll get the profit or loss. Close it. Then B's capital account debited to A's capital account. Why B's capital account debited to A's capital account? Because see over here, when you're doing the partners capital, no, there will be one shortage in A's capital account. There will be one shortage. They said no, A should not have any shortage. A should transfer this capital to the new firm. When A should transfer this capital to the new firm, if there is shortage, they said, don't worry, B will give money. So what did B do here? B removed 2,333 from his account and transferred it to A's account, because A's account should have 2,000 rupees which will go to the new firm. A's account should have 2,000 rupees which will go to new firm. Is this clear? Now that is the situation. Anybody had to bring money? No. B had enough money that just got adjusted in his capital account. So 2,000 and 3,000 will be transferred to RW and Co. 36,000. RW and Co. 36,000. So what happened over here? 19,000 plus 7,333 plus 15,000 minus 2,333. Okay, minus 3,000 only is required. So 36,000 will be transferred to RW and Co. RW and Co. You will transfer 36,000. Okay, finally 2,000 and 39,000 will be going to the new firm. This person is required to have so much capital but has extra capital over here. So the capital will get transferred to the new firm. That should be it with this particular question. Same thing you're going to repeat in the other person's books as well. That is W and Co. In W and Co also you're going to repeat, you're going to do repeat telecast of things. Is this clear, guys? Yes. Now next question. Question number 43 we have done. 44 is again A and B carrying on independent business. Okay, A is having independent business, B is having independent business. They decided to form a partnership firm. This type of question we have already seen. Okay, question number 45, what is happening? X and Y were in partnership in XY and Co. sharing profits in the proportion of 3:2. On 31st of March 2023, they accepted an offer from P Limited to acquire on that day their fixed assets. So this is also again an amalgamation question. You should be able to handle this. Okay, see, equity shares issued at premium. We have already seen this kind of a question that time. Okay, so next what we can do is one more question from higher relative capital method. We can have a look at higher relative capital method, as there was some confusion in that time. We had solved only one question. So let's go into higher relative capital method. Okay, this is the maximum loss. We'll take one more question on higher relative capital method to end 33. Question number 33. Okay, let's go to question number 33. The firm of Blue Collars presented you with the following balance sheet as on 31st March 2023. Okay, so now partners shared profits and loss in the ratio 4:3:3. Due to difference among the partners, it was decided to wind up, realize the assets and liabilities at the end of each month. Show how the amount should be distributed among the partners. So now what you're going to do, partners capital account, you're going to take balance 40,000 for L. How did you get 40,000? L is 40,000 and K 26,000. How? There is 30,000 over here and there is 4,000 current account balance over here. So this becomes 26,000 and J also will be 24,000 because 27,000 is there over here and 3,000 is there on the other side. So it is going to be 24,000. Clear? So now what you're going to do, understand this again. Maximum loss is simple. Higher relative capital you have to focus. So divided by the profit sharing ratio, 40,000 divided by 4 will become 10,000. 26,000 divided by 3, it will become 8,667. 24,000 divided by 3, it will become 8,000. Who has least figure over here? Least figure is with whom? It is with J. So now keep J's capital as the base. What is J's capital? 24,000. What is J's share? 3 by 10. So what should be the total? 80,000 should be the capital. Now this is the required capital. Distribute in the profit sharing ratio of 4:3:3. Distribute in the profit sharing ratio of 4:3:3. Now, when you do 4:3:3, what you will get? You will get the higher relative capital. See, the capital is 40,000, required capital is 32,000. That means he has higher capital of 8,000. Capital is 26,000, required capital is 24,000. So he has higher capital of 2,000. Capital is 24,000, required capital is 24,000. So 0. Clear? Now between these two guys, again repeat telecast. 4, 3. 8,000 divided by 4 becomes 2,000. 2,000 divided by 3 becomes 667. So what we have to do, again, keep the person who has least figure. Who has the least figure over here? B has the least figure. So because B has the least figure, take 2,000 as the base. 2,000 is for 3 by 7th share. What is 1? 4,667. So 4,667 distribute in the ratio of 4:3. That makes it 2,667 for one person and 2,000 for the other person. So out of 8,000, if required capital is this, 5,333 is higher relative capital. So 5,333, when we are taking it as higher relative capital, what you are going to do? First you are going to give to L. Okay, then what you are going to do? Next you are going to give 2667 and 2000 to L, K and L and K. After that, whatever comes, distribute in the ratio of 4:3:3. Nice plan we have made and kept. Now, if someone goes against the plan, we'll have to recompute. Right now, the plan is set. Okay. So now you're going to write balance payable, creditors, L, K and J. Now we will see what is going to happen, how it is going to start. Following realizations: May 15,000 from debtors and 20,000 by sale of stock. Expenses on realization was 500. Do we have some cash with us? Yes, cash is 3,000. Start with this cash balance 3,000. From debtors we got 15,000 and from stock we got 20,000. Stock we got 20,500 for realization expense. So we have 37,500 with us. Can we spend or can we distribute everything? No. They said that, where did they tell? Yeah. Partners decided to keep a minimum cash balance of 2,000 in the first 3 months and 1,000 thereafter. First 3 months they are going to keep 2,000. After that they are going to keep 1,000. So minus closing balance 2,000. 35,500 I have. I don't have to think also because I have not reached the partners yet. I have to still pay the creditor 35,500 and done. Now you have your balance payable 1,500, 40, 26 and 24. In June what happens? You have your opening balance which came from there to here. Okay, and in June balance of debtors realized 10,000. Balance of stock fetched 24,000. Okay, plus 10,000 and plus 24,000, that makes it 36,000. 36,000 is the total. 36,000. Now closing balance is what? Closing balance is 2,000. We got 36,000. Closing balance is 2,000. Second month also. Third month also 2,000 only. They said first 3 months 2,000. So closing balance you are going to remove 2,000. So amount available with you is 34,000. Now chup chap what you are going to do? 1,500 you are going to give to creditor. Done. After that, how to distribute? We have done one order of payment and kept nice one order of payment is there. First we have to give 5,333 to this guy. So quietly we'll go and give 5,333 to L. Okay, then we have to give 2,667 and 2,000 to L and K. So we will give 2,667 and 2,000 to L and K. That time if you see, okay, 32,000, 24,000, 24,000. Can you see they have higher capital, everything is paid. So now they are in the ratio of their profits itself. What was their profit sharing ratio? Their profit sharing ratio was 4:3:3. Can you see they are in the ratio of 4:3:3 now? So that problem is sorted. Now still you have amount available 22,500. That means after giving higher relative capital, after giving the higher relative capital also we still have some money. What to do with that? That has to be distributed in the ratio of 4:3:3. So distribute 22,500 in the ratio of 4:3:3, 9,6750 and 6750. Now this is your balance after the July month. June month. July there is nothing that is happening. Straight away we go into August. August what happened? August opening balance was 2,000. Okay, machinery we got 18,000. Can you see part of the machinery was sold for 18,000? Expenses incidental to sale was 600. So 18,000 you got minus 600. Now May, June, July, 3 months are over. Now 4th month we are in. Now we cannot keep the balance. Now we cannot keep the balance of 2,000. We need to keep the balance of only 1,000 cash. So amount available is 18,400. Nothing to worry. Directly you are going to distribute in the ratio of 4:3:3. Directly we are going to distribute in the ratio of 4:3:3. Clear? That time you will get the balance payable. Balance payable. Now September, part of the machinery valued in the books at 5,000 was taken by K in part discharge of an agreed value of 10,000. Balance of the machinery was sold for 30,000. Partners decided to keep minimum. Okay, now what happened over here? This fellow, he went against the plan. He took a machinery of 10,000 rupees. Okay, at an agreed value of 10,000 he took the machinery. Now the balance payable has changed all haywire it became. Okay, now because of that, what we are supposed to do? We are supposed to recalculate a higher relative capital. Again, we have to calculate higher relative capital. Somebody does not follow the plan. We have to recalculate higher relative capital. And if you see over here, this was the balance 15,640, 1730, 11,730. Now you put their profit sharing ratio, divide. Who has the least here? K. Keep K as the base. 1730 is 3 by 10. How much is 1? You got 5767. Distribute in 4 is to 3 is to 3. Capital is this much. So 13,333 is higher relative capital. Capital is this much, but 1730 is there. 10,000 is higher relative capital. So first you will give 13,333 to L, and then you will give 10,000 to J. 13,333 and 10,000 you will give to L and J, because can you see they are in the ratio of 4 is to 3 itself, because they were going according to plan. No, middle person only went against the plan. So they are still in the plan. So you will give 4 is to 3 ratio to these two people. Now you have to understand one thing. Okay, last amount we have, that's it. Opening balance 1,000, and we sold that remaining machinery also. We sold for 30,000. So 31,000 I have with me. 31,000 I have with me. That how are we going to distribute 31,000? I have to first give 13,333 and 10,000, correct? So I'll give 13,333 and 10,000, end of story. Then whatever I have, that is 13,333 plus 10,000 minus 31,000. I have 7,667 with me. That I will distribute to all the partners in the profit sharing ratio of 4 is to 3 is to 3. Then if you notice, I have given more than what I was supposed to give. This was the balance payable. I end up giving more to the partners. Okay, when I give more to the partners, it is not called as loss, it is surplus to the partners. So after distributing everything, we are in a situation where there is surplus to the partners. This is higher relative capital. So you have to make the higher relative capital contribution calculation. Then you have to do according to that. If at all it changes anywhere, if somebody takes some machinery or something, everything changes, then you'll have to recalculate the higher relative capital like how we did over here. Is this clear, guys? Yes, that should be it, guys. With partnership, we are done with partnership. We'll go into next chapters, okay, after this.